what we've seen is a huge increase in concessions given to buyers in order to close the deal. Sellers are having a really tough time out there. What we see in Redfin data is that 42% of recent offers had a concession where the seller gave money back to the buyer in some form. And that's up from about 30% or less historically. So it is a record high, and we're seeing this really increase. Concessions can amount to $5,000 or $10,000 on average to basically go to fix a roof or pay down a mortgage rate and make it more affordable for the buyer to have that mortgage.
Are there particular markets where you're seeing this more so, and where are they?
Yeah, certainly. So the markets that are cooling down the most in reaction to higher interest rates and inflation and the weaker economy, those are all out on the West Coast. We see in the news a lot of tech layoffs. It's impacting places like Seattle, San Francisco, Phoenix, San Diego, Vegas. Those are all markets that have seen a big increase in these concessions. And overall, they're cooling down fast. So these are ways that sellers are trying to not have to lower their price too much.
Taylor, why are we seeing the opposite go into effect? Cities where we are certainly not seeing this, according to your data: Austin, Philly, New York City, and Chicago. Why do you think that is?
It's a great question. Concessions are more common when the market's cooling rapidly and ones that are more sensitive. So where we see prices falling the fastest. So these are places, Chicago, New York, Philly. These are also places that have been a bit more resilient. We haven't seen the market cool down as rapidly. They've been more stable. Austin's a weird exception, and I'm not exactly sure why we're not seeing more concessions. I think one reason might be because sellers are actually aggressively cutting their price rather than giving it back in the form of concessions. And it had a big boom in equity and real estate prices. So sellers might be just a little bit more willing to cut their price aggressively in Austin.
I've heard of some concessions being made where they are waiving inspection, which this real estate agent urges you not ever to do, no matter how desperate you are. So the question is, are these concessions enough to kind of thaw this frozen market? And that comes down to mortgage rates. What point do you think mortgage rates will get some action going again, and when do you see them leveling out?
That's an excellent question. Mortgage rates have been the key driver here in both cooling the market and, what will be the key factor to bring buyers back in. I think this Redfin data about sellers' concessions actually points to some really good news that buyers are able to get a better deal than might be realized when you first just look at the data of what they could afford. They're getting significant points paid onto their mortgage to make it more affordable. And what is likely to happen is we expect in 2023 that rates will continue to decline. In fact, after Friday's jobs report, we saw a big drop in the bond market affecting mortgage rates. And so already we think that's going to bring some buyers back, and they might be encouraged to know that there's a lot of homes that are dropping their price out there. They might also be able to get some concession. Now, I did mention these amounts are relatively small, about $5,000 on average, but that could be more advantageous to a buyer than a $5,000 price cut. So buyers are a bit more willing to negotiate in a seller's concession than they are to accept a lower sale price or get a bargain that way. And so it might actually be worth more both to the buyer and the seller that way. And at the same time, as the market starts to recover a little bit when rates fall, we'll start to see this moderate out too.
And speaking of home prices, Taylor, some have had some very dire predictions about the year ahead, talking about a 20% peak to trough. How significantly do you think the drop will be nationally in home prices in 23?
So our outlook for 2023 is that home prices will fall about 4% relative to the previous year. That will certainly be sharper in some metros. In Seattle, San Francisco, home values have already fallen more than 10%. And there have been some segments of the market where values have fallen 20 or 25%. So there's definitely weakness out there reacting to the market conditions. But overall, nationally, things still aren't going to be that dire compared to 2008. So our outlook is that even as prices decline, there will still be some affordability challenges for buyers out there. And, we'll be in a tough market for at least the first half of the year.
Here in Southern California, I'm standing in front of this sign that's a for sale sign, right? Part of the problem is there aren't enough signs like this. There's, to put it simply, a massive inventory problem. So what's happening is that it's making things even more difficult for home buyers. Take a look.
We've been looking for a home for, I would say, 2 years, more or less, give or take.
Danielle Cohen and her husband David Jarvie from Los Angeles are facing the same dilemma as home buyers across the country.
It just came like to a grinding halt when interest rates went crazy, and now we're just not finding a lot on the market. So
I think a lot of people right now are afraid to list their house, so if they don't have to, they won't.
The average 30-year fixed loan is hovering around 6.5%. But as the Federal Reserve pulls back on the pace of its aggressive rate hikes, the Mortgage Bankers Association expects the 30-year fixed to drop to 5.2% by the end of this year. That's well below the historical average of 7.75%. Ed Fitz is a real estate agent and partner at the agency in Los Angeles.
Buyers are really holding off at the moment for a variety of reasons, including the new interest rates that's changed things dramatically since last spring. Nobody quite knows where the market is going next, either in Los Angeles or California or even nationally.
Also freezing the market, sellers are reluctant to drop their prices. In real estate, the asking price is often as much about psychology as it is about reality. Fitz has gathered data on this through an app he launched called Domicile Game of Homes, sort of like The Price is Right for real estate.
People who are not actively in the market, who are just guessing the prices, what's the asking price, what's the ultimate selling price, are guessing higher than the house actually sells. The mind of the average consumer hasn't caught up to the realities of the market right now.
But sellers are being forced to cut prices. Realtor.com estimates 1 in 5 sellers nationwide are lowering their asking price. The states with the biggest cuts, the western part of the country. Arizona, Nevada, and Utah topping the list. Realtor.com predicts the 2023 housing market could become a nobody's market, not friendly to buyers nor to sellers.
Every time she's around, the energy changes.
We caught up with Jason Oppenheim, star of the hit Netflix series Selling Sunset.
I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic, but I don't want to pretend that that means the real estate market's going to be, on the ascend.
Well, it is a new year, and you may be interested in a new house. Mortgage rates have cooled demand for homes. The number of homes sold is down 37% from a year ago. That's according to Redfin data. We want to take a deep dive into housing markets across the country and take a look at Denver, at Indianapolis, and at Charlotte. We have Kathy Casey, Caldwell Banker, residential brokerage realtor in Denver, Colorado. Dan O'Brien, realtor at True Blood Real Estate covering Indianapolis. And Sir Ashley Harrison, real estate broker at the Harrison Group with Fathom Realty in Charlotte, North Carolina. It's great to have the three of you here. We want to jump right in and get to what you're seeing in your respective regions. We're going to go around the horn pretty quickly. Kathy, let me start with you. What are the trends? What are you seeing in Denver?
So Denver, our market is cyclical. So typically the spring market starts in January. So we are already starting to see signs of the spring market showing that it may be a heated market. In December, the market was kind of slow and buyers really were taking their time. They were able to really pick and choose what they want, and they were asking for seller concessions and the contingencies that they haven't had the luxury to be able to ask for in the last couple of years.
Dan, what about you? What are you seeing in Indianapolis?
Yeah, things have certainly slowed down since the craziness of the COVID market, right? So things are lasting a little bit longer on the market. Days on market is up, but the median sales price is still up 9% or so year over year. But buyer demand has certainly slowed down with those rising interest rates. And so it's one of those things where we've been seeing new listings coming on the market, but they just take a little bit longer. And the question, like you were talking about, is do sellers, reduce the price? Do they play the waiting game? So we anticipate still a busy year this year. And, time will tell to see what happens.
Sir, how does this compare to what you're seeing in Charlotte?
Pretty similar. We're seeing more inventory, but less new listings, and buyer demand has fallen off, and we are getting a lot more seller concessions, but pricing has remained very sticky.
Sir, I want to stay with you because we mentioned the top 10 markets all basically in your region. North Carolina is on fire. What do you make of it? What makes North Carolina such a perfect storm for real estate markets right now?
Well, affordability. You named it earlier in the segment. Affordability is the driving point, and a lot of industry is coming to the Carolinas and North Carolina in particular. Just this past year, North Carolina was ranked #1 by Wall Street Journal as the #1 place to do business. So I think that's the main driving point.
Kathy, when you take a look at Denver's housing market, it's incredible taking a look at the prices because they have certainly exploded. They're up 30% when you compare it to the levels that we saw back in March 2020. What is that doing for demand? And I guess, where do you see prices headed? How long until they really come back down?
So, our prices luckily have been pretty much holding steady. I mean, we lost about 5% since the interest rates started to have that uptick. But the prices are still holding steady because inventory is still low. So, for buyers, this is a great time because now, the line's not as long for you to get into a house. So you can get into a house much easier than you could months ago. And, we have a saying in our industry that is, date the interest rate, marry the house. So go out, find a house that you like and you love, and then, wait till, you can get that interest rate at, that's more for 30 years, that's going to be more appealing to you.
The inventory story has been bleak across the country at best. However, not necessarily the case in Indy. What are you seeing there, Dan?
Yeah, so I mean, year over year, we're down we're up 75% from this time last year. However, to put that in perspective, we just now broke, the number where it was pre-COVID. So before March 2020, when the market went crazy, we're just now getting back to then. And at that time, we were talking about low inventory anyways. So, a lot of people talk about the last 6 to 12 months, but putting in a big picture view, we are still, low in inventory. It is technically a seller's market, but things are looking pretty good leading into the year.
So you're right in the middle of one of the hottest housing markets, if not the hottest housing market. What are some of the tips for people who are interested in or maybe looking to buy in Charlotte?
Yes, I say right now, if you have been on the margins and could not get your offer accepted in the past 2 years, now is the time to move. Although interest rates are a little higher, you're not competing with as many people. So the sellers weren't considering your offer. Now they will consider it, and they may offer seller concessions.
Concessions have been a theme across the country, just like low inventory. Redfin says 42% of home sales in the fourth quarter gave concessions. Kathy, what type of concessions are sellers forced to offer right now?
Right now, sellers are offering to help with the interest rate increase. So they are offering 2-1 buy downs. And if you don't know what that is, basically what that means is for the first 2 years, your interest rate would be lower than it would lower at the market rate right now, the current market rate. So they're offering that. Typically, that costs somewhere between $10,000 to $20,000, depending on how deep they want to cut the interest rate. And that's what's really helping buyers really get into the houses that they want to, because affordability is key here in Colorado. Just to give you some perspective, our home prices have doubled in the last 10 years, and so wages just can't keep up with that. So. Anything to help the buyers get into the house is what sellers are doing right now.
Dan, what about concessions in Indy? Is that something that's becoming more and more popular? And what are people offering?
Yeah, same thing here. People are getting creative with the mortgage lending. Different banks are offering different types of mortgage products to help with that increased mortgage rate. Also, sellers, again, similar, are offering a credit for a 2-1 buy down, or just in general to buy down the interest rate to make that more affordable for a buyer. Now we actually have buyers that are being protected by contingencies like inspection and appraisal, where a lot of times those were out the window during the peak craziness of the COVID market. And so it's not getting too crazy or anything like that, but sellers are absolutely having to negotiate. Gone are the days of, hey, my next door neighbor just sold last year for $100,000 over list price. Things are still happening where there are some hot areas that are demanding multiple offers in a matter of days, but sellers are having to actually come back and come to reality with negotiating like they used to.
Sir, what are you seeing in terms of concessions, and what in this market, as we're coming out of COVID, really with the new dynamic, what's the number one thing you recommend that helps move a house today?
Yeah, thank you for that. The concessions I see are paying for closing costs and to buy down the interest rate right now. And it really depends on the loan the buyer's getting and how much concessions they can ask and seek from the seller. The main thing I think buyers can do moving forward is to, one, study the market. know exactly what's happening. Don't assume just because the market is totally different than last year. Study the market, but also surround yourself with trusted professionals. That's the biggest thing.
Kathy, investor activity has been a huge story when it comes to housing. A lot of the pricing being driven by the jump that we certainly have seen in investor activity. How much of that are you seeing in Denver?
Well, I can tell you, I probably get a call, at least 3 or 4 calls a day from investors wanting to know if I have anything off market that they can fix up and flip, because it's really that tight for investors right now to find anything where they're going to be able, and pricing is kind of a guess, and not only say a guessing game, but you have to be really strategic. You have to really know how to price things. So investors, want to make sure they're going to be able to get that return on investment. So if they can't get it for a really just awesome price, then, it's really not worth it to them, because the uncertainty of the market has got them a little wavering in their decisions for investing into the market right now.
Dan, what's the investment activity in the Circle City?
Yeah, it's been very heavy. It's jumped from, I think in 2020, it was about 8 or 11% of the purchases were to investors, and 2022 is over 25%. So 1 in 4 houses is being sold to an investor right now. And you have some of these billion-dollar companies, Tricon, BlackRock, all these people with billions of dollars, and they can park it into a hard asset like real estate. And it's been really difficult, especially for first-time homebuyers, to compete with these all cash, no inspection, no appraisal offers. And it's also made it difficult for the rental market as well. Rent is up, 20% year over year. And so it's been a really difficult thing to combat. How do you, can you create laws to prohibit some of these big billion-dollar companies from doing it, but not impede on individual rights for, people that want to own investment properties as financial planning. But investment has definitely been a difficult topic here recently.
It's certainly amazing to really take a look at the uptick in activity. We want to go around the horn once again. Quickly, just get your thoughts. Sir, first to you, your top prediction for the housing market this year.
I think interest rates will come down to the low 5s, but it'll be harder to get a loan. And it's going to, at least in my area of the country, prices will level off but tend upward.
Kathy?
So I predict that we have about 90 days of this interest rates will still be kind of maybe even on uptick. And then I think that they will start to come down as well. And I believe that our prices will continue to hold. And so if you're looking to buy, don't wait, because you want to get out there before the rest of the market jumps back in. That's been on the sidelines.
Dan, you got the final word, your top prediction for 2023.
Yeah, very similar. So I think mortgage rates will level off, come back down towards the end of the year. Buyer activity will then pick back up. I don't anticipate any kind of decrease in value, anything like that, maybe plateau, but normalize back to a normal level.
Let's talk more about mortgage rates with Melissa Cohn, William Ravis Mortgage Regional Vice President. Melissa, nice to see you. Thanks for coming on. Where do you see these rates flattening out? And what do you think will be enough to really thaw what has become a frozen housing market?
Well, I think the good news is that we are seeing that inflation is moderating and cooling, as we saw this morning with the CPI number. And we're seeing other signs of weakening in the economy, and that means that bond yields are coming down. The 10-year Treasury was at a 3.45 the last time I looked at it. And, mortgage rates have declined by almost a full percentage point since they peaked in November. And I think that we can expect mortgage rates to go down another quarter or even as much as 0.5% over the course of the next month. It's the beginning of 2023. Everyone is back to zero in terms of meeting their goals, and everyone has to, bring loans in the door. And I think banks are going to sharpen their pencils. They're going to tighten up their margins and do whatever they can to bring volume in the door, and lower rates will bring, more real estate transactions. We also saw another figure that refinancing was at the highest level it's been in a while as rates have declined.
I do want to follow up on that refinancing in a second, but what would you tell those buyers who have been sitting on the sidelines waiting for rates to return to that mid to low 3 level in order to get back in on this market?
Well, I think people can't expect that we're going to go back to a 3% 30-year fixed rate. That happened because of COVID and the pandemic, and we don't want to find ourselves in that position again. If we can get interest rates to go back to where they were pre-COVID, call that anywhere from 3.75% to 4.5%, that would be a home run. But buyers need to, my favorite expression is you marry the house and you date the rate. So they want to find a way to get into the house today. You'll generally find that when mortgage rates are higher, that real estate prices tend to be a little bit softer. And when interest rates do come down, and they will come down more than just the 1/4 or 0.5% over the course of the next year and a half, real estate prices will start to go back up again, and there'll be more competition for the homes on the market.
Melissa, for the first-time home buyer, I think applying for a mortgage sounds very daunting. A lot of people don't know where to turn. What is your advice to that first-time home buyer in terms of what they need to know when doing that?
Well, I think that they need to, first of all, be willing to take into consideration looking at an adjustable rate mortgage. Looking at a 5 or a 7 year adjustable, that means that rate's fixed for the first 5 or 7 years, and it's the same thing as a fixed rate for that initial period, but the rate is going to be lower, and it'll make the home that much more affordable. They also need to make sure that they've done everything to keep their credit scores as high as possible, because in many banks price rates based on someone's credit score, and to make sure that they have sufficient money for the down payment and for reserves. We find a lot of first-time home buyers getting stuck because they maybe have enough money for the down payment, but haven't taken into consideration all of the closing costs and what you need to have for reserves. And the last thing is, in terms of looking at your credit, make sure you have enough credit. So many people today, especially younger people, tend to live off of a debit card or perhaps just one credit card. And many of the banks with better rates are going to want to see someone having 3 to 4 different active trade lines on their credit history.
Those ARMs, adjustable rates, certainly come with the downside. What's your word of warning to people that do go that route?
Well, I think the risk that you have with an adjustable rate is that either that you've had some sort of negative work issue where you no longer qualify to refinance, or for whatever reason, if the value of that home drops, you may not have the equity to refinance. But if you're locking in for, I say a 7 year adjustable is a safe period of time, you're going to mitigate those risks. Really the goal is what can you do to get into a house today, and then be prepared to refinance when fixed rates get down to a more acceptable level, if you think you're going to be in that home long term. Most first-time home buyers are not in their home for 10 or 15 years. The average, tenure of that home is probably closer to 7 or 8 years.
Well, so going back to that advice here for the first-time home buyer, you mentioned the down payment, how critical that is. People need to think about not only what they're putting down, but also budget for what they will be paying on a monthly basis going forward. 20%, that often is the number thrown out. Is that the best number, aside from obviously an all-cash offer, for a person that is buying a house to put down?
Well, the benefit of putting 20% down is that you don't have to have the mortgage insurance. So that saves you on a monthly payment. If you are a first-time home buyer for a conventional loan, which now goes up to $726,000, except in the high-cost areas where it's even higher, over $1 million, you can put down as little as 3%. But you obviously, the less you put down, the higher the payment and the higher the mortgage insurance that you're going to have to pay on top of the mortgage payment, the insurance, the taxes.
We're here with Jason Oppenheim, owner of the Oppenheim Group and star of Selling Sunset on Netflix. But before we get to Selling Sunset, we're going to talk about selling real estate. So what I've been hearing is a lot of doom and gloom in the market. Give us a reality check. What are you seeing out there?
I'm not the doom and gloom type. I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic. But I don't want to pretend that means the real estate market's going to be, on the ascend. I'd say we're probably in for like some type of homeostasis, like just not much growth, probably not much, downward either.
Do you think, you said so we've kind of reached what might be a homeostasis too. For you in your business day to day, what does that look like?
Well, we're going to have a rough couple of years, I think, because volume is down. So when I look at real estate, I guess there's two things: prices, which is really what the people care about, and then there's volume, which is what real estate agents care about. In terms of prices, I think there's going to be some stability, which is probably healthy for the market. We can't have that kind of, we don't want the spikes and downs. So I think we're going to see a relatively healthy market over the next few years in real estate as it relates to prices. And we've got a lot of people that own homes that have very low interest rate loans, and they're not going to be selling. So we're going to have low supply generally, probably low-ish demand.
What are kind of some of the concerns you're seeing that transcend income brackets?
Interest rates largely transcend income brackets, although I think affect more the lower income brackets. That is really the hardest. I mean, people talk about affordability of homes. Really, it's the down payment. You got to come up with a down payment. That's always been difficult. But now not only do you have the down payment, now you got to pay a 5 or 6% interest rate, even on a 5 or 10-year fixed. I think that will come down in the next couple of years. So I don't think it's a big deal if someone goes in and buys a house and has a 5% interest rate. And I don't recommend people getting 30 years anymore. You should probably get a 5-year. Probably you're going to be able to refinance in a few years. And buying's always better than renting if you can hold the asset and you can ride the ups and downs and you can take advantage of the appreciation over a decade or 2 decades or hopefully 3 decades. Then I think buying really always makes sense. Doesn't make sense always in the short term. You've got transaction costs, and you're limited in your mobility when you're an owner. You're dealing with a lot of hassles when it comes to the roof leak. It's not the landlord's fault anymore. Now it's your problem. So if you're looking to own and just for a couple of years, probably consider renting.
And here in LA, where, when people are buying now in the situations where they are, where are you seeing the money come from? What professions generally are they in? Are there any kind of trends you've seen in the cases where people are bucking the overall slowdown?
There's a lot of wealth out there still. So, I'm not concerned about the luxury market. Honestly, I'm not even really that concerned about any of the markets. There was an open house yesterday for a $1.6 million house up in the hills. 300 people came by the open house in this environment with these interest rates. So there's still demand out there. I think it's good. 2 years ago, even a year ago, everything was selling. I don't think that's healthy. I mean, crap was selling. And I think that developers and people should be building quality product. And I think people should be more discerning and not being, a year ago, literally you'd get 10 offers on a crappy house with no yard. Now, I think, again, it's back to a healthier market.
My sense that what I'm kind of getting from you is that despite the doom and gloom narrative out there, there is right sizing happening, and there's also a lot of reshuffling going on from where you sit.
Yeah, I think COVID changed a lot in our psyches. The at-home work, people focusing more on the house, more willing to move out of the city. You look at some of these states that were laughed at a few years ago, and now they are, where everyone's moving. Austin, Texas, and Miami, and Las Vegas, and like Scottsdale, Arizona. These were not places people took as seriously as they do now. And that trend is not going to, obviously we're going to see some people coming back into the big cities. I think New York and Los Angeles will be fine. And I think those cities will have some difficulty the next couple of years, but they're on the map. And now there's competition. You don't have to live in LA, you don't have to live in San Francisco, you don't have to live in New York. You can now live in these other cities. And I think that's going to be a draw away from some of the big cities if we can't get a handle on some of these macro issues that we're dealing with. I hope that we can. Like I said, I'm generally an optimist. I think that people that make money in real estate and pretty much anywhere have to be optimistic.
Let's talk real estate with Hines Global Chief Investment Officer David Steinbach. He's with us now. Good to see you, sir. So you say disruption brings real estate opportunities. Play that out for us. And where exist those primary opportunities?
Great. Well, look, thanks for having me. So Hines is a $100 billion global investment manager. We focus on real estate. We're in about 30 countries around the world. I'm actually calling from you here in Davos today. So I would say that disruption is definitely a topic here as well. I think that investors right now are really seeing the change that's already happened, right? Interest rates kind of riding this wave of low interest rates, and the cap rate compression that comes with that is over. And now the hard work of asset management really begins. And that's really what's in front of most investors today. I think, though, the general mood that I'm feeling here in Davos, though, is that I think that people are pretty somber about the realities of the market. and really starting to focus much more on the beginning of a new cycle rather than the end of an old one.
Sure. And rates that, should we believe, begin to fall, are they optimistic about investment opportunities in real estate as we move forward?
Yeah, so I think that the way to think about the built environment is certainly one is that for an institutional investor, real estate is a longer term investment that we're making. So it's not something that we're flipping in and out of like equities or bond. And most business plans are lasting 5 to 10 years. And so in light of that, I mean, interest rates are certainly a driver of value, and they've had their impact this last year. I think that obviously if rates continue to move in this coming year, that'll also be a driver. But I think what I'm saying, though, the focus is really on how to create the value at the real estate itself, how to drive rents, how to create something that is special and unique, something that is going to outperform within the context of a particular market. But where the rates are today, again, it does affect value. But I think most real estate investors are thinking longer term when they're underwriting a deal today.
Give me a sector and a region in terms of housing that you are optimistic about as we move forward.
Sure. Yeah. So Hines is involved in really all the major product types. We're in multifamily, we're in office, we're in logistics, retail. And certainly in the housing sector, I think particularly in apartments, which is what we focus on with our institutional and retail clients, it's really what is interesting about that asset class is the fact that rents mark to market every year. And that is different than the other major product types where investors are relying on a bit longer term leases. And the fact that mark to market every year means two things. One is you are going to see, as fundamentals have come down in many markets, particularly here in the United States, you will see returns come down as well. With that said, on the other side of recovery, it'll be the first to come back up because, again, you're marking to market at a much faster pace than the other product types. So look, broadly, I do think that demand around multifamily, while it has slowed, I do think that given this dynamic in the lease term, that it will be one of the first things that investors will be focused on the other side. And look, fundamentals in the United States, they are declining. So you have to focus on the fundamental real estate you're buying. And again, think longer term. I mean, you're buying something today, you're going to own it for 5 to 10 years. You want to make sure what you are going to buy today is something that will perform in that time frame.
Let's turn to office now, and one of the big question marks that lies ahead. Are you bullish or bearish, and what's been the impact of remote work, and do we know the true impact just yet?
Sure. So the way we are obviously investing is around the world, and I think this return from work question is a really interesting one, because when you zoom out and look at the world in total and look at how everyone has responded post-COVID, every country is not in the same place in terms of how much remote work that they're relying on. So Asia, for example, would be one end of the spectrum, and frankly, the West Coast of the United States would be the other end. And basically all the geographies are somewhere in between there, with Europe being somewhere in between as well. And so what that tells me is two things. One is it says that whatever you might be experiencing today in your market that you're seeing every day is not necessarily the felt experience of those around the world. So as an investor, you have to think globally in that perspective. But the second thing is that what we're seeing is that there is a steady trend back. I mean, the chart is up and to the right. And even markets that, like in Asia, where it was nowhere near like what it was in the West Coast of the United States, for example, even that is on the right road, if you will. With that said, what we're seeing as well is that particularly here in the United States, it statistically seems to us that 90% of the tenants are chasing about 10% of the space. And so if you own projects today in that 10%, what we're seeing in our portfolio is they're actually performing really well. I mean, we're seeing rents within that narrow band, which is the highest quality, obviously, some of the highest rents that we've done. We've got projects in New York, and it is surprising when you see the headlines and see the data. But what's interesting, though, is despite that dynamic, the 90 chasing the 10, capital markets seem to be painting a much broader brush across the product type and really not seeing through that yet. I think that'll be another thing that we're going to see evolve in the next coming quarters, where investors are going to be looking a bit more carefully at what exactly is happening in fundamentals and look at the data as they do their due diligence, I think that they'll take a turning view.
There doesn't seem to be very much appetite right now for building new homes. The market has essentially been frozen for quite some time. We have inventories at very low levels. Builder starts have been slowing, as you noted, and completions have been also very slow. We only have had 8.5% increase, are down 8.5% year over year in completions of homes, as builders have struggled during the pandemic with supply chain challenges and labor shortages to complete homes. And that's just resulting in sales slowing as well. We've seen this market cool. 35% lower number of sales over year in existing homes, and 15% lower in new homes. So this is a market that still has a way to heal, and we'll be struggling for a little while longer.
Christine, what are the major indications that you would look to really establish that the housing market is rebalancing?
So, well, I mean, we have to see a more, like I say, a balanced market. Right now, the sellers and buyers are not agreeing on prices. Sellers still are expecting to see their home sales at a higher price than the buyers are willing to pay. Buyers have been locked out of buying homes with higher mortgage rates and higher prices. Home prices have doubled since 2014. They're over 40% higher than they were before the pandemic. So that's really impacted affordability, and buyers are being priced out, and they just can't make those purchases. Now we are seeing mortgage rates have declined more recently. They've backed off of their peak that they reached, 7.1%, now back down to 6.3 or so, depending on the indicator that you're using. So once we see the affordability improve, then we'll see more buyers be able to purchase homes. And the same thing as we see mortgages rates decline, those locked in existing homeowners will be more likely to refinance or be more willing to move. And the spring season is coming up. We hope to see some improvement in the market coming up.
Improving supply chains are one critical measure for home builders, but then additionally, you think about the necessary materials going into those houses also coming down in price as well in order to make up that home. I mean, when you think about that calculus, what does that signal to you in terms of when some prospective home buyers can perhaps anticipate that there will be a more favorable market?
Well, so this is in the new homes market, right? So builders have been, over the pandemic, they've been faced by these challenges. Material supplies were constrained. The prices were increasing quite quickly. Those prices are coming back down, and the supply chains are easing. A lot of the supply chain constraints are improving. So that will help builder margins, and it will allow them to be able to deliver homes a little bit more easily than they have been during the pandemic. And that will hopefully it'll bring cost of construction down, and like I say, builders will be more able to complete homes and provide a little bit more on the inventory side of it.
The top challenge for 2023 is affordability. So you've got prices still elevated. You've also got mortgage rates significantly higher than they were a year ago. We're at about 7% now, which is almost double what we were at the start of 2022. So that continues to be challenging. But the good news is that inventory is up a little bit. Fewer buyers are actually out there hunting, so you might have a little less competition. Not to say that you're going to get a deal necessarily or a bargain. It's still a pretty challenging market, but it's not going to be as crazy nutty as it has been over the past couple of years. It's going to be more balanced, according to the experts I've spoken to. They say that's what we can expect. Not the frenzied, crazy pace, nothing at all like last year or the previous year, but a more balanced market. So that's good news.
So what tips do you have for people in this environment? How can they sort of edge out some of the competition and get a home?
Well, first things first, of course, you've got to, get your financial house in order. That means, wiping away any outstanding debt, boosting your credit score so that you can get the best possible rate on mortgages. Particularly important now since mortgage rates are so high. The better your credit score, the better mortgage rate you're actually going to get. Then, of course, you want to shop around to get pre-approved for that mortgage. And you do want to shop around. Don't just go to one lender. But Once you can figure out what you can comfortably afford month to month, shop around and see what kind of rate you can get that is going to meet your budget. Once you've got the finances squared away, then you can hit the ground running. But you don't actually have to run. That's the good thing about the market in 2023. You can actually take your time to some degree. You can look around, check out the neighborhoods, know what the crime situation is in the neighborhoods. Research the school district, because as you very well know, home values tend to hold up better in a decent school district. Also, check out the commute. What is your commute to work going to be like? Are you going to have to commute? You've actually got a little bit of time on your side. So look at the whole picture, and then also factor in additional financial costs. I think a lot of people overlook things like homeowners insurance, for example, in a market where I am in Florida. Those premiums have skyrocketed because of the hurricanes. So that's something you want to factor in as well. If you're mortgaging your purchase, you do have to get homeowners. But as I say, in a market like Florida or even a market like California, because of the wildfires, those premiums are extremely expensive. So you want to factor that in, as well as costs like the HOA fees, property taxes. I think a lot of people, especially first-time buyers, jump in feet first thinking, oh, they've got the down payment and they can figure out the monthly payments. But that's really just the start of home ownership. And then finally, I would say, make sure you're willing to make a long-term commitment, because the transaction costs of moving in and out every couple of years is just not worth it. So make sure you're able to commit to 3 to 5 years. Make sure your job is secure. And if your job isn't secure, make sure you've got some extra money in the bank parked away so that you don't run into a financial pickle. So there's a lot of different moving parts to buying in 2023. But again, the good news is that it's not going to be as crazy, competitive, bidding war type of situation that we've seen over the past couple of years.
U.S. housing starts declined in December for a fourth consecutive month, hitting its lowest level since July. Let's talk about what's ahead for housing with National Association of Home Builders CEO Jerry Howard as part of our real estate report brought to you by Intuit TurboTax. Good to see you, sir. Interesting to see this dynamic, the decline driven by a drop in multifamily while single-family projects actually rose. Your reaction to the data and the dynamic that you see on the screen there?
Well, the single-family increase is one that we're really looking forward to, and it's reflected in the new home index that we put out every month, going back up for the first time in 12 months. So single-family, we think, is going to sort of have a soft landing, solidify, and strengthen, so that by the end of next year, or by the end of this year, the beginning of next year, we think we're going to be in pretty good shape on single-family. Multifamily is another question here. Part of it is the amount of building we've had over the past few years. We've done very well in multifamily. And the other part of it is the administration's now talking about putting in rent controls. If there's anything that's going to stop the construction of multifamily housing, it's putting in rent controls. So I think you're going to see multifamily lag behind and stay in a decline a little bit, but single family will strengthen, and we're looking forward to this time next year, a pretty solid single family market with multifamily lagging a little bit behind.
And Jerry, the Homebuilder Confidence Index that you put out earlier this week, rising for the first time in a year. Do you think it's safe to say that the housing market has hit a turning point, or how are you looking at that improvement in the report?
Look, I'd love to say that, but it's only 1 month. 1 month is not a trend make. We're hopeful that we'll continue to see a sort of a stabilization and a soft landing. But I want to wait and see another month. It's a nice solid rise, 4 points after declining for 12 straight months. But to put it into context, last year at this time we were at 83. This year we're at 35. Big difference. We still got a ways to go, but there's reason for optimism.
And mortgage rates, I think, give people a little more sense of optimism, down to 6.15, third straight week they have declined. Do you see that continuing? And where do you believe that number flattens out later this year?
I do think we're going to see a continued decline in mortgage rates. We're very, very optimistic that the Fed is going to slow down its tightening. And we think that we're going to end up maybe a little bit below 5 this year. And that's very important. It's also important to remember the cost of capital at the beginning of the pipeline, the cost of capital for builders when they're buying the land, when they're improving the land, is also coming down. And that's crucial as well.
Jerry, you said below 5. That was the lowest that we've heard from anyone over the last couple months. Given that, the fact that you think it's going to fall so significantly from where it is today, I guess what level do you think it needs to drop to in order to spur some of that activity that we've long been waiting for?
Well, I'm wishing for that. If it gets below 5, I think you're going to see a real jump in housing starts.
Yeah, that would be a real surprise, and certainly unfreeze, thaw things out a little bit. Are there particular regions you are optimistic about in terms of building and that inventory number beginning to come up this year?
Well, you're always optimistic about the regions of the country that are pro-growth, the regions of the country that eliminate or at least reduce the regulatory burdens that builders and business people have to face. So what am I talking about? Talking about Florida, talking about the Carolinas, Texas, places like that.
Jerry, remodeling market sentiment there weakened in the fourth quarter. People aren't moving, and I guess people aren't remodeling their homes, at least at the rate that we had seen. It's still, though, in positive territory. When do you expect that to tick back up?
Well, when interest rates go down, remodeling also ticks back up. So we're looking for a relatively strong remodeling market throughout the entirety of this year.
And overall, just your prediction, your biggest prediction for where real estate is headed in 2023.
Well, as long as we can get the supply chain fixed, and it's been a slow slog getting it back to normal. If we can get the supply chain fixed, I think you're going to see the latter part of this year a real turnaround in new home construction on the single family side. And I think if we can get the supply chain fixed, it'll help cushion the blow on the multifamily side. Right now, cost of capital is coming down. It's about two things, supply chain and regulation.
Jerry, you're not only talking to those within the industry. I know you also have a regular dialogue with policymakers with the Biden administration. What are you hearing from them? And I guess what would you like to see happen in order to better assist the recovery in housing?
Well, I would like to see the Biden administration, if they're not going to be inclined to decrease the federal regulatory burden, I would like to see them put out some sort of incentives for state and local governments to decrease their regulatory burden on builders. That's number one. Number two, I'd like the Biden administration to understand that when you're talking about rent control, there are at least a half of the landlords in this country are small business people who make their living solely by the rental properties they have. Those are the same people that spent their own money to keep their tenants in their buildings during the pandemic, during the Great Recession. There is not as much of a problem as they're making out, and they need to be very careful or they're going to cause a worse problem in multifamily.
Yes, the banks dropped, remember, for that last Friday, then came back. Overall, earnings have been kind of lackluster at best. Let's be honest, though. Most of the big boys do start, next week, so we get some of the real big names. But I want to dive in on something. You guys are talking about housing data. Yes, the housing data has just been, terrible, maybe is the best way to put it. But look at housing stocks. Housing stocks are up today. Housing stocks are leading, right? The market is a leading indicator. We're not saying if you're selling your house, buying a house, that might be messy. But the stock market is leading, and that's strength, from consumer discretionary and housing. Those are things we didn't see last year, right? Let's be very clear. We didn't see that last year. So now we're seeing that. That is definitely something investors need to pay attention to.
That's something you bet would continue, though, Ryan?
Yeah, we would. We just released actually our 2023 outlook just this week. And one of our calls that you could say is more controversial, I guess, we don't see a recession this year. And I know, a lot of economists do, but we see some potential bottoming in the housing market. We see yields rolling over. We see huge spikes in people that are getting mortgages over the last week. The consumer, yes, it's not perfect, but the consumer, in our opinion, is still fairly strong. They still have that cushion of over $1 trillion of excess savings. And we think we can avoid a recession. And when you look what the stock market's doing here with the strength from all these different, look at tech, right? Tech did terrible last year. Now we're seeing leadership from there. It's a broad-based rally. To us, again, that's a different sign than we were seeing 12 months ago. And that's a positive thing.
Ryan, we really are coming off the worst year that we've seen for the market since 2008. I know you've done some historical data in terms of performance, how stocks tend to bounce back from bad years. What does that look like in terms of the performance that maybe we could expect here?
Yeah, good news is it's very rare, guys, to have two down years in a row, 73, 74, and then 3 years of the tech bubble. Those are also recessions. Again, we don't see a recession. If we have one, it's probably pretty minor with the consumer in pretty good shape going into it, not our base case. But bottom line is, yeah, stocks tend to bounce back. When you actually look at the worst 4 drops ever, guys, back to World War II, the following year was up every time, up like 27% on average. When you're just down for the year, you're up about 15% on average that next year, higher 80% of the time. So these are all just percentages of numbers, yes. But the key concept, again, it wasn't just bad for stocks, right? It was historically bad for bonds. A 60-40 portfolio, you had a really rough year. Now we've seen bonds actually coming back nicely and stocks, and we think it's going to be more of a back to normal. We think stocks, guys, can gain between 12 and 15% this year, with bonds giving you about 4 to 5%, kind of right about where the yields are. But we think, it's going to be a much better year than people give it credit for.
Digging your optimism, man. Tech layoffs, are those going to continue, and will they spread beyond the sector?
Yeah, we think they very well, great question. We think they very well could continue. If you look at overall tech layoffs, it's still such a small part of the overall economy. And other parts of the economy are still growing. So that's where it's so unique. We all know tech had that huge run in 2020, 21, where they hired. Now they're cutting some of the excess fat, I guess you could say. Don't like to see it, right? But at the same time, we don't think it's going to spread to the rest of the economy. I mean, look at what some of the, who was it? United Airlines said, right? I mean, people are still flying. People are still going out. They're still eating nice restaurants. It's just different areas that are slowing down, and clearly tech is. But that's kind of the economy. We still think it's going to grow this year.
Ryan, you mentioned the outperformance that we are certainly seeing in tech. When you take a look at today's market moves, what do you think is going to lead us higher in terms of the growth versus the value debate?
Yep. Yeah, we're sticking with value. I know growth has had a good run all of a sudden, guys. Value outperformed growth by about 21% last year. The last time it did something like that was in 2000. Here's what matters. The next 6 years, value continued to outperform. Just because you had one big year of outperformance, that doesn't mean it has to end. And we like I talked about, the cyclical value areas. We like small caps. We like industrials, your financials. Materials are starting to do better with some of those base metals. So if the economy avoids a recession, we think those are the areas you want to be in. We're neutral. Market weight is what I should say, technology in general. But we like value and cyclical value and small caps here for 2023.
Let's get you up to speed now on the housing market. More gloomy numbers out today showing a beaten down sector. Existing home sales falling to their lowest level since 2014. Sales of previously owned homes falling 17.8% last year to 5 million. That's according to the National Association of Realtors. Sales were down 1.5% on a month-to-month basis. December sales down 34% from the prior year. This is now the 11th straight month of declines. NAR Chief Economist Lawrence Yun says he's, quote, hopeful that the worst in home sales is probably come to an end. Home builders are feeling a bit better about the housing market, albeit just a bit, as sentiment ticked up in December for the first time in a year. Let's talk about where housing is headed and where it's hot in 23 with Kinlock Partners co-founder and CEO Bruce McNeilage. Bruce, good to see you back here. Broadly speaking, how do you characterize what you're seeing out there in the market to start this year? And is the worst behind us?
So I don't think it is. I think we are going back and forth. I think the market is still finding itself. And I think builders have really adjusted to things, to increase sales, to increase traffic in their models. But I don't think the worst. I think we've got some ways to go before we start ticking back up in the housing business.
We are seeing home builder stocks up pretty much across the board. KB Homes, Toll Brothers, Lennar, D.R. Horton, all of them up between 5 and 11%. Now, granted, that's after a tough 2022, but are you optimistic for the home builders, and what are you hearing from them?
So I've taken a poll and talked to many of them here in the last few days, and they're seeing more traffic, but traffic doesn't necessarily equate to sales. And so people are coming in, they're looking at the houses. The builders are doing a great job with concessions and some incentives, buying down the mortgage rates, the interest rates. And so we're starting to see some things turn, but high interest rates, the 6.5% or so range for the 30-year fixed mortgage that rate is still keeping some people away from buying houses.
Where do you see that mortgage rate heading in 2023, and where do you see it flattening out? Will that be enough to kind of thaw things out?
I think if we can get to 6% sometime to the middle of the end of this year, that'll really help builders and also buyers of homes. The people that are most affected are the entry-level buyer. And I think with the incentives, maybe reduction of prices a little bit, and the easing of these mortgage companies to give mortgages, I think will really, really help.
You talked about concessions. It's remarkable how many of them. That has really been the theme of 2022, which continues into 23. 42% of all transactions in Q4 had concessions. That's almost double from earlier in the year. What types of concessions are you seeing the most and where?
The two most popular concessions are not only the reduction in price, but giving large builders credits or buyers credits. It might be refrigerators, it might be blinds, it could be closing costs, title insurance, but they're also offering incentives that I really think is the best incentive. If rates were 6.5%, 7.5%, these builders are buying down the rates to 4.9%, 4%. And that really helps buyers because buyers are buying a payment. That's what they're looking for. What will their monthly payment be? And so if builders can buy down that interest rate, that's really what's going to drive people to the models. And then some inventory that hasn't sold, some standing inventory, I think will people have a good opportunity to pick up some good deals if they're looking to buy a home.
Good stuff. All right, the National Association of Realtors put out the top 10 housing markets for 23, all of them, all 10 in the South, the majority in the Southeast, with Atlanta taking the top spot, Raleigh, North Carolina, number 2. Why are those markets so hot? And is that where the majority of investment is also happening?
So my firm exclusively invests in the Deep South, both in Tennessee, Georgia, and throughout the Carolinas. We are seeing that's where migration is going from the Northeast and the Midwest. We're all seeing manufacturing jobs. There's an awful lot of automobile companies and manufacturing jobs going to the Southeast. And quite frankly, it's the cost. When you can buy a house for $275,000, $300,000, $325,000, a 4 or 5 bedroom house, that's also really going to be something that drives people to that city. And the jobs are also there. So those two things are really making it a very positive for the Southeast.
Yeah, Redfin says today a record 25% of users look to move in Q4. That is a record, and apparently they are moving to the South. Finally, Moody's has new numbers out today showing a record high 30% share of spending going towards rent in this country. Will you see that improve, do you think, in 2023? That is a massive number.
You know, it's a big number. And here in Nashville, I've seen it as high as 40 and 45%.
Wow.
Of course, in San Francisco, Los Angeles, that number's higher. But no, that number's not coming down. Now, rents this year will not have the robust increase that they've had last year of over 10%. I think we're going to see that relatively flat. And also, home rental companies like ours are starting to give incentives that make it more affordable for people to get in a house, but the high payments are still there.
Are you offering rental incentives?
We are in a couple cities in the Southeast. We are offering 1 month rent with a 1-year lease, or we're offering a 2-year lease where you're not going to get an increase in the second year. We've had a very good response from that program, and we see more and more companies doing that. And I think that's really helping ease things with the consumer that might not be able to buy right now, but is still looking for a high quality house for them to rent and their families to enjoy.
And is the inventory story changing for the positive in the rental space this year?
So inventory is still tight. However, people were building into that cycle in the downturn. So there seems to be a little bit more in the market. That's why we have a flattening out of what's going on as far as rental prices. And I don't really see that changing. There's been a lot of spec houses. Inventory has gone up for some of these builders. And because individuals haven't been able to qualify or have been a little gun shy to buy a house, builders are selling their houses at discounts to rental operators like us throughout the country.
We saw 616,000 new home sales in December 2021 versus 839,000 a year earlier. That really puts into perspective kind of how much things have come down, I guess, right?
Yeah, that's right. So that's a decline of, as you said, over 20%. It's very close to the declines that we've seen in existing home sales, over 30%. So make no mistake, the housing market is transacting at a much slower pace than we saw 1 year ago. Now, that makes sense when you consider how much has changed in the housing landscape. Mortgage rates have gone from 3% or so, a little roughly around 3% in December of 2021, all the way up to over 6%, close to 6.5% in December of 2022. So that is a huge change in the way that financing costs for buyers, and that has affected their monthly payments and affordability. And while incomes are up, they are not up enough to compensate for those higher costs in housing, and that's why we're seeing the transaction pace slow.
Danielle, we're seeing really layoffs start to spread throughout corporate America, notably in the tech space. Are you seeing any key markets, key housing markets, just start to outright collapse?
Well, we haven't seen an outright collapse, but I will say that in some of the markets that we track on a regular basis, we are seeing mild year-over-year price declines. And some of these are markets that have pretty significant contributions from the tech sector. Austin is one, for example, where we've seen mild year-over-year price declines. Phoenix, another area in the West that has been influenced by folks leaving from California and relocating. So it does have a tech sector influence as well. Now, I will say, these housing markets also saw significant price increases. So the mild declines that we're talking about, 2 to 3%, still mean that home prices are well up over pre-pandemic levels. So it's still pretty expensive in those markets, just down a little bit from the peaks.
Danielle, when people couldn't afford to perhaps purchase or finance their home or that new home, they went back into the rental market. For the renters that are out there, though, they felt the squeeze of that as you had a flood of potential buyers now coming back into that rental market and staying for longer, at least for this interim period of time. But on the rental side of the housing equation, have we started to see some of that price squeeze or that price increase start to at least moderate or normalize?
So yes, for renters in the market, in fact, today, we've got new rental data for December 2022. And what we see is that rent growth is down to 3.2%, which is the level that we saw right prior to the pandemic. So after declining and then skyrocketing, rent growth has moved back to a more normal pace for renters. That said, rents themselves are still significantly higher than they were before the pandemic. And for first-time homebuyers in particular that you talked about, making that trade-off of do I continue to rent or do I decide to buy, in 45 of the 50 markets that we studied, it is a much better decision to continue to rent if you're just looking at those monthly financial costs. You're going to see a much lower cost to rent as opposed to buying. And the differential is actually biggest in some of those tech markets. So the Austins and San Franciscos of the world, where, despite the fact that home prices may be slowing or in some cases declining, the rent buy trade-off is still tipped very heavily in favor of renting.
Now, Danielle, you guys just came out with a report on forecasting the 10 best markets for first-time homebuyers specifically in 2023. And besides the fact that I think I've only ever heard of one of these towns, what do they have in common? I mean, are people actually going to these various places?
Yeah, so these are places within metro areas. So the specific place name you may not be familiar with, but Moore, Oklahoma, for example, is in the Oklahoma City metro area. DeForest, Wisconsin is in the Milwaukee metro area. So they are little pockets of affordability within these broader metro areas where the housing market is expected to do relatively well. You'll notice there is a eastern shift to these markets in the sense that markets in the South, the Midwest, and the Northeast have more affordability. And so we're seeing more opportunities for home buyers in those markets. The other things that these markets have going on are a pretty good share of the population is young in that first-time home buyer age range. So first-time home buyers in these markets will find companionship, lots of other young people, good opportunities in housing, and also thriving local economies.
Everybody loves a turnaround story, right? The underdog. The epitaph was written on the housing market ad nauseum for the last 6 months, and you're starting to see signs that both the existing home market and the new home market are coming back. It's not a miraculous thing. It's not an immaculate thing. It clearly is dovetailing right with interest rates, which have fallen about 1% over the last 4 months after that, record high for this cycle in the plus 7% range come last fall. So a lot of people were on the sidelines, a lot of people looking over the fence, waiting for the opportunity to get into this market. And this drop in interest rates has really given them the opportunity.
I don't want to be the pessimist here, Tim, because I am an optimist when it comes to real estate. But if you're locked into a mortgage, high 2s, maybe low 3s, which most are, is a rate north of 6 going to get you off the sidelines? How low do you think they're going to get this year?
It's tough. Look, you're hitting right on the main point, which is you have this locked in effect. So if you're a seller or a prospective seller, I think it's close to 90% have got a interest rate in the 3s. So if you're looking at the sticker shock of a 6% or so, there's both the financial and there's also a psychological barrier to actually doing that. What you do see is some of the higher end coastal areas where people are actually selling those expensive houses and then going into migrating to areas that are more affordable, lower cost homes and whatnot, and buying those properties with cash. You're seeing about 30% of purchases right now are done with cash, and that means that it's about 10% higher than it had been historically. Doesn't bode well for the first-time home buyers, though, who have to compete with those all-cash offers, with contingencies around financing and home inspections and whatnot. So it's good in one sense, but bad for the first-time home buyers.
Tim, what's your view just in terms of the hottest areas where you think we'll likely see the most activity? It seems like time and time again, people are talking about the Sun Belt area, also just more specifically that southeast region as well. Is that where you're expecting to see the most activity?
Yeah, look, the things that are driving, Shauna, the affordability are generally about four things. You've got the employment markets, you've got the climate, you've got they're looking at suburbs, they're looking at more space, green space, bigger space. And of course, they have to be affordable. So, I mean, those are the markets that tend to be, historically has been in the Southwest, but you're seeing a lot of action, particularly a lot of building in the Northeast and the Midwest where land is cheap. And again, these economies can afford those sort of opportunities for prospective buyers.
Home builder stocks have been popping a bit to start the year. Will that continue?
Boy, those guys took it hard last year. I mean, it was a brutal market for them. There's no doubt coming. I think you've had the confidence rate for home builders has been dropping for 12 months. It's pretty brutal. So they're coming back. Look, come the first of this year, you're starting to see home mortgage purchase applications go up. You're seeing new home sales purchases go up. All of those things are particularly positive, but there's so many things going on. The government's got its hand in a couple of places and probably needs to get it in a couple of other places. And I'll just hit you the high notes and you can tell me where you want to go. If you think about the new home market, which is important because it's 20% of GDP, you want to stave off a recession, of course, but also if you build more supply, you have a market-based solution for bringing down the cost of housing, apartments or single families. So as you do that, then ultimately that impacts the CPI, the inflation rate, because 30% of inflation or CPI has to do with shelter. So you need to get more supply out there. Unfortunately, the government has been focused on the demand side of the equation so heavy and so long that they're now about 90% of all originations are guaranteed by the federal government. And they've been doing that because first they wanted to focus on tax incentives for home purchases. Then they wanted to focus on subsidizing interest rates. Then they wanted to expand access to credit, which has all been great. But if you're not focused on the supply side, then all you're doing is creating more demand. And without more supply, those sort of subsidies end up ignoring the benefits to higher prices that ignore the benefits to the sellers. So there needs to be something done there. And also the government can step in and do things to change input costs, material costs, skilled labor availability and cost, land costs, and big one has been regulatory compliance costs, which is almost $90,000 before you even drive a nail into a board or a brick into the ground. Those are the kinds of things that the government really needs to be focused on.
But are you concerned that that's a bit of fighting the Fed, putting more stimulus out there, kind of what got us into this mess?
Yeah, they've got some cognitive dissonance going on in the federal government right now, where you've got obviously Jerome Powell, who's trying to raise the cost of home ownership so that will ultimately back off demand. But at the same time, now you've got the federal government. Biden has came out with a plan that says this is their blueprint for a Bill of Rights for renters. And the idea there is that, look, we're going to put rent controls in place. We're going to try to prevent evictions from happening and things like that. That those are working at cross purposes in terms of what the government is trying to do. One side is trying to make it more expensive to bring down inflation, and the other one is dealing with the reality. It says, my God, my constituents are having to pay 40, 50, 60% of their income for their house payments, their rent payments, and all of those things. So they're trying to suppress it through these things like potentially rent controls, which are ill-fated for anybody who's ever read an economics book. It's a terrible idea that is well-intentioned, but I could go on with some of the consequences.
Home prices dropping for the fifth month in a row in November, according to Case-Shiller report out today. The latest sign that the housing market is still cooling off. But on a yearly basis, those prices are still up, climbing about 9.2% from 2021. Here with an inside look, we want to bring on the housing market. We want to bring in Glenn Kelman, the CEO of Redfin. Glenn, it's great to have you here. So let's step back a bit because mortgage rates have come back just a bit since peaking last year, right above 7%. The latest data that we've gotten on new home sales, on pending home sales, showing some sort of life. What's your assessment of the housing market today and any reasons to be optimistic?
Well, there are a few reasons for optimism. We're not out of the woods yet, but the market significantly improved in January. So Redfin, just to establish our credibility, called the top of the market on March 15th of 2022. We said that interest rates would bring the market down, but now we're seeing increased touring activity, more purchase applications, more offers being made over the past few weeks. It's still down from pandemic highs, but in November, we were off 35%. Now in January, we're only down 15 to 20%. So that's a significant improvement when you look at year-over-year numbers. And then the purchase applications for the week of January 20th were up, which was a surprise. Pending sales for December also up, a surprise. So it was a very weak market in Q4. It's significantly better now in January. Time will tell if rates are going to stay down.
And to your credit, and good to see you, Glenn, you called the top, so where's the bottom?
Well, we may have hit one bottom in November. That was definitely the nadir of the current market, but we could fall further if rates go up. Otherwise, there's still plenty of people who want to move to lower tax states, to more affordable parts of the country. So I think we need to see this housing boom over the past 2 years, not just as a fad, but perhaps unfinished business. There's still millennials coming of home buying age who want to buy a house. And if they can afford it, if rates stay down, I think we'll see some demand come back, not to the pandemic highs, which were crazy and unsustainable, but more to 4.5, 5 million units instead of the lows we saw in Q4, which were closer to an annualized rate of 4 million units.
What are your agents telling you in terms of increasing activity?
Well, some of our agents are seeing offer deadlines for the first time in agent-only listing remarks. We're starting to see bidding wars for really well-priced homes. It is still very hard to sell a condo in the urban core, but if you go out to the suburbs and you can find a house for under $500,000, those are in high demand. Investors used to bid for those properties and blow out our customers. The investors are mostly on the sideline right now, so people are starting to creep back into the market. There are a few places where we've seen 10, 20 offers on a home, which was absolutely out of the question in the fourth quarter.
Glenn, where are you seeing those bidding wars? Is it specific regions or is it strictly just housing price based?
Well, some of it is just that the seller has got to move and they've listed the property very low, but it is more popular in the suburbs. It is more popular for single family homes and under $500,000. That's the sweet spot. I wouldn't say it's the norm. It is still the exception, but it was absolutely unheard of 2 months ago. So to have the market come back at all is a real change. I have something in my throat. I can't help myself.
Go ahead, take a little cough. You got it?
Yeah, I'm ready.
So at what point, Glenn, do you think mortgage rates begin to flatten out? And is that enough to truly unthaw this market? Where will they bottom first?
Well, rates were up at 7 and now they're down to about 6. We're seeing some clients get a loan that starts with a 5% or a 5 on the rate. But rates can go back up very easily. There are very mixed signals on inflation right now. Your previous guest was just talking about what the Fed is going to do over the next 24 hours. So we're all sitting here going, trying to figure out whether it's going to go up or down.
Reports this week have shown the U.S. housing slump stretched into a fifth month as home prices abroad slide lower domestically as well as abroad. Now, despite rising interest rates, is now a good time to invest in real estate? Here to weigh in on that and the outlook for real estate investments is Principal Asset Management's Global Head of Research and Portfolio Strategy, Indranil Karlikar. Thank you for joining me, Indy. So I want to ask you, there's a lot of noise out there and a lot of signals to watch. How are you sorting through this and determining what we should be paying attention to when trying to invest in this space?
Yeah, good morning, Rachel. As you said, there's a lot of noise out in the market, and we believe that noise will continue for the foreseeable future. And the rationale is pretty simple, really. If you think about what's happening in the U.S. economy, we're seeing two forces at work. One is inflation, and the other is the Federal Reserve working hard to push that inflation level down. And so what we are telling investors is really focus on those two signals very, very clearly, because the direction of inflation will really determine the direction of the Fed's actions. And unfortunately, it seems that until the Fed, at least from our perspective, the Fed is likely to stay resolute in its wording and its language until it sees very clear signs that inflation is on the way down or feels comfortable that inflation is where it needs to be. And until that happens, we think the capital markets and real estate markets, for that matter, are going to remain somewhat volatile, somewhat turbulent. So what we are recommending investors is really stay focused on cash flows that are resilient, that can withstand the period of turbulence that we expect over the next 6 to 12 months. But also be prepared to pivot to opportunities, because when there's dislocation, there's also opportunity. So it's really building a resilient and nimble portfolio in real estate that focuses on the full array of opportunities that is available to a real estate investor, including of course the residential sector, but also be prepared to invest more opportunistically, more nimbly in the public quadrants of real estate. For example, REITs, when they dislocate, they might offer some interesting opportunities. So big picture, we're telling investors is be defensive, recognizing that we're going to enter a period of uncertainty, potential recession, but be prepared to be nimble and pivot when the opportunities do arise.
So then looking within REITs, then what are some of the key themes to keep an eye on when really determining when to enter the market and how to enter it?
Yeah, that's the million-dollar question, Rochelle. I think when we look at REITs, we look at it more holistically from the perspective of a real estate owner. And ultimately, REITs do offer a different form of ownership to commercial real estate, albeit in the public side. And so we look for similar things underlying REITs. How is their earnings? What's their cash flow opportunity? How resilient are these cash flows? So when we're looking at the opportunity for REITs, we are looking at which REIT stocks are more resilient in terms of the cash flows, which REIT stocks are able to generate stronger earnings despite the potential uncertainty. So when we're looking at REITs, we're looking at these two underlying drivers. But more importantly, we're also looking at when the timing may occur, when the timing may become more favorable in terms of the quote unquote Fed pivot, the great Fed pivot. Now, the challenge is, of course, it's very hard to precisely determine when the Fed does stop its interest rate tightening cycle. But we believe that time will come when it feels that the inflation outlook has improved materially. And when that timing does occur, the REIT market, the US listed REIT market, will become a really interesting spot to play in. So we're looking for a couple of things. We're looking for the earnings outlook. We're looking for REITs that throw off structurally resilient cash flows. And of course, we're looking for when there are clear signs that the Fed has done, at least for the time being, with its interest rate tightening policies.
And how are you seeing some of these investment strategies differ depending on age demographic?
That's a great question. We believe that the U.S., like any other developed market, is going through a profound change in its demographic outlook. We're aging as a society. We're getting grayer. And that's leading to a whole host of different opportunities, particularly in demographically driven real estate strategies. So I'll pick on a couple as, for example, if you look at the residential market in the US, it's a vast market. But for right or wrong reasons, people have typically, or investors, analysts have typically focused on this owner-occupied residential sector. We think if you step out of the owner-occupied residential sector, there are significant opportunities up and down the demographic scale to invest in it, whether it's single-family rentals, whether it's manufactured homes, whether it's age-restricted housing, whether it's senior living, whether it's assisted living, or it's care living. There's a whole gamut of demographic-related opportunities to invest in the U.S. residential sector. It's not only about single-family owner-occupied homes. And that's just one example of how you can play the demographic shift that's occurring in the U.S. But there's also other ways of playing the demographic shifts in the U.S. And the other is through, for example, the retail market. The retail patterns are changing. 10 years ago, e-commerce as a percentage of retail sales was growing, but it was pretty small. You look fast forward now, e-commerce is about 15, 16, 17% of retail sales. And a lot of that is being driven by the shift in the US demographics. The millennials, the Generation Z, the younger generation, much more liable to purchase and use e-commerce on their smartphones, on their tablets. And that's changing the way the U.S. retail industry is evolving. Bricks and mortars has always been important for retailers, but so is clicks and mortars. It's become really important to have that holistic experience for retailers. So that's another example of how the shifting demographics in the U.S. is actually shifting the way we shop, and that opens up opportunities as a real estate investor. Should you be invested only in bricks and mortars, or should you also invest in companies that give you clicks and mortars?
Mortgage rates continuing to fall. The average 30-year fixed sliding to 6.09% from 6.13%. That's according to Freddie Mac. Now, mortgage rates do not move directly with the Fed's interest rates, but more in line with the 10-year. But certainly notable that Jerome Powell indicated Wednesday, quote, "Given our outlook, I don't see us cutting rates this year." Mike Fratantoni is the Mortgage Bankers Association chief economist. He joins us now. Good to see you, sir. So that rate, I think a pretty notable move down near that 5 range. But given what the Fed chair said, how low do you think rates will get this year?
And so we're forecasting that we're going to be closer to 5% than 6% by the end of 2023. As you noted, the Fed, we think, still going to push up short-term rates at least one more time, one more 25 basis point hike. But long-term rates like 10-year treasuries, 30-year mortgages, already reflecting the weakness we're seeing in the economy, and honestly reflecting the fact that at some point the Fed will reverse course and begin to drop rates.
How low do you think rates need to drop in order to spur a lot more activity in the housing market? Because still, even though we have seen some improvement, we know sellers and a number of buyers still remain on the sideline.
Yeah, it's been interesting. Fourth quarter of 2022, the housing market, I think, was just dead in the water. And you look at the level of activity right now, it's still very low. Applications to buy a home still about 40% below where we were last year at this time. But we're beginning to see an increase in the level of activity, and that's in our data in terms of mortgage applications. It's in pending home sales from the realtors, and it's in builder sentiment from the home builders. So everything pointing in the same direction. The January a little bit better than that extraordinarily slow fourth quarter from last year.
Is the worst behind us, Mike? Excuse me.
Yeah, we were above 7% for a 30-year mortgage rate in fourth quarter last year. And now, like you said, last week we were a little above 6. And some of the data in the market today say a lot of mortgage lenders are quoting rates that begin with a 5. So I think that's going to be enough to get potential buyers much more interested in out looking for properties.
Mike, what about the state of the economy right now? Because that remains uncertain. If we do see a recession, how do you see that impacting housing over the next several months?
Yeah, that is our baseline forecast. So we think we're going to be in a recession the first half of this year. The unemployment rate, which was at 3.5% in December, we see getting above 5% by the end of 2023. And that's going to be a headwind, certainly, but a benefit, again, particularly for that first-time buyer, is rates down from 7 to maybe the mid-5s. Home prices, instead of growing double digits, we think are essentially going to be flat for much of the next 2 years. So from particularly a first-time home buyer perspective, the market's a bit more inviting. They might actually see some additional properties out on the market, particularly in the new home portion of the market. We've seen inventory pick up. In terms of existing homes, inventory is actually still quite tight. And a lot of current owners, if they don't have to sell into this somewhat weaker market, they may just hold on to their properties for a bit longer.
Historically speaking, where are those inventory levels, and when do you believe that story begins to change?
Yeah. So again, different on the new versus existing side. New home side, there's about 9 months of supply. A lot of that are homes under construction. And we expect that builders are going to be forward-leaning in terms of offering incentives and in some cases price cuts to move those homes. But a builder's in a different position from a current owner. Homeowners in the U.S. in the aggregate have about $30 trillion of home equity right now, and millions of them are sitting on mortgages that were taken out at all-time lows, 3% or even lower. So we have less than 3 months of supply on the existing side. So if you're a buyer, probably more opportunities to see in the new home market than the existing home market right now. 6 months of supply is typically what you think as a balanced market. Again, new home market looks like we got more than that, existing a lot less.
Mike, you mentioned the fact that some buyers are coming back into the market. How much leverage do buyers have today?
Well, certainly a lot more than they did last year at this time. Last year, it was all about, multiple bidding wars and properties going for well above list price. Now it's just not the same level of fever in the market. So, I think a buyer has a lot more leverage. I wouldn't overstate that, though. Again, given the lack of inventory on the existing side, if a current owner is not in any way distressed and doesn't have to move, they may not give a lot on price, but there may be other options available. You see many sellers, perhaps they're going to offer to buy down that buyer's mortgage rate for a period of time. That certainly happens in the new home market. So it's not all about price and negotiating around price. There are other terms of the transaction where a seller might be more flexible to get the property sold.
A sudden burst of optimism on the housing front today as we saw the largest monthly gain in a decade when it comes to confidence in the newly built single-family home market. The National Association of Home Builders Index rising 7 points to 42. Let's talk about the housing market and the boost of business creation, among other things. Joining us now is Shark Tank investor Barbara Corcoran, host of the Business Unusual podcast, founder of the Corcoran Group. Barbara, always wonderful to see you. Let's start with the trillion-dollar question. Is the worst behind us in the housing market? What are you seeing out there?
I think the worst is behind us because the housing market is showing signs of life for the first time in the last year. Everybody believes, whether it's true or not, that the Fed is done lifting rates. And with that, it's ushered a few more buyers into the marketplace. But when you think about it, the average price that we paid a while ago is not very different than we're paying 1 year later. I think the price now is $366,000, which is only 2% up from a year ago. But to pay for that house with the higher interest rates, the home buyer has to pay another $600 a month. Think about that. That's what slowed down the housing market, mostly the interest rates. The big problems still are high interest rates, and there's still a lack of inventory.
Yeah, so Barbara, that leads me then to, yes, we are starting to see signs of life, like you said, in the housing market. What's it going to take for the housing market to take off? When you talk about that mortgage rate number, what does that need to fall to in order to really see a huge boost in activity?
It's going to have to drop 2 points, and people are going to act like there's a sale on. Anybody who even has the first thought of buying a house is going to rush the market, and then we're going to have house prices go through the roof again, as we saw 2 years ago.
We've seen demand soften in the fourth quarter specifically. Not surprising, right? I mean, you talk about new housing and you talk about interest rates and all those things. However, when I joined Masonite a few years ago, one of my goals was to not have to wake up on February 24th and we were going to have a good year, right? Because everybody needs doors and everybody needs houses. And so we know we're in a cyclical market. We understand that it's a bit of a down cycle as we are here today, but we're trying to do things in the business that actually help us control our own destiny and grow in even down markets. So great news today, 670,000 houses sold. That's terrific. But in down markets, in up markets, we think we can be creative and innovative on what we do to help people solve life and living problems with their doors.
And when we think about the Internet of Things and the rise of the connected home, smart appliances, the door follows the front door, a big part of that as well. Tell us about how that segment is being penetrated by electronic gadgets.
Yeah, it's an interesting question, Jared. So we look at that trend of smart homes. And the doors have not been part of that. And yet consumers tell us connectivity and smart homes are important. So we did launch the first powered and connected entry door in the market called M-Power, going to be available nationwide at Home Depot later this year. And it allows you to connect to that smart home. So your video doorbell and your smart lock and your LED lighting, all controlled by apps. We absolutely see that as a trend. And we think we should be a leader in that space.
And what kind of demand are you seeing for sort of products? I know this particular product is new, but what kind of demand are you seeing for products sort of going in that direction?
You know, it's interesting because the pandemic sort of created people to be more aware of their doors. So privacy, for example, became a big deal. When you were trying to work out of your home and you were in your bedroom because that was the only door that had a room that had a door, and then you realized it was a hollow core door and you could hear everything on the other side. People then said, wow, maybe my life and living would be better if I had a solid wood door or a solid core door. And so we see a trend toward higher value products as people are more aware that their doors can and should play a more important role. Consumers talk to us about privacy, security, light, energy, ventilation, connectivity, and style. And so we are absolutely seeing mix. And in fact, one of the positive things in our earnings release yesterday was, again, positive mix in the business toward higher value products that help solve life and living problems.
We heard a lot about, over the pandemic, a lot about supply chain problems. Just wondering if those factored into your business model, the things that you had to overcome, perhaps. A lot of companies finally now able to shut that door, at least close it temporarily on that chapter, but wondering what your experience was.
Certainly, we had the same problems. Our supply chain team was working tirelessly to find alternative suppliers. And when all the boats were on the, we saw the pictures of the boats on the water in Long Beach waiting to be unloaded. Certainly, we had products on those boats, and it was a challenge, no question. But I do feel like, Jared, those problems are generally behind us, knock on wood. We feel like we're in a much better position from a supply chain perspective. And as I said, I hope those are problems of the past.
So what's happening with pricing then, if that's abating? I mean, as we've been talking about, we got the PCE numbers this morning that came in hotter than estimated. At least the January numbers, both on the wholesale and consumer level, they're not looking so great. What are you seeing in your business?
Right. Well, pricing, we're still seeing elevated costs, first of all. So not only are we using material that we bought sort of in the height of inflation, we are beginning to see some moderation with logistics, for example. But generally speaking, our costs are still elevated. So that's certainly problematic. We do, though, also believe that the value that doors actually add, and we haven't been capturing fair value for our products for many, many, many years. And so prices have been going up, our costs have been going up. We're beginning to see that moderating, but candidly, we're not expecting to see much of that in 2023.
Home prices in December of 2022 were up 5.8% year over year. That's according to the latest report out from Case-Shiller. That's actually down from a 7.6% year over year increase the previous month. So 6th month in a row that we have seen declines for home prices. So while there are some good news there in terms of the potential home buyers, the market certainly does have a way to go. So if you're in the market for a new home, we've got you covered because Bankrate is out with its list of the best metro areas for first-time home buyers. The results ranking 50 metro areas based on housing conditions and affordability, the job market, and wellness and culture. So let's take a look at the top 5, where they're saying is the best place to buy if you're a first-time home buyer. Coming in at number 5 is Jacksonville, Florida. This metro area ranking very high on the list for its strong jobs market. Number 4 is Minneapolis. Now, Minneapolis, the Twin Cities here, dominating the job market category, coming in at number 5 in that category out of the 50 metro areas. Number 3, Raleigh, North Carolina. We talked a lot about the strong housing market in Raleigh, North Carolina at this point. Number 2 is Kansas City. Kansas City receiving the high rankings in housing affordability. One note here, it scored significantly lower, though, in job market and also in wellness and culture. And that's why it's not the number 1 spot. Number 1, let's put it back up on the screen. What is it? Austin, Texas. We heard that right. Austin, Texas. It caught me by surprise. I got to be very honest with you, Dave, there. But the jobs market in Austin clearly has been booming. Also ranking near the top of that list and wellness and culture. So taking a look at this list of the top 5, you can certainly see the Sunbelt area very well represented in the top 5 of this.
Appreciate the drum roll. Very nice. Yeah, Austin has become a bit of a tech hub with you're seeing Google and Amazon. A lot of those companies move down there. But I, too, was shocked that that was number 1 on the list, in particular because the home prices have skyrocketed. They have doubled over the last decade, Shauna. So it'll be interesting to dive deeper into those numbers. That is not one city I think of about anything being affordable. It has become one of the more expensive cities to visit, to live in the country. It's right up there with Nashville.
Yeah, it certainly is. I mean, it is incredible there, just in terms of how much higher the cost is to live there. But Raleigh, North Carolina, you and I have talked time and time again about the housing market in North Carolina. So many people relocating down south to areas that are more affordable. And you can clearly see our area of the country is not well represented at all on this top 5 list.
A mass exodus from New York City. What is behind these numbers? Let's break them down with bank rate analyst Jeff Ostrowski. Jeff, nice to have you on the program. I do want to zero in on that #1 city for first-time home buyers, Austin, Texas, which Shauna just mentioned. Home prices up about 30% to pre-pandemic and have essentially doubled over the last decade. How does it come in at #1 in terms of first-time home buyers?
Well, that's a great question. And I was surprised as well. I don't know if I was shocked, but definitely surprised. But I think that the answer here is that we're looking at 4 categories and not just one. So if it were solely an affordability calculation, Cleveland would have come out at #1. But affordability was one of 4 factors that we looked at. The others were, as you've got on the screen, job market, and Austin ranks #1 nationally in job market in terms of job growth, in terms of employment rate. And then housing market conditions. The housing market actually has slowed quite a bit in Austin. So we haven't seen prices crash, of course, but we looked at things like days on market and inventory trends. So the idea here is to just measure how easy or difficult it is for first-time buyers who are out shopping for homes. And it's gotten a lot easier in Austin. I spoke to a home buyer there who a year and a half ago was one of 30 people in line for a condo, had to bid over asking and still got shut out. And then bought last fall and was the only bidder. So that's another thing that we looked at. The Austin market, even though it's still quite pricey, has fallen a bit. And in terms of affordability, we were comparing local home prices to local wages. And so all those tech employers coming into Austin that you just mentioned have really boosted wages in Austin. So it's it's a tough market for people who are making the same wages they might have been making 5 or 10 years ago, but for the folks who are working for tech companies and are enjoying this wage growth, it's actually an achievable homeownership is an achievable thing in Austin.
Yeah, that's a great point. Yeah, following this market, I heard many a story about people trying to buy homes in Austin, Texas, only to have someone come in and pay 20 to 30% over list price in cash as they were priced out of the market for a couple of years. Overall, when you look at the top 5, even the top 10, do you see COVID kind of changing where people want to live? And how much does remote work factor in?
I think it does definitely factor in. I mean, that's part of the reason we've been seeing the tech employers open up shop in some of these less expensive markets. I mean, Austin is certainly expensive compared to much of the rest of the heartland, but compared to California and Seattle, it's pretty affordable. But yes, that's definitely a factor. Texas has had huge in-migration, huge job growth over the past couple of years. Florida, which had a metro area in the top 5, also has seen a huge influx of people and jobs. So yes, some of these new arrivals are working for companies based locally, and others are just taking their big city paycheck to a slightly less expensive market.
Jeff, as interesting as the top 5 were, the bottom 5 may have been even more interesting. Number 46, Riverside, California. 47, San Diego, California. 48, our city, New York City, followed by Boston and Washington, D.C. Is there a mass exodus from these big coastal cities? And what is the impact down the line on those housing markets and economies?
Yeah, I don't know if it would be accurate to call it a mass exodus, but certainly, somewhat of an exodus. New York, the New York State definitely is losing population. California has lost some population, and so yes, those markets are seeing people leave. But in some ways, it might be an escape valve for those markets, because those places that you just rattled off, many of them got really expensive over the past 20 to 30 years. And we saw this this just geographic divide in terms of affordability. Those markets on the screen right now were very affordable, to the point that it was really hard for most Americans to consider moving to a lot of those coastal markets. Mobility really slowed down from about the 1990s on. And so now we're seeing a change. We're seeing a lot of people leave those markets and go to some of these more affordable markets. And so I think in some ways that might be healthy for the overall housing market. I mean, it's certainly difficult to be a first-time buyer in Austin from an affordability perspective, but there's a lot of the demand that had been driving up prices in these expensive markets is now going elsewhere, and so there might be an evening out of home prices in the coming years.
The underlying fundamentals of real estate are quite strong. What has happened in the real estate industry over the last year, we really had a tale of two markets. The first half of the market for the private real estate sector performed very strongly, whereas the second half of the year, we saw the market capitulate to what was occurring with the Fed's movements of interest rates. So what we've seen is a fallback in pricing, but what has endured are the fundamentals. We are sitting here today with some of the strongest underlying fundamentals in 3 of the 4 major sectors that we've ever seen. Vacancies, we finished the year in 2022 at 5.3% vacant, which was the lowest vacancy on record since keeping records in 1988. In addition to that, we saw the highest income growth for the real estate market for the year, 7.9% that we'd seen historically, except for a small time during the recovery from the pandemic. So what we're seeing here is market pricing changing as a result of the cost of capital changing, but still strong underlying fundamentals excluding the office sector.
So as we look at the 4 sectors, you mentioned office there, you also have residential, industrial and retail as well. Talk about residential in terms of where you see house prices going, and perhaps you also mentioned the role of millennials in your notes and how they're going to be affecting the housing outlook.
Yeah, so millennials have been a big part of the story over the last year as housing formation increased materially over the trend. I think that will continue. But housing prices are a bit challenged as a result of the cost associated with owning homes, in particular, the cost of mortgage financing, which we think bodes well for the rental market, both the traditional multifamily rental market as well as the single-family rental market. We have seen, however, some slowing, and I would call it more normalization, frankly, of demand in the rental market here as consumers, as renters, as homeowners are starting to feel the cost of increased goods and the cost of increased mortgages around the housing market.
And I want to ask you about the increase that we've seen in cash buyers. Bloomberg reporting that over 50% of the 13 cities that they were looking at in the Southeast, which we know was a hot market, especially during the pandemic, but seeing less institutional investors. What are you seeing in terms of the balance between, your regular, person trying to buy a house versus some of these institutional investors?
Yeah, so it stands to reason that if you think that mortgage rates are up temporarily, that if you can afford to buy a home unleveraged, you would buy a home unleveraged and then leverage it at a later date at the point in time when financing costs are significantly less. The institutional investor today is really historically has looked at real estate more as an income and diversification play and has been lower leveraged and sometimes no more than 15 to 20% leverage total in their underlying core real estate portfolios. So leverage has less of an impact on them in terms of their ability to participate in the market, but it obviously has an impact on the cost of capital and therefore the swings that we would see in the overall values associated with the real estate market. And as a result, flows have reversed in the real estate market from the first half of last year, where flows were still coming into the market, to the second half of last year, where flows were coming out of the market. That was partially due and mainly due to the performance of real estate relative to the other asset classes. The institutional market has become over allocated to real estate relative to their stated targets because of the performance of real estate relative to the other asset classes.
And just quickly, I wanted to get your top takeaways. Office and retail. We know you're bullish on retail and bullish on office, but overseas as well.
Yeah, so I would say that we're bullish on certain sectors of or subsectors of the retail market. We like the neighborhood shopping center market. Necessity-based retail, we think, has a place in the portfolio today. That's for a couple of reasons. One, we've seen very strong performance in grocery-anchored neighborhood centers. The vacancy levels are lower than they've been in 17 years, and you see a lot of service-oriented retail in neighborhood shopping centers, which is very difficult to disintermediate through e-commerce. On the office side for the most part, is very challenged, but you can't necessarily eliminate all of the office market or all office buildings from a portfolio. There are areas with strong job growth and strong population growth, and the best-in-class office buildings within those markets are still performing reasonably well. But it is clearly the worst-performing sector out of the four currently, and we expect that to continue. In the U.S., we have vacancies today that are high as they've been since the 1990s S&L crisis, and we expect throughout the year that they will eclipse the S&L crisis vacancies and hit peaks for vacancy as a result of, one, it is the most correlated to the business cycle, and as we head into a slower and slowing business cycle, we expect it to underperform. Right. And then obviously the hybrid working or work from home environment has an impact as well on demand for office. So we do expect office to trail the other three major sectors, and we expect to be underweight, but where we will own office is in, again, those cities and areas that have strong job and population growth, and will own the best-in-class office buildings in those locations.
Home prices were up nearly 6% year over year in December. That's down from a 7.6% gain in November and nearly a 4.5% lower than their June peak. And although they slipped a bit at the start of the year, mortgage rates have climbed even higher this week, with the 30-year fixed now 6.6%. and the 15-year just under 6%. And earlier this week, Moody's Analytics chief economist Mark Zandi told Yahoo Finance we've still got a ways to go until we find some calmer waters.
The one thing that is dead ahead, though, is more house price declines. I mean, to restore affordability, mortgage rates have to come down, incomes have to rise, and or house prices have to fall. And I think we'll get some combination of all three. So that means some further house price declines dead ahead. Now, prices have been falling for the last 5-6 months since last summer. I expect them to steadily decline through 2023 and into 2024. I think we see about a 10% peak to trough decline in price. We're down 2 percentage points already, so we're kind of 1/5 the way through the adjustment process.
All right, let's talk about this with Redfin chief economist Daryl Fairweather. Daryl, you heard Mr. Zandi there talking about the real estate market as he sees it and where it's going. Anecdotally, what are you seeing right now with these higher rates? It appeared that spring was coming, things were loosening up, but it feels like a tenuous time. What do you see across the country?
The housing market is much slower than it was this time last year. There are way fewer home sales, and there are fewer new listings coming on the market because many homeowners locked in a 3% rate just last year, and they don't see a reason to sell because there'll be buyers again. And buyers, of course, are facing high mortgage rates that makes it much less affordable to buy a home compared to last year.
So what does that mean for inventory levels? It doesn't seem like many more homes are going to be coming on the market anytime soon.
Yes, if you look on Redfin right now, you will see more homes for sale than you would have seen this time last year. But a lot of that inventory is stale. It's homes that have been sitting on the market, probably a bit overpriced, and have not yet attracted a buyer. And there are very few new listings coming on the market.
A month ago, mortgage rates were just above 6, and most felt, and it looked like they were going to sink below 6 and keep going down until the 5.5 range. And then boom, went straight back up, and here we are at 6.65. Are we headed back towards 7% on the 30-year?
Buyers are incredibly sensitive to rates. So anytime mortgage rates come down, they come right back to the market. And when mortgage rates go up, they leave the market. But with mortgage rates being so high, there's a chance they might go up. And a lot of buyers are just kind of looking at the market and thinking now is not the best time.
So, Daryl, within your forecast, though, what you guys are anticipating over there at Redfin, are you expecting this trend to the upside to continue, though?
We expect mortgage rates to fall below 6% to around 5.75% by the end of the year. But in between now and the end of the year, mortgage rates could come up and come back down. Now, the Fed is going to stay committed to fighting inflation, and that should eventually drive mortgage rates down. But it really is anyone's guess as to how long that will take.
Would you spotlight a particular region in the U.S. right now that seems just to continue to grow regardless of where the mortgage rates go? I mean, is it the Southeast? What's the region that just stays hot through all the conditions?
It's not so much staying hot, it's the markets that have stayed stable. So the Midwest, for example, never really took off during the pandemic. So they don't have very far to fall at all. Sorry if you hear my kid in the background. But places like the Southwest, like Texas, prices really took off in Austin. And now it's a big function.
Daryl, what are you seeing just in terms of a lot of the home buyers, a lot of first-time home buyers are staying on the sidelines here. They're waiting for something to change. They're remaining hopeful, though, that they are going to somehow score a good deal in the second half or maybe towards the end of the year. Do you see that as a possibility at all?
I think it's possible. I think that the second half of the year could be very strong if mortgage rates come down. We could have a reversal of seasonality because, like I said, as soon as mortgage rates come down, buyers come back.
All right, switching gears here, talking about the housing market, and a positive sign here for the industry, mortgage rates declining for the first time in over a month. New data out from Freddie Mac showing that the rate on a 30-year fixed mortgage ticking down to 6.6%. Joining us now for more on that, we want to bring in Jerry Howard, National Association of Home Builders CEO. And Jerry, let's start with the news of the week, and that, of course, is the drama that we have certainly seen play out within the banking sector, certainly spilling over to various industries throughout the market. How do you see this potentially affecting, or really is already affecting, the housing market?
Well, obviously, in the short term, interest rates are going to go down, and they have. And that's a good thing for housing. But what I'm concerned about, and what I think home builders around the country are concerned about, is what does it mean longer term? Most of the lending that home builders rely upon to acquire, develop, and construct comes from small regional banks. And if the regional banks are unstable, or even if they're just being more cautious in their lending, or if they're charging more for their lending, it's going to have an impact on housing starts at the worst possible time as we enter the spring building season. Now, I'm not saying that's going to happen. I'm saying that's a possible outcome. And that's why the home building industry is really right now sitting with bated breath, watching as this unfolds.
And Jerry, have you spoken to any industry players? Have you spoken to any regional banks? Because I get what you're saying. You're basically saying that these builders depend on these regional banks to build. I know that when you go to construct a home, to get a construction loan, often you are going to the regional banks. What's the chatter that you're hearing?
Well, just like I said, they're going to make hay while the sun shines. In the short term, interest rates are going to go down. We expect that to translate hopefully into sales. But in the mid and long term, we're holding our breath. We don't know how it's going to play out, just like you guys don't. And we've got to wait and see. So everyone is cautious. And I got to tell you, that's a change in attitude. At our annual trade show and convention back in January, everyone was upbeat for this year. So upbeat that we were actually thinking of changing our forecast and being more aggressive. Now I think we're going to sit tight for a while.
Jerry, are there questions now that maybe the worst of the housing pullback, maybe that isn't behind us?
If the banking sector is in trouble, it's going to impact housing a lot.
And what do you make of the mortgage rates that have been really volatile over the last several days? I mean, do you think that we are going into sort of a new norm when it comes to mortgage rates and what buyers are willing to buy at?
Oh, no, I don't think that's a new norm at all. I think that's just been part of the standard operating procedure in the housing industry. When rates fluctuate up, sales go down. When they come down, sales go up. Obviously, for each increase of 1 point in the mortgage rate, 100,000 people are priced out of the market for any particular house. So you've got to watch it very, very carefully. And buyers do as well as builders. I don't think there's anything new in that.
But what areas of the country are you seeing the most concerns? Because when it comes to mortgage rates, what I've noticed is that it really is regional. It really is sort of local as far as the impact. I mean, some areas are getting hit, and other areas you're still seeing prices sort of elevated.
I think the areas where you want to see, where you're seeing a sound economy that is based on more than one primary industry, a diverse economy, if you will, an area that is areas that are pro-growth are going to see stability in the housing markets. They're going to see normalcy in the housing markets. Those that are highly regulated, those that are anti-growth, those that are reliant upon one primary industry for their economy are going to see some problems. But everything right now holds on the overarching specter of trouble in the financial markets.
Certainly does. And Jerry, when it comes to some of the home builders, when it comes to construction, you and I have talked numerous times just about the labor shortage and that impact that is having on the housing sector. Are you seeing any improvement there?
We're starting to see some improvement as more and more Americans start to realize that, hey, I don't want to go to college. I can't go to college. Geez, I can have a whole lot more freedom and work outside if I get into the construction trades. We're starting to see that change a little bit, but it's got to change a whole lot more, or more to the point, we need to reform our immigration laws if we're really going to see a strong improvement in the labor markets for us.
Some good news out of the housing sector today. Existing home sales rising 14.5% in February. That's according to the National Association of Realtors. That's the largest monthly percentage increase since July of 2020. Joining us now is Jessica Lotz, National Association of Realtors Deputy Chief Economist and Vice President of Research. Nice to see you. Do you believe this is a blip or the beginning of a pattern? And where is it most pronounced? Much like Tip O'Neill said about politics, all real estate is local.
Indeed, all real estate is local. And we certainly are seeing home buyers back. They are excited about the spring market. They've gotten used to slightly lower rates than when we have seen that peak of 7%. I have to say the most pronounced is in the West region, where perhaps buyers actually had a little negotiating power, and they were taking advantage of that.
Jessica, where do you think we'll see the 30-year rate trend here? Do you think we're going to stay within that 6 to 7% range? Will we potentially get back above 7%?
I hope not. I do hope that we stay in that 6% range. That is our forecast, and maybe even dipping lower than that into the 5% range towards the end of the year. I have to say that buyers have gotten used to it. They understand that 3% is not going to happen anytime soon. And so they understand that they're going to have to pay more for the mortgage. All of that said, if we compare today's market versus last year's market, we know that last spring was insane. There was a lot of buyers coming into the market, really bidding up home prices and getting pretty frantic, waiving a lot of contingencies, trying to get into the home buying market. So right now, in a little more balanced market, is certainly healthier for home buyers coming in.
And it was really just a bit of a really quick downturn for rates that presumably caused the numbers we just saw. Do you think, again, to my prior question, is this the beginning of a long-term trend or just a 1 month, one-off number?
I do think that we have seen the bottom. I think that hopefully home sales will continue to increase. Certainly there's investors who are still in the market, but primary residence buyers, thinking about those first-time home buyers, potentially millennials who want to enter into the market, baby boomers who are retiring, all of that is driving demand all at once. And so I think that we are going to continue seeing home sales rise. I think we would have seen them higher if we had more inventory. And that's what we're really lacking right now.
Yeah, Jessica, what is the inventory picture right now? Have we seen any improvement? Because it looks like certainly a lot of regions still lack that inventory. So then that also begs the question, how many offers are some of these houses getting?
Yeah, absolutely. So we still have under 1 million units right now for sale. And if we think about the demand that's there, it's really not meeting that. In fact, we're seeing 2.7 offers for every home that's out there right now. Again, better than last spring when we saw 5.5, but again, 2.7 is a lot. That means there could be a potential bidding war, especially in incredibly hot areas. And we know that every neighborhood has that special area that someone wants to move into, and that could have the potential of bidding up prices.
Yeah, we're still seeing about 2.5 months of supply. We need about 4 to 6 to be truly healthy. We also saw prices decline, albeit 0.2%, but that was the first time in more than a decade that prices fell year over year. Again, regionally, where are prices falling the fastest? And do you think they'll continue to fall for the remainder of the year?
You know, I think it's hard to say with prices, especially when we know that there is the volatility in interest rates at the same time. If we look at where prices are really falling the most, we really are talking about those hot areas where we saw a lot of migration flow into. So the Boise's, unfortunately, the Austins, Salt Lake City, we saw home prices being bid up competitively in those areas throughout last year. And so now we're seeing that shrink. Now, I have to say, I don't know what's going to happen with home prices, but knowing that there's not much inventory and there is potential demand out there, it means that there could be some equilibrium that happens and continues to happen in the marketplace. And yes, 0.2%, sure, it's a decline, but we have to take that into context of 10 years of steady growth.
Just on the map that we were just showing, certainly the West Coast, we saw a huge jump, the month over month jump that we did see. What do you think we're going to see in terms of the fallout from SVB and some of the crisis that we are seeing playing out in the banking sector? Because yes, on the one hand, leads to lower rates because of the drop in the 10-year, but also the fact some of the instability there could cause some home buyers to stay on the sideline.
It's possible, but I think any home buyer who's seriously looking is their first call is going to be to their mortgage broker and say, can I lock in a lower rate? And can I actually competitively get into the home buying market right now with that lower rate? And they're going to move forward with that. I think we all know that one regional bank is one regional bank, and it's not looking like a wider fallout at this point. So I don't think that they're going to be broadly concerned. That being said, if they're in the tech sector, if they're living in that local area, certainly they're going to be feeling that worse than in other areas.
Commercial real estate has gotten a lot of attention as of late, right? There's been a lot of discussion about whether this is one of the areas of vulnerability as we are seeing rates move higher. What can you tell us about that from inside the industry?
Good morning. Thanks for having me on the program. Well, the industry has been under a lot of pressure really since fall of last year, when the successive interest rate increases really created a challenge in valuing commercial real estate, given the extremely rapid rise in the cost of debt. Commercial real estate is very dependent on leverage. On average, we have somewhere between a 40 to 60% long-term average use of leverage in the transactions that occur throughout the United States. That's gone up as high as 70 or 80% at various times of different cycles. But nonetheless, that is a significant portion of what makes the transaction work. And the shock to the marketplace from the successive and very aggressive rate hikes last year are still being absorbed. Now, the fact that yesterday we saw a 1/4 point movement instead of the 1/2 point movement that was planned prior to the banking crisis is a positive. Not so much because of the rate is lower than the 50 basis points, but the signaling that the Fed is nearing its tightening cycle. It's really taken a sledgehammer to the real estate market in a way that the successive increases were so dramatic and could have been done at a much slower pace if the Fed had started tightening in 2021. So the catch-up factor is what's really hurt the transaction market and the underwriting. So far, what we're seeing is sellers and buyers having to recalibrate on what the true valuation of commercial real estate is. Of course, that varies by property type and marketplace, but we're still in that recalibration phase of price discovery. The clarity that the end of the tightening cycle will bring is a positive move. Second to that will be clarity on whether we're going to have a recession or not. We still believe this is going to be more of a slowdown than a major recession. The employment market is still way too strong and has a lot of great foundation, as does the consumer, to point to any kind of a dramatic, serious recessionary forces coming into the picture. So with those two things coming together in the next few months, I think there will be the more clarity, but the market needs time to absorb this readjustment of valuations.
So trying to synthesize all of that, what would be in your calculus for either shallow or severe or mild, whatever it looks like, type of recession, the knock-on effect on the real estate market, considering that, it's not normal for rates to be at zero or near zero for as long as they were, and for the market to be able to set its own positions around that, and then now have to normalize when rates are actually getting back towards levels that many would say are actually perhaps a little bit more normal.
You bring up a great point in that 5% federal funds rate is not all that unusual and actually considered a normal interest rate. We're coming to that 5% federal funds rate from zero at a very quick pace. That's what's really shocked the markets and created this dislocation. Had that process been more gradual, had the Fed had been a little bit further ahead of the curve on inflation and not relied on the transitory judgment that was placed on what we were seeing in 2021 post-pandemic, we wouldn't have caused as much of a shock to the marketplace. So you're right, it's the absorption of that shock that's going to take time. Meanwhile, the unintended consequence of this rapid rate increase, of course, has showed up in the banking system. And there is a lot of concern about mortgage performance for commercial real estate. Commercial real estate is a significant part of the asset holdings throughout the banking system in the United States, particularly regional and local banks. The good news is when the current loans that are maturing were issued, 5 to 7 years ago, values were a lot lower than they are today. Occupancies and rents were a lot lower than they are today. And the foundation of commercial real estate assets is much stronger than it was going into 2008, 2009, because we haven't overbuilt, we haven't over-leveraged, and all of that gives the industry a lot more of a solid footing going into this rather uncertain phase of what's going to happen with the maturing loans. So having said that, there's going to be some non-performing loans. We're seeing some office buildings get handed back. We're seeing some challenges in refinancing maturing loans that are coming due that were short-term loans, maybe issued 2 or 3 years ago with a very short-term maturation cycle. And some of that is going to be problematic in the marketplace. And part of our job as advisors and brokers is to actually solve those problems with our clients, which we're actively doing. And there is a wide gap between the performance of, let's say, office buildings right now and multifamily properties and retail, for example. Those are all performing at a very different level.
But it sounds like overall that the perception that there is this huge bomb lying in wait or bombs lying in wait on balance sheets, especially bank balance sheets, it sounds like your message is that that's mistaken, or at least has been overstated by quite a bit.
I agree with that. Overstated is probably the best way to describe it, in that there will be issues. I don't want to gloss over that. But I just don't think it's going to be as systemic as some of the panicky headlines have suggested. And we've seen lenders work out solutions with owners when there's been those kind of maturing loan situations or bridge loan necessity to kind of help an owner get through a particular period of time in the cycle where we're having these forces come at us that are very unusual. You have to remember, commercial real estate has been through a pandemic, a very rapid recovery, and then a massive tightening of financial conditions, right, unlike anything we've seen in modern history. So the last 3 years have moved the industry through a significant roller coaster.
And so with that in mind, isn't it kind of a viable argument that the environment for commercial real estate has changed so drastically, whether that be the office workplace, whether that be a retail storefront footprint, all of that has dramatically shifted?
It definitely has, not all in a bad way. There's always opportunity in commercial real estate. In every down cycle, we've seen those investors that can reimagine a piece of real estate or can basically think long term, whether it's holding on to an asset or investing in new assets, come out as winners. And this is no different. What we're seeing is a dramatic difference between property types where, in a way, you can call office the new retail, because retail for the last 10 years was going through a complete revolution because of e-commerce. Brick and mortar retailing was changing in every way. And what emerged from that was the experiential retail, fitness, and health-oriented retail that has been so successful, was successful before the pandemic, has become successful again post-pandemic, and is driving retail to be, in many ways, the darling of the industry. That is a contrarian move. If you think about 4 or 5 years ago, when those investors that went into shopping centers, made those very important moves. On the other hand, office buildings, because of the hybrid workplace, because of the migration to the suburbs, especially office buildings in urban areas, have been hit very, very hard. We still have leases that have 3 to 4 years left on average. And when those renew, we're going to see shrinking of footprints and lower demand for office space, but not as bad as it seems today, because we're still recovering from the post-pandemic effects. Nonetheless, there is definitely shifts. Multifamilies coming out as a winner because home affordability is now a major issue, and people are opting to rent again instead of buying homes, given what's happened with interest rates. And then you have other property types like self-storage, for example, or manufactured housing, or life sciences that are doing extremely well.
Pending home sales rose for the third consecutive month, up 0.8% from January. For a deeper dive into the real estate sector, we welcome in Odetta Cushy, First American Deputy Chief Economist. Great to have you on the show, Odetta. So first, I want to get your reaction to this data and really the state of a housing market at the moment.
Absolutely. It's great to be here. I mean, the numbers beat consensus expectations. The expectation was that pending home sales would fall this month. And that's really because we had a month where rates went from 6% to 7% by the end of February. So the 0.8% is a modest gain, but it's the third month of increases, and it comes alongside increases in things like builder sentiment, mortgage applications. So it's a very soft start to the spring home buying season, which is a very crucial time for the housing industry. So we're off to sort of a soft start, but a lot of demand out there. The issue is really the volatility for mortgage rates and the lack of supply.
So you say this is a slow start, then what is the outlook from here?
It really is dependent on mortgage rates. This is a very interest rate sensitive sector. Right now, mortgage rates are down a little bit, and so that should help to coax some buyers off the sidelines, really help with affordability. But then, of course, you can't buy what's not for sale. And so inventory is just so low that, we might actually see a bit of an increase in prices because those who are shopping around might be stuck in a bidding war.
And as they like to say, real estate is local. So talk some of the markets here so that are seeing some of the sharpest changes.
So the West Coast, in particular, sort of the more traditionally expensive markets, San Jose, LA, San Francisco, we're starting to see double-digit price declines in those markets from the peak. Whereas markets in, the Midwest or even, the Florida, South Florida, Miami, prices are fairly resilient. They're still very high. The pending home sales from today showed that, there was regional increases in pending home sales in all regions except the West. So again, this traditionally more expensive markets are really the ones that are bearing the brunt of this affordability crunch and sort of the decline in the housing market.
So put this in context for us in terms of how it fares versus 2008, because a lot of people say, housing bubble, but are you seeing that as well?
No, this time it's different, or maybe I should say last time it's different. This is a fundamentally different housing market. We don't have, these loose lending standards, subprime mortgages. The fundamentals were really the driver of the house price acceleration over the pandemic. It was an increase in demand and against very, very limited supply. That was the result of that was house price appreciation. That was not the case last time around. It was driven by speculative, lending practices and fix and flip buyers. And we're not seeing that, consumers that were buying homes are in a much better position.
And what do you think are some of the risks that perhaps some people aren't really pricing in at the moment when it comes to the housing market?
Well, the risk right now is if we have a job loss recession. Right now, we're seeing price declines, pretty broad-based price declines. Obviously, some places are more resilient than others. But if you have those price declines alongside job losses, that's really when we're at risk for distress or foreclosures. You really need both. People have an inability to pay their mortgage and also underwater on their properties to have the outcome of foreclosure. foreclosure. And right now, the job market is very strong, so we're not worried about it at the moment. But if that starts to happen, that's really where I would be concerned.
And obviously this is happening amid a banking crisis that seems to at least be stifled for the moment. But we're looking at what might happen in the future in terms of tighter lending conditions. We know that people have been watching the commercial real estate market. And what about the residential market as well?
It's a little too soon to tell. I do think we'll probably have some tightening in residential real estate, not to the extent that we'll see on the commercial real estate side. It's interesting because there's sort of this housing benefit from the banking bust because mortgage rates sort of came down. There was all of this uncertainty, investors sort of flocked to the safety of U.S. Treasury bonds and mortgage rates declined. And so you get this affordability benefit from lower mortgage rates, but then of course the potential for credit tightening could negatively impact the spring home buying season.
And obviously this is a snapshot. What else should we be looking at in terms of direction for where the housing market goes from here?
So, obviously mortgage rates are the big thing, but recession risk, uncertainty is really the other side. And I think coming back to demographics, there's all this demand out there. The problem in the housing market's not demand. There are plenty of buyers on the sideline. There's a massive generation of millennials that are aging into their prime home buying years, and they're sort of waiting for the market to be more affordable so that they can jump in. So I think from a long-term fundamental perspective, you have this demographic tailwind, and really the question mark is what will happen with mortgage rates going forward.
And even as we look at things like affordability and also availability, when we look at what's happening with construction trends as well, how much more difficult is that going to make the picture?
That is the question. Inventory. The inventory is so low from a historic standpoint right now. Existing homeowners are staying put. 93% of existing homeowners are locked into mortgage rates below 6%. And so in this environment of higher mortgage rates, they don't have an incentive to leave that low mortgage rate. And so they're not selling their homes. There's sort of this seller's strike in the housing market. And the majority of home inventory is existing home inventory. So if they're not selling, there's nothing out there. Builders are sort of picking up the slack. So they're sort of gaining market share when it comes to inventory. So if you can't find an existing home for sale, it's possible that you might find a new home for sale because that inventory has been increasing.
And in terms of how builders are changing, because some of that I've been speaking to who used to do some of these big luxury homes are now looking at sort of more affordable townhouses, trying to really adapt to these market conditions. What are you seeing at the luxury end versus sort of the lower end of the housing market?
It's still really hard to build for that first-time home buyer. The number of projects that are priced below $300,000, which would be where that first-time home buyer is very, very limited. It's just not profitable for builders to build at that price point, but certainly that's a price point they need to be thinking about because there's this huge demographic of potential first-time home buyers that are looking in those price ranges.
Cautious optimism on the housing front with some new numbers in the housing data today. February pending home sales rising for the third consecutive month. They're up 0.8% from January, but still down 21% year over year. Joining us now with more insight into the housing market is Danielle Hale, Realtor.com chief economist. Nice to see you, Danielle. We've asked this question more times than we care to remember, but is the worst behind us? Because it is entirely unclear when you dive inside the data.
Yeah, so my expectation is that we have seen the low in existing home sales. That doesn't mean it's going to be a straight shot up from here. I do think we'll see some ups and downs in home sales in the year ahead in response to what happens with mortgage rates. With a lot of home shoppers at the edge of their budgets as home prices remain high and mortgage rates remain relatively high. What happens to mortgage rates is really going to impact whether people can move forward with their home purchase decisions. And so I expect that we'll continue to see that home shoppers are sensitive to fluctuations in mortgage rates moving forward.
And Danielle, in this economic data that we just got, and also in Realtor.com's your guys' data, there is certainly a discrepancy in terms of where we are seeing hot markets and where some markets are underperforming. How does the East Coast stack up against the West, and where are the most popular areas, at least right now?
And so in general, markets that are doing better right now as far as sales and pricing activity are out in the Northeast and in the Midwest and the South, where homes are relatively more affordable. The West Coast has not fared quite as well. In part, it saw some rapid run-ups in home prices before, but also it is a pricey area. And so that affordability equation is harder to square out there on the West Coast. And so we're seeing a bit of a pullback in activity out West, whereas the other regions saw an increase in pending home sales activity in the latest data.
Boy, that gives you a real good look at how relative real estate is. Mortgage rates, we'll get Freddie Mac Thursday, but Mortgage Bankers Association has them at 6.45% on the 30-year. Where do you see them heading from here? Because that also has been conflicting in recent weeks.
Yeah, I mean, we're at the stage in the cycle where the data is really important. And so if the Fed can, in fact, get to the end of the tightening cycle with one more rate hike, maybe two, then I think that gives mortgage rates some room to move down. But if inflation is stickier and persistent, and if the Fed has to ratchet expectations up again for how long its short-term rate is going to need to remain elevated, then that means we could see mortgage rates pull back up again. So I think we're going to see mortgage rates fluctuate between 6 and 7% as the future kind of comes into clearer focus. And so we're going to see a bit of up and down in the home sales activity in the year ahead in response to those mortgage rate fluctuations.
Danielle, what about the inventory picture? Because that has certainly been a huge topic, obviously a big issue if you're one of those home buyers looking for a house right now. When do you see that improving, and what's it going to take?
Well, it is improving. It just hasn't improved enough, maybe, for most buyers. The market is certainly not a buyer's market because in most markets, we're still looking at much more constrained inventory conditions than we saw before the pandemic. In fact, nationwide, there are still only about half as many homes for sale as was the case before the pandemic. On the flip side, though, home inventory is up really significantly compared to last year. So it's a bit of a glass half full, half empty, depending on what your comparison point is. The good news is that we're moving in the right direction. So we are seeing more inventory on the market available. The sort of downside of that good news is that it's because homes are sitting for longer. So there's less churn in the market as opposed to a lot of seller enthusiasm. And we think that higher mortgage rates are, again, playing a factor there because a lot of existing homeowners have locked in very low mortgage rates. And so it's less enticing for them to make a move if they would also have to take on a higher mortgage rate. Now, existing homeowners who have largely paid off their mortgages and so have very low balances or may even be able to make a purchase in cash, they're less affected by mortgage rates. And so those are the types of buyers that we're seeing active in this market. Now, the exciting thing is that we're moving towards the best time of year for home sellers when you think about the seasonal conditions that we see in housing. So that's going to create some opportunities for homeowners going forward. If they do choose to participate in the market, we're getting very close to the best time of year to list your home for sale.
Then when is the best time to buy a home?
When is the best time to buy a home? So it depends on your situation, but seasonally, buyers generally have the best balance of opportunities in the fall, sellers in the early spring.
All right, mortgage rates moving for a third straight week down. The average 30-year fixed down to 6.32% from 6.42 1 week ago. That's according to Freddie Mac. Down from north of 7% in early November, of course, far more than the 4.67 1 year ago. Let's talk about the housing outlook with Lawrence Yu, National Association of Realtors Chief Economist. Good to see you, sir. So what is driving these rates down, and where do you believe they will begin to flatten out?
Good afternoon. Certainly, the mortgage rates are becoming much better for the consumers. I think the consumers recognize that 3%, 4% mortgage rates of the COVID period, those were special circumstances, bonus conditions. The new normal could be around 6%, and essentially that's where we are. And for people who are considering buying, well, someone who may have been priced out at 7% are now beginning to be very eager as the mortgage rates are approaching 6%. But the reasoning is very simple. The Federal Reserve is in essence is saying maybe there's only one more rate hike or maybe none at all, given the regional bank a little wobbleness in that sector. So therefore, the mortgage rate has pretty much already topped out. The key question is, are we going to have sufficient supply to adequately meet some of the potentially rising demand?
And Lawrence, what are you seeing in terms of supply, those inventory levels, which we know have been very, very low now for quite some time? How big of a challenge is that still here for the market?
It is a big challenge. We have only 1 million homes out in the marketplace. Pre-COVID, it was closer to 2 million. So the inventory situation has not really improved. And therefore, we need to think about supply, bringing more supply, giving the incentive for the builders, Maybe there's too much regulation for home building activity, land use regulation, and also consider some of the zoning so that we can produce more housing rather than be restricted by zoning regulations. So we have to really think about bringing more supply to the market, because clearly there is a pent-up demand. Millennials did not participate in the market in the last year, but there is a aspiration for home ownership among the younger adults, and we need to assure there is adequate supply to meet that future demand.
And we're seeing some of that shift in new numbers that show baby boomers have overtaken millennials as the largest generation of home buyers, nearly 40%. That's up from 29% a year ago. What's behind that shift?
It's essentially saying that last year, in a period of fast rising mortgage rates, it squeezed away the first-time buyers, while for existing homeowners, they saw substantial price gain, 30%, 40% price gain in short 3-year time span. And therefore, for existing homeowners, they can always sell their home, use the proceeds as a down payment for their next purchase. But for the first-time buyers, they don't have that luxury. They're looking at mortgage rates, and rising mortgage rate essentially squeeze them away. And from the future perspective, I mean, we want home ownership opportunity for all age group. So the high mortgage rate last year really killed off the younger adult generation.
Yeah, and Lawrence, more specifically to that point, when we talk about how much of the first-time home buyers, the percentage there that they make up of all of home purchases, where does that stand now? And do you see that changing anytime soon?
Last year, exceptionally low. Only 26% of all home buyers were first-time buyers. Pre-COVID days, we would have said closer to 40% as being normal. So Federal Reserve clearly need to understand that when they raise interest rates, it will cause some harm to the economy. We are seeing it in the regional bank, but also from the home buying opportunity, rising interest rate is essentially limiting people of middle income or moderate income, or people who are on the more better situated circumstances. Baby boomers have already accumulated wealth. I mean, they're in a much better situation. So one has to consider, especially in light where we have so much apartment building construction occurring in the country, well, rents will surely come down, which means CPI, consumer price inflation, will come down towards the year end. So maybe the Fed can stop raising interest rate, knowing that inflation will be coming down.
I want to get your thoughts quickly on this LA mansion tax, which goes into effect on Saturday. You're seeing a rush of sellers trying to get their home not just sold, but closed by Saturday. Is that a smart move? And what is the net impact of it?
Not a good move. It just means that Los Angeles is saying, well, look, if you succeed in life, you have some wealth, we don't want you around here. So I think there will be large out-migration away from LA. Maybe they will go to Arizona, Nevada. So in the interim, maybe they collect some mansion tax temporarily, short term. But over the long term, they have lost out on many productive individuals as they have gone to other states.
And despite 2022 proving to be a difficult home buying environment, Hispanics increased their home ownership rate to 48.6%. That's according to a new report from the National Association of Hispanic Real Estate Professionals. For more on the outlook for real estate, we're joined by 21st Century CEO Mike Meadler. Mike, thank you for joining us here. Could you just dig into some of these stats for us? Some of them pretty eye-opening.
Hey, Jared, absolutely. So I just came back 2 weeks ago from the National Association of Hispanic Real Estate Professionals down in Washington, D.C., where they just released their home ownership report. Believe it or not, Latinos are the only demographic that consistently grew their home ownership over the last decade. You mentioned the number, about 48.6% home ownership across that group. Urban Institute believes that Latinos will account for 70% of first-time home buyers over the next 20 years. And so I think that's being driven obviously by the cohort in general, their median age being much younger than the general population, and the fact that they increased by about 630,000 new household formations in 2022, which was the largest gain that that group has seen in a decade and the largest among any demographic group. So like many others, they're looking for their fair share of the American dream here and buying a home.
What are you seeing in terms of the real estate that Century 21 is working through right now, and particularly married with the existing home sales data that we'd seen, of course, lagging, but at the same time, perhaps you can give us a bit more kind of real-time data component to this, given where we've seen the average price begin to improve a little bit.
Yeah, Brett, I think we're going to continue to see a somewhat of a challenging year from an overall units perspective. What's interesting is that NAR just put out at the end of February a big leap from January, obviously, at about 14.6% increase in overall sales. And I know that now the pending home sales report has increased 3 months in a row. So kind of away from the bottom that we saw, just call it, in the fourth quarter of last year. But we're still 23% behind where we were last year. And I think for the first time, you're seeing a little bit of a crack in the armor here, where after 131 straight months in a row of year-over-year price increase, we actually started pulling back on median price last month, about 20 basis points. So, there's still, I think, just like your last guest said, with inflation and mortgage rates, there's some guesswork to be done, but there are still a lot of people who are going to be, transacting and buying and selling homes. As we know, shelter's a necessity, and I think there's still a lot of pent-up demand out there.
And I say price improvement from perhaps a potential buyer's perspective here, Mike. I'm still out here doing as many Zillow searches and looking online as I can, as I imagine many other people are, and in different parts of the states here, personally for myself. So where are you seeing the most pickup? Is there any shift in regionality that you're also seeing, even as home buyers and prospective buyers are looking for deals where they can find them?
Brad, it's a great question. And there actually has been, right? We've seen the South, especially states like Texas and like Florida, really being drivers. And just this last month, it's really been the Northeast who has been holding steady and increasing from an overall housing perspective. Just literally on my block this week, yesterday, there was an open house. I must have saw 30 families through that open house. And so I think inventory continues to be the driving issue, right? We're under about 3 months of inventory when a normal market is about 6 months. And homes that, are out there and go to market are selling within 30 to 35 days. So, the serious buyers, the folks who I think have been in the market for a while and are truly looking for that home, are seeing a little bit less competition with where mortgage rates are. But, there's still a lot of folks out there who are looking to buy and sell homes.
And Mike, I just want to bring this back for our last question to the state of the Hispanic homeownership report that we were talking about earlier. Multi-generational living, really a big thing in the Hispanic community. I grew up in Miami, so I saw this firsthand. And I would think as a reaction to these high prices, unaffordable prices that we're seeing, maybe those options, that multi-generational option is being considered more. Just wondering if you're seeing that in the data.
Absolutely, Jared. In fact, the data shows that for the Latino population, multi-generation is about 32% of that cohort, and they are the largest cohort of multi-generation. A lot of co-borrowing as well. So people are getting creative, especially the Latino marketplace, to achieve that dream of home ownership. And you're absolutely right. I think that's what it's taking now with the affordability challenges that we're seeing in almost every market.
What should home buyers be watching with regard to the policy pathway from the Federal Reserve and how that impacts what they're going to be paying and even their financing options?
Yeah, Brad, I say this all the time, right? When you're when you're out there and you're actually renting, you're paying 100% interest, right? And so to me, it's one of the best gateways into wealth building and creation. There's no way to time the market, unfortunately. I was watching what the MBA was saying as far as believing that mortgage rates are going to average and come down. I don't know if that's true or not. But right now, you have to think of it like this. We're still below the historical 50-year average on mortgage rates. If you're looking to buy, if the price is right, make sure you're always monitoring your credit score. Make sure you're continuing to build for a down payment and working with a great real estate professional who's going to help usher you through this big process and the largest financial transaction that most people are going to conduct.
Mortgage rates continuing to cool this week. The average 30-year fix falling for a fifth straight week, albeit very slightly in this case, to 6.27%. That's according to Freddie Mac. So where are we headed, and what is the collateral damage the past year on the mortgage industry? Mike Fratantoni is the Mortgage Bankers Association chief economist, and Danielle Hale, Realtor.com chief economist. Nice to see you both. Danielle, we'll start with you. It has been a difficult start to the year, but rates are, as we mentioned, coming down. How optimistic are you that things are turning around as we enter the spring and then the peak summer season?
Yeah, I think we've seen the low in existing home sales. So I think we're going to see home sales go up from here, especially if mortgage rates remain in the lower end of the range that we've seen recently. But it's not going to be a quick climb. I think it's going to be a pretty slow climb and probably a little bit uneven too. So as consumers, buyers, and sellers get used to these lower, slightly lower mortgage rates that are still much higher than they were, almost double what they were at the start of last year. So it's a different environment, but the consumer is slowly getting used to this new normal.
Yeah, and Mike, where do you think rates level out? I think people are expecting them to get below 5. It does not appear to be the case.
Yeah, typically we think about mortgage rates as a spread over 10-year Treasury rates. Ordinarily, that would be about 2 percentage points above a 10-year Treasury, but lately they've been 3 percentage points above. A lot of that reflecting the incredible financial market volatility, uncertainty about where the Fed's headed. We've had a banking mini crisis as well, concerns there that how that's going to impact the MBS market. We do think that rates will drop below 6 as we get through the year, though. And that certainly will bring more buyers into the market.
Yeah, will it be enough to unfreeze both sides is the question. To the broader damage, MBA data shows banks and mortgage firms lost money on home loans last year. How significant was the damage, Mike?
So if we go back to 2021, your typical mortgage lender had a profit of about $2,300 per loan. Last year, they lost about $300 per loan. And this is despite the fact that lenders were doing everything they could to cut costs. Peak employment in the industry was in late 21. Lenders have cut about 18% of their staffing thus far, but industry volume fell 50% last year. So still more consolidation, still more cuts likely to come. And the purchase market remains about 30% below where we were last year at this time. So a really challenging environment for mortgage lenders.
Those are some shocking numbers. Danielle, when you're losing $300 per loan, what's the impact on buyers, on sellers, on the industry?
Well, I think the report highlights that it wasn't just buyers and sellers that have had to adjust to some really seismic changes in the financial landscape. So the industry had to shift to, and everyone has had to be pretty nimble. And, as the market was going through this transition, it made it really difficult to know what to expect. How high were mortgage rates going to go? What did that mean for affordability for buyers and sellers? Does that mean, do I hurry up and try to buy now? Do I wait it out and try to buy on the flip side as mortgage rates eventually come down, which many expect? What's interesting is that even though we've seen mortgage rates start to ease, as inflation seems to be getting under control, the labor market is still largely chugging along, consumers are still expecting mortgage rates to be a bit higher. So that may mean as we see these dips in mortgage rates, some buyers are going to try to take advantage of these opportunities to get into the market. And in fact, we saw that with the February existing home sales data, that home sales surged in response to lower mortgage rates to start the year. And so we may see this up and down as mortgage rates fluctuate up and down in the sales environment in the year ahead.
Of course, inventory remains a massive issue. Some more stunning numbers from MBA there, Mike. Just 32% of mortgage firms were profitable last year, down from 98% 2 years prior. What does this mean moving forward for loan conditions for buyers and for sellers?
Yeah, so 2021 was a record refinance year, and given that so many homeowners refinance to rates of 3% or below, there's just not that refinance opportunity right now. So that's the major scaling factor for the industry. But as I mentioned, with rates more than doubling last year, as Danielle said, purchase volume is way off too. And some of that is affordability, but I totally agree with where Danielle was going, where we're seeing in our purchase application data, any week you get a drop in rates, home buyers are back in putting in applications for a mortgage. And really the constraint is on the supply side, the only 2.5 months of inventory on the market in terms of existing homes. So it's been a very challenging environment for lenders. I think from the consumer's perspective, that means you've got a lot of lenders out there who are more than ready to help you and help you get that right loan for that home purchase.
That's interesting. When you take this all into perspective with the SVB collapse, how much more difficult, or maybe to Mike's point there, Danielle, is it going to be easier to get a loan in the next several months as we get into the hot summer season?
Yeah, I think, this year you're not going to have the same refinance demand as Mike was talking about. Lenders are eager, they're looking for business. So as a consumer, it probably makes sense to shop around. That's always a good idea, but especially now in these market conditions where you might find lenders that are more or less willing to work in your situation. As Mike noted, inventory is still a problem, even though we see that the number of homes on the market is up about 44% compared to a year ago. They're still down about half from where they were before the pandemic. So it's a bit of a glass half full, glass half empty. Depending on your comparison point, things are a bit better, but there's still more room to see improvement in the market to get things back to where we were before. The other thing that I would note that's sort of a good news, bad news story for buyers, homes are sitting on the market a little bit longer. That gives them more time to make decisions, which is especially important for first-time home buyers who want to take the time to make the right decision. On the flip side, we're not seeing as many homeowners decide to sell, and so there's not as much churn or refresh in the housing market. A lot of the additional homes that are on the market today have been sitting for a while. So if you're looking for something very particular as a consumer, you might have to wait a little while to find it or loosen up your criteria in order to get into a home that works for you.
Mike, is now the time then for prospective buyers to feel empowered and to shop around and have a little control over the type of loan they can get right now?
Well, I think in terms of the home selection out there, that's really the challenge, right? Just not enough properties to look at. And I think some folks might get the impression with this overall picture that, home prices are dropping, but honestly, we're not seeing it in the national data at this point. Certainly West Coast, mountain states are seeing some declines. So I think, wouldn't want to give a buyer a false impression that this is a weak market where they're going to have a huge amount of leverage. But compared to where they were last year or the year prior, I think that buyer does have more leverage in the home buying process. And then, as I mentioned, in the lending process, absolutely. You got thousands of lenders out there who are very eager to work with you, given the challenges they're facing in terms of drumming up new business.
Home builder sentiment rose in April for the fourth consecutive month. The NAHB citing low existing inventory for driving confidence. Joining us now is Jerry Howard, National Association of Home Builders CEO. Jerry, always good to see you. So got the chart behind us of the home builders sentiment, and you see it ticking up quite a bit from the beginning of the year, but we are nowhere near these levels from January 22. Those were in the mid 80s. We're still in negative territory below 50. What do we need to get back up the mountain?
Well, building costs are still, I think, the strongest wind that's in our face right now. Building costs, because of material costs and labor costs, are really an issue. Also, there's still some unease in the banking community, and that's making it particularly difficult for builders at the front end of the pipeline, where they buy the land. Acquisition, development, and construction is the term of art. An AD&C loan, those are a little bit harder to come by. Mortgage rates are pretty steady, below 7. That's good. Not great, but good. But we still got to get the cost of capital for the builders themselves down. So cost of capital, cost of materials, cost of labor, those are the things that are bothering us right now. Then, of course, you add the regulatory environment. This administration is much more pro-regulation than the previous administration, and that adds to costs as well.
Jerry, Ines here. Talk to us a little bit about the cost of capital, the lending requirements that you were mentioning. I mean, how is this affecting the industry?
Well, I'm starting to hear more and more builders say that their banks, and builders generally get their loans from regional, small, local banks. As a result of the crisis out there in California, that a lot of the banks are being a lot more cautious about lending in general and to builders for acquisition, development, and construction in particular.
Boy, that is really interesting. I have not heard that to this point, Jerry. A lot of people wait for bank CEOs to kind of tell them about the state of the economy. What are your builders telling you that gives you a good sense of where this economy is headed?
Well, we had forecast going back to last winter that by the end of this year, we should be back to a pretty healthy housing economy. And I still think that that's the case. As I travel the country, as I talk to builders all over, the demand is there. The fact that there is so little existing inventory on the market is beneficial. So I think that if we can get some of these costs down a little bit, or at least in control, that we could have a pretty good fourth quarter and going into next year.
And you mentioned the building materials, that those costs are still high. Do you see relief on the horizon anytime soon? What are you forecasting?
We're very concerned about building material costs. The supply chain is still not back to what it was pre-pandemic. It's taking a long time to get things. Some of the geopolitical issues in the world are impacting the supply chain, and even our relationship with Canada and the possibility of getting more consistent supply of lumber from our Canadian neighbors to the north is problematic. So I don't really see a whole lot of relief on that front. So we're going to have to look at it from the regulatory front and the labor front, hopefully.
Of course, underneath all this, Jerry, are mortgage rates, which have been ticking down pretty steadily, but also appear to be leveling out a bit. Where do you think we'll be later this year in terms of the average 30-year fixed? And as long as it's above 6, is it going to be enough to unfreeze this market, to get buyers and sellers off the sidelines?
We'd like to get it down below 6, obviously. I'm not overly optimistic that that's going to happen. But on the other hand, I'm not overly pessimistic that it's going to go higher again either. I think you're going to see mortgage rates stay in the mid-6 range.
And are builders offering incentives to buyers?
Builders had been lowering their prices pretty consistently over the fourth quarter of last year and into the first quarter of this year. That trend seems to be slowing down significantly. Other incentives that they were offering were upgrades on specific components of the house. I think that's probably going to stay in place for a while.
And finally, inventory been another major issue underlying everything. 1/3 of inventory new construction compared to a little more than 10% historically. Telling you what, and when does that dynamic change?
Well, that dynamic changes when people start to put their existing homes on the market, whenever that is. Right now, I think a lot of people who potentially would have sold and maybe downsized if you're a baby boomer are deciding to remodel, renovate, and stay in place. That's an issue, and it's only going to exacerbate the fact that we're about 1 million or more housing units short in this country. If we can't build more and they're not going to put more on the market, we're going to still have a bottleneck there.
We're getting a glimpse at the state of the housing market this morning. U.S. housing starts declined in March as building permits plummeted. This data is closely watched by economists for a look at how the economy is faring as the Federal Reserve battles inflation and as mortgage rates skyrocket. For more on the state of housing, let's bring in Adam Beam. He's a founder and CEO of Beam, a fintech company for contractors that helps them get paid more seamlessly. Adam, so you're on the front line. You're seeing the payments that go to the contractors. What are your observations about the overall health of the construction industry right now?
Yeah, thank you, Inez, for having me. It's a really good question. And, we see that generally construction is a very diversified industry. And so residential contractors, if housing starts to decline, they switch to other types of products, major home renovations, additions. So, generally the best construction companies are not seeing a slowdown. If anything, they're having trouble getting access to the skilled labor that they need to continue building more housing.
And I'll get to that skilled labor in just a second, but are you seeing a sort of bifurcation when it comes to commercial? Because I know that you deal with both, with commercial and residential, when it comes to commercial construction versus residential construction.
Yeah, so I can't speak broadly of the market here, but what I do see is that we're seeing a shift from new construction of office buildings to interior renovations, tenant improvement, et cetera. So the same is true in commercial. It's highly, highly diversified.
Interesting. Are you seeing it because there's now talk about office buildings that are going to be turned, or the idea of turning them into residential? Have you been hearing from from the industry players there about plans to turn some of these office buildings into apartments, let's say.
Yeah, you hear about it. It's happening in Texas. It's happening in other states with more relaxed permitting rules. But overall, it's a very difficult process. We don't have any contractors today who are doing that. But I'm certainly excited by that idea. And we need more housing. Connecting back to housing starts, inventory is at an all-time low. We need to be building more housing. When we zoom out, we see that we're in a housing crisis. And so despite the number of housing starts going down on a month over month basis, we still need to be building a lot more. And so Beam looks at the market in more of a 10-year view. And we know that we need to be building more housing.
And staying on that housing theme, do you see different areas of the country that are tighter than others areas of the country? I mean, because there are some states where you have more housing starts, and in other states you've got the blue states where there's not as much. So what are you observing?
Yeah, it's a hyper local industry. And so the statistics we're seeing are really aggregated across the entire country. But if you look at a specific city, or if you look at a very specific even municipality, you're going to see a very different story. And so what we see, I'm here in San Francisco, we see a lot of development of ADUs, accessory dwelling units. We see a lot of major home renovations. We're not seeing as many housing starts. But if you go to the Midwest, you'll see a lot of new housing starts. And it's just the nature of the industry is it's very, very localized.
And let's talk for a second about the labor market when it comes to construction, because during a slowdown, and when there's a slowdown, construction is really the sector where you see sort of the deterioration happening. But we're not necessarily seeing that in construction. So is there still a very tight labor market when it comes to the construction industry?
Completely. We are in a 600,000 skilled labor job shortage. So there's openings for 600,000 skilled laborers. And that is really the prevailing statistic in the industry. If housing starts to decline by a couple percent, that doesn't change the fact that we are missing skilled laborers. And so really what Beam's thinking about in the long term is how do we get construction businesses to be more efficient, to have access to more capital so that they can hire more workers, train more workers, and build up that skilled labor pool. That's going to drive construction prices down. That's going to make it easier to build more housing. That's going to get us out of this housing crisis that we're in.
And how has the recent banking crisis impacted, if at all, the construction industry? I mean, have you heard from construction players about lending standards, about concerns about lending standards?
We don't work too much on the lending side of things, and so I don't have much to say there. But what I can say is that a lot of construction businesses and a lot of contractors do work with small regional banks. They saw, I think, most of what happened with Silicon Valley Bank as kind of a one-off. Folks that we work with were not particularly concerned. I think that mortgages overall are we're seeing in the numbers that folks are still able to get them. The interest rates obviously are higher, and so it comes at a higher cost, but we're not seeing sort of broadly any major shifts there.
Indeed. Well, we have a housing sector health check this morning with single-family housing starts for March coming in 2.7% above revised February numbers. Building permits also out this morning, falling sharply in March. For more on the state of the housing market, we're joined by Moody's economist Matthew Walsh. Matthew, thank you for joining me. So this week, we're obviously getting at least a sense of the tone of what's happening in the housing market at the moment. What are your biggest takeaways from the data we have so far?
Yeah, thank you for having me. It's great to be here. I think the biggest takeaway right now is that, we're at a bit of an inflection point in the housing market. The construction data is always a bit noisy, but the trend is undoubtedly clear right now. We're seeing that, home building has stabilized. That began late last year, and we're definitely seeing that in the data. There are a few other things I think I just want to call out. I mean, the big thing is that February's data was revised lower. This was a seasonably warm winter, and that has largely affected the seasonal adjustment process. So, as expected, we saw February's data revised a bit lower, and it's definitely important to take this data with a grain of salt.
And so overall, we're still monitoring very closely where median prices are coming in at. Matt, what does that signal to you about where the broader housing market stands, given some of the recent notches lower or declines that we've seen on those average home prices?
Yeah, I think, we saw home prices come in a bit. They definitely are falling a bit slower than we saw the first half of last year, or the middle half of last year. The declines are largely due to affordability, which is still a really big problem in the housing market. With mortgage rates coming in slightly from where they were in October, they peaked just north of 7%. That has helped improve some of the affordability issues and brought some buyers back into the market. But just given the rapid pace of appreciation over the past 2 years, home affordability is still a major problem. And one thing that we look at here at Moody's is overvaluation, which is a great signal for where home prices will continue, where home prices can fall, and to the extent of which they'll fall over the next year. And while overvaluation is coming in a bit as median home prices fall, they're still very high relative to their historical values.
And so then how can we expect this to decline at some point? Obviously, you have rising interest rates. So if you're already an existing homeowner, you're not going to want to sell and have to take on higher interest rates. At what point will we see perhaps a sharper decline in some of these house prices, given the inventory is still so tight?
Yeah, that's a great question. I mean, for one, I think we're not expecting really sharp decreases. Certainly what we're going to see is nothing like what we saw in the last house price correction. We should see, a much slower decline than what we saw before, and even slower than what we saw in the first bit of this house price correction. We're expecting prices to come in about 5 to 10%, depending on the index that you look at over the next 2 years. One thing I think is important to note is, we're entering that spring home buying season. And while inventories are low right now, we should start to see inventories creep up as a lot more people decide to make the move. I don't think we don't plan to see any large increase in inventory. People are locked into those ultra low interest rates. But as more people decide to make the move, I think we can expect some increase in inventory levels over the course of the spring.
If we continue to have an affordability problem, how much does that continue to also trickle into the rent scenario and the calculus around where rent prices continue to moderate, especially in major metropolitan cities?
Yeah, that's another great question. I think, it's important to kind of break out the difference between the multifamily side and the single family side. While we still see, the single family side, particularly constricted in terms of availability of homes and availability of rentals, we're going to see this pretty significant increase in multifamily completions over the next year. Right now, we have a record number of units that are under construction, and multifamily compose a significant share of that. And as those units come online, we should start to see some of the high rents that we witnessed over the past 2 years come in quickly. I know recent data is showing some declines on rentals for the first time in quite a while, and that's on a year-over-year level. So, we are starting to see those rents decline a bit, and obviously that has major implications for the inflation picture.
All right. And Matthew, we have these home improvement stocks that are up there at the moment. A lot of people, when COVID first hit and they realized they weren't going to move, started doing a lot of home improvement. We did start to see that taper off. There's only so much improvement that you're going to do in your house over a certain period of time. What are your expectations there, and how much spending you think consumers are still willing to do on home improvement?
Yeah, that's one thing that we're keeping a close eye on here. I think as the housing stock gets older, we'll definitely see a lot of spending on home improvement. You have a lot of people who are kind of stuck in place right now just because there are not so many homes available. And people are locked into these low rates. So they are choosing to invest in their own home because they're in a way forced to stay there. So they're taking some of that money that they would spend on a down payment that they maybe can no longer afford, and invest in their current property and spend on renovations or remodeling or things like that.
Bad news for home buyers today. Mortgage rates back up after 5 straight weeks of declines. The 30-year fix jumping to 6.39%. That's from 6.27 according to Freddie Mac. 1 year ago, those rates 5.11. So what does this mean for the state of the housing industry? We welcome in Nicole Bachot, Zillow senior economist. Nice to see you. So what do you think this means? Are we going to plateau right at this rate and remain frozen in the housing market for the rest of the year?
We're not really expecting rates to move dramatically from where they are right now. This kind of 6.5% that we've seen bouncing around over the past couple of weeks is pretty likely to be somewhere within that realm for the rest of the year, right? We're not going to see the rates we saw in 2021, coming back anytime soon. What we are seeing right now is inventory is super low on the market, and that's really what's causing a lot of the fluctuation, as well as these rate increases that are really, blocking both buyers and sellers from being able to interact.
Nicole, you just mentioned those inventory levels. Are they going to improve at all, given the fact that maybe the spring buying season we could see a little bit more traction?
So we've seen prices starting to increase this spring, but I think a lot of that is just due to the fact that those buyers who can't afford to shop are shopping, and there's not any homes for them to look at, right? We have these sellers who are locked into their 3% rates and aren't really willing or able to give up that home, and they're sitting on that existing inventory. Our new listings are way down. That's leading to overall inventory remaining tight, and that's going to continue to, lead to high prices and affordability challenges.
Existing home sales in today down 2.4% from February, down 22% year over year. Tells you what about the road ahead?
So, that shows us, again, both on the side of sellers not being able or willing to list their homes because of the low rates they're locked in at, and also buyers facing these affordability challenges. Both sides are leading to those lower sales numbers, and affordability is really the sticking factor there. And mortgage rates do have the biggest impact on mortgage affordability in this market.
Pricing, what are you seeing on a regional basis? And I guess, what does that signal just in terms of what we could expect here for the remainder of the year, possibly?
So we've seen some price stabilization and kind of price corrections in some markets, that especially markets where affordability is the biggest hurdle. We're looking at Inland West and West Coast markets have seen, some of the larger kind of price corrections happening, just as we're getting back into a place where we can find mortgage affordability again. And it looks like it's going to be, honestly, a pretty long time before we're back to what we historically saw as, what mortgage affordability should look like. So, as far as regional changes in prices, those Western markets have seen a lot of movements, but really we're starting to see things kind of picking up again this spring across countries, across the country, in different regions. As the spring, like I said, the competition is coming back into the market with, buyers ready to buy and few homes that are available for them to look at. That's going to increase prices across the board.
Yeah, of the National Association of Realtors, the numbers they have out today, 3 regions up, and then the West down 7.5%. And the numbers we saw yesterday from Redfin showed Boise, Idaho down 15+%, and Austin and Sacramento and San Francisco all down double figures year over year. But are they still okay in terms of pre-COVID numbers? Are you underwater? Are you still doing okay if you own a home out west?
Yeah, when you hear something like down 10% or 15%, in home prices, that can be really shocking. But when you look at the fact that a lot of those markets were up 40-50% from 2019 levels, we still have the vast majority of homeowners in a really good position when we look at equity. We still see foreclosures near historic lows. We don't have a lot of people underwater or in distressed situations. And this market is pretty friendly to folks who need to sell their home, if that's an option that you wanted to face. Being able to sell your home on this market is really easy, and in terms of there are a lot of buyers who are going to be willing to look at it. So.
Nicole, what are you seeing from a rental perspective? Because I'm looking at the latest numbers here from CoreLogic showing that growth is significantly slowing. That has been the case over the last couple of months. Is that consistent with what you're seeing, and by how much?
Yeah, so we are seeing rents starting to slow down a little bit, about 0.5% down in terms of rent prices from the last month. And, that just tells us that, we're seeing this affordability issue in rentals as well. We're seeing, a lot of folks kind of staying put where they're at. And as we've had the kind of a shift over the past several months from single family construction to multifamily construction, getting those multifamily units out there has been able to increase the rental vacancy rate, which does put less pressure on prices. And that affordability kind of breathing room for renters is going to be really helpful in a time that we've had a lot of challenges in the economy and there are a lot of hits to budgets. So finding that stabilization in rent prices is going to be really helpful for renter households to be able to recover.
When you're the Zillow senior economist, you probably get a lot of friends texting you at questions like, when is a good time for me to buy, Nicole? What do you tell them?
Yes. Yeah. So, when the right time to buy for you is a really personal decision that has a lot of factors that don't have to do with the housing market. If you're looking at, how do I time the market right? It's really important to, first of all, have your finances in order, understand what it's going to take to get you qualified for a mortgage and understand what price of a home and what price of a mortgage you can realistically qualify for. Get your credit up. Work with multiple lenders to make sure that you're getting the best rates and quotes and
but
fees.
But Nicole, I'd be texting you back. I'd be saying, I know all that. When are conditions going to be favorable for me to jump back in this pool?
Yeah, we're not really seeing a market that's going to be super, super friendly in the ways that, we've maybe seen in the past, at least for the rest of this year, right? We're still going to see rates being challenging. We're still going to see inventory being challenging. And so really working to find ways to make this market work, buying discount points, using a 2-1 buy down, tapping into down payment assistance resources. Those things are going to be able to help bridge that gap for those looking to transact in this market.
And let's also get an economist's view of what is going on with housing, with the Fed expected to keep interest rates elevated through 2023. Our next guest says the housing market will likely be in a recession through this year. Abi Omodumbi is a PNC senior economist. He joins us now. So these numbers aside for a moment, although they weren't great, housing recession this year. Talk us through that thesis. Is it going to happen? When is it going to happen? And what does that look like?
Thanks for having me. The housing market has been in a downturn since fall of 2022 due to elevated mortgage rates. We expect mortgage rates to remain elevated through 2023. And also, consumers are very concerned about the economy. Consumers are concerned about high inflation, about rising interest rates. And we expect the downturn, which started in fall of 2022, to continue through 2023.
And so with this kind of combined with where financial conditions currently sit and the prospects for financial conditions, is it going to be easier or harder for people who are looking to get into the housing market to get a loan that not only they qualify for, but is also on favorable terms for them over an extended period of time?
So financial conditions will likely tighten in 2023. We do expect the Fed to raise the Fed's funds rate by 0.25 percentage point when they meet in 2 weeks. And also, after the bank failures in March, many banks are likely to be more cautious. So we might see some tighter lending standards. So we are forecasting that, we are going to get a 10% decline in house prices this year. There will be more of a balance in the housing market. There will be less demand and more supply, and that will contribute to the decline in house prices, which we're currently forecasting.
And as we know, the housing market is really different region by region. Even what I was just talking about for this past month's existing home sales, right, that the Northeast was fairly steady, the other regions fell. When you look at that 10% price decline, what does that look like sort of region by region? Or is that, more the average everywhere?
All right, so we saw massive price increases in, many areas in the West, right? So think of Boise, Idaho, San Francisco, San Diego, those were clearly unsustainable. So I think we're going to see bigger increases in the Western states. And also just on a month-over-month basis in recent months, we've been seeing bigger declines in the Western states compared to the Eastern states. And I think that is likely going to continue through 2023.
And so additionally here, let's talk about some of the housing starts and permits particularly, because they fell in March, and some of them really driven by declines in multifamily segments there. Where do we expect that to begin to balance out?
Right. So we saw big declines in the multifamily segments, but we actually saw big increases in single family starts. So starts were actually up for the first quarter of this year. But I think that's, for the rest of this year, we're likely to see a decline in starts due to higher financing costs for home builders. We've seen an improvements in home builder sentiment in recent months, but it's still below the key break-even measure of 50. So home building conditions are still bad. I don't expect there to be a substantial improvement of that this year. So I think we're likely to see a decline in starts and permits through the end of this year.
Abby, what does all of this do for home ownership rates? This is a conversation that Brad and I have frequently, right? There's especially sort of millennial home ownership and affordability, et cetera. Is this drop, I mean, even if it's not a great thing for the overall economy, does it allow more people to get into the housing market?
I think, home ownership has been difficult for a lot of folks, particularly first-time home buyers, given the big increases in house prices, which we've seen, particularly, since the pandemic started. I think that's, conditions will be more favorable for first-time homeowners this year, particularly because of the declines which we're expecting. So I think that we are going to see, more of a balance this year. We're going to see weaker demand due to higher financing costs. We're also going to see more supply come online. So we're going to see a lot of new construction that's going to come online, and that's potentially going to be beneficial for first-time homeowners.
What's the correlation that you're seeing, Abby? And I mean, even as we think about first-time homeowners, and I, as a millennial, kind of initiate my frowny face sequence because I'm just trying to get into that cohort of people who do own homes. Living in New York makes that harder. But anyway, at the end of the day, where should I be going to? I mean, a lot of people were talking about the regionality of where some of the inventory that's coming online is shifting, where some of these sales are shifting to as well. How is that correlating even with what we're seeing on the employment situation front, where you've got people who are looking to still maintain employment, but at the same time look for more affordable terms that they can live within, regardless of where that may be in the country, as long as there is a job available for them? How do you kind of compare the two together and meld the employment situation with the housing data?
Yes, so I think that's after the Great Recession, one of the reasons why we had a Great Recession was because, we built too many homes. But we've had very tight supply for the past decade. So I think that, there will need to be, some improved supply in terms of new construction. And I think that's where new-time homeowners, will be able to, tap into that. They'll be able to probably buy once we see improved construction of new homes, and which we expect. So I think that as inflation moderates and as supply chains continue to improve, we're going to see more construction come online, which, again, will be favorable to new homeowners.
The latest minutes from the Federal Reserve says economists believe that the banking turmoil will trigger a mild recession later this year. But does that mean that you should put the search for your dream home on hold? Joining now to weigh in on the considerations home buyers are making in today's market, we've got Columbia Business School's Paul Milstein, who is the professor of real estate, and Christopher Mayer, thanks so much for taking the time here today. First and foremost, Chris, what should people be remembering when they are looking at the environment right now, looking at the Fed's policy pathway and hearing what bank execs are saying, while at the same time just saying, look, guys, I'm just trying to buy a home. I'm just looking for the spot of my dreams.
Look, as far as I'm concerned, I think they should first focus on let's buy a home and how to think about it. But I will say that it's the economic environment is a very tough environment. When I was on here about a year and a half ago, I think my kind of headline quote was, now might be one of the worst times to buy a home in the coming year that there has been in a long time. And I still think it's a pretty tough time to buy a home right now. It's the macro environment is tough, but there's also just not a lot on the market, and there's probably not going to be a lot on the market coming, for quite some time.
Let's talk about that quite some time for a moment, Chris. It's Julie here, because are we talking about potentially a generation in Gen Z that will never buy their own home, potentially? In a higher proportion than
no, I think sometime is kind of a year or 2, 3 years. The lifetime is a little bit longer, But, I will say that for a long time, we've seen the home ownership rate declining in this country. If you look at sort of young people, we're talking decades, not just a Gen Z issue. And, that's really been driven by challenges. Wages at the bottom in the middle of the income distribution haven't been keeping up with, the housing market and even with the cost of living. And so it's gotten tougher for many people to be in a financial position to buy a home. And credit has never really recovered from where it was, not just in 2005 and 6, but even in the early 2000s. Credit has continued to be tighter to buy a home, going forward. So times have been challenging for those folks. I think for the Gen Z people that are looking and saying, are we, thinking about buying a home at some point, which includes my kids at some level, I think the answer is yes, they will be able to do so. But, a lot of the houses, right now with interest rates having fallen so much during the, 2000 to 2020, 2021, a lot of people who owned homes refinance mortgages. And there are a lot of people out there sitting with 2 3/4, 3.25% mortgages. And those people are just not going to be anxious to sell their homes in an environment where the new home they have to buy, that trade up home, is going to be, at an interest rate of 6.5 or 7, even at 6. So a lot of those folks are going to say, look, I'm going to renovate. I'm going to kind of stay in the home. So that's the sense that there just aren't, a lot of the homes that would have been traditional starter homes, I think people are going to be staying in longer. And so I think that's going to open up the market for home builders and new construction in a way to make the case to people to try and trade up a little bit. And I think home builders may also want to start to kind of move, down market a little bit and try and build more of the kind of housing that first-time home buyers would want to get. So some of this really is a supply issue as much as a demand issue.
Yeah, I mean, I'm telling you, my searches have really changed from Toll Brothers homes to now just cars that have a good frunk. So at the end of the day, I mean, the search patterns have changed. The prices that we're looking to pay have changed so drastically. Have the credit scoring practices changed enough to really keep up with all of the different payments that we make, to give a better sense of the payments that we are able to make on a timely manner, to give us kind of a better shot at getting approved for a loan, even when we're going for something as large and as equitable as a home purchase?
Yeah. So I will sort of say one of the big focuses of the Biden administration from a housing policy is to try and open up access to home buying, to look at alternative measures of credit for people who may not be fully participating in the traditional housing finance system, but make their rent payments on time and have made the rent payments on time for years. And so there has been a big push to create alternative credit scores that are ways to broaden access to credit to, traditionally disadvantaged groups of people. And that's been a very important focus. I think we've seen some action there, and we're going to see more, both at FHA, VA, and at FHFA, Fannie and Freddie. So I think there is a push to broaden access to credit, to have alternative ways to look at that for folks, because it is, for some people, I think there are people who historically would have been able to buy a home, but the tighter measures of credit that people are looking at now are saying, gee, we're going to make it harder for you. And I think those are people who could and should buy homes, were able to sustain home ownership historically. And, we got to a home ownership rate in this country of 69%. And that was a good thing, not a bad thing. And lots of those people were able to continue to make their payments. And we should be able to provide a broader amount of credit into the market.
And just quickly, Chris, for those who are not, aside from home buying for a minute, if somebody wants to invest in real estate, and I know that's a big bucket right now, what's the best way to do it? Is it buying home builder stocks? Is it buying fractional, multifamily? What do you think?
I think if you're looking at investing in real estate right now, I would start with real estate investment trusts. They've been beat up a lot. You can buy, shares of office REITs or apartment REITs, even, to some extent, single family, where, particularly office and apartment, where you're able to buy at very significant discounts to the market. I think the buy to rent is a tough business, and you've seen institutions pull out of buying new properties, and the iBuyers have bought out. because it's sort of a lethal combination of home prices that are very sticky on the high side, rents that where there's pressure to start falling a little bit, and very expensive credit. And the combination of those three things doesn't make it great for sort of buying with an investment horizon. At the moment, it works if you're trying to live in the home over a longer period of time, but it's a tough market for investors. And I've never been a big fan of fractional ownership other than in vacation homes, where I think there's a thesis there. But, selling a fraction, buying a fraction of your home, having somebody co-invest with you, unless it's a relative, go focus on trying to get an FHA loan. Those are available, buy the home, save a little bit for a down payment. The traditional way of buying a home is still the best way to do it. The fractional things are often expensive and not great deals for consumers, who are buying a home to live in it, or, rent to own. Those business models are more expensive than just doing the things the old fashioned way.
Consumers are more confident in the housing industry, but it's a much better time to be a seller than a buyer, according to a recent survey by Fannie Mae. Redfin's chief economist, Daryl Fairweather, joins us now to discuss why some of the homeowners are quiet quitting the housing market. Really? My goodness. Okay, so quiet quitting, how does that show up in some of the numbers that we've been tracking here economically?
Well, homeowners were able to lock in 3% mortgage rates during the pandemic, and they don't want to give those up, especially if they have to move. They're going to be facing a 6.5% interest rate. So they're just bowing out. New listings are down over 20% from last year, which is really constricting inventory and means that if you're a buyer, there isn't much to choose from, and you're still going to be competing for those really desirable homes on the market.
So what is all of this doing to pricing, right? Because on the one hand, if I'm a seller and I don't want to rotate into a higher interest rate in a new house, I would be asking more if I was going to put my house on the market. But if I don't put my house on the market at all, and then there's tighter supply, that would imply higher prices too. So what's happening?
Well, given how high interest rates are, we would have expected prices to come down a lot, but because there's not any new listings, it means that buyers are still competing. Prices are down a little bit. They're down 3% from last year. That gap may grow a bit, but for the most part, home values have already adjusted to these high rates, and a lot of buyers are looking at the interest rates and just saying well, I want to buy a home, I'm just going to have to put up with it, especially for first-time home buyers.
Are there demographic shifts or shifts in even consumer behavior that you anticipate having an outsized impact on the housing market over the course of this year?
Millennials are the biggest generation. They're entering into that age where they want to have a family, settle down, buy a home, and they're all doing it at the same time, which is why there's still this competition, especially for those desirable homes. Condos, on the one hand, aren't getting much competition because you might as well rent if you're going to get a little condo in a big tower, but those single-family homes that have a yard, that are moderately priced, are still getting a lot of competition.
So demographic effects, let's also talk regional effects. I'm going to call him out. We have a British producer on our team. And he says, I don't understand when you have in this country such a divergence in housing markets, say on the different coasts or middle of the country. Talk us through the different trends we're seeing in different places.
The West Coast is being hit hard by these mortgage rates because homes are so expensive. So when you're looking at $1 million plus home, a 6.5% mortgage rate adds up to potentially $1,000 extra a month. A lot of buyers just don't want to stomach that, and they're still moving. They're still leaving these expensive coastal areas for the center of the country, for those more affordable markets. The Northeast and the Midwest have been really stable through the pandemic, and so they're still stable now. And then Florida was on fire during the pandemic and continues to go up in price. People still want to move to Florida.
What about areas that have been more impacted because of weather and how that factors into the consideration of what region you're buying a home in? Where have you seen that kind of either moderate prices or moderate the market in entirety?
For the most part, the climate hasn't really translated to a difference in prices. We did an experiment at Redfin where when we posted flood data, we put some people in the control, some people in the test to see the impact of seeing that flood data. And people did choose homes with lower flood risk. But on net, people are still leaving the more resilient areas for climate on the coast and going to places like Florida, which obviously isn't very resilient, and also the Southwest. People are most concerned with affordability over things like weather or climate.
That seems to sort of set us up for disaster, doesn't it? But that's a whole other conversation. How long does it take to get back to a more normal place in the housing market? What is that what would normal even look like?
We really need to build more homes, and that's where I'm a little bit more optimistic because the jobs report just came out. There are new construction jobs being added. We're seeing builders out there because people can't buy existing homes. There aren't many for sale, so they're moving to new construction. And that's going to help the inventory in the long run. When the housing market does come back, when mortgage rates come back, I'm optimistic that there's going to be more inventory because of this added supply of new construction.
Amid all the talk around recession, and for some consumers, depending upon their economic income scale, they're already feeling that. And so how does that change, even if you're looking for a house, how has that altered where you could potentially pick up savings in a home, say on your energy? Are people looking for more energy efficient homes or ones that they could convert into energy efficient homes as well?
I think that's a really smart thing to look at. A lot of people just look at their mortgage payment or their property taxes, and they don't consider things like how much energy is costing them or water. And water is becoming more and more in short supply in places in the Southwest. So I think homeowners, it is a good idea to look into things like drought-resistant landscaping, to think about insulating their home so that they can heat it more efficiently. And there are these tax credits now from the IRA, which might help them with that.
Sort of on a similar note, we keep asking, and it occurs to me, we keep asking a lot of different CEOs, are people trading down? Are people trading down when it comes to houses? Are they looking at smaller houses, for example, right now that are more affordable?
Well, the luxury homes, those big homes, are the hardest to sell right now because if you're pinching your budget, you're going to downgrade from, say, the 4-bedroom with the bonus office to work from home to that 3-bedroom or 2-bedroom. And there's also a demographic of people, the baby boomers, who are looking into retirement. They may be selling their home, taking their equity, and then buying a smaller home with cash. That way they avoid the whole mortgage problem, and that's probably fueling a lot of demand for Florida, people retiring as well.
And then on the kind of policy pathway that we're on right now for the Fed, I mean, even though they've continued to rise, when there is finally that cut, are we expecting just a wave of refinances out there?
I do think people who have bought a mortgage at 6.5% are planning on refinancing when mortgage rates come down. It's going to be a bit of a timing problem because if they start coming down, they may say, well, they're down to 5% now. Maybe they'll be at 4% next year. Maybe I'll wait. So I don't think it's going to be a wave. I think it'll be more a steady stream of refinances as people seem to want to refinance and get that lower mortgage payment.
Mortgage rates are declining for the 4th consecutive week. Freddie Mac reporting the average 30-year fixed rate at 6.33%, the lowest since September. Rates may be coming down, but they're still a lot more than double what they were a year ago. A Bank of America securities note finds that about 95% of current mortgage holders have rates at 5% or lower. Definitely not the environment most owners want to sell in. Shauna?
All right, well, let's discuss how this will impact the housing sector. And for that, we want to bring in Matt Vernon, Bank of America, head of retail banking. Matt, we'll get to this new survey in just a minute. But first, just your take on what we heard from the mortgage rates falling for the 4th week in a row, the lowest that we've seen since September, the implications that will have for the real estate industry.
Hey, it's nothing but good news for the industry. We saw a massive and abrupt change here over the last 6 months that has certainly shocked the system for a variety of different reasons and certainly put questions on consumers' minds on, is this a good time to enter into the home buying market? So any movement like this is nothing but good news to help our clients get back into the market for sure.
There really are two camps forming at this point, Matt. And one says, yeah, we'll probably lose low single digits into 23 and basically level out. But there is a complete opposite side of the school that says we are looking at a crash, perhaps a 20% peak to trough decline in home prices. Which are you in?
Yeah, we're probably on the latter of that. We would say as we look at next year that home prices are going to flatten out from a historical appreciation over the last 2 years to more of that 1% to 2% level next year. You could certainly see some market variability across the country, as you would imagine, but we certainly don't believe that we're going to see that crash that the latter there would have said.
Matt, supply has long been an issue here with the real estate market as of late, I should say. You're out with a new Homebuyer Insights report taking a look into whether Gen Z and baby boomers, if they do plan to move out of houses that they had prior to retirement. What did you find?
Yeah, interesting enough, baby boomers and Gen X make up 70% of all households that out there, close to 80 million households that are out there. And of that 70%, 78% of baby boomers and Gen X say that they will stay in the home that they are either in, they've retired, or the home that they're going to retire into. So you can imagine with that large population of those two groups, that's going to put more stress, more challenge into the inventory challenges that the market's facing today.
Yeah, and what are the implications of those numbers on the broader housing sector?
Yeah, I think the biggest implication is it's going to exacerbate the inventory challenge that we're seeing. If you look back to pre-pandemic, we had about 1.4 million homes listed. That number today is around 787,000. And the fact that the millennials and Gen X make up a disproportionate portion of the denominator at this point just makes that even more challenging. Couple that with the fact that we've got stagnant housing growth from a development perspective, so the builder business, and then you've got pent up demand, just makes this mortgage market even more challenging than we've seen recently, for sure.
Matt, why are most baby boomers and Gen Xers deciding to stay in their home? Is it all because of rates and where home prices are today?
You know, it's a combination of things. It's one, they love the home they're in. They've made memories there. They've raised children there. They've done a lot of things, so they love it. They've also improved it over the years, so they think that this is the home and it has that which they need for going forward, and they really love it. Now, rates is certainly playing it. Affordability is certainly playing into it, and finding that next home is playing into it. But more than anything, the survey 78% said it's because I love the home that I'm in and I'm comfortable in the home that I'm in.
Maybe if you get rates back in the 3 range, they start to love it a little less, right? Because now they're going to pay way more. So that dynamic could certainly change. What is, largely speaking, the inventory story, both in single and multifamily?
Yeah, it's certainly at near all-time lows. We're off of the trough that we were in, call it 3 and 4 or 5 months ago. Supplies roughly 3.5 months. But that number that I mentioned, 1.4 trillion down to 700,000 plus, that is an extremely low number for us, but it still gives about 3.5. Now, good news is, I think Mortgage Bankers Association recently came out with some numbers that said in October, inventory is up 38% over a previous quarter. So we're beginning to see the market listings come back for sure.
Real estate company Zillow saying that if the U.S. does default on its debts, mortgage rates are going to go through the roof. Joining us now is Zillow senior economist Jeff Zucker. Jeff, it's good to see you. Jeff Tucker. Sorry about that. Jeff, break this down for us. When we talk about the impact that a debt default is going to have on the housing market, mortgage rates are going to jump by how much?
Yeah, we have estimated that they might jump as high as 8.4%. Based on the current relationship with the 10-year Treasury yield. And really at the root of that, what it's coming back to is the concern about systemic risk in the financial system as everyone begins to doubt the collateral and their counterparties anytime they're making loans. What that means for consumers and home buyers is borrowing costs are likely to rise really substantially.
To what extent has it already seeped into the thinking around home buying right now?
I don't think we've seen too much impact yet. We've certainly seen the 1 month and the 3 month Treasury bills already see their yield rise pretty astronomically in the last couple of weeks. I think a lot of folks are still, expecting and hoping that a resolution to the debt ceiling crisis comes along so that this won't actually impact those long-term yields, long-term borrowing costs. So at the moment, I don't think it's quite yet filtering through. But just because it's unlikely doesn't mean it's impossible. And so one of the reasons we did this research was just to highlight what a serious issue it is and why it is so important to come to a resolution on the debt ceiling and hopefully never find out exactly what does happen if we crash through it in default on the debt.
Yeah, hopefully we don't. Jeff, what are you seeing just in terms of activity today and how that compares to some of the expectations that we had headed into this year when we initially thought that maybe mortgage rates would be a little bit lower than where they are today?
Yeah, borrowing costs do remain high. They've been quite volatile. They're still bouncing around between 6.25% and 6.5% on a 30-year mortgage. That's a lot more interest that home buyers are paying. And I think maybe the biggest surprise of the spring home shopping season is how many buyers are kind of forging ahead in spite of that. Buyers kind of went missing in action in last fall and last winter. There was a lot of concern that home prices might even decline this year. And instead, a lot of buyers have kind of come back to the market, They're out there shopping for homes. Yes, it's a lower level of activity. Fewer homes are trading hands. But a big part of the reason for that is when those home shoppers have returned to the market, they're not finding as many listings as they would have hoped for, or as we would expect in really any previous spring selling season. There just aren't that many new listings hitting Zillow every week as we would expect or as homebuyers would like to see. So the ones that do come to the market are getting a surprising amount of competition and actually seeing the prices get bid up again.
Well, that was my next question there. What does that mean for prices? I mean, you have to imagine those who maybe sort of sat out for a few months, coming back into the market, realizing the inventory still isn't there, but the same buyers are there. That's got to be a bit demoralizing. I mean, how much higher are prices spiking right now?
So luckily, they're not spiking. You know, we're not back to the frenzied spring shopping season of 2021 or 2022. Our home price index is rising at about a 1% pace, not seasonally adjusted. So that's not a spike, but it is a sort of competitive spring shopping season. Homes are selling in a median of 10 days to go pending. That's a bit slower than last year when it was just 6 days for the typical home to go pending in April. But, you know, compared to any time pre-pandemic, that still qualifies as a very fast moving market. So I think that underscores for buyers that, you know, it's not too hot to handle like it may have felt last year or the year before, but you need to be prepared to move quickly in a market like this. If you see a home that you like, you need to be pre-approved, you need to be working with an agent so you can be one of those folks who makes an offer on it within the first weekend or by that offer review date on Monday or Tuesday.
Higher prices, higher rates, certainly a tough environment for prospective home buyers. Jeff, when you talk about the inventory issue right now, do you see that improving at all? And what will it take in order to get there?
Yeah, the inventory is quite low. I think part of the story is that so many existing homeowners locked in a mortgage at 3% or less in some cases. And so for them, if they need a big mortgage on their next home, that presents a really high hurdle to moving. They'll pay a lot more interest when they move. I think it's important to remember, though, that many home buyers own their homes outright. Many of them, many of those folks who might move maybe are thinking of retiring from, you know, Boston or Seattle, moving to Florida or Phoenix, and they might be able to buy that home they're retiring in cash. So there's a lot of scenarios where people could be coming off the sidelines. I think as folks hear the news that that homes are selling quickly and prices haven't actually particularly fallen, that could draw some more sellers out. And then probably the elephant in the room here is new construction. So home builders have absolutely heard this news that there's not much existing home inventory to compete with them. So they are kind of filling the void. They are continuing to crank through and complete the homes that they started building last fall, last year, as they suddenly see buyers lining up to buy them again.
Mortgage rates ticking down just slightly this week. The 30-year fixed falling to 6.35% from 6.39% the week before. Now, this is the second straight week of declines. Rates climbed to 5% in April of 2022 and have stayed above that line since then, apart from just 1 week. Although there are some signs inflation is cooling slightly, the Fed's tightening cycle has kept mortgage rates high. And there's a new complication that could actually raise rates: the stalemate in Congress over the debt ceiling. Now, Zillow reveals mortgage rates could soar above 8% if the U.S. defaults on its debts, sending the average mortgage payment up 22%. For more on this, we turn to John Lovallo, UBS U.S. Home Builders and Building Products Equity Research Analyst. Good to have you on the show here. So I'm wondering, are your predictions about what would happen with a debt ceiling default here, would they be as dire as what Zillow is projecting?
Hey, Rochelle, how are you? Thanks for having me. Frankly, look, if there's a default on debt here in the U.S., we've got some big problems that extend, well beyond what's happening in the home building industry. I can tell you that, I read the article that Zillow put out there. It's interesting. I think the math is sound. If you go from 6.5%, mortgage rate to 8.5% on a $450,000 average new home in the U.S., your payment's going to go up by about $7,200 per year. That's about 22%. Would that? I think a lot depends on how long this sort of crisis lasts, and how long consumer confidence is really strained. So we'll have to wait and see. I don't have a prediction on what it would do for mortgage rates, but we are in a situation where affordability is challenged, and so anything that negatively impacts interest rates would be negative.
And you figure this is coming at a time where, the Fed's still debating whether or not to hold interest rates at the moment. What are we likely then to see happen between now and then as we get closer to that X date?
I think that there could be incremental pressure up on interest rates. I think if you look at affordability from a housing standpoint, it's important to think of in two components. One, there's the interest rate component, which we're clearly speaking of. There's also home prices. And I think that, those are the two levers that need to adjust in order to find the clearing price in a market for a home. Home prices have remained very resilient, which I think is a testament of the demand that's out there currently. Also, the fact that there's very little existing home supply, only 2.6 months, in fact, of existing home supply on the market. So, there's various things that could happen. I think at the end of the day, we're looking at a market that is underbuilt, and there is a tremendous amount of pent-up demand that's still out there. And so we still remain, fairly optimistic on the overall market.
And as you mentioned there, you have fewer listings that also helping, push prices up, steady buyer demand as well. In terms of affordability, when do you expect that to pick back up? Because it's still a very tough time, especially if you're a first-time home buyer.
It is a very tough time. I think that what's interesting, and going back to the fact that there's very little existing home inventory on the market, to the extent that folks are looking to buy a home, they are more inclined today than probably at any point in history to look at a new home. And what the home builders have been able to do, many of which own their own captive finance companies, is to help buyers find that clearing price, whether it's through incentives on lowering the actual price of the home, or actually what's been happening more often is buying down interest rates. And they have the ability to do this because of the captive finance arms that they have. And so buyers out there today that are buying new homes are not paying 6.5%, that, the headline rate. They're paying, under 5% in most cases. And so I think that, that sort of lever is very important to keep buying, the buying wheel continuing to turn. And we think that, that positions the public home builders in particular extremely, extremely well here in this environment.
And we know you track what people are searching for in terms of, home buying. So what sort of price points are we looking at? And we know that the Sunbelt regions were doing well, but we're starting to see some nuances showing up there as well.
Yeah. So, the Google Home search note that we put out showed that, essentially normal seasonality as we moved into, April on both the new home side and the existing home side, which is encouraging and sort of what's to be expected. The average new home in the U.S. right now is about $450,000. I think to your point, Rochelle, as you move into sort of the hotter areas of the market, the Sunbelt states, if you will, depending on the market, because this is a very localized business, home building, prices could be significantly lower. And I think that's where we're seeing the hottest demand is if you look at price points that are, sort of with a 3 handle on them. Just if you think about Texas and Florida, different markets across, those states in particular where things are particularly hot, that's really where the hottest demand has been. Now, the consumer in general, or the home buyer in general, has been pretty resilient. And so there's been demand across the spectrum, but we still think that the sort of the hottest part of the market is that first-time entry-level buyer, where both the buyer, which is very need-based and driven by life events, and the home builder are able to sort of, again, meet that clearing price by maybe building a smaller footprint, maybe moving a little further out from the city than perhaps would have initially been desired. But there are ways to still make that math pencil.
Well, in a post-pandemic world, office occupancy hovers just under 50%. That's according to a report out from Castle. Now, many workers still opting for hybrid or full-time work from home. But what if work was your home or extremely close to it? Enter Elon Musk. The Tesla CEO has purchased land near Tesla facilities outside Austin, Texas, where he reportedly plans to build a community for employees dubbed Snailbrook. That's according to a Wall Street Journal report. Now, Snailbrook isn't Musk's first foray into a corporate community. In 2021, Musk encouraged employees to move near SpaceX Starship facility in Texas. The concept of a company town is not new and was popular practice in the turn of the century for mining and railroad companies. But in an age where less folks are traveling to the office, could companies like Tesla incentivize workers with affordable and nearby housing? Shimon Shakuri, founder and president of Ariel Property Advisors, joins us now with a deeper dive into what this could mean for the future of work. Great to have you on the show here. So this is a curious proposition here, something, I know we've seen it in, with companies like Foxconn sort of building these communities, having people closer. How do you see this working, though, in this day and age?
First of all, thanks for having me. I think that we always have to look at the bigger picture of why this is happening. And one of the things that we learned about is statistically by 2035, the United States will be short 4.3 million housing units based on the National Multifamily Council. And I think that's a really important statistic to understand. We are in a housing crisis. The second statistic is from my hometown, which is New York City. The Real Estate Board of New York is telling us that we'll be missing 560,000 units in 2030. And when it comes to that, there are two elements that policymakers, public officials can help with. One is they focus on regulation, which is important for low-income housing, but they focus less, unfortunately, in many cases, on the incentives to build more housing, which is the supply side of the equation, which is super important. So you're mentioning the Elon Musk situation where he said that he left California because of overtaxation and overregulation, and that's part of what's happening. I think he's looking for solutions that are beyond what the public officials have been presenting. And I can give you some examples or some successful examples of what has happened in New York City over the past few years that was successful and what's happening now that's a little less successful.
Yeah, let's get to some of those examples because, so that way we can get to the reality of what's been working and what hasn't been working so far.
Perfect. So between 2010 and 2020, New York City added 117,000 residential rental units. That's 68% of the total construction that took place in the residential world. And most of it was because there was a 421A or Affordable New York tax abatement. So residential developers had the incentive to develop residential rentals with a component of affordability. However, that program stopped in June of 2022. And you see that the first quarter of this year has only 9,000 plus scheduled permits. And that's about half of what it was the quarter before. And I'll tell you that that's going to decline because of these misalignment in incentives. And incentives, by the way, are sometimes something that the cities can do that doesn't cost them much. The first incentive is zoning. When you provide the zoning to or allow more density, you're really essentially allowing the building to be built or a bigger building to be built within the same location. The second thing is the tax incentive that I just described, the property tax incentive. If you have a vacant lot today, it doesn't produce tax revenue. If you build a building, if you incentivize the developer to build a residential rental building, it's adding housing and it's adding jobs. And in the future, while that tax abatement phases out, you can benefit from taxes as well.
But Shimon, what about tying your fate essentially, not just now your job if you take on a job here, but also literally the roof over your head? If you get laid off and you've already tied your fate and your housing to a company, I mean, surely that's not something a lot of people are comfortable with.
Yeah, it's a great question, and it's a social question that we have to ask ourselves. And, if you live in a community that provides you with housing and with your job and you have to move away, that could be an issue, but it's not really different than living in any city, right? And being laid off and having to pay the rent in a way. So all of these items needs to be taken into consideration. And that's when regulation comes to place. In case of, low-income housing or low-income needs, we definitely as a society have to take care of that. But it's the supply side of the equation is the one item that we all have to focus on moving forward to mitigate that housing crisis. And that's part of what I think that our elected official should think about. It does need political courage. I want to say one more thing about our elected officials, because I got to give credit to the mayor of New York City and to the governor. They have been discussing the supply of housing and the incentives of supply of housing here in New York City in the biggest possible way. I really hope it trickles down to the rest of the elected officials. We have great leadership. Let's make sure that we build more housing here.
So for some, perhaps, private companies who want to sort of take things into their own hands when it comes to affordability, I mean, even Mr. Beast, aka Jimmy Donaldson, known for his philanthropy, bought a neighborhood, in Greenville, North Carolina, where he grew up, for his family and for some of his employees to be able to commute closer to work. Some backlash, a lot of people a little bit uncomfortable with that. But what do you think about the role of some of these private sort of corporate communities being involved as they do wait for more affordability from lawmakers and for prices to come down?
Yeah, I can give you examples from the commercial world, actually, here in New York City. One of the things we've seen in office that Google is building their own campus, for example, here in New York City. So private companies are doing that. JP Morgan is building their own offices here. So private companies are investing in real estate for the benefit of their employees on a commercial level. When it comes to the residential level, I think that that larger companies are sometimes taking or trying to help communities. We've seen that with Amazon. We've seen that with Google. They're not acting directly, investing in their employees' housing. They're investing in their communities. And I think that makes a lot more sense because, again, you're living in a certain community, you're working in a certain community, and as a corporation, as corporate America, you are investing in affordable housing in these specific communities, which I think makes a lot of sense and the right social elements to it as well, if that makes sense.
April housing starts rose a little over 2% after a dip in March, but building permits and completions both saw declines. Joining us for more on the housing market, we've got Robert Dietz. He's National Association of Home Builders chief economist. Robert, good to have you on today. A bit of a good with the bad in this report when you consider, number one, the pace of completions at a 15-month low, offsetting the housing starts that we saw hit its 7-month high. To what extent is this a sign of things to come when you consider credit is tightening and you still have material shortages?
Yeah, it's a reminder of the challenges the market faces. We desperately need new inventory. The level of resale inventory for single family homes right now is less than a 3-month supply. There are actually more realtors in the country than there are single family homes available for sale. Builders are ready to begin to step up production. In fact, we have seen now 5 straight months of increases in the builder sentiment indicator that we publish here at NAHB. That's a good indicator that builders are feeling more confident about the market. That's driven by low levels of inventory. But the availability of credit, building material challenges, and the ongoing labor shortages all represent significant obstacles for construction. So, the only way we're going to solve the inventory crisis is by building more homes, but that challenge continues.
Robert, what does the timeline look like on that, just in terms of how quickly or lack thereof, I guess how long it could be until we see substantial improvement when it comes to inventory?
Frankly, it's going to be a few more years. There's a lot of different estimates of the structural housing deficit that the United States faces. My team believes it's about 1.5 million homes. There are larger estimates out there. Freddie Mac believes it's 4 million homes. But on the single family home building side, we really need to be building a little bit more than 1.1 million single family homes a year in order to meaningfully reduce that housing deficit. Right now, say 2023, we're probably only going to build somewhere between 800 and 900,000 homes. So that's just not going to do it. And that means it's going to be continuing a frustrating environment for prospective first-time homebuyers.
Yeah, those numbers you just put out there, pretty sobering and point to just the dynamic in the market right now and how uneven that is. We have seen a lot of buyers, or at least sellers, or incentives driving sales. To what extent can that keep pace with the demand?
Yeah, I mean, demand definitely weakened at beginning in March of last year. So builders in particular were using things like mortgage rate buy downs to induce demand in the market. That actually was successful because one of the things that we learned was the sweet spot in the housing market right now appears to be getting long-term mortgage interest rates near or right below 6%. According to Freddie Mac, mortgage interest rates are right at 6.4%. So our expectation is, as we clear the point at which the Federal Reserve has stopped raising interest rates and bond markets begin to anticipate slowing macroeconomic conditions, then mortgage rates will settle in by the end of the year in that 6% range. So the demand is going to come, But the challenge is going to be on the supply side. The resale inventory is not going to hit the market because you have a lot of homeowners sitting on 2 and 3% mortgage rates, and they don't want to sell their home because they don't want to give up that low rate. So you're not going to get help from the resale side. So it's got to come from new construction. And of course, builders continue to face the fact that building material costs are up 35 to 40% from where they were pre-COVID. So there's a lot of obstacles in the way. I think this is something that's going to play out for the remainder of this decade. That's how long it's going to take to reduce that structural housing deficit.
So, Robert, despite all that and all the challenges that lie ahead for home builders, we are seeing their sentiment improve just a bit. But we're right around 50, the break-even level. What are you hearing in terms of the optimism that's out there? What's behind that?
Cautious optimism driven by lack of inventory, which is competition in the new construction space, but ongoing concerns. One that's picking up right now in particular is impacts from some of the challenges faced by regional banks. For most home builders, in order to build a home, they've got to go and acquire land, develop lots, and actually construct that home before they sell it. So that requires access to builder financing. And about 85% of that financing for private home builders comes from community and regional banks. The average rate of a development loan right now is above 10%. So that means a slower lot development pipeline, higher development costs, and ongoing challenges with inventory.
Have we already started to see that pullback when you talk about the direct correlation with the struggles we've seen in regional banks? I mean, you highlight that there's already been a 5% decline in deposits.
Yeah, a little bit. Yeah, the 5% decline in terms of bank deposits is part of that story. I think the prime factor here is just the increase in the prime rate, which of course is a direct consequence of the Federal Reserve increasing interest rates. So yeah, anecdotally in our surveys, builders have said it's gotten more difficult to obtain that kind of financing. And we're particularly seeing that, by the way, in the multifamily space. So our expectation is we're going to see a fairly large slowdown as we head into macro weakness on the apartment development side.
Robert, in terms of what you're seeing on a regional basis, where are the strongest housing markets today?
Yeah, I mean, when you think about the single family home building market, more than 50% of it is in the South. 3 of the top 5 top building markets are in Texas. 3 of the top 10 are in Florida. And there are some pockets of strength outside the South. The mountain states, which did experience a fairly large slowdown in 2022, we expect them to rebound because they've got strong population growth trends. And there's pockets of strength in the Midwest. Examples would include Columbus, Ohio, Indianapolis, places where housing affordability offers a real advantage for home buyers and employers. So, we've seen a lot of challenges in the coastal markets. That's going to continue, and that's due to lack of land availability and higher regulatory costs.
Yeah, the cloud hanging over the sector, of course, has been when are we going to start to see this rate hiking cycle ease? When you look to 2024, are we likely to see the bounce back then in the first part of the year? How do you look at that in the context of the housing market right now?
Yeah, our forecast is like everyone else's. We think the Fed is effectively done, maybe one additional rate hike, but unlikely. So the expectation is that the 30-year fixed rate mortgage will settle in at near that 6% level by the time we get at the start of next year. So, we think single family home building right now is forming a bottom after about 3 quarters of significant weakness. We'll start to see the monthly data improve during the second half of this year. And that means 2024 is going to see a year of growth after years of decline in 22 and 2023. And then, as I said earlier, 2025 through 2030 look like a pretty good runway for home building growth, given that ongoing structural housing deficit.
Yeah, we're looking at existing home sales for the month of April, falling by 3.4% month over month to an annual pace of 4.28 million here. So seeing some continuing weakness on the existing home sales front. I should also mention, by the way, we got the index of leading economic indicators falling by 0.6%. That was in line with economist estimates. But the housing data has really been sort of mixed and confusing, if you will. I was just noticing on an anecdotal basis, we keep talking about how tight supply is. Yeah. But as I was driving around my town yesterday, I was seeing quite a few for sale signs. A lot of them were already under contract, though. So it seems like maybe they're still getting, I don't know, the days on the market has been lengthening a little bit. And I know it's very region specific, but I was surprised to see a new crop of those signs sort of popping up that I hadn't noticed before, for what it's worth.
Does it seem like there's a lot of traffic going into to some of those open houses too then?
I don't know. It wasn't a Sunday, so I can't. That tends to be the day, right, that you get that kind of stuff. So I'm not quite sure if we're still seeing that traffic. But as we look through the data from the National Association of Realtors, and they talk about this stuff, it does seem like that things are kind of muddling along here, and we're not seeing a lot of improvement.
Yeah, and even as we're thinking about where, and you mentioned the regionality, that's going to be amazingly important to keep in context here as we move forward, because that'll give us an idea of where affordability actually still is right now. When we think about some of the major metropolitan areas and even kind of marrying that to where employment shifts have taken place too, for those who are still working from home, to Elon Musk's chagrin or not, there is a much larger consideration of where new home buyers, millennials especially, can start taking on home ownership. And for this period of time, it'll be interesting to see where some of the dust settles on a regionality basis as well, considering the shifts out of some major cities and even into from one major metropolitan area into another that might be more affordable and favorable on a price perspective. Well, joining us now for more on the state of the economy and specifically the housing sector is Jose Torres, who is the Interactive Brokers senior economist, alongside Danielle Hale, who is the realtor.com chief economist. We've been talking about retail all week. Let's talk about realty right now and real estate here. Danielle, when we consider where the market sits right now, what is a significant trend that you see emerging that could perhaps set the tone for when the housing market starts to come back in full force?
Yeah, I think if you're looking at when the housing market starts to come back, you've really got to look at affordability. So you've got a good number of people that would like to buy homes, but prices are still high and mortgage rates are still relatively high. They've come down in some recent weeks. But if you look at March mortgage rates compared to February mortgage rates, when a lot of these April home closings we're talking about would have gone under contract, they were still up about 0.25%. So, it's not huge. It's certainly not the leaps and bounds we were seeing 0.25 point a week last year, but it does mean mortgage rates are still a bit of a headwind. So I think seeing those mortgage rates come back down to below 6% is going to make a bigger difference for shoppers in the market today. I think it's also going to help on the inventory side. So we know that a lot of existing homeowners, roughly 2/3, have mortgage rates that are locked in at or below 4%. And so the narrower that gap is between market mortgage rates and the mortgage rates that people hold on their existing mortgages, the easier it is for existing homeowners to make the decision to move and trade up. But right now, the incentive just isn't there. As long as their home is a reasonably good fit for their needs, it's hard to make the case for moving.
Yeah, that definitely makes sense. Jose, how much of a headwind is this? How much is this holding back overall economic growth that we are not seeing a more robust housing market?
Well, thanks for having me. Well, real estate makes up about 20% of the economy. So when transactions go down, there's a lot of income weakness across, from realtors to durable goods manufacturers to construction companies and all of the above. And really, I think a lot of what is going to determine where the real estate market's going to go is where inflation's going and where the Fed is going. If you think that rates are going to stay, long-term rates that is, higher for longer, then it's hard to make the argument that the real estate market has already hit a bottom. I think as the consumer continues to slow, as the labor market softens, as the unemployment rate ticks up, I think the real estate market is going to soften further in the second half of this year as we descend into recession.
Jose, just to say with you for a second, what is delivering a new home getting any more easy for companies? Is there any kind of improvement in that side of the housing market?
Well, absolutely. You've had lumber prices come down significantly. You've also had supply chains improve a lot as well, and that's helped builders deliver homes. But again, the affordability situation is a particularly significant headwind, and affordability has been a headwind with a robust labor market. As the labor market begins to slow, pandemic savings begin to dwindle, I'm expecting the housing market to continue to be cool and transactions lead prices like in earlier cycles. We're seeing the same thing occur with office real estate. Transactions are down significantly, prices not that much because sellers are reluctant to want to sell into this market, but eventually they will have to. And I think the same thing is going to happen in the residential real estate market, albeit at a more tempered level, because the work from home headwinds aren't there like they are for office. And residential real estate, of course, is helped a lot by that work from home trend that allows folks to have more flexibility with where they live.
Danielle, I want to turn to the rental market as well as part of all this, because I know you guys just came out with some research as well that there was single-digit growth in the rental market for the 9th month in a row after 15 straight months of declines. It looks like rental rates, median rent, up just about 0.3%. Is that portion of it sort of good news on the inflation front, that we're seeing that increase in rents moderating a little bit?
It is. So we've seen, as you mentioned, that moderation in rents for 15 months. Rents were up well above double digits, almost 20% on a year-over-year basis before then. So it's a significant cooling. And one of the main factors that's been driving inflation recently is shelter inflation. And that includes prices of rents, an estimate of owner equivalent rents that are based on market rent. So when we see rents moving up, it tends to push up inflation. Now, we've seen rents growth moderate, as I noted, for 15 months. The reason we haven't seen that picked up in inflation yet is because the government looks at transaction prices for not just transaction prices, but rents for all homeowners and renters, so people living in all housing units, whereas our data is looking at advertised rent prices. So the market is a little bit faster to adjust for those landlords with vacant units that are looking to fill them to rent. And we're seeing that adjustment slow. For a lot of renters who didn't move, say stayed in their same unit, their rents grow a bit more slowly than market rents. And so they still have some room to catch up. That's why we're seeing that inflation number continue to tick up. But we do expect we're going to see it slow. In fact, actually, in the most recent data, it dropped down just a tick from 8.2% to 8.1%. It's not a huge improvement, but I think it's the beginning of a more continued easing in that inflation measure for rentals. And that's really important for overall headline inflation.
Yeah, Danielle, as a person who stuck around New York, I don't want to catch up with the rate of growth that we have seen in rental. But, you know, if there is one thing that could help with how much people are paying for rent on a monthly basis, it could be the number of new build outs that are set to come online as well. Is that going to kind of mitigate any concern or any of the pain or pressure that renters are paying right now?
Yeah, absolutely. So we've talked about underbuilding in the housing market, in the for sale market, but that has also been the case in the multifamily market. We just have seen a slower ramp up in response to the aftermath of the last decade. But right now, we have a record number of multifamily units under construction. It's almost as high as the peak of single family construction in the mid 2000s. So there is a significant amount of multifamily that is going to hit the market in the next year or so. And that is going to help. Rental units have seen a record low vacancy rates or long-term low vacancy rates up until the most recent quarter. We saw a very modest uptick above 6% for the rental vacancy rates. But until those rental vacancy rates get back closer to 7%, I think we're still going to see some pressure on the rental side of things. But with the number of multifamily units under construction likely to hit the market in the months ahead, I think we're finally going to see some easing on the vacancy pressure and the shortage pressure that has helped drive rent increases up so much.
And Jose, a broader inflation question as well, as we think about these rental rates, as we think about housing prices for that matter. How are you looking at the overall inflation picture and where we are still seeing sort of the most acute upward pressure? We heard, for example, from Walmart today saying it is still seeing input cost inflation. So how are you thinking about the big picture here?
Well, I think services are the primary driver, and that tends to be particularly sticky. Wages are also rising at a pace that is totally inconsistent with the Fed's 2% inflation target. And like Danielle said earlier, shelter is also cooling, but is it cooling down to a 2% inflation level? And the answer is no. While rents nationally are cooling, rents in some areas of the country, like in New York City, are at record highs. So I think taken together, services continue to be the primary threat on the inflationary front, and services are also working itself through expectations. We saw earlier in the University of Michigan's Consumer Sentiment Survey, expected inflation over the long term ticked up pretty dramatically. And that is affecting consumer behavior. That is affecting employer behavior. That is affecting landlord behavior. And it all looks like we're entering into a new regime of 4% inflation. And if the Fed is serious, and I think they are with Powell at the helm, about getting to that 2% target, then further monetary policy restraint is warranted. And under those conditions, I think that unfortunately, we're going to have a little bit of a soft patch in the second half of this year.
U.S. new home sales rising unexpectedly in April, hitting its highest level in just over a year as inventory issues push buyers to new homes. This comes as Americans also navigate elevated mortgage rates, making real estate a pricey game to play. Joining us now, Nest Seeker's international chief economist, Aaron Sykes. Aaron, it's great to see you here. So certainly an impressive number when it comes to new home sales. What does this really tell us about the current dynamics at play and the edge that it seems builders do have in this market?
Yeah, well, it's finally nice to report some good news in the housing market. And I'm excited to see this, particularly because typically these numbers are very lagging. This is numbers from April, and we've seen a lot of traction via boots on the ground agents in the last month or so saying that activity is picking up. So this just reiterates that that is actually true. And I think what happened here is that developers are industry insiders. So this number that is 13% or the best number in 13 months, it's developer-owned property selling to buyers, not resales in the market. And that's particular because these developers, they're the industry insiders that knew what was coming. They saw the foreshadowing of the current market, and they reduced their prices and enhanced their, different attributes in order to make deals happen. And we're actually seeing prices of new homes 8.2% lower than this time last year. So they really made quite a few concessions. Now, in contrast, independent sellers, those in the resale market, homes listed on MLS, they were holding fast for, those COVID highs. They thought that they could still get those numbers. But we've seen the price reductions kick in towards the end of April, throughout May, and now we're getting back on the same page. So we're seeing even footing between these new homes and resale homes.
Yeah, bottom line, though, even though we're talking about a 13-month high, the reality is the supply just isn't keeping up with demand. That's certainly, as you point out, why we're seeing so many new home sales or that pace accelerate. What's the timeline look like right now? When you think about the mismatch between supply and demand, I mean, how quickly can we see that inventory build up from the new home side?
Yeah, so it's really tough because right now developers are not pulling the trigger on new single family home construction. And that's because materials are still very high and also labor is still costly. So they don't see that margin. Developers are not fully altruistic. Just because there is a shortage of inventory in the market doesn't mean that they're going to build things for cost. So they need to make sure that there is meat on the bones in order to motivate them to build these new homes. And that said, there is a dearth of supply in the multifamily market. So when we look at new home starts, we typically see that number driven by multifamily, and we've been seeing the single family pull back for quite an extended period of time. And that's where the true inventory shortage lies. So you need to see that pick up, and then you'll need to see multifamily pull back a little bit. And the reason why we're seeing so many people interested in multifamily is because condos tend to be less expensive, less square footage than single family homes, lower maintenance. People are splitting their time between two different locations now with the remote work from home. And unfortunately, people are getting into the perpetual renting cycle. When you look at the potential of having a 7% mortgage versus paying the highest rent in history and potentially never getting out of that rental cycle and never owning a property and just paying your landlord's mortgage, 7% is not so bad. Ask our parents, they were paying 18%.
But the problem is, though, Aaron, a lot of people don't believe that, or a lot of people don't see that, at least right now. So what do you think mortgage rates need to fall to in order to spur that activity? Are we talking 6% or lower?
So typically we say 6% is that tipping point. Anything above 6% is kind of high, anything below is a win. But if you look over the 50-year historic average, we see that that number is 7.77% as the average mortgage rate. So really anything below 7.77% is still truly a logical number to get into for a 30-year mortgage. And I think people are coming to that realization. They were very hesitant to pull the trigger and make offers on homes the last 6 months, but we've seen that activity pick up because we keep hearing the Fed over and over again say, hey, we're not going to drop these rates until we see 2% sustained inflation. That just doesn't mean 1 month of reading at 2%. That means 3, 4, 5 months reading at 2%. That means these rates are not going anywhere anytime soon.
Pending home sales at a standstill last month, high mortgage rates and low inventory are keeping buyers on the sideline. And in the latest week, mortgage rates jumped. The 30-year fix now at 6.57%. That's according to Freddie Mac. Joining us now is Jeff Tucker. He's at Zillow, a senior economist. Jeff, great to see you here again. So mortgage rates headed higher for another week here, highest level that we've seen in just about 2 months. How big of a chill is this higher rates environment going to have on the housing market, which is already struggling to regain some of that momentum that it's lost?
That's right. Mortgage rates are in the driver's seat for the housing market this year and really for the last 12 months. Those higher interest rates have taken that typical monthly payment from about 24% of the median household income just 2 years ago, now up over 36% of that typical household income. So for a lot of buyers, they're already stretched to the breaking point by, interest rates closer to 6%. So as it's kind of hovering back up, lifting off closer towards 7%, that's going to push even more buyers out of the running. And for many buyers who still kind of push through and find a way to buy a home, they need to adjust their budget and maybe shop for a smaller home or shop in a lower priced part of town, which is something we're seeing all over the country. That activity and demand is holding up a little bit better in sort of the bargain neighborhoods and cities in metro areas, while it's actually taking the biggest hit in those kind of pricier neighborhoods.
That 24 to 36% jump is pretty incredible when you think about how much buyers were already stretched trying to buy, especially first-time buyers. What does that shift look like when you say we're starting to see a shift in neighborhoods largely because so many buyers are being priced out? What are the hotspots now?
Yeah, so what that actually means is, when we ask are prices falling, for instance, it really kind of depends on where you look. So prices have come down, especially in, sort of ritzier suburbs. So here in the Seattle area, that would be places like Bellevue and Redmond, what we call the East Side, often kind of centered around big tech employers. Sort of these nicer suburban neighborhoods are actually seeing listings kind of linger on the market for longer. Meanwhile, more affordable neighborhoods and more affordable cities are actually still seeing homes sell quite quickly. They're still selling at prices above what those same homes would have sold for last year. That is also kind of affecting the sales mix. So I think it is actually making that median sale price decline look a bit steeper than it actually has been if you kind of control for quality, just because more of that sales mix is moving from these kind of ritzy neighborhoods to more middle-class neighborhoods, because that's where people can still make the math pencil out to afford a mortgage today.
Jeff, you talk about affordability being a huge issue, mortgage rates going back to that, trending to the upside. Do you think we'll see 7% again before the end of the year?
It's certainly a possibility. I think at the moment, there is probably some uncertainty bleeding into the bond market, bleeding into the mortgage market, from all the uncertainty about the debt ceiling. So it could be that if that gets resolved in a timely way and the markets finally get a little bit of that relief, then we could see rates kind of cool back off. But if this gets drawn out and kind of gets ratcheted up to the last minute, that could continue to put some upward pressure on mortgage rates. And of course, the other source of uncertainty is, what is the Fed going to do? We're all kind of on pins and needles wondering, are they going to pause here? Are they going to keep hiking? Every day we get more data about the macroeconomy. Even today's release was kind of mixed news, where GDP looked strong, but gross domestic income was surprisingly weak. So someone can kind of read any of this data as glass half full or half empty. And it's up to the Fed to kind of decide which way they're going to read it. And are they going to continue on a hawkish path, which would, I think, make it more likely we end up back towards 7% mortgage rates.
What does all this mean for sellers? I mean, we're talking about higher rates, right? Higher mortgage payments, limited inventory. So you think sellers are in a pretty strong position, and yet we keep hearing about this still being a buyer's market because they can negotiate down even if it's not the price itself.
Yeah, it's a difficult market for some folks to gauge. It's certainly cooler than last spring or the one before, but if you're a homeowner considering selling and you're just going to hold out until things are as frenzied as they were in spring of 2021, you'll be holding your breath a long time, because I don't think the market's ever going to be quite that big a seller's market again. And if you go out and list today, there's still very little competition from other listings down the block. In the first 4 months of the year, we've had about 500,000 fewer new listings come to market than on average in those first 4 months of the year before the pandemic. So it dropped from about 1.65 to 1.15 million, or about 30% fewer new listings. So if you are a seller, you've got a hot commodity, you've got a scarce item that a lot of people do want to buy, even if a lot of them are kind of knocked out of the running by these high mortgage rates. Some buyers are still out there. You know, we just saw the pending sales were down about 20% year over year, but it's looking like these new listings are down closer to 25 or 30%. So demand is down a bit, but supply is down even more, which is good news if you're in position to sell a house right now.
Home prices are rising nationwide as inflation remains stubborn and mortgage rates remain high as Americans compete for fewer available homes. Home prices in March were up 0.4% compared to February. Now that's the second month in a row that we have seen gains after 7 months of declines. Annually, prices rose 0.7%. For more on this, we want to bring in Craig Lazara, S&P Dow Jones Indices Managing Director for Index Investment Strategy. Craig, it's great to see you here. So 2 months in a row that we have seen the price of homes begin to rise once again. Is this the start of a new trend?
It's hard to say. 2 months certainly does not a trend make, but I have to say it's very encouraging. I mean, we had a huge surge in house prices from the beginning of the pandemic until roughly June of 2022. Then, as you mentioned, 6 or 7 months of declines. And now we're beginning to see the first increases. That doesn't say things couldn't turn around and go the other way, but I think there are at least some hopeful signs that we may have hit a bottom.
Yeah, Craig, it feels like so much of this is being driven by the lack of inventory, really. And a lot of homeowners who are still saying, or home buyers in the market, who are still staying the course despite the higher rates. Where are you seeing the biggest growth right now?
Well, the biggest growth is really coming from the southeast region of the country, and that's been true for the last 6 months or so. The leading, we monitor 20 metro areas. The biggest increase in the last month was from Miami, followed by Tampa, followed by Charlotte. Atlanta is typically in the mix as well. So very strong growth in the southeast. Where it's weakest is basically in the western, the Pacific and Mountain time zones. Seattle and San Francisco on a 12-month basis are both down in double digits. So one of the most interesting things about following these markets it has always been to see the regional differences, and that's certainly been very apparent in the last year or so.
Craig, what do you think is behind the differences? Because Miami was a little bit of a surprise to me, the fact that it's still up so significantly year over year. And this is a city that has seen a tremendous amount of price increase over the last 2.5 to 3 years.
Yeah, I think the only insight I can offer, but I think it's an important one, is if you look at any studies and from any number of places on the extent of internal migration, it's not hard to find out that California is losing population, for the first time in its history, as far as I'm aware. New York is losing population, New Jersey. Where is population growing? Florida, Texas, the other kind of warm weather, low cost, low tax states. So you have this big demographic surge moving toward the southeast, and it's not surprising given that we see the regional patterns that we do. I mean, you'd expect to see house prices be relatively strong in areas where there's internal migration, prices to be relatively weak where there's out migration, and that's more or less what we're seeing.
Craig, you talk about some of those markets that we saw strength pre-pandemic that have obviously moved to the downside. Looking at the numbers here in terms of price changes on a negative level, San Francisco, Seattle. I mean, you talk about sort of these major markets that we saw before the pandemic. What is it going to take for those markets to see a turnaround?
Oh my goodness. I think that California is having to deal with an outward migration. You can attribute that to any number of things. I mean, if you pick up any story about San Francisco, you'll see mentions of rampant homelessness, crime problems, lack of law enforcement, and so forth. It's expensive. We know that. Tax rates in California are very high. We know that. All of those things together have helped, in my view, to produce the trend toward outward migration. Now, on the other side, the technology business, of course, is dominant in Silicon Valley. It's not surprising that California has held up as at very high housing prices, even though they've come down. To me, it's part of what has to be, I think, figured out is what is the future of remote work? Are people able to have jobs at Apple and Google and NVIDIA now, the big Silicon Valley companies, and have to be there, or are they allowed to work remotely? Because clearly one of the things that's driven a lot of the trends in the past several years has been the rise of remote work. I have 3 colleagues normally in our New York office every day who are in Texas and Florida now. Those are just the 3 I know about. So if write that on a large scale, and it's a difficult environment for places like California to overcome.
It's certainly extremely challenging for those types of cities. Craig, what about when we talk about the overall challenges, obviously, that are facing the housing sector right now? Higher mortgage rates are obviously one of those headwinds. Also, just a slowing economy. What's your assessment of that, and what that means more specifically for home prices here in the near future?
Well, both of those things are clearly headwinds. Interest rates now, mortgage rates are certainly dramatically higher than they were a couple years ago. By historical standards, they're not so bad at all. But there certainly has been a trend for people. If you've bought a house with a very low mortgage or refinanced to a low rate over the period of extremely low rates, it's understandable that people would be reluctant to let go of that attractive rate. So that's clearly a headwind as it becomes more expensive to own as rates go up. And then the other, I think, is the uncertainty level. I mean, what does the economy do? I mean, do we manage to come to a slowing of inflation without a full-fledged recession? I mean, obviously, if that's possible, and I'm not certainly going to forecast that it is or it isn't, but if that's what happens, you would expect that to be relatively benign for housing prices if we have either continuing high inflation and higher rates or a recession that successfully reduces inflation. Either of those things would be bad from a housing standpoint. So it wouldn't shock me if prices remain, at least have some tailwind for the next several months.
9% fewer home purchases in the first quarter than last year, according to new data from Redfin. And after 7 months of declines, housing prices are ticking higher again. So what does this mean for the Fed decision in June? Let's bring back in Lindsay Piegza, Stifel chief economist here. All right, so to what extent is the Fed going to read through some of the housing data and make their policy decision off of where that is slowing?
Well, I don't think they're going to make their policy decision specifically on home prices or shelter costs. But when we look at inflation in totality, we have to recognize that shelter is a substantial component when we look at the CPI. So from the Fed's perspective, this will be a driving force to whether or not they feel comfortable. Prices are on a clear downward trend back to that 2% target. And in fact, as we heard from Fed official Bowman earlier this week, the lack of improvement in shelter costs will make it more difficult for the Fed to justify a change in policy, as we don't expect that headline number to continue to retreat to 2% in a more discernible way. So from a housing perspective, I do think that this is going to be one of the sticking points for inflation. Now, we have seen housing market activity slow precipitously, as you mentioned. Home sales are down, albeit that second derivative decline, meaning still positive transactions, but significantly a reduced number of transactions. But even with demand off of peak levels and supply arguably off of the low, there still is a sizable gap in terms of the housing supply relative to that demand in the marketplace, suggesting that we will see somewhat of a floor provided to home prices. That's not to say we couldn't reverse course here and continue to see downward momentum, but an 07-08 housing market, this certainly is not. So from the Fed's perspective, when we talk about over 8% growth in terms of the shelter component in CPI, this is going to complicate the picture for June, particularly as that conversation among those supporting a pause comes into play against those that point to the shelter costs and say, we simply can't risk taking to the sidelines quite yet.
But to your point, it's so funny that you talked about this is not an 07-08, because I've wondered that, and there's been, sometimes conversation around that, particularly where we see the strong pricing power in parts of the country, particularly like you think of the Northeast, when you look at data coming out of the Northeast. Do prices need to come down more, or do they even have that potential to come down more within the housing market in certain regions, especially again in the Northeast?
Well, I think it's a national issue when we talk about the supply issues. Going into this cycle, we were at a multi-year deficit in terms of supply. And so even with natural population growth, immigration, natural household formation, even at these low levels, given that multi-year deficit of supply, that's going to continue to produce a gap between that clearing mechanism where prices would fall, allowing that equilibrium. So I do think that from an affordability standpoint, absolutely, potential home buyers would like to see prices come back down more in line with a historical ability to make that home purchase. But when we look at market metrics, unless we see a significant run up in supply, it's unlikely that we see any type of price decline as we saw in the 07-08 housing market.
Lindsay, you mentioned something earlier that was really interesting, and I'm trying to admittedly wrap my own head around it a little bit more. And as you were mentioning that we're going to see kind of a bottoming setting in as more capacity comes online, I guess I naturally wonder, why wouldn't that be or create some type of resistance to the upside for pricing?
Well, I do think that it could, but you have to look at it from the demand side. And we don't expect a steady level of demand. We expect demand to continue to increase. As I mentioned, just with natural population growth, immigration, household formation, this is going to affect the other side of the equation. So we can't just look at it as a vacuum and say, this is a steady level of demand. If we increase supply, we can find a clearing level. We have to look at this as a constant moving target point, and demand is one of those key components that's going to continue to influence the level of prices in the marketplace.
They say home is where the heart is, but for those looking to find a home in the U.S., well, that path to ownership may be pretty tough to navigate. New U.S. listings falling 25% from a year ago. And with buyers facing higher rates, the state of the housing market is anything but simple. So here to give us a better sense of what is playing out across the country, we're taking a look at Tampa, Florida with Smith & Associates real estate realtor Melanie Atkinson, a look at Indianapolis with True Blood real estate realtor Dan O'Brien, and Denver, Colorado with Kathy Casey, Coldwell Banker residential brokerage realtor. Great to have all three of you all in different parts of the country. I want to go around the horn real quick just to give us a better sense of exactly what you're seeing. So let's start east. We'll work our way west. Melanie, I want to start with you. What are you seeing right now in Tampa?
Sure. That statistic that you just put up is exactly what we're seeing in Tampa as well. We've seen a slowdown in market activity in general with buyers, but we've also seen most sellers don't want to sell their house. So buyers out there just don't have much to choose from. So the supply has not increased much, which means the prices haven't dropped too much.
And then I want to jump in here and bring the rest of you all in here and see what the trends that you're seeing in the rest of your regions. Let's go out west for this one. Kathy?
Hi. So, yeah, I would like to echo that. Our market has definitely slowed down. We were at such a hot fever pitch last year, and as everybody knows, the fever is not good. So I just feel like we're slow and steady now. I feel like we have a more stable market, more sustainable market. I actually think it's better for buyers than it was last year, even though the interest rates are higher, because number one, you're not paying over asking. We're getting some seller concessions, and interest rates are high, but there's workarounds on that as well.
Dan, what are you seeing in the Midwest?
Very similar. It's still a seller's market. It's still a competitive market, but it is certainly a different ball game than it was 12 to 18 months ago. It's been quite the ride as we were seeing those skyrocketing rates last year and a lot of uncertainty of what was going to happen. Are we going to see 10% interest rates? But now, interest rates have somewhat semi-normalized, where now buyers are looking in that 6.5, upper 6 range, where they've kind of accepted, unfortunately, this is the new norm, but the expectation is that rates are going to hopefully come back down in the next 12 months and they can ultimately refinance. So there was a lot of uncertainty. The second half of last year definitely slowed down. We didn't see any kind of big dip or anything like that, but we certainly saw a plateau and a reduction of buyer activity. But so far, the spring and summer market has picked back up. We're starting to see some more historical trends as things have happened pre-COVID crazy market.
Dan, what about that buyer activity? Are buyers being more pickier in this environment?
Absolutely. They actually have a chance to think about buying a house before they have to jump in against 40 other offers. So like she was saying, it's ultimately a healthier market. Of course, now sellers are saying, well, wait a second, where are all these offers and where's the waived inspections and waived appraisals? But at the end of the day, it is a much healthier market. Things are slower. Average days on market here are actually close to 80 days, which is a very high number compared to the last several years, but I've been in the business almost a decade, and certainly that's not an uncommon number. So buyers are a little bit choosier, a little bit pickier. They have some time really thinking about, okay, if this is a big investment, interest rates are higher compared to what they were. Is this really what I want? So at the end of the day, I think it's in a good spot.
And I want to quickly get to you, Melanie and Kathy. In your regions, is it a buyer's or a seller's market or none of the above?
I would say in Tampa, it's none of the above. So in Tampa, what we're seeing is we still only have about 2 months of inventory. And one of our biggest problems is quality of inventory. So if you have a house that goes on the market in Tampa that's really well prepared, then that house typically will have a lot of offers, maybe not as much as we did last year. You might have went from 10 offers to 2 offers, but we're still seeing multiple offer situations here in the Tampa Bay area. Florida is still really a desirable place for people to relocate to. We are just seeing houses stay on the market longer, but those houses that are staying on the market tend to be the ones that are in worse condition and need a lot of help and construction, and buyers just don't want to deal with that on top of having to pay, historically high prices and higher interest rates.
Kathy?
So, yeah, despite what you see on TV shows, it's not all designer clothes, glamour shots, and fancy cars that's happening in our market right now. So basically, so our average days on market is about 34 days. So it still is a seller's market in our region. At that 34 days, it wouldn't hit to a buyer's market until we're over 90 days. So we are still in the seller's market, but it actually is working well for both buyers and sellers because as you previously mentioned, buyers do have a chance to actually look and they don't have to make a decision in 10 minutes for the house that they want to buy. Another thing that I have noted, and this was put out by NAR, that 65% of those that purchased during the pandemic have some sort of buyer's remorse. And I think that is because they had to make their decisions so quickly. And, they really wish they would have gotten, the 3rd bathroom or the 4th bedroom or in a better neighborhood. And so for those buyers, some of them feel like they are stuck because of the interest rates they got. But there are definitely ways that we can work around that. I'm starting to see a trend in lenders offering permanent interest buy down So instead of just the 2-1 buy down, we're starting to see a trend in permanent buy downs. Just last couple of weeks ago, I had a buyer that had a builder that actually brought her rate down 2 interest points. So it was 6.5 and it was brought down to 4.5%. And so because these are permanent buy downs, this really allows them to qualify for more house. So like I said, there's ways around trying to get around the interest rates and what's happening in the market, but I definitely feel it's kind of even kill for both buyer and seller, but still leaning more towards the seller's favor.
Dan, for those who are looking to buy in the Indianapolis area, what do they need to know? What's the 1, 2, 3 tips that you would share with them?
Again, it's always about being prepared. If you're a buyer and you're coming in there not having spoken to a mortgage lender about getting pre-approved, if you don't know what you really want, at the end of the day, you're going to waste your time, right? So it's always one of those as a buyer, have your stuff in order, talk to a mortgage lender, talk with a professional realtor, figure out what you're looking for. Because, I said that days on market are up. However, there are still zones that are very competitive. Hamilton County is on the north of the Indianapolis area, and it's, kind of the affluent suburb. And we are absolutely still looking at multiple offer scenarios. And, an interesting statistic here is that in Hamilton County, there have been more sales over $1 million than under $200,000, right? So in this market for Denver, that might seem crazy that we can even think of under $200,000. But here, the average price point, the median sales price in greater Indianapolis is $280,000. So, we have some areas that are still selling very quickly. Even the high-end homes, at least what we would consider high-end for this market, are selling in a short period of time. So again, to the comment of the nicer homes, still, very, very quick at selling. But if you're a buyer, make sure that you know kind of what you're doing. If you get in there, you may or may not have time to get a pre-approval letter, depending on what the house is doing, if there are multiple offers. So that's the biggest thing that I can recommend is talk to a professional, both a mortgage lender and a realtor, to kind of understand what you're looking at.
200,000, Dan, that would get you a shoebox here in New York. Melanie, I want to quickly get back to Florida because I was recently down there, not in your region, but in Miami. I noticed the heat down there. What are you seeing in terms of the cash spend? So we saw some data from Redfin showing about a third of home buyers are paying cash. Are you seeing that play out in what the data is showing you down there in Florida?
Not as much as it was before. So keep in mind that over the past couple of years, a lot of the cash buyers were actually corporate companies that were coming in and purchasing houses with cash with the purpose of then using them as rentals. We also had people from all over the country buying second homes here. They were selling houses up north. Coming down with a lot of cash because the prices were up all over the country. So people had all of this cash to spend. So either they were coming down here for primary homes or secondary ones. But for the most part, in general, because the market activity has slowed, obviously the cash activity has slowed. And more significantly, we don't see those corporate buyers out there quite as much, which is great for the lower end price points and first-time home buyers if they're not competing against corporate buyers.
Mortgage applications are seeing a boost in demand coming after recent declines in mortgage rates. Applications saw its biggest weekly advance in 3 months, increasing 7.2%. But the issue with housing affordability is far from over, leaving more room for housing demand to improve. In this latest installment of our week-long series, Real Estate, The New Reality, we are taking a deeper dive into housing construction in relation to the push and pull of supply and demand dynamics. Let's bring in Chris Porter, John Burns Research and Consulting Senior Vice President. Good to have you on today, Chris. So walk us through what that supply-demand dynamic looks like right now.
Yeah, I mean, we've got some pretty strong demand for housing. Obviously, people want to, they've got to live in a house, right? And we've got a growing population. The challenge is just the supply is not there, especially on the resale side. We are at a very low levels of resale supply. And, I think that's actually created a bit of a floor on how far prices could fall, at least temporarily. And also, it's given some more market share to the home builders. The new construction has really kind of been able to step in and represent a bigger share of the inventory available for sale. And that's why you see, the builders doing quite well right now.
And so I believe it's by your calculations, we need 17.1 million more new homes over the next 10 years to meet the demand. Are we going to get those houses? Are we going to actually see that many be built?
So the affordability plays into this in big ways, and that's under sort of normal affordability conditions. We are still not in normal affordability conditions right now. People are still paying a greater share of their income towards housing than they have historically. And the way that you bring affordability back into check is one of three ways. You either raise incomes, you lower mortgage rates, or you lower home prices. And we really haven't seen prices come down all that much. That differs by market, obviously. Incomes are still growing pretty solidly, but mortgage rates remain, high, and that's been a big challenge in housing right now. Where the new home side has been able to benefit from that is by offering some of these rate buy downs and getting buyers in at lower rates.
How quickly does that supply need to come online in order to bring those rates down? And how do we get there?
I think once rates start to fall, and we think they will, I think we're not going back down to 3% rates anytime soon. And I think that was indicated today in the Fed announcement that, we're not going to see the Fed funds rate come down anytime quickly. And, I think mortgage rates are going to stay elevated beyond what people have been used to over the last several years. And so what it's going to take is to get the demand, to get the construction there. I think the demand will play out over time, but we're probably going to see less household formation in the short term until people can feel affordability is in their favor and they can purchase a home.
Do we also need to fundamentally reset our expectations of what home ownership, what percentage of Americans will end up being homeowners?
I think it's interesting. So you've got sort of two ends of the spectrum here. You have this massive wave of older adults who have 80% home ownership, and that's a number that's getting bigger as older adults age into their later years and very high home ownership. It's the younger adults that have that lower home ownership rate today. We've seen a little bit of an uptick in the last couple of years amongst the younger adults, just as they had more money in their pockets through government stimulus, as mortgage rates were sub 3%, many of them were able to get in. But I think with rates staying high, it's going to be a challenge for homeownership to rise in the near term until that affordability measure gets a little bit more into check.
Well, and to add on to that, if you talk about supply, we talk so much about single family homes, single family units, but it really is about multifamily units as well, sort of becoming increasingly the only option for any kind of ownership. If you sort of look down the line on where things have been moving, what does that mix look like?
Yeah, so think about it. It's about 2/3 single family, about 1/3 multifamily in terms of the new construction. We've got a lot of multifamily in the pipeline right now that's delivering to the market. I do think we're going to see a bit of slowing in multifamily over the next several years, and we do think that single family will probably won't slow by as much on a percentage basis here in the next couple of years, as we have this group of millennials that's moving into those years where they're purchasing homes in bigger numbers, and even that Gen Z group moving into those home buying years. We're seeing more shifting towards that single family, and so we'll start to see that balance probably remain about the 2/3, 1/3 split. But certainly we've got a lot of multifamily coming online right now.
As part of our week-long series, Real Estate, the New Reality, we're taking a look at inequality in housing availability. A study out from the National Association of Realtors shows that middle-income buyers are experiencing the largest affordable home shortage in 2023. Here to explain is Yahoo Finance housing reporter Rebecca Chin. Rebecca, let's break this down.
So we are seeing a huge housing shortage in the nation right now, but this data has shown us that middle-income families are seeing the pain the most. So there are about 51% of families in the U.S. that are making $75,000 or less, but there are only 23% of housings that are affordable and available to these families. What that means is if two of these households within this income bracket goes house hunting, one or more than one of them will come out empty-handed, or they're forced to buy something that's more expensive and that's out of their budget. So in addition to what we're seeing for that, we're also seeing that this inequality has really been worse in the last 5 years. So in 2018, there was still about 50% of housing available to middle-income families. But today, in 2023, that number shaved off by more than half to just 23%.
Wow. So what's caused the imbalance in the market and a shift in housing inequality here?
So there's really a couple major reasons. So we can start from the supply side. We have really been underbuilding houses in this market since the Great Recession for the last decade. But what is being built right now is not really what is needed, meaning that a lot of developers, they focus on the higher end luxury product because that's what makes sense for them profit-wise and profit margin. And on side of the demand, there is, on top of family formation that has happened in the last couple of years, the Great Migration is also causing an issue. What that means is families that are moving from these more expensive cities to the lower cost places, they're really driving up prices in the traditionally more affordable places. But what it hasn't done is it hasn't really lowered prices enough in expensive cities. So it's really causing this a shift overall in prices across the nation. And what we are also seeing is, of course, borrowing costs has really gone up a lot. Yeah. So a house that used to be affordable for the family may not be affordable anymore just because interest rate is so high today.
Lennar started its spring season with a bang. The earnings release really showcased that home buyers aren't shying away from these higher interest rates that we just saw. I mean, I know we saw some easing, but there's still a lot of demand there. In this quarter, Lennar reported an accelerated housing starts. That is a really good gauge on how the home builder is really expecting and looking forward. It's also feeding into that housing appetite that's out there. The best performing markets were on the east and central regions. Some of those cities include Charlotte, Raleigh, Dallas, Houston, and you know, we pointed out the lack of homes, housing stock really offers Lennar some of those incentives to offer. So some of those closing cost assistance, some incentives, also rate buy downs to really drive up demand. But looking forward, Lennar is expecting to deliver between 68,000 and 70,000 homes this year, with home prices remaining pretty steady. But some Wall Street analysts are actually on the fence when it comes to Lennar's output compared to its peers like D.R. Horton, who are able to kind of grab the localized market and grow its volume. So that's something to look forward to look out for.
All right. Well, the Fed called out housing costs yesterday. They said they're still too high. So how did Lennar respond to this in their earnings call in terms of their rental business?
Yes. So Lennar has a multi-family rental business. Executives actually talked down their rental market because there is more supply out there. And so Lennar isn't expecting rents to come down too much. But other rental data shows that it's going to be a big challenge this year and next year for landlords and tenants, because the supply that's on the market is actually geared towards the higher end tenant, not necessarily tackling the affordable housing crunch that we are dealing with. So the Fed said yesterday that rental costs remain pretty high. And he said it signals to the policymakers that more needs to get done.
Spring selling season started with a bang. The home builder beat expectations on the top and bottom line. Yahoo Finance's Danny Romero joins us with more on how home buyers are accepting the new normal for interest rates. The stock up in a big way, hitting a new high today.
Yeah, what a blowout spring selling season for Lennar. I mean, the report really shows that home buyers aren't really shying away from these higher interest rates. And for this quarter, Lennar reported new orders were up, especially in the east and west region. Lennar also worked through its backlog, which is very key for these home builders. They're down 29% for the year, and most of that backlog was actually in the west and in the east region. But the lack of homes for the resale market is really boosting Lennar to up their guidance, their full year guidance. So they're expecting to deliver between 68,000 to 70,000 homes for the full year. And remember, builders are price takers. So Lennar has been slashing some of those home prices to really drive up demand. They've also been offering incentives like rate buy downs that really look attractive when a mortgage rate is close to that 7% almost. But however, some analysts on Wall Street are a little bit on the fence when it comes to Lennar. The fact that when they look across the board at all the home builders, they're against their peers like D.R. Horton, they're really a little bit on the fence because they say that Lennar isn't really in a position to grow when it comes to the volume of homes. So that is something that it will be up for consideration.
Lennar's on the higher end, right, of the home building spectrum?
It's affordable. It would be considered affordable.
Oh, I'm thinking Pulte.
Yes.
I'm getting my home builders mixed up. The conference call starts soon. So what are you going to be zeroing in on?
Spec starts is really a good gauge to really see how this home builder is going to look for the next quarter. And spec homes are unsold homes that have at least a foundation in the ground. And across the board, home builders like Pulte and Toll Brothers have really increased their spec starts. So it's a wait and see to see if they also echo the same sentiment as well.
Yeah, and it sort of comes down to what you've been talking about for a while, which is the inventory. It's just not there when you compare it to pre-pandemic levels. I mean, how long does this momentum continue for a name like Lennar?
I mean, I guess we'll have to see. You know, the spec starts will really be that gauge to really, to see how the outlook will look ahead for that home builder. But I mean, across the board, they're increasing. So I'm assuming that Lennar will also increase as well. And depending on the region too, they've been focusing a lot on the East Coast and the West region as well, which is very interesting to see because of the home prices in those areas as well.
In our final installment of Real Estate, the New Reality, we're taking a look at the issue of housing affordability and how one unique class of homes are addressing the issue. They're known as accessory dwelling units, or ADUs for short, and they're being developed at a rapid rate across California. Akiko Fujita joins us from Los Angeles outside one of those ADUs. Hey, Akiko.
Hey there, Rochelle. Well, you said those three letters, ADU. That has become a critical part of the real estate conversation here in California. And put simply, they are backyard units that function much like a single family home. We are actually inside one here. This used to be a 2-car garage, and the homeowners have converted into a 500 square foot space. You see, we've got a kitchen here. You walk over to the corner. We've got the bathroom. And then I'm going to give you a quick tour on the other side here because there is a bedroom also attached to this unit. All of this done in the backyard here. And the reason we are seeing so much growth in these units is because of a law that changed back in 2017 here in California, legalizing the permitting of ADUs, and the numbers really tell the story. Last year alone, 23,000 permits for ADUs issued here in California. That is a 60% jump year on year. Here in LA, the numbers were even more staggering. The number of ADU permits issued were 5 times that of single family homes. And the growth has become so big here. Even the co-founder of Airbnb, Joe Gebbia, has jumped in on this space. He launched a company called Samara last year. I spoke to him about the opportunity he sees in this space. Take a listen.
You could say that the idea of ADUs has become culturally popular, especially since the pandemic, because people's values towards their homes have shifted. They've changed. 58% of Americans still spend at least 2 or 3 days a week working from home. And currently 1 in every 5 households throughout the United States has 2 adult generations living together. So these are big shifts in the way that people think about home. And I think as we've seen these changes, we've also seen governments get behind this, because ADUs to governments are providing horizontal density throughout cities and neighborhoods. And so governments have changed laws to make it even easier for people to get ADUs. In fact, they're basically making it a right to have an ADU in your backyard. And as you mentioned, in California, they changed the laws in 2017, and since then have had a 17x increase in permit applications. That's phenomenal growth. And so I think it shows that there's a demand there, and that the easier that you make it for someone to have an ADU, there's clearly a market.
So talk to me about how Samara fits into this market, because you've got a template in place. How does it all work?
So the way it works is you go to samara.com and you configure your backyard unit. We have a studio, a 1-bed, and a new 2-bed unit. And so just like you would configure a Tesla online, you configure a Samara backyard unit. And when you hit order, we receive your order, and we go through a process where we handle everything for the customer. So that's both the construction of the unit in our factory, but it's also the hard stuff, the heavy lifting, the things that homeowners don't want to deal with. That includes permitting, soil samples, utility hookups, and a very long list that a lot of consumers, when they see that list, they say, you know what? They throw their hands in the air and they say, I'm not an expert in home construction. I don't want to deal with this. And so what we decided as part of the Samara brand is that we would take care of not only the structure, but also the service. Also everything that gets in the way of people saying, well, I'd like to have this extra space in my life. So we decided to do everything. And so after we get the order and we go through the whole process, we produce in our factory, we ship it on our truck, and we crane it in to the specified backyard.
I know it's been just over 6 months since official launch. What does that demand picture look like, and how concerned are you about that pulling back along with the demand in the housing market overall?
Well, they're all commensurate. But I think what you'll find, what we've seen with people who want ADUs, is that it's actually a phenomenal income generator. And the majority of people get an ADU in their backyard to rent it out and to generate income. So it's a trend that I saw at Airbnb of hosts renting out backyard units. And it's a trend that we see more and more now that we're in the industry, because it's kind of a no-brainer. If you're a homeowner, you've already paid for the land. And now that we've created this simple offering where you can literally just order online, and we handle everything for the consumer and for the homeowner. It's a fairly clear proposition of a way to make some extra income.
When you think about how the law shifted in California specifically, it was about addressing the housing crunch, the shortage there, and having more units. But I'm looking at a price point for Samara, and correct me if I'm wrong, it's roughly, what, $300,000 if we're looking at a 1-bedroom to 2-bedroom unit?
That's right.
I mean, that's a pretty high price point, even if we're looking at additional housing, trying to bring the cost down. I mean, how significant a dent, when you look at ADUs overall, do you think it can make in the larger issue of housing supply?
Yeah, look, I think it's going to take a lot of different ways to attack housing, not only in California, but across the country. I think this is one of many options that governments and developers have to make a dent in the problem. And the price, for California is fairly competitive when you take into consideration labor costs and the fact that we're doing everything for the customers, not just the construction of the home and the materials. It's actually the permitting costs and the water hookups and all of the nitty-gritty things that a customer has to pay for.
California's gotten a lot of attention around ADUs just because of the sheer number that you pointed to in terms of permits that have been given on ADUs. But we know a number of other cities, states have also been looking at this too. I mean, how much of a template do you think this can be for other states, whether it is on the West Coast or in places like Texas, to address the housing supply overall?
Well, in true fashion, California is ahead of the curve. They are leading the way on this, and other states are following. There's been at least 8 other states that have passed laws very similar to California's. I know Texas is evaluating some ADU laws at the moment, along with a number of other states across the U.S. Because, again, governments realize this is a fairly simple way to add more horizontal density. And the other point is that not only governments love it, but neighborhoods love it as well, because in California, cities have mandates to add more housing over the next couple of years. And neighborhoods love ADUs because rather than putting in, a multi-family mid-rise in the middle of the neighborhood, they can actually add the similar amount of density without adversely affecting the visual character of the neighborhood. So it's a win across the board.
What does that mean for Samara moving forward? I mean, I imagine that really opens up the market for you beyond California, where you got started.
That's right. I think we are well positioned to tap into this existing customer demand. And I think we'll actually expand the market by making it even easier for people to acquire a dwelling. And the other thing of why I think there's market growth here is that people are using this not only for income, but for a multitude of other reasons and use cases. And if you think about how life changes over time, what having extra space in your backyard could provide for you. Sure, it could be income on demand as you need it. There's also use cases of housing elderly parents close by. of housing college graduates when they come back post-graduation, of working from home, having a quiet, productive space, quiet, productive office right in your backyard. So I think the benefit of this form factor of housing is that it can be many things, and it can actually adapt with people over time, depending on the needs that they have in their life.
You know, for homeowners, ADUs are all about flexibility. He talked about the additional income generators through short-term rental, long-term rental. We've also heard from realtors that increasingly homeowners are looking at these spaces as an office space with so many more people working remotely. Now, we are outside the ADU now, and I want to walk this direction because that'll give you some perspective on where they are being built. That's where the ADU is. This is where the actual home is. In some cases, you've got homeowners who are actually living in the ADU so they can rent out the main home as well. Now, the housing affordability issue really has driven the growth that we've seen here in California. And it's worth noting that the average, or we should say the median rental here in California is 41% higher than the national average. But one of these units can go and rent for anywhere from $2,000 to $3,000 a month. So that's raised some criticism from those who say, look, this isn't exactly affordable housing. We should note it's not just California. Denver, over in Colorado, the most recent city to pass changes to their zoning laws to allow for more ADUs. We've also seen changes in states like Washington State. So this is something that is really taking shape across the country as we look at the housing crunch, supply crunch, as well as the affordability issue. By the way, the next step here in California where people are looking at is the potential for homeowners to be able to sell one of these ADUs. Right now, it's strictly limited to rentals. If they can actually build out the unit for roughly $300,000, potentially sell it, that'll really open up the real estate market here.
If you're feeling the pinch of higher rents, you are not alone. While rents are finally showing signs of cooling, prices do still remain high. Typical rents for the month of May reached $2,048. That's up 4.8% from a year earlier, according to Zillow. And Skylar Olson, Zillow's chief economist, is joining us now. Skylar, we've talked a lot about home prices, purchase prices, but we got to talk about rents as well. Obviously, this is a big part of the economy for people who don't own homes. What's the outlook here for rental levels?
Yeah, well, when we're looking at the rental market right now, especially depending on where we're looking, you're balancing a few things. You know, we had a lot of migration over the course of the pandemic, a lot of reasons to move. That's probably starting to slow down. We've also seen some areas that have delivered a lot of new apartments. Construction in the multifamily space was very hot and heavy over the course of the pandemic as well to kind of meet that need and meet that demand. So now where we're looking, you know, there are areas where rent continues to be soft and even is possibly falling, you know, on a month-over-month basis. But that is more and more rare as actually we start to see things in the rental market heat back up. It's softer than, say, a pre-pandemic month, but certainly much more pressure than, say, 5 months ago. Now, when we're looking at that and we're trying to understand, you know, what is happening, there is a headwind to the rental market from the mortgage rates within for sale, as we just have a big buildup of people needing homes. This is a massive generation of millennials that are putting pressure on the market. Just to put a number in your mind here, if I think about all the households that are living within, families, individuals and couples that are living within other unrelated households, you're looking at 3.4 million. That's a lot of underbuilding. So the fact that we continue to see pressure come back on rental markets, softer than pre-pandemic for sure, but still rental price growth that's, you know, on par with a pretty steady growth.
This is almost the second day in a row where I'm summoning Jimmy McMillan into the conversation because the rent is too high. At the end of the day, Skylar, when you think about what type of capacity needs to be brought online, what are some of the time markers that you would be looking at?
Yeah, in terms of time markers. So you mean like when we need these kinds of things? I mean, absolutely right now there's an emergency for many people. If we think about like what it means at a household level, then I'm going to talk about the typical household. So for many households, this could be much worse, right? Over the course of the pandemic, you might expect that rent would take 3% more out of your paycheck every month. Now, you're also dealing with general inflation at this time. So households are probably finding it increasingly difficult to save. That puts them at financial instability, especially if you're expecting to go towards, say, a recession, or you might be a bit more concerned about job loss moving forward. So, in terms of the needs for a break to American households, the time is most certainly now. In terms of timing, like how long we might be in this crisis, we inherited it, in the beginning of the pandemic. It was here. We were already talking about it. And then in terms of moving forward, we might expect to see a lot of pressure on housing for the next decade when we talk about generational flows.
And you note this less competition for rental units on the market as people do sort of tighten their belts, perhaps taking on a roommate, trying to do other things like that. So at what point do you see that also then affecting rental prices? Will they start going down then as more people start doing that?
Yeah, I think what's happening right now in different rental markets, there's actually some unwinding probably going on as we start to see new supply. But a lot of that new supply was in places where we were seeing a lot of good growth, inflow. So when we think about what, metros are receiving a lot of inbound population, those areas are often the places where rent is continuing to grow and people continue to have to pursue strategies like that, right? That $3.4 million number that I mentioned, by the way, not dollars, 3.4 million families or couples or individuals that are living within other households. So say doubling up with a non-relative, those are non-relatives. There are plenty right now, and we saw over the course of the pandemic, this surge of people that go back to live with family, of course. So the boogeyman in every boomer's basement is their, millennial adult son, right? Just kind of saving up to get financially stable. And potentially saving up to try and enter a for-sale market that is also increasingly challenging, especially at the lower affordable end.
That is an amazing image, Skylar. I want to ask how all of this feeds into the big picture and the Fed's inflation data that they track, right? Because we talk a lot about so-called owner's equivalent rent as a proxy, right? But here's actual rents that we know what's going on with them. So it sounds like that this is not going to be something that helps inflation decelerate in the near term.
Well, I look at this every month as something I get very excited to refresh, this graph that I track that looks at that month-over-month pace within the shelter components of CPI, both, for renters and owners equivalent rent. And I look at that month-over-month pace of our Zillow Observed Rent Index, which, as you mentioned, tracks real asking rate rent. So it does not include concessions. So we do, other analysis on that to see there are absolutely places that are offering more concessions, but market rate rent, we did start to see those shelter components of CPI start falling at around a year lag after Zori hit this fever pitch, towards, the fever was kind of towards the very beginning of 2022, end of 2021. Once that fever kind of broke on that rental market, 10 months later, you see those shelter components of the release market, which dominates the CPI measures that are across the full housing stock. So, okay, what do I expect today? If I look at those month-over-month shelter components, we're about less than halfway back down to, say, a pre-pandemic pace in the release market. We are softer than pre-pandemic in those asking rate rents. So I think that's a good sign for the overall general inflation that the shelter component pressure is easing. It's not going to be a source of incredible softness in general prices, but it is easing relative to those pandemic, highs and heat. And that should help the release market continue to soften down, but maybe more slowly than we wanted.
All right, kicking off the week with some good news in the housing market. Groundbreaking on new homes surging nearly 22% in May, the biggest jump in nearly a year. That's according to the National Association of Home Builders. Building permits also jumped last month, rising over 5% from April. For more on that data, we turn to Jim Tubin, National Association of Home Builders CEO. I know we've got some good data out too, and I'm sorry, the housing starts from the government. Let's talk about both data points that we have, both confidence, starts. It looks like housing is just having a moment more than we expected. How would you characterize what we're seeing right now, Jim?
Cautious optimism is how I would characterize it. Yesterday, we saw the NHB Wells Fargo Housing Market Index jump to 55 points, which puts us in positive territory. The sixth month in a row of an increase after 12 months of a decline in 2023. So definitely our builders' optimism, forward-looking index to the future of the housing market and the strength of the housing market certainly was confirmed today by the starts and permit numbers. So we are cautiously optimistic that we are starting to see that rebound in home construction and housing.
Jim, what's fueling that cautious, optimistic, as you put it, outlook here at this point? Because even though it is still cautiously optimistic, it's much better than we have seen in recent months.
Well, I think what we have seen is obviously demand is very, very high for housing. And with so few existing homes on the market, people are now turning towards new home sales. In fact, newly constructed home sales are making up a larger percentage of the monthly for sale numbers, which means that as people turn towards newly constructed homes, we're going to see that our members and the builders across the country are going to respond to that, and they're going to put more supply in the marketplace. And so, and then you add on to that the fact that people are starting to get more comfortable with what I would say are these elevated interest rates up in the 6 or 7%. That's no longer a barrier to entry for a lot of people.
Yeah, Jim, that used to be the number. So 6% was kind of the number where you saw people saying, hold up, we're not going into this kind of market. So is your expectation, is it really right now what we're seeing like an inventory issue? Is that what's fueling the strength that we're seeing, or, to a certain degree, the strength that we're seeing in the housing market?
We're underbuilt, and we're underbuilt, and we have been for the last decade. And I think finally and demand has remained high, even though we saw a sag last year in demand as interest rates crept up and up, and people got a little bit nervous about how high they would go. As we've reached this plateau, it's clear that people are willing to re-enter the market at this interest rate level, and I just think that demand remains high, and as long as local, state, and federal lawmakers are willing to create the regulatory environment that allow us to deliver homes at an affordable price, I think we're going to see this in a sustained level for the next little while.
What are you seeing just in terms of the incentives that builders are offering to attract buyers? Is something we've been talking about for the last couple of months. Is that still the case, and what are they doing now?
Well, we are actually, in the numbers that we're watching, we're seeing the incentives, not only the number of builders who are offering incentives, but also the incentives themselves are dropping, which means to me that the public is willing to come into the marketplace and doesn't need those incentives to get over the goal line to purchase a home. So that, I think, is a good sign about the health of the marketplace, but also importantly, the health of the home buyer out there. So that's a one positive sign we've seen that's breaking a recent trend.
Speaking of the health of the home buyer, there has been an affordability issue when it comes to some of the homes on the market, So what are you seeing in terms of ways to address that issue?
Well, I think when it comes to affordability, it's firstly when we talk about the construction of new homes, it starts and ends with regulatory burdens on the construction of homes. Local governments put time delays in front of builders. Regulatory burdens, even at the federal level, those all drive up the cost of housing. And then you also have to think about the supply chain. We have not fully resolved the supply chain bottlenecks in all of the building materials out there, nor have we seen inflation drop all the way back down to the Fed's target rate of 2%. So there still continues to be supply chain concerns out there as well. And then the last piece, of course, is how builders finance their homes, and that's through the acquisition, development, and construction lending in the country, traditionally done by community banks. That lending is much more expensive, and the availability of that credit has gotten tighter over the last 6 months.
So with all that, Jim, taken into account, then what do you think the housing market looks like by the end of the year, given the fact that there are still so many, it sounds like, challenges here presented to the industry?
Well, again, it's like I call on policymakers to try to do what they can to lessen that regulatory burden on housing and move more housing production into the pipeline faster. I am encouraged by the numbers that we've seen, not only over the last 6 months with our builder sentiment, but now these permit and starts numbers point to, again, a cautious optimism for the second half of this year. And I'm optimistic that we'll see the market and the construction center continue to rebound through 2023 and then really start to take off in 2024.
Well, new data is highlighting just how tight the housing market still is. Existing home sales essentially flat in May compared to April, but compared to a year ago, sales were down 20%. Joining us now is National Association of Realtors Chief Economist Lawrence Yun. Lawrence, good to have you back on the show again. I'm looking at inventory levels here for May, at least. They are the lowest dating back to 1999. Is there any relief in sight?
The low inventory is hindering sales potential. And you can see that by the fact that 1/3 of the sold property in the latest month were sold above list price, meaning multiple offers are happening. So the shortage of inventory is not fully satisfying all the buyers in the marketplace. So once we get more inventory, one can easily anticipate a boost to sales. And of course, mortgage rate also is a big important factor in the housing sector.
Lawrence, you mentioned getting more inventory eventually, and that obviously is going to free up some of the availability here for potential home buyers. What does that timeline, though, look like, given the fact that we're in this uncertain economic environment and people simply aren't moving from their homes given the lower rates that they locked in over the last 2 years, 3 years?
Eventually it has to be the home builders. They have to build more in line with the population growth and the job growth. Let's remember, the total number of people working today is about 4 million above pre-pandemic levels. So we have far more people, but fewer sales activity because of limited inventory. But the good news regarding the builders is that the latest data is showing single-family home construction housing starts at near 1 million. So we have not seen that level in the 10 years prior to the pandemic. So builders are ramping up, their profits are turning in, and there's a financial incentive to produce more. But it's gonna take time. So in the short-term measure, one of the things that our organization is talking to members of Congress is to say, can we incentivize some of the mom and pop real estate investors to unload, possibly by lowering the capital gains tax temporarily, so we can immediately bring more inventory to the market so that first-time buyers who have been struggling, maybe they get more choices.
Yeah, well, what's the prospect of that? I mean, what kind of timeline are you looking at the potential for that policy going forward?
We are in the discussion because I think people understand, the country understand, that we need to have a steady ladder towards home ownership. We don't want to have a divided society where homeowners are getting substantial housing wealth, which has been the case in recent years, while the renters just frustrated, like not making any progress in life. So to assure that first-time buyers, who incidentally were below 30% of all purchases, normal level will be closer to 40%. So we want that first-time buyer, younger generation, to taste the home ownership and the wealth that goes along with it. But right now is a very difficult, challenging circumstances. So we have to get the communication started regarding getting more investor inventory onto the market, put a condition to say you only get capital gains tax relief if it's sold to owner-occupant or the first-time buyers, so that it's not an investor-to-investor transaction.
Lawrence, what does all this mean then for prices going forward? Because the fact that there is still this pent-up demand, low inventory, that sort of put a floor on prices. Is that going to continue to be the case here going forward, do you think?
The prices have been roughly stable in terms of the national median price, even though we do see some variation. Upper end market, yes, prices are coming down. And for people looking to buy those expensive homes, there is a better chance for the buyers to get that better price negotiation. but not the case for the mid-price or more affordable price range homes where they're attracting multiple offers. And also out in the West region, we are seeing about 5% reduction in median prices. So there is some variation, but with the mortgage rate possibly stabilizing or possibly even decreasing later in the year, let's hope that the Fed, as they get more incoming data, they see that inflation is much calmer, rents are much calmer, and they don't have to raise interest rate. Well, that's going to be very favorable for mortgage rates, and the buyers will be coming in. The key question is whether we will have sufficient supply.
Lawrence, from a buyer side, who's actually in the market looking? I mean, you'd think that the things that you've highlighted there, whether it is the prices that we've seen, the mortgage rates that have gone up, a lot of first-time homeowners prospective home buyers have essentially been pushed out.
So the buyers, interestingly, the real estate investors have actually stepped away. So we are finding that small decrease among real estate investors. So these are the people who are buying right now are essentially the homeowners who are exchanging home, either trade up buyers or trade down buyers. And they can do so because they acquire sizable housing wealth over the years. They sell their home, use the proceed as a down payment for their next home purchase. So right now, it's essentially the homeowners exchanging properties. The first-time buyers are struggling, and the real estate investors are beginning to step away from the market.
All right, taking a look at housing starts, they rose for the second straight month in May, with construction on new homes reaching the highest level since last April, boosted by strong demand, which our next guest says could be a very favorable environment for homebuilder stocks. Rafe Jadrosich, Bank of America senior homebuilders analyst, joins us now with more. Good to see you, Rafe. So as we look at some of this data that's been coming out over this past week, then, which of these homebuilders are in the best position right now?
Sure, great. Thanks for having me. So we do think it is a favorable backdrop for home builders right now. New home sales have definitely inflected positively year to date. We've seen a strong recovery after the slowdown at the end of last year. So if we think about specific home builders that we like right now, Toll Brothers is our top pick. We think it's really attractive on a valuation basis. It's trading just slightly above its book value with a return on equity that is far above its historical average. We also think it's well positioned to benefit from the tightness in the existing home market that you've seen out there.
Rafe, you all recently had a housing symposium earlier this month with home builders in attendance. What were the top three themes that you would say came up?
Yeah, I think the really big theme this year that's come out is just the tightness in the existing home market right now. There's just not a lot of resale inventory that's on the market. Historically, if you look at new home inventory as a percent of the total inventory that's available, it's about 10 or 15%. Right now, we've actually seen that increase to 30% of the total available inventory. And it's just existing home inventory is very tight. There's a rate lock-in effect that's going on right now, where about 80% of current homeowners that have a mortgage that's below 4%. So while mortgage rates are 7%, the incentive to move is very low. I think that the second kind of key takeaway that we had was that home builders are accelerating starts. You saw the data that came out earlier this week. Just in response to the really strong demand, we're starting to see a pickup in overall construction activity. And then the final, I think, takeaway would just be the supply chains are starting to ease. Still elongated build cycles, but we are seeing a little bit of relief there.
Yeah, Rafe, what are we seeing in terms of input costs? Because yes, we have seen some relief when you look at the price of lumber, for example, down substantially on a year-over-year basis. But in terms of how big of a challenge this is for home builders compared to what it looked like pre-pandemic, how does that stack up?
So if you look at the overall cost to build a home from 2018 to now, we think it's up about 45% if you just look at the materials. And home prices are up 47% over the same period. So we've still seen a lot of inflation. There is relief coming in right now from lumber costs, as you said. Lumber costs are down over 50% year over year. And that's the largest single input from a material perspective. When you look outside of lumber, the rest of building products generally are still inflationary. Labor is still tight, and land prices still haven't come down. So generally still an inflationary environment if you back out lumber, but lumber is a big tailwind to margins right now.
And Rafe, as we look year to date at some of these home builder stocks, some of them have been absolute rock stars. When you look at D.R. Horton and Lennar, they're both up over 30% year to date. Toll Brothers up over 50%. KB Homes up more than 60%. How much more upside do you still see then coming into the second half of the year?
Yeah, it's a great question, and the stock performance has been really strong, especially relative to the rest of the market. I think what's important about home builders is that the valuation is still below the long-term historical average. So usually they've traded at an average of about 1.5 times book. So the book value per share is actually increased by more than the stock prices over the last few years. So we're still probably about 10 or 15% below the historical long-term average valuation. So we still see some upside on the valuation side.
And Rafe, I got to ask you about with rates expected to climb through the rest of this year, what risk do you project that posing to the home builders, for instance?
Right. So obviously the 7% mortgage rate is definitely a big headwind to affordability. If you look, about a year ago, beginning of last year, mortgage rates were at 3%. They've gone all the way to 7%, a huge headwind to affordability. What we've seen is mortgage spreads, so that's the spread of the 30-year mortgage over the 10-year Treasury, are at all-time high levels. So even with the FOMC announcement last week and the commentary that you're still seeing 2 rate hikes, mortgage rates have actually gone down slightly over the last 3 weeks. So we think that spread is more than capturing the additional hikes that are coming, and mortgage rates we'd actually expect to be flatter down through the remainder of this year.
Rafe, what about pricing? Because we entered the year expecting, many were calling for a double-digit decline in home prices. We haven't seen that yet because demand has remained strong, inventory a huge issue, and people are willing to pay what people are asking for homes. Is that going to continue to be the case, do you think?
So if you look at new home prices, they're probably about 10% off of the peak levels. And that's a combination of incentives and price cuts from the home builders. And then we've seen a stabilization there. So there has been elasticity in the market. From the existing home side, it's been relatively stable. We're only 1 or 2% off of the peak level. And the story there is just the lack of available inventory. But home builders have seen a stabilization in prices. And there's actually some markets where they've come back and started to increase price again. So we would expect a kind of pricing to be stable between now and the end of the year.
And obviously, once you have the demand, you do want that supply. You know that inventory is an issue, but you also have a tighter credit environment. So what is that doing for construction loans to be able to get some of these buildings off the ground?
Yeah, that's a great question. So there's 2 aspects of credit. You have the consumer borrowing side on the mortgage rates, which we talked about how elevated they are, and then you have home builders that are borrowing to finance their business. From a private builder perspective, which we think is about a third of the market that rely on construction loans, the NAHB survey on the current cost to finance a single-family construction is 12.8% as of the first quarter. That's up, over 500 basis points over the last 3 years. So the cost to finance for a private builder has gone up really materially. So we think that actually positions public builders to take market share as private builders come under some cost pressure.
U.S. Treasury yields in focus this morning as investors prepare for a week of fresh economic data that will better illustrate the state of the U.S. economy. On the docket, consumer confidence, new and pending home sales, and PCE and consumer sentiment. Joining us now with what to expect from the week ahead is Bill Adams, Comerica Bank Chief Economist. Bill, thank you so much for joining us. So first up, what would you say is the main target this week? Would it be PCE in your view?
I think that's probably what's going to be most important. That'll be both the state of the consumer with spending on services as well as goods. We haven't really seen as much service data for the month of May yet. And then on top of that, we're going to get the Fed's preferred measure of inflation.
And so is that going to come down, do you think? Are we going to be going in the right direction, not just for that data, but any other upcoming inflation data in the coming weeks?
We're in a part of the year where the inflation data is really getting graded on a curve, and it's an easy curve because the year-over-year comparison is now comparing against the spring and summer of 2022 when energy prices were surging after Russia invaded Ukraine. So something would have to go really, really wrong for inflation not to slow in the month of May in this release. I think the bigger question is going to be what happens to sticky service prices And the Fed has said that they are concerned that those sticky service prices, that's the cost of getting a haircut, the cost of sending your kids to daycare or getting your car repaired, those are not slowing as much as energy prices or food prices. And the Fed wants to see the overall economy cooler so that we see less pricing pressure, less pricing power from businesses and less pricing pressure from wages, bringing overall inflation lower, not just this year, but next year as well.
Bill, the housing market has held up strong recently, and we have more housing data coming in this week, new home sales, et cetera. Are you expecting the housing market to remain resilient?
I think the housing market's going to be resilient in the second half of this year. And I think there's a good chance that the bottom, both for residential construction, as well as the bottom for new home sales, is in. There is a big drag on home buying power from high mortgage rates at this point. But high mortgage rates also mean that a lot of people who might have downsized, might have moved, might have sold in 2023 are holding on to their 2 3/4% mortgage and are not putting that home on the market. And that means there's just much less supply of existing homes. And that is funneling home buyers into the newly built segment and really supporting construction and transactions in that part of the housing market.
Does that also imply, Bill, that once rates stop going up or even start to go down, that we will see more of a lift to the housing market than we would have traditionally?
Another way of thinking about it is that the Fed is going to be more reluctant to cut interest rates given how resilient housing has been. And so while I think that the Fed's next decision, probably a 1/4 percentage point hike in July, I'd say better than 50-50 that that's the last hike of this cycle. But I'm now thinking that the Fed will probably go quite slowly in 2024 in reducing interest rates. Right now, I have rate cuts penciled in only quarterly next year, so still leaving short-term rates at a relatively high level at the end of 2024. And that's different from what I was thinking 3 months ago when I thought housing was going to be more of a headwind to the economy and that headwind would last longer.
So, Bill, what other differences have changed in your view on the economic picture? From your view, are we headed to a recession still this year?
You know, I have that recession in my forecast. It's for economic forecasters, we're kind of in the extraordinary claims require extraordinary evidence at this point. And with the yield curve so inverted, you kind of have to have the extraordinary evidence that the economy wouldn't have a recession. The Fed's own, the New York Fed's forecasting model based on the yield curve has a 70% odds of a recession over the next 12 months. So to say that, you know, the other 30% is going to come through, you need to point to something really remarkable going on in the economy now, keeping it out of recession. There are some good things happening, though. In addition to housing, you've got consumer incomes, household incomes outpacing inflation since June of last year. And the labor market in general is remarkably resilient. Labor force participation of workers under the age of 55 is at the highest in over a decade. So that side of the economy is holding up quite well. It's possible we'll dodge a recession. I think right now the central case is probably a mild pullback in activity, and we can argue over it for months and months once the data come in, whether it was just a soft patch or an actual mild recession. But I think the odds of a more serious recession seem lower than they did 6 months ago.
Bill, this week, the Supreme Court is expected to rule on the Biden case involving the student loan repayment moratorium and kind of determine what happens next. If the moratorium expires as expected in September and there's no other legislation on that front, what effect is that going to have on the economy and consumer spending?
Well, people who are spending more to pay back their student loans are going to be spending less on everything else. That's obvious. But I think the question is, how does that play in the mix of other things affecting consumer spending in late 2023 and 2024? And there is a lot of support to consumer spending right now from the very solid labor market, from solid wage gains, from less inflation, gas prices down from their peaks last year, and a lot of consumers who have fixed rate mortgages who are not exposed to the increase in housing costs are experiencing less inflation than you see in the CPI index. So that's the support. To the downside, you have the restart of student loans, and then also these long and variable lags of monetary policy that are likely to make credit-funded parts of consumer spending, think auto sales, grow less quickly in 2024 than they otherwise might have.
Well, we got a fresh batch of data out on housing today. Home prices rose for the third straight month in April from March, but compared to a year ago, they posted their first year-over-year price decline in 11 years, while new home sales for May increased 12%. This all comes as higher mortgage rates have made home purchases more expensive for buyers, but potentially signal a sign of recovery in the market. For more on this, let's bring in Danielle Hale, Realtor.com chief economist. We just threw out a lot of numbers there, Danielle. Month on month, things look better. Does that point to a recovery?
I think it's too soon to say that we're in a housing recovery. We have been saying for quite some time that we think the sales low was in January. But I think today's price weakness is something that we're going to end up seeing for the next several months. In fact, just last week, we revised our housing forecast. We had been among the more bullish outlooks for this year for home prices, and we've taken our home price growth forecast and revised it. So we expect home prices to slip for the year, but less than 1%. So we don't think it's going to be a huge decline, but we do think some of the softness in home prices is going to stay with us. Buyers and sellers are trying to figure out what the right pricing level is in the wake of high mortgage rates, and that is a challenge compounded by the fact that we don't have a lot of home sales transactions right now. So it's going to be an interesting year in housing.
Danielle, when do you expect, you mentioned that further 1% decline in prices, when do you expect we'll see that bottom? Are we talking within the next couple of months ahead of the fall buying season?
So there are a couple of things going on in the housing market. So there's a strong seasonal pattern in the housing market. We tend to see the highest prices of the year in the summer and the lowest prices of the year in fall and winter. So that trend is happening. So even though prices are declining year over year, they're moving up. I expect that we will see the usual cooling off that we see in the fall, but the year over year price trends may continue to decline. So I think we'll see that weakness sort of stretch through the next couple years. And then we'll start to see home prices rebound more convincingly in 2024.
What are you seeing among buyers right now that are in the market? And to what extent have you seen them continue to stay on the sidelines because of inventory, because of higher mortgage rates?
Well, it's interesting. It's more sellers that seem to be staying on the sidelines. Buyers, on the other hand, seem to be quite active. And if you look at the existing home sales data that came out last week, it was pretty steady. It actually moved up a little bit. And if you look at the new home sales data that was out today, it surged for the month. So that is lending credence to the idea that if you build it, if it's for sale, buyers are interested. And I will say there is one piece of information from new home sales data that suggests that it's not that buyers are interested in everything. They're interested in affordable homes. And so if you look at the price distribution of homes that were sold in the new home sales data, you see an increasing share of homes were sold under the $300,000 price point. So buyers are out there and most interested in homes at that affordable price point.
Yeah, so Danielle, what does that tell us then about first-time home buyers? It sounds like maybe they're accounting for the majority here of some of the activity that we're seeing.
Well, I don't know that they're accounting for the majority because it is still a challenging market from an affordability perspective. But I do think first timers are getting some opportunities because the market is less competitive than it has been. And because a lot of existing homeowners who might be repeat buyers are choosing to stay put and hold on to their low mortgage rate. So that's opened the door for first time home buyers. It's still not necessarily easy, but there are some advantages that they have now that they haven't had in a while.
In terms of regions that we're seeing strength, the Southeast continuing to be the strongest region. The West, where I am seeing the weakest activity, at least within the sector, the space. What's driving some of those gains, at least in the Southeast? Is it about sort of this migration that we keep hearing that has happened over time? And is it about the opportunities, the price points? What are you seeing there that leads to the strength?
Yeah, depending on the metric that you're looking at, whether it's sales or prices or market competitiveness, we generally see both the Southeast, the Northeast and the Midwest performing well. Those are regions of the country where housing is much more affordable and where the labor market has shown some resilience. The one thing that is consistent across all of the different measures, no matter how you're looking at it, the West seems to be lagging behind from a price and transaction perspective. New home sales data today, for example, most regions were up. The Northeast up by double compared to last year, but the West actually a little bit behind where new home sales were in that region last year. So the employment situation in the West has not been as strong. We've not seen as much recovery. And the tech sector, which is heavily concentrated in the West, has also been a bit of a drag on the regional economy. And we're seeing that reflected in home prices and sales trends.
Danielle, what are you seeing in the rental market? I know you have new data out showing that renters are seeing some relief. How much relief are we seeing, and how big of a dip is this indicative that maybe a trend is going to start?
Yeah, so it was the first decline in our rental data since we've been tracking it, which goes all the way back to trend data goes back to 2020. It was a continuation of a slowdown in rent price growth. So we saw that start roughly in January of 2022, and that number has just gradually eased to the point of declining now in this first month of data in May. I think we're going to see some continued weakness in the rent side of things, on top of the fact that we've got some imbalance already. There's a record number of multifamily units that are under construction and that are expected to hit the market later this year into early next year. That's a lot of supply coming online. Great news for renters who have contended with high rents. Even though they're coming down, they're still very close to highs. But that is going to mean a more interesting landscape for landlords as they're trying to figure out how to price to make sure that they can maximize occupancy in the years ahead.
All right, taking a look at new home sales in May, they defied concerns over a slowdown in the housing market, rising 12.2% compared to the prior month and up 20% from 2022, the fastest pace in over a year, boosted by limited inventory in the existing homes market. Will we continue to see this level of activity, though? Joining us now is Brad Dillman, Cortland chief economist. So, Brad, I want to get your big takeaways from these numbers, the month over month and the yearly view, to really give us a sense of where we are right now in terms of the housing market.
Yeah, so we had a substantial slowdown in new home sales, and now they've been rallying for several months here. Now we've seen a really big jump that kind of corresponds with some of the activity that we've seen in housing starts in general. The last housing starts print was very, very strong. To the point that many people think it may even be revised down. But it was strong in particular, not only because multifamily new starts were still strong, that's to say structures with 5 units or more, but because single family starts had really jumped. And again, we're seeing this in the new home sales figures as well. We're also seeing a return of some strength, or at least a very clear bottoming in at least the month-to-month pricing in the housing market, as represented by the Case-Shiller index as well. So it appeared to me that after about a year and a half, or really a year of some kind of slowdown in general in housing activity and disinflation in home prices, that we're now seeing a floor and then a potential rally.
And I know a lot of people have been waiting for the single-family home market to catch up with the multi-family market there. But talk about the supply of homes, because we did see the supply of homes available fell 0.9%, down 2.9% from last year. So what are we seeing here? At what point are we going to see this level out more?
Yeah, we're certainly seeing, homes listed for sale, right, have come down. But at the same time, we've got a lot of housing under construction. The new housing starts data would tell us that we now have, it's increasing again, close to 1.7 million housing units under construction. That's enough to rebuild every house, every home in Connecticut, and then half of Wyoming. There's a lot of housing under construction today. So we don't really need to look at the existing home sales, the existing houses that are being listed. We can really just see that there's a lot of new product in pipeline, and we're already seeing that start to clear in the increased new home sales.
And as we're in this pausing phase for the Federal Reserve here, then what is that going to do in terms of interest rates and people thinking, is now still a good time to buy? Should I wait and perhaps then refinance if I do buy now?
Yeah, I think that's a question a lot of consumers are asking themselves. It really depends on what's going to happen at the long end of the curve. Our own analysis right now would say that because the Federal Reserve is still engaged in QT, that's to say that it's shrinking its balance sheet, and that some of that shrinkage is coming from the mortgage-backed security space. Not only is the 10-year artificially high, arguably, but even the mortgage spread is pretty wide. So right now, I think people could look to at least the potential benefit that at some point these long-term interest rates might come in a little bit so that they might refinance. But certainly it's a challenge for anybody trying to buy a home today if they have to be using leverage.
And do you think we're at the end of the hiking stage for the Fed?
Yeah, we do. We think, again, the market indicates there could be a possibility of another hike here or there, but I think it's quite clear that if anything, they're more likely to end up cutting over the next year than continuing a bold hiking pattern. My own view would be that continued disinflation just in the CPI index, that's again to say that inflation itself is cooling, could give room for the Fed to create a policy rate that corresponds with the lower inflation rate without us necessarily going into a recession. That's another way of saying we could see rate cuts without us going into a recession.
It is clear we're starting to see some stability in housing as more home buyers are adapting to higher mortgage rates. Our next guest says Americans won't be seeing any sort of spiraling crisis in the housing market, at least not for now. Ben Eisen is with us. He is reporter for the Wall Street Journal. Ben, it's good to see you here. We just got those pending home sales seeing decline. But the dynamic that really seems to be dominating right now is that there are just not enough houses out there as we see mortgage rates continue to persist at relatively high levels. So what's your take as you think about the housing sector?
Well, thanks for having me, guys. It's been an interesting situation to watch the housing market over the past year. I think, when we were thinking about what was in store for the housing market a year ago, when the Fed was in the middle of raising rates at a super rapid pace and mortgage rates were going up super rapidly, there was kind of an assumption that we were going to have this big dip in home prices. And while we've definitely seen that in some areas of the country, the overall housing market has held up relatively well. And as you mentioned, it really comes down to that lack of supply. So even if you have this sort of reduction in demand, you still have a lot more demand than supply. And, home builders can't build fast enough. And what you're seeing is that people have really sort of become a bit more accustomed to the state of affairs right now. We've seen mortgage rates rise really rapidly, but they've been in sort of a range between 6 and 7% for much of the last year. And as a result, you see people start to get used to those rates, and demand starts to come back in. So you've seen a slight rise in existing home sales. You've seen mortgage applications up over the past couple of weeks. You saw that dip in pending home sales, but you saw that big surge in the Northeast, suggesting that there's definitely kind of this pool of demand that's still out there, and that's likely to kind of help bolster home prices. It's hard to say what's in store going forward, but for now we're not seeing this kind of precipitous decline in home prices.
Do you expect, one of the things that's been kind of trending, I believe, in social conversations over the past couple days now is the amount of rental properties that were purchased over the course of the pandemic for low financing. And now that there has been even this resurgence of travel, there still is a concern from some of the owners of those rental properties that they're not seeing enough traffic because there are other more affordable options that are out there. So all that considered, could we see a wave of potential new homes, existing homes, come back on the market? And what would that do in the current demand profile that we see right now?
It's certainly possible. It's on the existing home sales side, what you have is you have these people that sort of feel locked into not selling their homes. So maybe people who bought over the last couple of years, or even further back, but and they like to move up to a new home and put their home on the market and sort of jumpstart this kind of movement of houses, across the housing market, but they don't want to give up a 3% rate, take a 6% rate. And that's been one of the sort of key factors keeping demand off the market. That said, if you see rates continue to stabilize and you see people get used to it, and be willing to kind of factor that into their budget, then you start to see those people put their existing homes on the market and jumpstart the movement of housing. And that said, there still is this kind of push and pull between whether it is better to rent versus own, in terms of factoring that into a monthly budget. And the rise in rates has definitely appended that calculation. But we are seeing kind of like the top, we had a lot of people move back into the rental market or, decide to rent rather than, buying immediately. And so you had that rise in rental prices. And now you're seeing that equation kind of start to rebalance again. And the rapid rise in rents that we saw has kind of topped out and is coming back down to earth. So, some of the kind of dramatic movements that we had last year and all of that is, starting to reverse or at least stabilize.
Ben, I want to pivot topics, but just briefly before we do that, in 15 seconds or less, what will be the true measure of whether or not the Fed wins its fight against inflation, at least as indicated by the housing market?
That's a good question. I think the Fed probably doesn't want to see home prices rising double-digit percentages in some of these cities that continue to be hot. The thing that makes it hard to look at the housing market right now is that it's a series of regional markets. It always has been, but you're seeing wide divergences. So home prices falling in some places, but surging in other places. So to see that kind of calming down in some of the hottest markets, I think is definitely one thing that they'll be looking at.
And Ben, talking of banks, I want to get your take on the banking sector. The Federal Reserve conducted its first annual stress test since the regional banking crisis this spring. We got the results yesterday. All 23 of the biggest lenders in the U.S. did pass. Some, like U.S. Bancorp, Citizens, and Truist, did feel a little bit more of a squeeze as we looked at the criteria. But as we near the beginning of the new quarter, big banks like J.P. Morgan and Goldman Sachs could be facing tighter profit margins as a result of all of this. So as you look at the results of the stress tests, as we look forward, what signs are you looking for from the banks?
The stress tests are pretty interesting because they put out the scenarios that they use to stress test the banks before the regional banking crisis that we saw, and those tests had sort of as their what they were testing against was a big recession in which interest rates decline, and you start to see a lot of the kind of the opposite things than what caused the regional bank failures that we had. So in many ways, it's sort of backward looking. And so you saw all of these banks come through and they looked pretty strong and they looked like they were doing well, which in many cases they are, but they also were sort of testing against a scenario that is not quite what we're seeing. So, that's just one thing to keep in mind when you look at those stress tests. And, I think we're going to be seeing other regulatory moves as we kind of move forward throughout the summer. There's more regulations that are kind of being considered right now, and other ways that regulators are devising to kind of test the banks. And I think as a measure of bank health, the banks look good, but this was sort of backward looking, for the moment.
The housing sector has been in the spotlight with disruptions in home sales, home building, and inventory due to a mix of macroeconomic conditions like inflation and, of course, tightening monetary policy. Fannie Mae, the government-sponsored housing organization, recently revised its housing call. Yahoo Finance's Danny Romero joins us with more on what's ahead for the housing market. Hey, Danny.
Hi there. Well, Rochelle, we've hit that halfway mark this year, and economists on the street, including Fannie Mae, are revising their forecasts. Fannie Mae, the agency, is forecasting that national home sales will drop about 1% this year and 2% next year. Now, why is this coming? What's going on here? Well, the reason is the tight housing supply, which is supporting those home prices to be elevated. And home building has ramped up tremendously this year. Home prices are proving to be resilient, outperforming expectations due to those baby boomers aging in place. The Gen Xers also locking in those low mortgage rates, and home building ramping up production and supply. Again, Fannie Mae isn't expecting home prices to crash, but more like to fall even further. We've seen some overheated markets like in the Western region. Those home prices are falling, while in the Midwest and in the Northeast, home prices are a little bit on the elevated side. Now, looking forward, looking ahead, Fannie Mae is forecasting that the 30-year fixed mortgage rate will hit by the end of the year, will hit about 6%, and by next year, it'll be about 5%. Rochelle?
And so, Danny, keeping in mind that there are a few key events this week, you've got Fed minutes, the jobs report looming as well. What's anticipated next then for mortgage rates for people who are looking?
So mortgage rates could go even higher given the key events this week. If we take a look at the 30-year fixed mortgage rate, it is about 7%. So it could go even up. Bond traders are anticipating, expecting volatility this week, which could push the 10-year Treasury yield to hit that 4%, as investors are really attracted to investing and buying government bonds. Why is this important? Well, the 10-year Treasury yield is the closest proxy to the 30-year fixed mortgage rate. So it's a good gauge on where mortgage rates could land.
A new report highlighting the state of real estate in New York City. Prices edging down in the second quarter compared to a year ago, but they're still hovering near record highs. Joining us now is Frances Katzen, founder of the Katzen team at Douglas Elliman. Good to talk to you today. So there's some positive in here, some stability, hovering near record levels. What's holding the market?
Cash. And people wanting to take an opportunity to get in while there's a capitulation in the market for sales. And I think the cash component is definitely creating leverage amongst the sales because there's not a lot of mortgage deals taking place right now. They're very impacted by the rate hikes.
Frances, where is that? I guess who is buying? Because when you're focused on New York, obviously the average selling price in New York is extremely high when you compare it to what we're seeing play out in the rest of the country. So where is that demand coming from?
It depends on which area. I mean, you've got families that do need to upgrade, that do need to buy, and then you've got people who want to take opportunity while there's a lag in the market. The people that are buying are the people that have the means and the discretionary income to exercise it, to be honest. I mean, the outlier states are definitely feeling it. It's definitely flat for the spring season, but I think ultimately there are deals to be had, and I think that is basically what's driving it, and the lack of demand. We are down 20.8% in inventory right now. And that's the cadence that's holding it.
Going back to Shauna's point, though, if you're talking about all cash offers here, I mean, are investors just kind of parking their money there?
It's twofold. I mean, I think the proliferation of cash is basically pushed forward by the lack of mortgage deals. And I'm not sure that it's necessarily more cash. It's just that the cash deals are becoming the prominent presenter. We're down on the cash deals anyway by 29%, but 65.4% of the deals that are closing are cash.
Frances, you mentioned
the average pricing, not the luxury sector, the averaging pricing right now is down at 1.2 million.
Yeah, but still 1.2 million, a heck of a lot of money, and certainly pricing out a lot of people who are looking for a home at this point. But Frances, you touched on something that really applies to almost everyone that is looking for a house right now, and that's the lack of inventory that is available. When it comes to New York, are you seeing any improvement along those lines, or what does the timeline for a potential improvement look like?
We saw a lag in inventory for April and May, which is usually a very strong season. And we're down for the first time in 11 years, year to date. So that's normally our big push for our inventory. I think that people were hoping to see more inventory hit during the spring market, but I think people are holding back because of the rate hike. People have to say goodbye to what they currently have, which is averaging 2.5% to 3.5% interest rates. And now we're seeing interest rates ticking just under 6% and a 30-year fix at almost 7+. So I think that's the big dilemma of why we're seeing such a shape of lack of inventory. And the big question will be after the summer doldrum and we're back into the first quarter in September, the quarter of September, what we're going to see in terms of inventory brought back forward. I think everyone's trying to time it.
If we're talking about this from an investment perspective, how does New York City compare with some other major cities? If we're talking about the luxury market, I mean, how much more upside is there to be had in New York compared to some others?
I think New York by nature is a hub for investment. I think most people want to park their cash in New York, London, and Paris. So I think New York's always got the upper hand in terms of desirability for performance, especially from overseas. As it relates to the outer areas outside of New York, I think what we're finding is that although it's flat, we're still hearing about bidding wars taking place in Connecticut or in Texas. LA is still performing. It's not as the boom years of 2021 and 2022, but I definitely think that if the unit's priced right in any segment, you're going to have a complete bidding war because there's just not enough inventory because of what I mentioned before.
Frances, what is all of this doing to the rental market? Because I've seen the recent numbers here out of New York City, and it's extremely expensive. Over $4,000, I believe, the average price for a one-bedroom. How, I guess, do you see the lack of inventory, the fact that that situation might not improve anytime soon? What's that going to do to the rental market going forward?
I mean, it's going to tighten it up. I mean, I think even in November of last year, we were down in inventory at 2.7%. Right now, inventory has been spotty because I think the entry market was trying to get in. But because the rates started to jump back up, people couldn't make the numbers work. And so even though it was a 40% increase on the average rent from COVID times, it still was inherently better than trying to take a mortgage as an entry market buyer because it was too high. So I think what you're going to see is that the rental market's going to sustain a certain amount of strength, which I think is frustrating a lot of people who've been priced out.
Inflation continued to cool in June, rising at the slowest annual rate since March of 2021. Year over year, we saw core CPI rise just 3%. Joining us now, we've got Jens Nordvig, who is the Exante Data Inc. founder and CEO, and we've got Stephen Juneau, who is the Bank of America Securities U.S. economist. Gentlemen, thanks so much for taking the time here with us today. Jens, you're here in studio with us, so I'll go to you first on this. As we think about the headline figure that we saw, does this move the needle at all with the Fed, given that we've just had their meeting minutes not too long ago kind of spell out exactly how their tenor already was coming into not just this data, but also the next meeting too?
Yeah, so I think in terms of the next Fed meeting, like it's almost like the Fed is locked in. I don't think they're going to change their opinion about that. But really what matters for market is what the trend looking a little bit further ahead. And I think this number today is a very important number, right? We've had a huge debate about how sticky services inflation is going to be. And it's mostly the services that drives the core number, right? And this is the first reading we've had that has been less than 0.3 on the month for almost 2 years. And actually, if you look at the unrounded numbers, this number was close to 0.1. So this is a new situation. We've already had goods prices being very low. In fact, no goods inflation for the last 3-4 months, right? So if we also have the services prices starting to show some moderation, it's a very big deal for the Fed. So I think July is almost a given, right? But all that expectation that the Fed might continue to go beyond July, that is now in question, like you said.
Yeah. Stephen, I want to bring you into this. I mean, again, just to put a fine point on this, finally, right? It feels like this is finally cracking, that we are finally getting a little bit of relief. Put that in perspective for us. Like, how relieved should we be? Is this, should we believe this? Is it actually slowing down?
Yeah, well, first of all, thanks for having me on. And I would absolutely agree. We're finally getting kind of those softer prints. We're seeing that progress being made on the inflation front. As Jens noted, we did see core goods, ex-used cars. We've seen that flat for the last 3 or 4 months. I believe on a 3-month annualized rate, it's basically at 0.2. I mean, that's pretty impressive. I mean, it's not the deflation we were hoping for, but it is significant disinflation. We were running at 4.7% annualized in the first quarter. So that's really a big improvement. And you're also seeing shelter come down. You're seeing rent prices moderate. You're seeing OER come down. That was expected, right? You've seen that in the asking rent data. It's going to continue to evolve, continue to be a downward force on the inflation data. And now you also have used car prices falling. That was a big thing, right? The last 2 months were marked by used car prices increasing by 4% month over month or more. And now you get that 0.5% month over month drop, and you're likely going to see bigger drops coming in the coming months. And that's going to put further downward pressure on core. So I agree. I mean, some of these things may not repeat, right? They may not be as big. Airfares was a big decline. But I agree, this is a very soft report. We saw a lot of things to like. And we're seeing a lot of progress on the inflation front. And it's a continuation. You know, the last 2 months were marred by idiosyncratic factors. And now we're seeing those kind of fade a little bit, or really reverse and kind of push it down the opposite way.
Stephen, just as you were mentioning housing a moment ago, I want to kind of help make sense of this a little bit more, perhaps for my own edification and even that of some of our viewers as well, because we were talking earlier about how housing prices had accounted for 70% of the year-over-year increase, and yet coming down. So perhaps you could just help us break that down a little bit more.
Yeah, so you have to realize housing is the biggest component of the CPI basket. So it's always going to have an outweighed influence on the overall numbers. So that's what's been happening, but it's also a lagging indicator. So the way CPI does rents is it doesn't reflect what's really going on the ground floor, what's happening to someone who's taking on a new rent today. And what we're seeing in terms of what people are facing in terms of new rents and what we've seen in progress there over the last 6-9 months is that new rent inflation, asking rent inflation, is really moving lower. And what that means is that it's eventually going to catch up in the CPI data. We're seeing that already. We saw that step down in shelter inflation. We saw that continue this month a little bit. It's running at about a 0.4, 0.5% annualized pace, or 0.5% month over month pace, rather, instead of that 0.7, 0.8% pace that we saw to start the year. But now we're seeing that step down, and we think that progresses just given what we're seeing in asking rents. And again, it's a big share. It's the biggest component of the CPI basket. So as that comes down, we're going to see core CPI come down a little bit more. We're going to see headline come down a little bit more, and we should see inflation continue to moderate a little bit over the course of this year.
Jens, I want to linger on shelter inflation a little bit. And this is a conversation that's been going on for a little while now, that it's a pretend number, right? Owner's equivalent rent is something that is sort of made up. It's like, what would you be paying if you were renting the property? But should we just, do we just have to live with it at this point? Like the Fed doesn't seem to be, the BLS doesn't seem to be, they don't seem to be moving away from this measure, right?
No, I think the Fed is aware of this lag. Like Powell has been very explicit that he knows that there's some kind of lagged process there. And also the specific, everybody have their favorite breakdown of the CPI report, right? And Powell has a breakdown where he strips out those measures and looks at other core services, right? So in terms of policy, they're going to look at this holistically, right? And now we clearly have some improvement. And even if there's that lag, they're going to see increasingly through that. So I think it's a very important turning point. And it's going to ease, like those people who are extremely concerned about very persistent services inflation, they're going to be less worried. And I think the other thing I would say is that inflation expectations really have been under control for quite some time. Like obviously 2 years ago, the Fed was clearly behind, but they got kind of up to speed, and inflation expectations were never a worry, right? So like the argument for the Fed going extremely aggressively is that they're somehow like way behind the curve, right? Our inflation expectations are going bananas. That's not the case, right? So I think there's a situation where the Fed can say, okay, we've tightened a lot. We're going to do one more in July, and then we're probably going to take a break now. So this number makes that much, much more likely than before.
Fed's rate hikes continue to ripple through the housing market, even if bulled-up investors in stocks don't care to pay attention. We just saw lackluster housing starts figures for June. The question now is what's next in housing? National Association of Home Builders CEO Jim Tobin perhaps has that answer for us. Jim, good to see you here. Let me frame it to you this way. You have RH, Home Furnishings Company, that CEO, Gary Friedman's painting the housing market as completely falling apart. But if you look at the permits component of the housing start today, signs of life. Where should, or should I say, who should investors believe?
Well, I think what we look at the way housing starts came out today, if we take out the May numbers, which we believe seem to be abnormally high, and maybe that's a little bit more of an aberration now. What the June numbers show us is that we're actually back on trend. In fact, even with this dip, we're still looking at the largest number of housing starts since June of last year. So the demand continues to be out there. But when we look a little bit forward ourselves, we are seeing interest rates are starting to wear on home buyers out there. Permits give us a little bit of a breathing room in the future, but right now it seems that while demand is there, very few people are able to meet those or match those 7% interest rates.
Jim, should home buyers, potential home buyers, or even those that are selling, should they almost be thinking as 7% or that 7% level as the new normal, or do you think we will see maybe some downward movement here in rates between now and year end?
Yeah, we think that interest rates are going to settle downward over the next 6 months, without a doubt. We're clearly at the end or about to be at the end of the Fed's tightening phase. And that said, I don't see the Fed easing anytime soon. In fact, we predict that the Fed's going to hold steady for probably another year or so. So I think while interest rates should come down, or at least mortgage rates should come down over the course of the next 6 months, I still think that home buyers need to get used to 6% or even 5.5%. But gone are the days of our 3 or 4% mortgages.
Jim, what should millennials living with their parents right now be doing? You have some money saved, maybe $150,000, $200,000. Do you just bite the bullet, take out a mortgage at these rates, and finally get into a home and get out of your parents' basement?
Yeah, I'm pro homeownership, plain and simple. So for me, if you've got money saved out, you've got money for a down payment, go ahead and dip your toes in. You're going to find more new homes, brand new homes are for sale than existing homes. We are running into this phenomenon where a lot of the existing homeowners are in those 3 or 4% mortgage rates that I talked about, and they're reluctant to move out into those higher rates. But there are some new products out there, and I would encourage anybody who wants to dip their toe into home ownership and to get in now. If you can find a home that meets your need and you can qualify for it. But it's always a great time to buy, especially with the market where it is. I'm encouraged that it's time to buy.
Jim, when it comes to lot availability for these home builders who are looking to build homes, is that an issue yet? And I guess if it's not yet, is that something that could potentially be a massive challenge here?
Yeah, I think the challenge facing our builders now is finding land to develop. That's a big issue, which means local governments need to help. If we're going to solve the housing affordability crisis in this country, and the only way to truly do that is to build more housing, then we're looking for local governments to embrace the need for home ownership and to encourage home ownership and rental. By making sure that they're putting the policies in place to find more land, and then lending will begin to ease over the course of the next 6 months or so. So there's opportunities out there, but it's going to take everybody pulling on the home ownership wagon to move forward.
Jim, all I think investors have heard from home builders, among other things, the past 2 years, and that has continued into the first half of this year, is inflation in materials prices, lumber, metal, labor, you name it. Has inflation started to turn in the components that go into building a home?
It has definitely. Lumber reached its peak about 2 years ago. That's now consistently down, which is great to see. In a lot of ways, the building material supply pipeline is whack-a-mole. Some components are up higher than others, while others are down, and then they seem to reverse over the next several months. Give an example. Right now, electrical transformers and electrical components that power a home are the real drag on home construction and apartment construction right now. But I do think inflation is easing in the component space and will continue to do so. And we know how much the Fed is watching all of that and all those inflationary numbers. But from a home ownership perspective, we're encouraged that things are trending in the right way.
Investors cheered last month's cooling U.S. inflation data as an encouraging sign for the economy's recovery and a hint that we may be nearing the end of the Federal Reserve's rate increase cycle. But our guest says inflation could actually get worse before the year is done, and markets may be in for a shock. We want to welcome back in Wells Fargo, Daryl Cronk with us now. So let's do a deeper dive of this. You kind of teased this out. We have some notes that you shared with us. We know inflation cooled, but your take on this is not so fast, basically, in terms of how we interpret this.
Yeah, if you look at past inflation cycles, right, and I think it's true of this one too, is you typically have a quick rise in inflation. We saw that last year, peaked at 9% on the CPI in June of last year, a quick fall in inflation, and then often it bumps along in a kind of a consolidation phase, and then it rises again. That's about how all of them have happened. What's interesting is, okay, you start breaking down what are the components that drive inflation, right? So we saw inflation drop nicely last week, and CPI came down from 4% of the headline to 3%, right? If you look at the back half of the year, you say, okay, is that trend going to continue? Which I think markets have bought into, right? This immaculate disinflation, and we're just going to go down to the Fed's 2% number and stay. But think about it this way. Just in the year-over-year comparisons, which is how we measure inflation, the rate of change, you need oil prices to be at $70 to keep inflation flat. Oil today is at 80, right? So it needs to come down. Gasoline futures and prices are up 20% in the last 60 days, right? So you think about inflation at the headline number, energy and food, right? And then I get into the core number, which is still sitting at 4.8, way above where the Fed wants to be, right? What are the drivers of core? Shelter, housing, right? We just talked about housing and the strength there. So you need the housing market to kind of roll over. You need wages to roll over and labor to roll over, which so far has been sticky and hasn't happened yet. So I think the risk here, and again, it's a risk, is that in the back half of the year, inflation could actually tick higher. It's not going back to 9%, but it could go from 3% back closer to 4%, which then has the Fed in a very different position. The Fed is not done in July then and needs to do more work later this year, candidly.
Even if it doesn't tick back up, even if it stays around where it is right now, we've talked to a number of investors who have suggested the market is wildly over-optimistic in thinking the Fed is going to be cutting next year because of a drop in inflation. It sounds like you're in that camp as well.
Yeah, I think it's tough to make the case for big, massive cuts. You reverse engineer that argument and say, why would the Fed aggressively cut when they've been so diligent and so resilient on the inflation conversation?
If the recession arrives and inflation goes way down.
Yeah, I mean, basically the Fed would have to do quick and emergency cuts if the economy does the Thelma and Louise right off the cliff, right? And none of us want that, and we're not predicting that, but I'm just saying that's the recipe for why the Fed comes back aggressively and says, wow, we've got to reverse course and add stimulus back into the economy. Right now, they're talking about still tightening policy, not easing policy. And the market has perennially got this wrong. The market has been pricing in cuts, and keep pushing that out on the calendar. Now it's pushed out, if you look at Fed funds futures, out into kind of mid-2024.
So obviously the vast majority expect next week that we're going to see a hike, but many industry experts that we talk to think it's kind of going to be one more and done. You're not in that camp, I'm guessing.
I don't think so.
Is it a to and through?
Yeah, I think it's more that, to be honest, Diane, because again, the data just doesn't suggest that that's going to be the case. And what's interesting, and this will be an interesting case in behavioral finance or psychology that will get studied at business schools for years, right? Which is the Fed has never wavered on their message, right? For the past 12 to 18 months. Powell has been resilient in saying, look, we are going to see this through until we get to 2 to 2.5%. Even if you assume inflation doesn't tick back higher, like we just talked about, 3 to 2, that last mile traveled is a really hard mile. You've got to tighten policy aggressively even from here to get us to 2, in our opinion, unless you drop into a recession, which would be disinflationary or deflationary. So we think the Fed probably does have more work to do. That's not priced into the market today, right? The market has to reset that. And that's going to probably create some volatility in the back half of the year. So here at mid-year, we'd kind of fade this big move in equities, this 16, 17%. You know, it's been all on multiple expansion, nothing on earnings growth, which has been well documented. So, you know, what multiple do you want to pay for the next dollar of earnings? Do you want to pay 21, 22, 23 times in a slowing growth environment and an environment where policy is still tightening? I would be careful there.
So it sounds so. You're saying you think that stocks are going to come to that realization. What's going to cause them to come to that realization, right? So what would change? The momentum is clearly the upside.
It is. The pain trade is to the upside.
Yeah. What's going to change that?
So what will change that will be inflation and Fed expectations. But more importantly, everybody talks about what the Fed's going to do with Fed funds. And, you know, there's been some out there saying the Fed will need to take this to 6% or possibly even higher to ultimately arrest inflation. What's interesting, if you go back and watch market action over the last 12, 18, 24 months, every time the 10-year Treasury, the long side of the curve, has gotten above 4%, it's gotten really hard on equities. We just experienced that earlier this year. We experienced it in October of last year. When you drop below 4, it's kind of party on, right? And everybody just believes that, you know, that low interest rate environment on the long side of the curve, which is pegged to growth and inflation, tells you that, you know, the Fed has done its job and they've won the war. And we're just not so convinced. And history would be on our side of that, which is it's not just easy to arrest inflation once it goes higher, right? Like I said, it goes up quickly, comes down quickly, and then often has resurgence periods of time. So if it were that easy, we'd have heroes for past Fed chair people, right, who have done this miraculously, when the only one we probably lift up is Paul Volcker, who took interest rates all the way to 20%, right, to finally arrest inflation.
Home prices, at least in our national index, seem to have peaked almost a year ago in June of 2022. They then declined through January of this year, 2023, so about a 6 or 7 month period of decline. And that total decline amounted to about 5% from peak to trough. Since January, we've had now 4 consecutive months of increases. In fact, this month's release, or today's release, which was for the month of May, made it 4 months in a row, and we have seen increasing prices. So pretty clearly, looking at those data anyway, you would say the decline that looked like it probably had ended in January, it's ended in January. We're now clearly in an uptrend. Second thing to say, I think, is that the increase is very broad. We monitor not only the national composite, but also 20 individual cities, and every one of the 20 was up in the month of May and also in the month of April. So it's not a decline or a gain that's concentrated in 1 or 2 areas, but instead is quite broad. I guess the third thing to say, and this is always among the most interesting things when we look at these data, is that the regional differences are quite striking. I mean, for literally 5 years until this month, the city with the largest year-over-year gain had been what I think of as a war. Vegas for about a year, and Phoenix for nearly 3 years, and last year or so, it's gone back and forth between Tampa and Miami. This month, Chicago and Cleveland in second place. So we're seeing a resurgence of the Rust Belt in these most recent data.
So, Craig, when we're talking about 20 cities, obviously, individual storylines going on there as well, but the national picture. Is there a snapshot here where you can point to say why we are continuing to see the rebound? What's driving it?
Well, I think a couple of things. One is that the rapid increase in mortgage interest rates that we saw last year has come to an end. I mean, when I say rapid, I mean we went in the space of maybe 6 months or less from a mortgage rate with a 2 or 3 handle up to something with a 6 or 7 handle, and it's kind of stabilized after that. I think it ticked up a bit today, but we're still relatively stable compared to what was going on a year ago. So there hasn't been that rapid increase in rates, and obviously the more mortgage rates go up, the less affordable houses become, and the less able people are to buy them. The second thing is that as the economy has evolved over the last, say, six months to a year, it looks increasingly as though the Federal Reserve will be able to pull off what I think they would call a soft landing. In other words, a reduction in in inflation rates without putting the economy into a full-fledged recession. Obviously, if there is it influences people's incomes negatively, it negatively affects houses. We haven't had that yet. So the fact that the rates seem to have flattened out, if not decreased, and the economy is still reasonably strong are both good things for the housing market. The additional factor, of course, that everyone who studies this is aware of, is that because so many people either bought for the first time or refinanced several years ago when mortgage rates were in the 2 to 3 neighborhood, for those people to move and move up even to a larger house, even if they need a larger house, becomes much more expensive because they not only have to pay for the larger house, they have to pay for a much higher cost of financing.
Well, the inventory crunch in the housing market getting worse last month. New data from Realtor.com shows there are 20% fewer homes newly listed up for sale in July compared to last year. Danielle Hale is the chief economist at Realtor.com, joining us now. Danielle, Danny just talking about that 5% rate, which is kind of the tipping point that gets sellers or potential sellers off the sideline. I mean, what are other factors that you're finding that's really adding to that supply crunch?
I think the mortgage rate lock-in effect is a big one. but it plays into this overall affordability picture. So we look at the number of homes that are on the market right now, it's down. But then if we look at the number of homes that we've built over the last decade, it's really trailed the number of households that have created. The most recent data from the census, the housing vacancy survey, showed that homeowner vacancy is at a record low of 0.7%. There just aren't a lot of homes that are out there sitting empty, unused. And when you don't have slack in a market, which is very much the case in the housing market right now, you tend to see a lot of upward price pressure. And that's a challenge when mortgage rates are back getting close to long-term highs, close to 7% again, because already prices are high, borrowing costs are high, there's not a lot of affordability for buyers, and a lot of potential sellers are going to turn around and buy. So what's a problem for those buyers is also something that factors into a lot of seller decisions as well.
So Danielle, Diane here. So you're not winning if you're a seller, you're not winning if you're a buyer. Who's the winner in all this?
Yeah, I mean, I think people who can manage to find a new home that fits their needs, it's in their budget. It's not easy, but it can be done. And those are people who can win. There are some advantages for buyers right now. The fact that there aren't a lot of homes for sale is not one of them, but there's less competition in the market right now because not everyone can navigate these higher home prices and higher mortgage rates. Another opportunity is for very equity or cash rich buyers. They tend to be older buyers, maybe baby boomers who are looking to downsize, especially if they're considering downsizing from an expensive market to a lower cost market. They have some flexibility right now in a market that's less competitive than it has been over the past couple of years. So even though it's a challenging market, home shoppers do have some means of navigating it. And we're seeing this in our data. Our cross-market demand data shows that a record high number of people are looking for a home in a market other than where they live. So we think affordability is driving a lot of that trend, especially when you consider that the biggest areas where people are looking for homes elsewhere are in the West. And then the fastest growing region for people who are shopping elsewhere is the Northeast. Those are also very high cost markets. So people who are in high cost markets are looking for homes elsewhere, really trying to capitalize on affordability.
I mean, does that suggest further migration then as a result of affordability if you're looking at a market outside of where you are right now because you can't buy a house there?
Potentially. What I think is interesting, so we're measuring this as a share of the market. And so while the absolute numbers of people moving far away may actually be lower because we have seen fewer home sales this year, and we expect to see a 10-year low in home sales in 2023 as a whole, they are an increasing share of the market. So the people who are moving right now are the people who have that flexibility to maybe relocate, or maybe they're at that retirement stage in their life where they don't need to stay tied to their current location and their current job. And so, they're willing to relocate. I think it's very surprising in light of the fact that we're seeing a lot of return to office behavior increase. And so, greater demands on workers to be in the office. In spite of that, we're still seeing a lot of cross-market shopping. We think affordability is driving that. In fact, in research with the Wall Street Journal, we found that markets in the Midwest are topping those areas where housing markets are still good. We're still seeing price growth, quality of life indicators are good. People are trying to have their home and be able to afford it, and affordable areas continue to pop to the top of our list.
Danielle, going back to that supply crunch, what we have seen is that's led to a big uptick in construction. We saw that reflected, for example, most recently in those numbers we got out from Caterpillar. At what point does that construction supply coming online catch up to the demand and the supply that's needed?
Yeah, I think just understanding the magnitude of the problem, depending on the assumptions you make about multifamily construction and single family construction, you can get anywhere from an estimate of like 2 to 6 million homes that we're short. And for context, we build about 1.5 million homes a year. So it's a huge hole. Even if all we did was build to fill the gap that exists, we're looking at a 2 to 5 year problem. And that's not considering all those new households that are formed. So there is a lot of opportunity for construction. And I think that's going to continue over the next several years. Fortunately, if you look at multifamily construction in particular, the number of multifamily units under construction right now is at a record high. So there is some relief on the way for renters and apartment dwellers, and single family construction has been relatively high, not at the peak of its range, but it could stand to benefit from some more construction as well.
New data showing home prices have reached record highs in more than half of the major markets. That's according to research out today from the real estate fintech company Black Knight. It found that prices are still rising, but at a slightly slower pace compared to previous months. Now, it's a boost to homeowner equity levels, but as mortgage rates near 7% on average, many are holding on to homes for longer, causing an inventory crunch in the market. Here to discuss further is the Vice President of Black Knight's Equity Research, Andy Walden. Andy, thanks so much for joining us today. All right, let's dive right into some of your numbers that you all produced in your report. We're seeing that prices have peaked in or reached new heights in 30 of the 50 largest markets. Where are we seeing the largest increases?
Yeah, absolutely. And really it's Midwest and Northeastern markets. It's markets that didn't cool down quite as much last year. They're more comparatively affordable. They have deeper inventory deficits. So that's where you're seeing the markets that are the furthest up is kind of that Midwest and certainly Northeast, kind of centered around Connecticut. And then the areas that are the furthest down, certainly Austin, Texas is really the one market that's still in a very corrective type environment. And really across the Western US, they're down from last year.
Andy, could you just kind of outline what an unusual circumstance we find ourselves in for the U.S. housing market? According to your own notes, affordability is the worst it's been in 37 years, but we have very low delinquency levels because people are locked in at lower rates. I'm just wondering if there's a canary in the coal mine when we think about what happened with the global financial crisis. Back then, we had people with multiple properties, and they were using their houses as ATMs. Anything like that going on today?
It's not, right? When you look at home affordability, it's very similar to where it was in 2005, 2006. And so certainly that catches your eye. And as we all know, we have significant affordability challenges out there in the market. In terms of risk of mortgage performance, significantly less risk than there was last time around, not only because of the quality of mortgages out there in the market, but because of the lack of that adjustable rate activity out there in the market as well. In 2006, you had a quarter of the mortgage market that was made up of adjustable rate loans. Today, it's 5%, and very little reset activity set to take place over the next few months. And the 10.5 million folks that took out rate term refis are still benefiting from those low rates right now. And so mortgage is really affordable for folks that took them out prior to 2022. Little different story for folks that are shopping for them today.
And I got to ask you, Andy, some of your research showed that the number of underwater homeowners, to Jared's point, it's on the rise. Obviously not nowhere near the levels that we saw during the financial crisis and that housing bubble that we saw. Is there any potential for this to go much higher and there to potentially be a housing bubble, or is really just the inventory is not there, so it can't happen now?
Yeah, is there the potential? Absolutely there is, right? There's a lot of downward pressure on price from the lack of affordability. As you mentioned, inventory holding those prices high. So when you look at underwater mortgage holders, there's only about 0.65%, about 344,000. Now there's two ways to look at that. One is, hey, it's up 70% year over year. That's concerning. The other way to look at it is it's still historically very, very low. We still have less than 4% of mortgage holders that have less than 10% equity in their home. They're even close to underwater. So still very strong from a historical perspective. And the needle is moving in the right direction given how firm and even strong prices have been so far this year.
And I think it's fair to characterize overall, this is a seller's market, but this is a very big country that we live in. There's a lot of disparate regions within the U.S. And are there any places where one might find a bargain, if we can even use that word, in this market?
Yeah, probably not a bargain. Probably isn't the right word, right? But there are some more affordable areas of the country, right? Everyone is less affordable. If you look at the 100 largest markets in the U.S., everybody's less affordable than their long-run averages. But when you look at places that are a little bit closer, it's your Midwest, it's your Ohio. You've got some heat in Connecticut, right? So it's some of those Midwestern markets that aren't quite as volatile, that didn't see that massive run up in prices or as big of a run up in prices in 2020, 21, 22, that are more affordable today, that maybe you could, I don't think I would even use the word snatch a deal, but get closer to that, right? Get a little bit more balanced in your efforts there.
Andy, I love the shout out to my home state. I'm originally from Ohio, actually. So shout out to Ohio. And to your point, for instance, the home my sister lives in, it would be a shoebox here in New York for that same price. And Jared made the point about it being a seller's market. But is it really, you know, when you think about it? Because if a seller puts their home on the market, they have to go and try to find a new home. And with affordability where it is, that challenge, I mean, how do you resolve this pickle if it's not a seller's market and it's not a buyer's market? And I've asked this to one of our guests recently, who is winning here?
I think the answer is nobody, right? Nobody's winning right now. I mean, it is a seller's market by the numbers. If you look at months of inventory out there, it's 2.9 months. It's firmly in the seller's camp. But you're right, it's not a sell and rebuyer's market because you can get the price you want on the sale of your home, but then you're having to go out there, give up your low rate and compete at higher interest rates and higher prices. And so really, I mean, to your point, there are no winners in today's market, right? It's a challenging market for folks trying to relocate, certainly a challenging market for folks trying to enter in. I think the winners are existing homeowners, right? We talked about equity getting back to near record levels. I think those are the folks that, you know, have locked in those low payments, have locked in a low purchase price, that are seeing the benefits of those low rates in their equity grow. I think those are the winners in today's market.
And if we think about the current 30-year mortgage rate, how much does that need to go up to create some real hiccups in the market, finally seeing some people completely priced out? Or on the flip side, what if it goes down? Is there any threshold that just opens the market up in the other direction?
Yeah, it's a really good question. If you see interest rates go up, the problem is it's a double-edged sword, right? So certainly it prices folks out, but it locks folks more into their existing homes as well. So you're reducing demand, but you're also reducing supply at the same time. And we're already seeing that with interest rates at 7% right now, which is why the Fed is having a challenging time bringing affordability back into whack, because they're reducing demand, but at the same time they're reducing supply, and it's just kind of locking the market up. In terms of when do we start to see the market unlock on the way down? I think you would see demand come back kind of gradually on the way down. And even when we've seen interest rates get down into the 6.5% to 6% interest rate at points in time, you'll see borrowers return to the market. My question is, when do sellers return? Because we haven't seen that. Even when interest rates have begun to ease a little bit, we haven't seen those sellers dip their toes back into the market. And that's the more concerning part for me.
It's getting harder for Americans to purchase their dream homes. Persistent inventory challenges are continuing to create challenges for home buyers. In the month of June, the U.S. registered its lowest inventory count since the National Association of Realtors began tracking this data since 1982. Well, our next guest says 2023 could go down as the tightest inventory market conditions to have ever been recorded. For more on the state of the housing market, we're joined by Lawrence Yun, National Association of Realtors Chief Economist. Great to have you back on the show here. So let's break down some of this data, because I know you've said that the recovery hasn't taken place, but the housing recession is over. So where are we now, and what breaks this holding pattern?
We are in a very unique housing cycle. We saw the buyers pull back initially when the interest rates were much higher, but now the buyers, multiple offers are happening, but the supply is not there. At the same time, the builders are having great time. They're making profits. They're building those empty new units, and they're able to find buyers. So we are in a very unique circumstance, but the inventory clog up, that is holding back the potential for recovery.
And how quickly can home builders ramp up production, especially when you factor in needing to hire workers and to try and meet some of this demand?
The cost of construction is rising. One has to consider, the building permitting process, which may take a very, very long time, especially in some states like California, which will hinder a continuing supply situation. But what really needs to happen is, can we find an incentive, tax incentive, to unleash some of the inventory held by mom and pop real estate investors? There are over 20 million single-family housing units that are rented out. But if we can get even just 1% of those inventory onto the market through tax incentive, essentially reduction in capital gains tax, if it is sold to, say, first-time buyer or with some income limitation, that will spur more supply immediately, and that will help the housing market and the broader economy. So that will be one consideration I think the Congress should seriously consider. But in the meantime, it's about the builders and maybe changing housing family circumstances. Some people have to move, new job, new child, maybe changes in their marriage status, getting married or divorced. All that will also lead to some addition in the supply just from long-term demographic factors.
Now, how likely is that to happen? We already have a very tight labor market. Nobody wants to have to then now take on higher, mortgage interest rates as well. What sort of timeline could we be looking at when we might start seeing meaningful loosening in terms of the inventory that's out there?
So it's a gradual, steady improvement in inventory, but the big change is either that tax incentive or if the Fed decides to stop raising interest rate. Because one of the reasons for the low supply is that homeowners do not want to trade away their low interest rate for much higher interest rate as they are making their residential movement. But if the interest rate begins to calm down a bit, at least the cost of the move becomes less painful than before. So we could encourage more people to move also by the Fed stopping raising interest rate, especially in light of the fact that Fed has really damaged the regional banks, small-sized banks. I mean, the big banks are fairly immune, but small-sized banks are important for the country, and we cannot further damage the balance sheet of the small-sized banks.
And it certainly doesn't help. We're already seeing, some weaknesses in those regional banks. Moody's downgrading some of the larger banks as well today. But when you look at what people tend to look at, which is the 30-year fixed mortgage, some of the projections for the NAR, 6.4% this year, declining to perhaps 6% in 2024. How much of this pent-up demand are we going to see then start to get released by then?
Oh, yeah, you will see a rush of buyers coming in with lower interest rate. But also, good thing is, again, some of the homeowners who are really liking their low interest rate, well, if the interest rate comes down a bit, they are willing to give up their 3-4% mortgage rate, which they locked into a few years ago. So low interest rate will not only unleash demand, but it will also begin to unleash supply situation.
And Lawrence, where are the deals to be had? Because a lot of people, purchased homes to use as Airbnbs or secondary homes and rentals as well, and, feeling some pressure there as well. Where are the deals to be had regionally in the United States?
Regionally, the Midwest, the most affordable regions of the country, you look at, say, Cincinnati, Indianapolis, the typical median home price at around $250,000. So someone from, say, coastal region, whether from, say, California market, New York, they go into the Midwest, they can buy all cash at times, or the mortgage payment will be very, very manageable. And the job growth in the southern states are very, very strong, whether from Florida all the way to the Carolinas or Texas. Strong job growth is adding to that demand.
Well, consumer prices showed a faster year-over-year increase in July compared to the previous month, as CPI rose 3.2% in July. That's a slight acceleration from June's 3% increase, and it's still well above the Federal Reserve's 2% inflation target. San Francisco Fed President Mary Daly spoke exclusively with Yahoo Finance this morning and had this to say about a potential rate cut this year.
We are a long way from that kind of conversation. We're right now trying to decide if the policy rate is high enough to be sufficiently restrictive if we held it for some time. But definitely you're bringing up a conversation that I expect we'll be having next year. I just can't tell you the answer to that conversation because a lot of that's going to depend on, the vast majority of that will depend on the economy and the path of inflation.
For more on what this means moving forward, we want to welcome in Jeffrey Kleintop, Charles Schwab Chief Global Investment Strategist. Jeffrey, good to talk to you today. So Mary Daly, they're saying that the conversation really is about whether those rates are high enough. But even if they are high enough, at the end of the day, it feels like we're going to be at these elevated levels for a while. What does that data point today tell you? What's your takeaway?
Well, I think that we need to look at the bounce that we're seeing today in the headline number as not being transitory. Inflation is going to be much harder to push down from here, meaning we've gotten used to this steady drumbeat of lower and lower and lower numbers, and now that's being interrupted here. One driver for this is energy prices. U.S. oil inventories have been tumbling. The supply side is tightening as OPEC leader Saudi Arabia delivers on that hefty 1 million barrel per day cutback pledge for this month and next month, and said they could even go further. And CPI is now facing resistance to going lower from housing, which nearly makes up all of CPI in the U.S. at this point. But an adverse commodity price shock, as Mary Daly points out, while it's a real possibility, well, I'll say, especially given the El Nino extreme weather impacts on supply chains and production we could see later this year, we don't think that necessarily would mean that the Fed would hike rates. In fact, in the past, the Fed's reaction to a surge in commodity prices or some kind of commodity price shock has actually been to cut rates rather than hike them.
So, Jeffrey, given all that, I was going to ask before that last point there, do you think the market is being too optimistic then when it's looking at this print? Or given what you just said there lastly, maybe they are reading this correctly?
Well, I mean, the Fed can't completely take rate hikes off the table, although we believe they're done. And I think that means there'll be still some lingering concern about when can they really declare victory over inflation and when might they begin to cut rates. I like to look at Brazil. Brazil began to hike rates 1 year before the Fed did. They paused rate hikes 1 year before the Fed did to the month. And maybe they've now started to cut rates. So maybe in August, next year, we start to see Fed rate hikes, cuts. If that's the case, that could be a little disappointing to a market that's already expecting rate cuts sometime early next year.
Jeffrey, you talk about central bank over in Brazil, but when you look at the major central banks globally, you've sort of highlighted this divergence we're starting to see. Obviously, the Fed has been out in front, the ECB a little behind, and then the BOJ just now trying to tweak that yield curve a little. What does that growing divergence mean for markets? To what extent does that inject more volatility?
Yeah, I think it does inject more volatility when we start to see this departure. We're so used to everything being in sync, and now we kind of get this divergence, and countries are looking at different levels of inflation now. Again, maybe it's stabilizing a little bit here in the U.S., not quite getting down to 2, but we're still seeing plunging inflation in Canada. It's coming down to the UK, but it's still high. So we're at different points in the cycle, and that can mean more volatility in currencies and more volatility in the markets. It's noteworthy that the VIX really came rocketing higher on that news that the BOJ was going to be changing their yield curve control. And that's because the VIX was frankly too low at 13, the lowest level since prior to the pandemic. The markets were just not braced for any event that could drive volatility. And I think there will be a number of events that could drive volatility in the second half of this year. That doesn't mean stocks have to go down. It just means the ups and downs are going to be more frequent and more dramatic.
So, Jeffrey, given that, then what should investors do? How do they protect their portfolios against some of that expected volatility?
One of the things I want to do is focus on markets where they're not priced for perfection. And one that stands out to me is Europe. Eurozone valuations are below average. The current price to earnings ratio based on the next 12 months of earnings for the Eurozone stock market is 12.4. That's below its 10-year average. And I think investors may begin to recognize the durability of this index. It's now outperforming the U.S. this year. And, the U.S. stocks obviously trading above their long-term price to earnings ratio do suggest maybe there's some risk and some vulnerability to any disappointments that might come along with this inflation data, disruptions tied to El Nino effects later this year, or changes in policy, particularly given the particular volatility around China's approach to managing their economy. So lots of potential risks there. I'm favoring those countries that are not priced for perfection. I find those overseas.
Jeffrey, what about the fixed income space? I mean, you were sort of highlighting what we're seeing in central bank policy. In many ways, what we're seeing abroad, not just the ECB, but a place like the Bank of Japan, could really affect treasuries at a time when we have seen higher yields. How are we likely to see that shift up, and where are you positioned in that way?
Yeah, so interest rates are stubbornly higher here, and I guess they've come down a little bit this week, but overall, they've been moving higher. What I'm finding is that shorter duration stocks, companies that get more of their cash flow in the near term, the way out in the future, are behaving really well. They've actually been the outperformers since interest rates began to rise back in August of 2020. And now with the yield curve changes from the Bank of Japan, returning money to Japan, that yen carry trade unwinding, there might be more upside to interest rates and borrowing costs. So companies that can fund their operations out of cash flow are being valued more highly by investors. We're seeing those shorter duration stocks raise based on low price to cash flow ratios, really outperforming here. They stumbled a little bit with all the bank concerns earlier this year, but they're back outperforming again. I'd advise investors to take a look at that characteristic, low price to cash flow, as a winning one for the remainder of the year.
So Jeffrey, here we are almost in the middle of August, that second quarter earnings season. We're getting towards the end of it. We've seen a significant number of beats, 79% of companies posting earnings beat when we compare that to analyst expectations. What's been your big takeaway from earnings season so far?
Layoffs is what actually stood out to me so far this earnings reporting season. Sure, a number of companies are beating, but one of the reasons is, they're kind of looking at managing labor costs. We saw Canada's unemployment rate rise for the third straight month in July, joining other G7 economies. And what I'm seeing is that the commentary from business leaders so far this earnings season is reflecting more layoff announcements. Words like reduction in force, headcount reduction, job cuts, outnumbering those that talk about hiring or labor shortages or difficulty in filling positions, which had dominated calls all last year. And we're hearing this not just out of technology. We heard that maybe last quarter. Now it's CVS, it's InBev, it's Biogen, Qualcomm, money manager T. Rowe Price. So it's not just concentrated in tech. We could be starting to see a turn here in the global labor market with broader ramifications for investors. Remember, usually corporate leaders tell shareholders before they actually start to make those cuts. So we'll have to see how that begins to affect things here as we look out to the third quarter and beyond.
What does this also mean for labor costs? I mean, that's been one of those areas that we've heard, right, from so many of these companies that have been reporting their results, how much they've, for example, had to increase prices because of the labor costs going up. I mean, are we going to start to see a pullback on the back end there, too?
We could begin to see that. I guess Disney maybe hinted a little bit about that at the end of the day yesterday with their report, that maybe we're starting to see a little bit of an ease in some of those labor costs. I know it may not feel that way right now, given all the strikes taking place, but I think they're a lagging indicator. In general, what we're seeing is a tremendous easing in the demand for workers. We're seeing the job openings begin to fall. Like I talked about here with layoffs on calls, we're starting to see a number of countries now with 2 or 3 months in a row of a rising unemployment rate. So I think some of those wage pressures are going to begin to fall, perhaps in lagged effect here with inflation, and that should begin to brighten up the bottom line a little bit, but we have to temper our enthusiasm because at the same time, of course, that can mean less revenue growth as those workers also have less fuel for consumption.
Well, the July CPI report showed inflation is moderating. Both headline and core CPI rose 0.2%, driven mostly by rent and food prices. But is it still too soon to declare it a win for the Fed and its goal of a soft landing? San Francisco Fed President Mary Daly weighed in earlier on Yahoo Finance.
It is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target. We don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
Joining us now is Gus Fauché, Chief Economist at PNC Financial Services Group. Gus, good to talk to you today. You heard Mary Daly there sort of saying that the Fed's job is certainly not over yet. When you look at annual core inflation, we're talking 4.7%. So what does today's data today tell you about how sticky that last 2.5% or so is going to be to get to that 2% target?
Yeah, it's going to be difficult to get down to 2%, and it's going to take a further slowing in the labor market. On the good hand, however, we do see that inflation, core inflation outside of housing services, is falling pretty quickly. But, housing is still an addition to inflation, and strong wage growth is still a problem for inflation. So I think it'll take some further softening in the labor market to get that core inflation back to the Fed's 2% objective.
Gus, do you think the Fed needs to hike again in order to get more softening in the labor market?
I don't think so at this point. We are seeing slower job growth. We are seeing wage growth ease off a bit. And I think that monetary policy at this point is still quite contractionary. The Fed funds rate is between 5.25% and 5.5%. That's weighing on economic growth. And I think given the slowing in inflation that we've been seeing, the slowing in job growth that we've been seeing, the Fed can keep the Fed funds rate there in the near term. And then if need be, they can raise it towards the end of 2023 if it looks like inflation isn't slowing as much as they expect.
So what does this all say about what the outlook is? You know, in the grand scheme of things, we keep talking about the soft landing, but it really is about avoiding a recession while trying to pull back that, or actually cool down some of that inflation. It is starting to come down, but as we noted at the very top, we're still off that target for the Fed.
That's right. And again, monetary policy is still contractionary. It's still weighing on economic growth. I still think the most likely outcome is we get a mild recession starting in late 2023 or early 2024. But there's still close to a 40% probability that we get out of this with weak growth, but not an outright recession. So the Fed has been dealt a difficult hand. I think they're doing a reasonably good job of playing that hand. But the most likely outcome is recession, but there's still decent chance we can get out of this with some bumps along the way, but not an outright recession.
Gus, how are you looking at the uptick that we've seen in gas prices? We've seen a pretty significant surge over the last month, and I guess how much that's going to potentially here complicate the Fed's fight with inflation, at least in the short term.
Well, I think you heard President Daly say that they don't have much control over energy prices or food prices. So I think that they're going to look through that. I think we'll see a supply response that brings energy prices back down again. I think the Fed is much more focused on core inflation because that's what they feel they can affect. So I don't think that that's a big issue for the Fed right now.
You don't think higher energy prices are a big issue, even though that could potentially reaccelerate inflation?
Again, I think the Fed is more focused on core inflation, which is moving in the right direction, albeit slowly. And then I do think that any increase in energy prices is likely to be temporary, and the pass-through to core inflation is going to be quite limited.
Gus, when it comes to, and we're very far from talking about potential rate cuts or what that conversation will look like, in order for the Fed just to start potentially talking about it, what do you think, how much more progress do you think they need to see?
I think that they need core inflation that is back down below 3%, and we're a ways from that now. We will get some help from housing. I think we will get some help from a softer labor market, but unless we see a very substantial deterioration in the labor market in the near term or inflation that slows much more dramatically, I think we're probably 9 months away from a rate cut.
So, Gus, we're obviously looking ahead to that next FOMC meeting in September, but in between that, we've got the Jackson Hole Symposium in a few weeks. Does the messaging change at all, you think, at this point, given the data that we've gotten, or is it still pretty consistent in terms of the Fed trying to keep optionality?
Oh, absolutely. Obviously, there's a lot that could happen to inflation, to the labor market over the next few months. The Fed has said that they're going to be looking at the data. We heard President Daly talking about that. And so I think that, the Fed will indicate that they're not planning to hike in the near term, but that if inflation doesn't slow as much as they're expecting, or if the labor market continues to run strong, that they are willing to raise the Fed funds rate in order to get that inflation back down to 2% over the longer run.
Well, Home Depot saw pressure in big-ticket discretionary spending weigh on same-store sales in its second quarter. The cautious consumer also causing the home improvement retailer to reaffirm its guidance that it set last quarter, expecting a drop in sales and adjusted earnings for the full year. Joining us now is Bill Darcy, National Kitchen and Bath Association CEO. Thank you for joining me this morning here. So, looking at this pullback that we're seeing in comparable sales falling, especially these big ticket items, these costing $1,000 or more, dropping about 5.5% in the second quarter. What is that telling us about how consumers are feeling about these big ticket items, having really been stuck in these homes for the last 3 years?
Great to be with you this morning. NKBA partners with John Burns to bring the Kitchen and Bath Market Index to our industry every quarter. And we've seen that growth has slowed in alignment with what Home Depot was talking about this morning, about 3% year over year decline in sales. And foot traffic has been down in the showrooms and about 8% since the prior quarter. So the retailers have been struggling with that foot traffic.
And what do you chalk that up to? Is it that a lot of people already made all the improvements they were going to make during the pandemic and they really don't want to then take on a new mortgage and perhaps, spend even more in a new home?
It's really that, it's the price pressures that we're all dealing with as consumers. They're uber sensitive to pricing, and especially at the lower and mid price tiers, not as much on the higher end. A lot of online price shopping, but they did do a lot of projects during the pandemic, and our industry was very healthy through the pandemic. And because these continual price pressures, the consumers can only take so much. I think the long game, though, what we're seeing is a very strong health for remodeling. So despite them dealing with the short-term pressures of pricing, there's a lot of manufacturers making big investments. And I think we see a lot of long-term health in the remodeling sector.
And talk about some of the key findings in that KBMI index. I mean, right now it's rated 56 out of 100. That's down from 62 in the first quarter of 23. But we are seeing, as you mentioned, the kitchen and bath area specifically also going at a slower rate in the second quarter. What is it about perhaps some of these big ticket items and the spending? What are some of the consumer patterns you're seeing there?
Yeah, the consumer still, I think, most people want to invest in the home. The pandemic just accelerated that investment and focus on the home. But it is tough because especially at the lower and mid tiers, the consumers are, they're dealing with high gas prices and inflation. But those high interest rates don't harm the remodeling sector as much because there's a lot of equity in the homes, as we talked about, the lower interest rates that people are in. So they really, instead of moving, are continuing to be interested in investing in the home. However, at the moment, they're just dealing with these cost pressures, so it's causing them to pause a bit during this this period. But we do see a big rebound coming in 2024, again, primarily because you have 22 million homes in prime remodeling years. And there's a lot of repair, replacement, and remodel that's required in the North American housing stock. So, but in the current period, they're dealing with these price pressures that all consumers are right now. So that's impacted our retailers significantly, as you saw in the Home Depot's earnings as well.
And of course, if we are expecting that boom in 2024, you're going to need labor in order to build a lot of these projects. What are you seeing in the labor market here in terms of, access to workers to really keep up with some of these projects that you're expecting?
Yeah, that is a big struggle, and it's been only exceeded by those pointed pressures that have come with the recession fears and other things. But right now, we are back to the labor shortage is the number one fear in our industry, and it's an ongoing long-term problem. As you likely know, the young people entering the market is not strong, and retailers like Home Depot are dealing with it in the contractor market, and we're dealing with it. Home Depot is our member, as well as the smaller retailers, really struggling to find young people. We try to do all we can, and I'm on the operating committee of a skilled labor fund that continues to drive interest for young people and construction careers. But it's very difficult as the young folks are not as focused on these careers as they were in the past. So we have to continue to work very hard to help support the industry and spread the message about the positive as far as being part of this industry. It's very tough right now, and the labor shortage is hurting us.
And is there anything that can be done in terms of innovation? I mean, we talk about, AI and sort of, smart building and things like that. What sort of investments do you think the industry should be making while they do wait for some of these labor and these skills to catch up?
Yeah, it's interesting on the AI and really in technology in general, because to me, that's the appeal for the young folks is there's so much tech involved in our industry and the investments in different types of home construction. Certainly in the kitchen and the bath, you have this IoT environment and connected devices, and the devices talking with us and telling us when they need service. And, so to me, there is a big appeal. And my call out to young people and the parents is look at the technology in our industry. And if your young folks want to be involved in technology, the home construction, the home industry and repair and remodel is a place to be. There's a lot of tech involved. So there is a lot of investment. And I think the consumer is really looking at areas where, how can it help me immediately? When it can tell me there's a leak, can it tell me my appliance needs service? But in addition to that, I think we're all just so accustomed to everything talking to us and giving us notifications. I think there's a continued investment our industry is making in high performance, high technology cooking and in the bathroom and sanctuary spaces.
And as we talk about technology in this industry, what about the way that people are currently shopping for some of these items for their small projects or big ticket items? It used to be everyone sort of flood to the big box stores, but there are a lot of other options now. What are some of the changes that you're seeing?
Yeah, it's interesting. We are still a high touch industry, but there's a lot of shopping and price comparisons being done online, and it's accelerated right now due to the cost pressure. So it's a matter of for us meeting in between where know that consumers are shopping online, know that they're doing a lot of price comparisons, but they really still want to go into the showrooms and retailers and see the products. There's so much that we interact with in our kitchens and our baths that it's hard to make a decision online for the full product. There's so many dynamics that go into it, and what you want to have your kitchen achieve in cooking and ventilation and lighting and countertop services. There's just a lot in our industry, and so it's a high touch environment. But there's so much that can be done, and the consumers are certainly pursuing that through online and their ability to experience a product, or up to the certain point. They would like to be much more prepared when they enter the showroom than, as you say, in the old days when they just wandered in and got to experience it for the first time, potentially in a physical environment.
Home building activity accelerating in July as existing inventory for buyers remains historically low. Now, housing starts of single-family homes jumping nearly 7%, but as mortgage rates climb, could that put a dent in future construction? Here to talk a little bit more about that, we want to bring in National Association of Home Builders CEO Jim Tobin. Jim, it's good to see you here. So on the one hand, housing starts have really been the outperformer in today's real estate market, given the fact that inventory of existing homes is so low. But then you're also competing with the higher rates. That's sidelining some buyers. So what does all this then mean for construction and demand for construction going forward?
Well, good afternoon. It's great to be with you. What it means is we're going to continue to see this kind of yo-yo effect from month to month, with permits being up, then they're down. Our HMI, our Wells Fargo HMI, that's up and then it's down. So it's kind of a mixed bag. I think what we are seeing is that the Fed's efforts to crush inflation are in turn starting to crush demand in housing. 7% mortgage rates are really keeping people on the sidelines, keeping people in their home, their existing homes, which give construction kind of an outsized portion of the for sale market, or new construction outsized portion of the for sale market. So construction looks good, but we're still facing the headwinds. Lending for construction loans, that continues to be very high, as well as construction costs and labor concerns continue to be a drag on new home construction and new apartment construction.
Yeah, I mean, single family homes there, the growth that we saw on that front sort of outweighing the declines on the multifamily front. I mean, how sustainable is that cycle when you consider the demand? I mean, can we call it demand destruction? Because we are seeing mortgage rates push higher. That's sort of sidelining a lot of sellers as well as buyers.
Demand is still there. It's just the question of reminding people that it's still a time to buy a home. If you are a credit-worthy borrower, and you have some money to put down, it is worth getting into this market. And new construction is now a part of the market that people are starting to take a better look at. And now it's time for our local lawmakers and our state lawmakers and our federal lawmakers to do everything they can to clear the way, whether it's government regulation or land use policies, to help us continue to build that new product. Because again, demand remains strong even despite these high interest rates. And what we're seeing is on the new home market, we're starting to see our builders put in more incentives to attract people into the market, with lowering prices or are doing rate buy downs. People are doing more and more. Our builders are doing more and more to get people into home ownership because they know demand is high despite these mortgage rates.
Yeah, Jim, you've been calling for the government to do a bit more to help make housing more affordable. From your conversations, are you confident that we'll see anything over the next several months, given the fact that some of the dynamics that you were talking about still makes it a pretty tough time for people to afford?
Yeah, when we're at all levels of the government, we're talking all of the time, and the challenge is that everybody recognizes that housing affordability is a problem for most Americans out there, whether you're a new first-time home buyer, first-generation home buyer, or a family looking to move up. it is hard times out there. So what we need to do is get lawmakers to find a way to speed up the permitting process, stop with review after review after review, and let our members build. But you also have the challenge right now. We're facing the headwinds of climate change as well, and the regulations that the federal government is imposing on new construction, specifically when it comes to energy codes and even resiliency codes. I mean, there's so much cost that goes into a house, so much regulation, that we need lawmakers to recognize that every regulation is going to add to the cost and drive people from home ownership. We have to make a balanced decision about good regulations that do good for health, safety in the built environment, and be mindful of what it costs for people to own a home.
What are those delays? I mean, what kind of timeline are you talking about? And particularly around climate, because there are new regulations that are being introduced every year as a result of the changes that we're seeing.
Yeah, a lot of it has to do with the building materials that go in to meet climate requirements. So, if, for instance, 10 or 15 years ago, a lot of wall and ceiling construction was 2x4 construction. Now, in order to meet some of the energy requirements and insulation requirements, you have to use 2x6 construction, and 2x6s are more expensive than 2x4s. That is a great example of just the cost of construction when it comes to energy efficiency. It has to do with our effort to try to meet climate change, sure, but we're not balancing home affordability when it comes to these issues. It's really frustrating times. 10 years ago, you could build an average single family home in about 3 months. Now it is stretched to 8 months, and as you know, time is money. Mortgage rates change in that time frame. So it's just delays and regulations really continue to be the biggest drag on the industry right now, especially when we talked about new home construction making up a bigger and bigger portion of the for sale market.
Well, inflation is coming down across the U.S. with the annual rate sitting just above 3%. That is still above the Fed's 2% inflation target. But one city has managed to get ahead of the central bank. Rates in Minneapolis fell below 2% in May. Now they are down to 1%. The decline largely attributed to the region's push to increase affordable housing. For more on this, we turn to Peter Frosch, CEO of the Minneapolis-St. Paul Regional Economic Development Partnership. Peter, it's good to talk to you. I want to preface this by saying we're talking about affordable housing because shelter, which includes housing costs, is the single biggest contributor to inflation that we're seeing right now. But your plan in Minneapolis, and I mean your as in the city's plan, began before the pandemic. Walk me through how the city approached this issue differently from others, why you think that has brought down inflation to where it is today.
Right. Well, we appreciate the attention on the issue. We're excited about these numbers. It has a lot to do with anticipation. I think what we've seen across the country is that if you're waiting to work on house price inflation, once that trend is really running and multiple years into it, it's very hard to get a hold of. So back in 2015, 16, 17, regional leaders across Minneapolis, St. Paul got together. We have a shared practice of tracking key economic indicators, and we saw that housing prices and rental prices were starting to go up and at a rate that we hadn't seen before. And that sparked a real focus among leaders across the region, even those who weren't focused on housing, to say, what's behind this and what do we need to do to get ahead of it?
So, Peter, when you talk about the fact that you have made progress, the fact that it's under that 2% level that the Fed's struggling to get to on a national level, but how do you keep this trend going? When you talk about keeping Minneapolis more affordable when you compare it to cities of similar size, how do you maintain that advantage?
Well, I think the way that we got here is by having an all-in approach. There's no single solution. There's no single responsible party when it comes to managing housing costs. And it has certainly to do with income, but it's also production. And so together, the region created a set of production goals of 18,000 units a year, which over the past 3 years, the region has exceeded. So that focus on production is key. And one of the reasons I think we've collectively been successful in this geography around production is because you have a lot of creativity and innovation happening regarding housing. So one of the areas around transit corridors, we've had 20 years of major investments in transit infrastructure, and that has unlocked a significant amount of private investment into housing and multifamily housing at affordable and market rate along those transit corridors. Added to that, you had a focus in Minneapolis and St. Paul going back to 2010 and 2012 around converting downtowns into neighborhoods. And so I think there was some data that came out in the last few days showing that Minneapolis has seen some of the highest rates of conversion of office into apartments of any of the downtowns in the country. And then we're reinventing spaces. So suburban malls, golf courses, major industrial zones have all been in the process of being converted into multi-use spaces that include significant amounts of housing. And that's been going on for a number of years.
So some creativity in your approach, but how do you get all the players, the stakeholders on board? Because some of those ideas you just pointed to, we have seen them proposed in other cities, but it's mired in red tape. There's often a lot of pushback from the local community about expanding affordable housing. I mean, how do you get those competing, or how did you manage to get some of those competing interests on board?
I think part of it has to do with the nature of the geography of this region. For those who aren't as familiar with Minneapolis-St. Paul, the city of Minneapolis is only 11% of the total population, which is roughly 3.7 million. And so you have dozens of cities, all of whom are under pressure to generate solutions. And so it kind of creates this ecosystem of innovation around housing. And I think that's really at the root of what we've seen, that you have a lot of responsible parties who have different options depending on the part of geography they have. The city of Minneapolis has done some really important things, not only in terms of investing in its budget, but several years ago, prior to the pandemic, it was, I believe, one of the first, if not the first, major U.S. city to eliminate single-family zoning, which takes a number of years to work through the system, but it's a very powerful signal about kind of signaling, a new sense of innovation and new aggressiveness in terms of how we as a place need to address the issue of housing.
To what extent do you think this can be replicated on a national level? I mean, we talk so much about inflation and rising costs, and yet it feels like your model really points to the importance of local and state efforts.
Yeah, I think it's a kind of a shared responsibility model that's got a strong bias towards action and experimentation. So not everything that has been going on here has worked around housing, but I think there's a lot of visibility and real-time sharing about that. And the nature of that experimentation has enabled some de-risking. So, one suburban community will try something, others are seeing it when it works, it speeds adoption in other locations. I mean, other places have suburban malls, they have former industrial zones, they have downtowns and transit corridors. So none of that is necessarily different. I think it maybe has to do with the focus, and then also having goals and tracking those goals is always useful. And I think that might be one of the distinguishing characteristics in our region.
Mortgage rates topping 7% this week, hitting levels that we haven't seen in more than 2 decades. The average rate for a 30-year fixed mortgage rising to 7.09%. That's the highest point that we've seen since April of 2002. And it's just the third time that rates have exceeded 7% since then. For more on what this means for the broader economy, we want to welcome in Jose Torres, Interactive Brokers senior economist. Jose, it's great to see you again. So let's talk about the fact that we're seeing mortgage rates once again on the rise, reaching levels, like I just said, that we haven't seen in about 21 years. What does this do to the housing market? Then what does this do to the broader economy?
Thanks for having me. Well, unfortunately, rates this high, what it does is that it constrains the housing market. And right now you have existing homeowners they're stuck with low rates and they don't want to sell and then have to go assume thousands more in monthly payments on another property. So that's constraining transactions in the existing home sale market. Now, the new home sale market is doing a little better this year. However, affordability just remains too constrained with rates above 7%. Like you said, these are rates that we haven't seen in a really long time, pre-Great Financial Crisis, and it constrains the real estate section of the economy, which makes up about a fifth of it. So anything from construction workers, durable goods manufacturers, materials folks, everything that's related to real estate starts to deteriorate whenever you have transactions down this much. Now, another difficult situation is the fact that rates can continue to go higher. You have the Fed not buying long-term bonds. You have the U.S. Treasury with a high need to borrow, and you also have sticky inflation. So long-term rates could go higher from here. So I'm a little nervous if rates go to 7.5 or 8, that we'll have some price corrections in the real estate market.
So what's the expectation for what would happen if it went to, I almost want to say, God forbid, 8%? That's, I mean, you know, I haven't seen levels like that. I want to say in my lifetime, but I was living in the 80s, so I know it's been worse. But what's the expectation for what it would do to the housing market, given the constraint we already see there?
And to your point, a lot of folks say, well, you know, we've had rates like this in the past, but what we haven't had is rates and prices this high simultaneously. And I think that's the important constraint. And the longer that rates stay above 7%, or even if they go to 7.5 or 8, you know, you're going to have some problems. You're going to have some forced selling eventually, maybe not in the single family market, but in the multi-family market where you've had a lot of construction, you could have some forced selling there. You could have some forced selling in Airbnb. On the commercial side, a lot of the rates are floating rates. So a lot of folks that made investments in 2021 with rates at 3%, now that's repriced to 7 and 8%. Maintenance costs have gone up, insurance costs have gone up, and it really weighs on the real estate sector overall.
So, Jose, we have some worry just about what the real estate sector is going to look like here, at least in the short term. But when you take a look at some of the recent estimates that we're getting out, Atlanta Fed seeing third quarter GDP growth of 5.8%. We talk about the fact that the economy has certainly surpassed many forecasters' expectations up until this point, but 5.8% growth, is that realistic?
No, it's not realistic, and Atlanta GDP tends to be very, very hot initially sometimes, and you know it could be very volatile. It's not realistic. Now, what is true about what you said is that a lot of us have been surprised by the strength of the consumer. You know, we didn't think that the consumer would be able to digest all these rate hikes and have their pandemic savings begin to dwindle and rack up all this credit card debt. And then you also have looming student loan payments coming on in October. So we've all been surprised, but I think that the consumer is going to begin to slow down after Labor Day more significantly. I'm starting to see that in travel bookings and restaurant reservations. We're starting to see at the margins, the consumer start to lose momentum. And that I think it's going to happen at the same time that the long and variable lags of the Federal Reserve's monetary policy start to hit the economy. So we could have a soft patch in late 23, early 24.
And how does that bode for the overall economic picture, especially to your point, there's data out from the Federal Reserve Bank of San Francisco pointing out what's happening with regard to that weakening in savings that we're seeing and the spin off of that excess savings that people had during the pandemic. What is the expectation for where we land by the time this year closes out economically?
You know, I think the consumer is going to stay afloat, and I think the saving grace for the consumer is this hot labor market that we have. And businesses are immune to these interest rate hikes at this juncture because they're flush with cash and they want to earn returns, and there's labor shortages. So consumers, even if they're having affordability troubles or budget constraints, they can still go out there, get a job, have some good, strong wage gains to offset a lot of those pressures. So I think that if we do get that soft patch in late 23, early 24, it's not going to be a tight kind of recession that we're used to seeing where there's a lot of joblessness, we'll have a slight tick up in the unemployment rate, and folks will feel it more from an affordability standpoint. They'll start to trade down. Companies will start to invest a little less, but it won't be significant unemployment like we've seen in previous cycles. The demographics just don't support that, and corporate appetite to earn returns and make money is just too high right now.
Jose, there's this long-going debate right now about excess savings and what exactly those levels look like. Some, like you have the San Francisco Fed here, saying that there's not much left. You have others that say actually the situation looks okay. Does this argument or does this debate still matter as much, given the fact that we have seen inflation pretty steadily ease here over the last year or so?
Yeah, I think it matters, and I think the reason it matters is what's the cost of bringing inflation down, right? And some of it is corporate pricing power declining, margins contracting, earnings not being as good. And then of course consumers not having that tailwind of nominal prices going up and all of their incomes going up. So as inflation comes down and those interest rate hikes and that balance sheet reduction, and also the credit crunch that we've been experiencing at the margins due to the regional banks, when that starts to hit, all at the same time that the consumer is slowly weakening, that could pose some risks looking forward. But also, the market is doing very well this year, we're in a soft patch now, rough seasonal period, but the market's doing really well, and young folks are involved, and they're happy that the market's going up, and that's giving them extra purchasing power. Also, the propensity to save isn't that high because the housing market is so out of reach for so many individuals. Durable goods also out of reach for many individuals. Cost of financing too high, prices too high, access to credit not as high. So those things in combination make it where consumers want to invest on services. They want to travel, they want to go out and eat, they want to enjoy themselves. And that's what's been most problematic with inflation, has been labor-intensive services. And that's what we've been seeing consumers do in an environment where houses and durable goods are too expensive.
Mortgage rates are staying high. Last week, Freddie Mac data showed that both the 30-year and 15-year mortgage rates were approaching 7%. And with that in mind, mortgage rates are not the only thing worrying investors about the housing market. Home builders are reporting a significant drop in buyer traffic. Inventory is at low levels and sales have seen a stuttered recovery. Redfin's CEO Glenn Kelman said that the market has hit rock bottom, adding that sales volume couldn't be worse. And if the mortgage interest rate were to continue increasing and hit 8%, analysts are saying that things will only get worse. Let's bring in Redfin Chief Economist Daryl Fairweather to discuss more about this and about the state of the real estate market. Good to have you back on the show here. So we saw Redfin out with a new report this morning that new builds making up nearly a third of single-family houses on the market. Tell us, what is this all doing now in terms of the state of real estate right now?
There is a real inventory problem in the housing market. There are about 18% fewer homes for sale now than there were last year. And last year wasn't great for inventory either. So if you're a buyer looking for a home, chances are you're going to be seeing a lot of new construction relative to the number of existing homes, which has been great for builders in this really hard market given mortgage rates, and has meant that building activity is continuing and contributing to GDP.
But then when are we going to see affordability catch up with that? Because a lot of homeowners, obviously, they can afford to sit in their homes for longer, but you have renters trying to get into the market and just not being able to afford these homes.
Well, affordability is complex. It's not just prices, it's also mortgage rates, and mortgage rates are near 7% when they were at 3% during the pandemic. So that is a huge jump in the monthly mortgage payments that buyers would have to pay. Now, if you're paying cash, you can avoid that, but that further exacerbates this inequality problem in housing, where the wealthy can find a home and build equity, but people who are just trying to break into the housing market are having a very difficult time.
Now, for some people, they say, look, no matter what the interest rate is looking like, it's better to just sort of buy a home. But as you're trying to sort of weigh the buy versus rent discussion here, what should people consider in this sort of environment?
It's really about the long term. So if you're planning on staying in your home for 5 years or more, buying is the way to go because prices will go up over that horizon. And when you go to sell, you will have equity, or you can not sell and just stay put and not have to worry about rising rents. Rents aren't going up so fast right now, and it is more affordable to rent a home than to buy one in almost all of the country. But in the long term, we do expect rents to continue to grow. And if you buy now, you can at least put a cap on what your monthly housing cost is going to be.
And as a lot of people sort of moved around during the pandemic, trying to get the most bang for their buck when they were working from home, we saw obviously, the Southeast really benefiting from that. In this sort of environment, are there certain states or major cities that are really benefiting the most, or where people can really get the most bang for their buck right now?
Well, benefit, it kind of depends on who you're talking about. The homeowners in places like Florida are probably happy to see their equity go up as so many people have moved into the state. But the renters and people who are just trying to get their foot in the door in the housing market are probably really worried about how fast housing has gone up in price, and that's for rentals and for homes for sale. Now, in places on the coast, like coastal California, prices are down, but mortgage rates are so high that if you're a home buyer, it doesn't really compensate for that. So you may be glad that prices are down in places like Los Angeles, San Francisco, but it's still not easy to get into the market if you're a first-time home buyer.
And something interesting that Redfin came out with, a report showing that the typical teacher can afford just 12% of the homes near the school that they actually work at, and that's down from 30% in 2019. So in terms of affordability for your everyday person who's now having to pay more just to try and live closer to work, are we getting any signs of that perhaps tempering at any point?
Not in the near term. And what was so interesting about that report is that places like Nashville and Denver that haven't really been at the top of the list in terms of being really expensive are some of the places where only 1% of homes for sale are affordable to a teacher. So that's very worrying that in more parts of the country, we're seeing this big divide in terms of who can afford to live close to where they work. And we need to build a lot more, especially in these places that people want to live, in order to combat that and to make it easier for people to just have a home and go to work and live their lives.
And in terms of the things that help get, more houses on the market, things like labor improvement when it comes to home builders, the cost of lumber and things like that, are we starting to see within those sectors some improvements here? Or when will we see enough improvement to balance out the demand that's out there right now?
It's still a challenging environment for builders. They have a hard time getting labor because there's not a lot of people skilled in construction in the US, even though we could bring them in through immigration policy. Currently, it's just very difficult to hire people. And the materials costs have gone up considerably since the pandemic. There aren't the supply chain shortages, so it's not like builders can't get what they need. They're likely just paying more for it and having to pass that cost on to the buyer.
All right, we are expecting to get a much clearer picture on the housing market this week as new and existing home sale data set to be released. It comes as mortgage rates hit a 2-decade high at 7%, which has stalled the market, along with issues of inventory and high prices. Joining us now is Lawrence Yun, Chief Economist at the National Association of Realtors. Lawrence, thanks so much for joining us today. So I know last week when I saw that number of mortgage rates hitting 7%, it was a shocker to me. I was alive in the 80s, though not old enough to kind of know anything that was going on. But I want to ask you, are you expecting them to go even higher?
The 7% mark, last time it crossed that was back in November of last year, and that brought the home sales down in December and January. So clearly indicating the sensitivity of the housing sector to the mortgage rates. So right now the mortgage rates are touching that cyclical high level. I don't think it will break higher. I mean, I truly wish the Fed would stop raising interest rate because they are clearly overreacting. The overall inflation rate is coming down. So if the Fed basically say they're done, I think we could see mortgage rate trend down back towards 6%, which would be great news for all the potential home buyers, but also home sellers. Home sellers have been resisting to list their property, but with lower interest rate, maybe the cost of giving up their 3-4% mortgage rate becomes less painful.
You know, you're outlining a number of the dynamics that are making this market a bit of a head scratcher for some people, as we have people who do not want to relinquish their homes or sell their homes because they're enjoying those very low interest rates. But the fact remains, we have new home builders hitting record highs this year in terms of their stock. If you would have told me that at the beginning of the year, I would have said, no, that's not possible. But nevertheless, here we are. The housing market has proven quite resilient. Do you believe that there are just structural and structural factors that are just providing this incredible tailwind? And I'm just wondering what you see as maybe the cyclical and the variable factors right now.
Well, the long-term factors are about population growth and job growth. The job levels today are 4 million more people working compared to pre-COVID record highs. So we are continuing to add jobs, and naturally people have dreams about owning a home. So that is providing this steady interest in the home buying, while the cyclical factor is mortgage rate. That determines the timing of whether people can get into the market or whether they are pushed out of the market, depending upon their finances. We have seen the cash share transaction begin to rise because people who have substantial housing wealth, say in California, they're selling their property and going to nearby adjacent states of Idaho, Nevada, and purchasing all cash, just completely bypassing the mortgage market. So it is a very interesting market, and also very little distressed property sales, even though home sales are much lower.
Lawrence, I want to ask you, so we're going to go from Wall Street to Main Street here. You mentioned the word dream. A big part of the American dream is owning a home. Affordability has become a serious issue once again. Is the American dream dead?
Well, American dream is alive. Is whether or not Fed will permit that dream to be realized. Because if the mortgage rate was to somehow go up to 8%, now by historical standard, that is still not that bad, but by recent standards, that is very high, and it's going to price out many young adults out of the marketplace. So it's going to create a huge social divide. Homeowners smiling big, while the renters feel like their dream is out of reach, frustrated that other people are getting the housing wealth while they are left out, paying higher rents each month. So we don't want to create this persistent social divide. So one way to assure that there is a path towards ownership is to make sure that the economy is working correctly, and so far jobs are being created, even though now the numbers become a little less robust job creation. But the Fed, I mean, they have to look what the inflation will be in the future, and the future inflation, say by December, will be well under 2%, because the heavyweight component, the rents will be coming down for the simple fact that apartment construction is at a 40-year high.
All right, let's say mortgage rates do top out now at about 7%, maybe a little higher. Have you done the math? Do you know if they come down to 6% to 5%, what kind of value and what kind of deals that unlocks for the average home buyer here in the U.S.?
Well, you know, if the mortgage rate was to come down, we always say that people on the fence, the buyers, are now in the fence and begin to search for homes. So we will have increased demand. But what will be unique in the current cycle is that as the mortgage rate decline, all these pent-up sellers are people who are currently living in a home, but they have additional child in the family. Maybe they got married, or maybe they have a new job at different part of the town. They want to make those move, but they don't want to make the move if the mortgage rate is very high, where they don't want to give up their current low mortgage rates. But if the mortgage rate begins to come down, some of the sellers will say, well, it is still painful, but not that painful, and they will make the move. So increase in demand and increase in supply as mortgage rate come down.
Well, we will certainly see what happens when we get some new data on this week on both sales and the next level for rates. And of course, we'll be watching to see where the Fed goes next. Lawrence Yun, Chief Economist at the National Association of Realtors. Thanks so much.
Also, as we've been talking about, earnings from Lowe's this morning coming in a little more optimistic than its competitor Home Depot's results last week. Lowe's comparable sales down a little less than expected at 1.6%. Meanwhile, Home Depot's were down 2%. So what do these results really say about the housing market. Joining us now, we've got Cole Smead, Smead Capital Management CEO. Cole, great to have you here with us this morning. So perhaps we could start off with that question. What does this say about the broader housing market, given that you've got two of the larger DIY plus some of those larger business-to-business contracts and purchasers that take place for both of these companies?
Yeah, so we've owned Home Depot for years. We think housing has been probably the most misunderstood part of the economy looking back over the last 10 years. No one thought we'd be where we're at on housing, where tight supply, even though affordability is terrible right now relative to the last decade, is causing housing to be strong. I think what Home Depot and Lowe's have had to deal with is, as interest rates have increased, it just marginally caused people to look less to a home equity line to revamp their home and do things of that nature. That's a bigger component of their life versus just housing supply itself is really more to do with the home builders. So I do think the one tailwind that Lowe's and Home Depot have and will continue to have for many years to come is we've busted one of the great myths of all time, which was that millennials were never going to buy houses. And now that they own them, that's such a huge customer base to those retailers. And those DIY companies like Home Depot and Lowe's, I think, have really good secular trends in their favor.
At the same time, housing is getting less affordable, right? In part because of what's going on with interest rates. In part, we're just not seeing much movement within the existing home sales market because people don't want to sell to pay those rates. So, are we going to have a period of more stagnation that's going to continue?
Well, to your point on supply, it's such a healthy environment. In other words, why are high rates not, causing housing to fall apart? Because there's no available homes for purchase. What are some other myths that were out there on housing? Baby boomers were going to move out of their houses and go into assisted living earlier on. That never happened. COVID proved that won't happen. They'll live in their houses till they're 90, which would be a shock to what people thought 10 years ago. So I think there's other trends that are going on in housing that are really causing that tightness. But again, unless you have the higher income from a new job or you're getting paid better to move to a new area, you aren't going to leave your 3% mortgage, 4% mortgage, et cetera. It's only based on income will someone do a move up trade or just a pure need and they have the equity to do it. That's a very healthy housing market. Go back to 2007. You'll find we had the largest supply of homes available for sale that we've ever had. Which housing market would you want to be in? The one that's going to be a nightmare for years, or tight supply that looks like it's going to be a bull market for quite a long time? By the way, housing is the only good game in real estate, just so we're all on the same page. It's the only game in town doing well.
And so with what you're seeing in housing at this point in time, and I'll give you some anecdotal evidence. I went back home to Pennsylvania, at least where I grew up, and there's an entirely new kind of just residential community being built up where there used to be cornfields. And we're seeing that in several states. This is just kind of one example. And I have no doubt in Arizona, perhaps not cornfields being transitioned, but some other area where it was wide, vast, open, where new developments are popping up. And it seems like much of that could be driven by a few things in each of those markets. And all of this to say, are you seeing more perhaps new first-time home buyers saying, you know what, we'll just try and get a new home versus purchasing an existing home and then doing a bunch of the DIY renovations? What does that tell us about the housing market?
Well, there are no homes for sale. So it has to come from new supply ultimately, because someone's got to move to that new supply to make the existing homes up for sale. So I think again, new supply will tell us what's going to happen in housing, whether you're Home Depot or Lowe's or whether you're Lennar and D.R. Horton. To your point, a large project out in the cornfield, to quote the Monty Python, "'Tis merely a flesh wound." It's not changing supply at all. Here we are in Arizona. Water's a big deal. So you go look at municipalities like Maricopa, Arizona, Casa Grande, Arizona. You'll find that cities like that have water, they're growing rapidly. They're some of the fastest growing cities in America. If you go to other municipalities where you don't have water, you're not going to grow as much. So I think there are some, constraints in each market. Some markets, it's just available land. How costly is that land? In other places like the West, it will come down to water. But don't forget, when you turn corn farmland into housing, you actually use less water. It's one of the things I always tell people here. If we turn fields into houses, we got a lot more water here in Arizona.
When you're looking across the real estate industry and just trying to decide where to invest, as you mentioned, other parts are not doing so great, but, there are parts like data centers, like warehouses, et cetera, that are doing a bit better. I mean, forget about office for a minute. Are there other areas of real estate that are interesting to you guys?
So if you look at the cap rates across the real estate space, it's gone from as good as it got at low rates to the largest rise in cap rates you'll ever see probably in your lifetime. So for example, use industrial. Industrial is trading at 4% cap rates. You're not going to find industrial trading at those cap rates. You're going to find them waking up somewhere closer to 5 or 6%. That's just tectonically different, because then someone going to develop new industrial has got to pay a premium to that because there's risk for the bank to have them build it. So I think that's really the trend you're seeing. Multifamily, I think if you go look at Howard Hughes Corp, they're trying to build apartments. They said, I think it was last quarter, they went to 49 banks looking for loans on a multifamily project. They couldn't get lending. That is very common. Banks are shutting lending down. Or if they are going to provide lending, you're going to pay 10, 14, 16% construction loans. So I think that helps existing assets out there, but at the same time, it doesn't help the price of those assets. There's going to be less supply in a lot of real estate arenas, but I mean, we got to swallow kind of a pig through a python here. Commercial real estate's worth a lot less. We don't really know how bad it is. We don't really know what the reset price is. We're probably going to peak over 10% cap rates in commercial office. And then the question is, what's the good properties and what's the bad properties? I was just in Seattle 2 weeks ago. Downtown Seattle's a ghost town relative to when I grew up in that town. That's very common in West Coast cities. It's very common in parts of the East Coast as well. So we have got to get through those problems. And I also think that will spill over into the banking space as we look forward 5 years. Not all banks will be affected by that, but it just goes to show you that we have real problems based on the price of money changing. And obviously that's what the Fed's doing on the short end of the curve.
All right, next time you're in Seattle, I need you to pick up some fish seasoning for me because I've been asking everybody that goes out.
I'll be there next week.
Yeah, done deal. All right, I'll write it down. Just while we're on the topic though of housing, Cole, just to bring it to some of the current events that have taken place too, and I think about the hurricanes here, about all of these different kind of severe storm systems that people who are purchasing a home are thinking about even more so. Is that likely to move the needle on where people are even willing to either move and start new financing on a home project, or just move the needle at all in terms of where people are deciding to take up residence?
I think the affordability land is bigger than the weather. I mean, for example, Florida has had cheap land historically. If you look back 20 years, you always paid nightmare hurricane insurance down there. It's a very expensive thing to do. And so I don't think the weather side's a very big deal. Can you get cheap land? Back to supply. That's the supply question. If you can get cheap land, you're going to find supply grow in the region. That's why you're seeing building continue to grow in the South. That's why you're seeing, building continue to grow in the Southwest, in parts of the Midwest, but you're not seeing as much on the West Coast. You're not going to see as much in the Mid-Atlantic or the Northeast. So I think we're definitely seeing a trend of people moving. And I also think the other thing you can add into that is the work from home. It's not going to be as bad as it was in the pandemic, but we're definitely not going back to 2019 work standards. I think mothers with children that work, they're the dominant force in that conversation, and they're going to dictate to America how they're going to work and when they're going to work. And I think that's really changing housing, in my opinion.
We continue to track shares of Lowe's today. Right now, they're up more than 3.5% after the company's results came in mixed. They fell slightly short of expected sales on lower DIY demand. The company, though, did stick by its full-year forecast, having already predicted that sales will slow this year as pandemic-era demand cools. Lowe's outlook for the year echoes that of rival Home Depot, both bracing for a slowdown in home improvement. And we should say Lowe's comp sales fell, but not as much as estimated. Joining us now is Max Rocklenko, TD Cowen director, on these Lowe's numbers. What stood out to you from Lowe's in terms of execution here, maybe that helped it edge out the estimates, considering that the macro environment is a little dicey right now?
Yeah, thanks a lot for having me on this morning. Lowe's had good numbers. Overall, they were better than expected, both with same-store sales coming in ahead, down 1.6%, but better than what ourselves and others modeled, as well as EBIT margin, which also did quite well. The company, to your point, did reiterate guidance. So all these things are positives, and the stock is reacting nicely. Overall, the company is doing a really nice job of executing in a very mixed to tough backdrop. You mentioned that the pro environment remains better than DIY, and we are seeing pro continue to outperform.
So what does this spell out for where the company is going to be able to also maintain margins? They talked a little bit about that and what they were doing and trying to reduce expenses and making sure that they're not kind of missing out on just driving a good customer experience. But at the same time, investors want to hear about the margins, and even in an environment like this where there is a macro concern, still securitizing some of those margins top of mind.
Yeah, management has done a great job over the last handful of years of really improving operations, both at the store level as well as HQ. They're well on their way, but we still think that they have several years more to go. They previously would underinvest at times in some of their stores, some of the IT, and these are some of the major areas where they've been investing. And we are seeing an improvement in margins. Gross margin did quite well, and we're excited about some of the other initiatives that they've got going, which we think are going to help margins in the back half of the year.
When it comes to the pro business at Lowe's, they seem to have done a little bit better in contrast with what we heard from Home Depot. What do you think is going on there?
Sure. So Lowe's has done a really nice job with the pro business for the last several years. They're really looking to take market share with the smaller pros, whereas at this point, Home Depot and their initiatives are really focused on those large and much more complex pros. So Lowe's is doing a really nice job. But at the end of the day, their pro business today does remain roughly 25% of mix versus Home Depot that's at about 50%. So Lowe's is doing well, but the size of the business today does remain much smaller than where Home Depot is.
When we were comparing some of the results that came out between Home Depot and Lowe's as well, one of the areas that comes to mind within this broader inventory set and the SKUs that both of them have, they overlap in some of those kind of larger durables that a lot of consumers are not going to need, 2 lawnmowers or 2 refrigerators. Some people might need 2 refrigerators. Whatever the case may be, they're still going to have the issue of just managing that type of inventory expectation. Is there kind of a firm footing that you believe that Lowe's executives and their management team have around making sure that they are moving through excess inventory in some departments versus others where maybe they're looking to get more of that pro partnership in there, which has more of a propensity to spend on a continued basis?
The Lowe's management team during the course of the pandemic has done a really nice job of managing inventory. They certainly have a proven track record of doing this. That being said, to your point, those large discretionary big ticket items is where we've seen the most softness as the consumer does continue to pull back. We think that management will continue to do a good job of managing inventory. This is something that has been expected for some time, but the trend is decelerating. So it's certainly one of the top areas that we've monitored.
Max, just lastly, while we have you, I mean, we know that there's been a shift of spending among consumers from goods to more of that thrust towards services right now, or services and experiences. We could even kind of round that out into. But what about the in-home experience? Is there anything within these earnings results that say people are willing to still invest in certain parts of their home experience? I know it's not necessarily a service as we might think about it, but I don't know. I feel like it's a good experience when I've got my living environment up to snuff and, just able to relax at home, kick back with a beer or something like that. I don't know. How do you look at it from your perspective?
Well, I think you're absolutely right. What Lowe's as well as Home Depot's results are telling us are 2 things. One, the professional business continues to do really well. And all that ultimately is the homeowner hiring contractors to work on, small to medium to large size projects for them. So they're continuing to spend there. And then additionally, the homeowners themselves are spending on small DIY projects themselves. So to your point, there is still a lot of money that is going towards improving your home, your living situation. Where the pullback really is occurring is much more on that discretionary big ticket side. things like, patio furniture, things like grills that, a lot of people bought during the pandemic. So we're all certainly continuing to spend on the home. We are just being a little bit more mindful and choiceful than we have been in the past.
And as we saw with Toll Brothers reporting, raising its sales expectations, new homes are in demand as the supply of existing home sales dwindles. New home sales came in well above expectations the month of July at 714,000 homes, up 4.4% month over month. Joining us now, we've got Jessica Lotz, who is the National Association of Realtors Deputy Chief Economist and Vice President of Research. Jessica, great to have you here with us this morning. If we were to kind of paint a broad stroke of where we stand within the housing market and kind of pair that with the shelter costs that consumers are continuing to have to monitor at a household basis here, what is the overall kind of summary that people should be remembering here?
Well, good morning. It's good to be here. I will say it's a very interesting picture right now. We have a lot of strong demand for housing. There's a lot of consumers who are sitting on the sidelines. Interest rates, though, keep going up, and that is very hard for consumers today. And the second factor that is really impacting consumers is inventory. We know that for existing home sales, we have about 1 million homes on the marketplace. It is very hard to find a home today if a shopper is out there. And so they are turning to new homes, which can take longer to build, but they know that eventually they will get that product that they want.
So Jessica, what's the gap right now between demand and supply?
Well, for every home that's out there, we're actually seeing 35% are moving more than the asking price. So I would say that there's a bidding war for those homes that are out there. The typical home right now that's listed has 3 offers on it. So we know that there is a lot of demand, probably 3 to 1, honestly, when we think about the consumers who are trying to get into the housing market versus those who are successfully doing so.
We got a little bit of insight about the delivery of homes from Toll Brothers earnings as we were breaking those down a moment ago. But has that more broadly improved from where we were even a year ago?
Well, certainly. I think if we think about throughout the pandemic, just all of the delays that we were seeing for new homes coming into the marketplace, really, it was quite a difference for someone who may have been thinking maybe 6 to 9 months is the traditional time frame versus their homes being even canceled by builders because they couldn't get the supplies, they couldn't get the laborers, they couldn't overcome all of the hurdles that builders are having.
All of this would seem to suggest that pricing is not going to moderate anytime soon, right, Jessica?
Well, right. I mean, even for existing home sales, even though home sales are down, we're still seeing prices go up because of that limited inventory. And for new home sales, we're seeing that is a pretty significant gap. So you have to really be a higher end buyer to be able to afford that new home sale. That gap is $30,000. That's not insignificant, especially with this rise in rates.
If you have then on the other side, people and households that are having to pay higher rent costs in the interim period, what type of longer term ramification does that have for people that want to get into the home buying sector or home buying portion of the broader market, but are barred because at least in this interim period, cannot because financing doesn't make sense or they're not a high income consumer with the ability to go and buy a new home. And then on the other side, they're spending more for rent. So that puts a dent perhaps in the timeline or lengthens the timeline that they're looking at to purchase a home.
Absolutely. And, this is the really difficult part of today's housing market is that we know that first-time home buyers are at an all-time low. We saw a slight increase last month, but 1 month doesn't really represent the entire year of declines that we have seen. And the age of first-time home buyers is at an all-time high of 36 years old. They're renting for a longer period of time, having to save for a longer period of time. And we have to remember, too, a 36-year-old, that's someone who could have childcare costs. That's someone who could have student loan debt, a car loan, rental costs, all of these. And at 36 years old, it's real hard to convince mom and dad that you want to move into the basement with 2 kids in tow. So I think we have to remember, too, this changes the dynamic of these first-time home buyers.
How much will student loan repayment and reassumption of those payments then impact the broader home buying sector?
I think this is a really good question and one we don't have an answer to right now. We know that people are going to suddenly have an influx of a payment that they haven't had to make in a couple of years. Now they're going to have to. And some student loan debt holders have been actually paying on that principal of the debt, paying that down, taking advantage of not having interest over this time period. But others have been putting that to the sidelines and saying, you know what, I'll deal with that when I have to, but I can't right now. Now they're going to have to.
Well, let's take a look at the housing market. It isn't showing many signs of cooling, even as mortgage rates hit a 22-year high. The Case-Shiller Index showed housing prices continued to rise in June. The national composite up almost 1% month over month and seeing no change compared to last year. Now, prices have held strong thanks to low existing home inventory. That's been a boon for home builders. Looking at home builder stocks, they're all up over 20% year to date. Luxury builder Toll Brothers said in its latest report that the average price per home in its backlog is $1.75 million. Now that's up from $1.43 million last year. Joining us now is Heidi Patalano, National Mortgage News Editor-in-Chief. So good to see you here, Heidi. We still have this very tight housing market here. Good news for home builders, though, but when do some of these home buyers get a break?
Right, that's a very good question. It seems like there is really no relief in sight for home buyers looking for some price breaks. Definitely, there's a inventory crunch right now, and that is keeping prices high despite the fact that mortgage rates are still inching up. We saw last week that mortgage rates hit 7.23%, the 30-year fixed average, which is just a high not seen in 22 years. And with Federal Reserve Chair Jerome Powell signaling last week that he's open to continuing to raise the federal funds rate, we can expect that rates will stay up that high. But as I'm saying, otherwise, those homeowners who would otherwise list now are not incentivized to do so because the rates are so high, which keeps supply so tight and prices up.
So I was doing a little TI-84 calculator here just before the show, looking at one of the recent reports that came out from a new home builder and Toll Brothers last week, just looking at the year-over-year increase that they're seeing in the backlog of homes that they're still delivering right now, and it came out to about 3.5%. A lot of buyers might look at that and say, okay, well, that is kind of pairing with year-over-year inflation as of right now. But where is it different for some of the home builders and the new home market when it comes to the delivery and that timeline for delivery, especially given that this is one of the more expensive home builders out there? And what does that spell out about the broader housing market, too? If you have a company in Toll Brothers saying that, all right, we still need time to be able to deliver on all of these homes, and we've got significant backlog, and then at the same time we need to write down where there is inventory that is unsold as well.
Yeah, well, it's an interesting question because, we saw that new home sales hit a high last week. And so but yet home builder sentiment is down slightly because the rates, because of the interest rates scaring off some buyers. So we're seeing some of them offer incentives to get people into those homes. They're offering breaks in the customization of the homes that they're going to deliver and in closing costs. So it's an interesting situation because there is that high demand. There may be a backlog that they're still catching up to, but there are certainly buyers for those homes out there.
So Heidi, as we look regionally then, and people are trying to decide, is it better to sort of get an existing home or try and wait for one of these new builds, considering, sometimes the cost can kind of add on as you go in with a new build. How should people be looking at how to decide whether to buy a new build versus some of the limited existing home inventory?
Well, I think it really depends on which market you're in. One thing we're seeing about the home price trends is that they're really varying quite a bit from market to market regionally. So we saw prices go up in certain parts of the country, in the Northeast, for example, but yet in markets like Seattle and San Francisco, we saw prices go down. And also that new home inventory isn't coming up evenly across the market. So, I think it really depends on where you're at. The other thing that's an interesting part of this is that
rental prices for single family homes have sort of slowed in terms of their growth. And so right now that is seeming like an attractive option in terms of staying in a rental and waiting it out for for interest rates to come down.
Heidi, we often talk about how student loan resumption and payment resumption is going to impact small purchases, things from the footwear that you might get all the way to whether or not you're going to buy a new television. But what about for that large purchase that a lot of borrowers are still trying to be able to figure out how they can finance in the future? How does student loan repayments now have a broader impact on that housing market?
Right. Well, that's a very good question. I've heard lots of different opinions on how that's going to play out. I've heard some say that, it's actually already baked in. This, like, underwriters now are still, they've always kind of kept in the student loan as part of the financial picture when assessing a borrower over the past several years, despite the Biden administration's measures with that. But then I've also heard that, psychologically, that's a huge burden to these potential buyers. And so that this may, in fact, scare them off of, thinking it's something that they can do right now.
Mortgage rates above 7%, low inventory, and rising prices. Just this week, pending home sales are down 14%. Now that's a 14% decline from a year ago. Joining us now, we want to bring in Glenn Kelman. He's the CEO of Redfin. So Glenn, the big question is what is this cooling effect? How big of a cooling effect is this going to have on the housing market? What do you think?
Well, rates have been high all year. They peaked in August. They seem to be easing slightly now. So I don't think sales volume could go any lower. And prices are actually headed up because inventory is down. So I think the market is in a holding pattern, waiting for a break from the Federal Reserve.
As are so many other sectors, Glenn. It's been interesting to see how home buyers, as well as builders, have tried to work around the rates as well as inventory levels. We have seen an incredible buildup in new construction, new homes. You've talked, though, about this generational shift that is happening right now as a result of lack of affordability, as well as just the lack of opportunity to buy homes. I wonder if you can touch on that, because, we sort of talk about homes day in and day out, but what is this sort of this long-term shift that we're seeing as a result of where we are today?
Well, it's decline in the American dream, isn't it? At this point, 30 years ago in their life cycle, baby boomers own more than 20% of U.S. national wealth, whereas millennials own less than 10%. And it's simply because millennials can't afford a home. We pulled the ladder up just as millennials were coming of home buying age. Home prices shot through the roof, then rates shot through the roof. And now there's so many people who want to move and can't. There is still unfinished business in this country where people want to leave the coastal cities for less affordable parts of the country, but those for more affordable parts of the country. But now the more affordable parts become less affordable too. And so really, it's just a case of arrested development where people who want to move can't. And it's a tragedy.
So then, Glenn, how does this play out?
Well, you just see lower household formation, more people living with mom and dad, shacking up with roommates instead of striking out on their own. It's one reason why family formation is down. People aren't getting married as much. They aren't starting families and having children because they just don't have the living space to do this. And so I think that housing is a basic human need. We are going to see more people looking for homes. The real issue is inventory. There are so many folks who want to move up who aren't putting their homes on the market because they can't even afford the place they have now. Interest rates have gone up so much. They are loath to leave behind that 3% mortgage rate. And so the real crimp in the industry isn't actually demand, it's supply. There's not much of either, but there's especially low supply with new listings down more than 10% year on year. And that was from a low in 2022.
Glenn, what has all this meant for your business on Redfin?
It's been a wild ride. So sales volume is around 4.1 million units, and we've had to make adjustments just because we employ our real estate agents, and that means that we have to keep them busy. So we went through a couple of layoffs at the end of last year. We're doing better now. We expect share to increase in the second half of this year, but it's been very disruptive. And yet, we still believe there's just a better way to buy or sell a home, that you could sell it for 1%, that you can get better service, that you can click a button to see into a property, or excuse me, to go tour it. So all of those things are still true. It's just hard to be a publicly traded company when you're in a very cyclical seasonal business. We're going to see it through, though.
Glenn, when it comes to those people who are still out there looking for homes, they're still maybe among the buyers that are able to afford this. What's the demographic there? What are you seeing in terms of the people that are able to afford and where they're buying?
Well, some of them are Nepo home buyers, people who are borrowing money from mom and dad. So traditionally, America has had more class mobility than anyone else just because we've had more land. People have been able to buy into the American dream with a very small down payment. But because we tightened credit after the great financial crisis, and now we've got rates where they are, the only people who can buy a home often are the people with cash in hand. And that either means older people or children of wealthy people. So we're just seeing an increase in cash buyers and a decrease in everyone else who has to get financing.
What about for developers? Are you seeing, sort of investors kind of pull out of the market because the upside isn't as significant, the inventory or the opportunities just aren't there? What are you seeing on that front?
Well, it's a tale of two investors. So the home builders are doing really well. A third of new listings are new construction listings because traditional listings that are coming from people who own a home just aren't on the market. People have decided to stay off the market because they want to keep that 3% mortgage. And so the builders have really got a monopoly on the attractive inventory, and more people than ever are buying new construction as a result. But if you're talking about investors who are Airbnb investors, where they're buying a home and flipping it, for the first time, we've seen them come under some duress. If you go to these really bubbly markets like a Boise or an Austin, they haven't been able to get the rent. They're trying to sell the property, and sometimes they're bringing cash to the closing table. Mostly, we haven't seen the kind of distress that marked 2008, which created all this inventory when no one else wanted to sell, foreclosure, short sales, and all the rest. But the investors who are trying to make a mint by creating an Airbnb empire are, in some places, just a few, starting to get upside down.
Glenn, going back to what you said earlier, when we talk about the tight inventory, obviously pushing prices higher, how much higher, I guess, how much longer do you see this trend staying intact?
Well, you tell me. When is the Federal Reserve going to lower rates? I know that the employment numbers eased a little bit, but mostly it's really a tale of two economies, too, that the rest of the economy is doing really well, which means that the housing economy isn't likely to catch a break by the end of 2023. Rates are going to stay around 7% or higher for the rest of the year, as far as we can tell. And I think until we get some rate relief, we're not going to see more inventory because people are going to want to hold on to their loans. And we're not going to see that much demand because so many people just can't afford the mortgage payment. So it's going to be a holding pattern at least through the rest of this year and probably into 24.
Shelter component of July Consumer Price Index, which makes up a third of the overall CPI index that increased more than 7%. Investors are eagerly awaiting August's CPI report, which is set to release Wednesday ahead of the Federal Reserve's upcoming policy meeting. For the Fed, it seems taming inflation also means navigating a housing crisis, perhaps. On this particular topic, let's bring in Kyle Campbell, staff writer over at the American Banker, to weigh in. Kyle, great to have you here on set with us. First and foremost, do you think about that housing component there? Is that expected to abate or recede a little bit, or is that something that we should expect to remain hot?
So, Fed Chair Jerome Powell spoke to this a bit during his Jackson Hole address. He said that there are sort of deflationary pressures in the pipeline, if you will. And what he's referring to there is the fact that it takes a while for rents that are either sort of stable from the year before or even potentially lower to show up in inflation indexes, because someone has to sign a new lease, they have to renew in order for that to show up. And both the CPI and the PCE index, which is the Fed's preferred measure of inflation, they focus primarily on rents or rental equivalents for homeowners. So when you see things like rising mortgage costs and home prices, it's sort of a different story. But of course, it's all the same market, and so they are related in certain ways. And how those two sort of interact with one another, I think, is going to sort of determine the trajectory of things moving forward.
But is there a risk there, though, the fact that it does just take into account rent, not so much the buying side of things, that potentially the Fed would possibly have to rethink their strategy, rethink their policy if we start to see more cracks in the system?
Of course, yeah. I mean, or even just let's say there's a pause of some sort that gives homeowners who maybe have wanted to sell for a while but didn't want to go out into the market with rising mortgage rates. They might say, well, okay, now I feel like I can actually put my house up for sale. You suddenly have that inventory, and then you have home prices surging. Could that then lead to a change in prices on, the rental side on one end, or just sort of a uptick in broader inflation in other categories? That's the question. Yeah.
What categories would that overflow into?
Well, so I mean, the mortgage, where mortgage rates are at, it impacts labor as well. Because there's a huge, the housing sector is a huge part of the labor market. It could, if those prices are rising, it could lead to other sort of related services increasing in price as well. So it's not sort of the direct cost of buying a home, but it's the things that are affiliated with it and how that sort of interacts with the broader economy.
Kyle, when we take into account the fact that prices have not dropped nearly as dramatically as many of the forecasters were expecting this year, a lot of that has to do with the fact that the supply and demand picture remains extremely out of balance. When we talk about the timeline and what needs to happen in order to get better balance between those two, what needs to happen?
A lot of things need to happen, but it's mostly supply side. Ultimately, prices are not going to abate until supply and demand are better aligned. And of course, the Fed tries to suppress demand by making costs higher. But what we're seeing is that they cannot drive down demand enough to reach the level of supply, which is so low thanks to years of underbuilding and sort of local policies that have restrained housing markets.
Well, high prices continue to squeeze prospective home buyers. A new report from Realtor.com shows the lack of affordability as the number one reason buyers are staying on the sidelines. Other reasons include affordable home availability. We're talking about inventory. They're saving for a down payment and getting approved for a mortgage. We're going to get some updates on the housing market next week with housing starts, builder confidence, and existing home sales data coming out. Joining us now is chief economist for Realtor.com, Danielle Hale. Danielle, it feels like there's not a lot of relief in sight every time we talk to you, but where do things stand right now? I mean, we're talking about the first-time home buyer really being squeezed. Those rates are near 8% now.
Yeah, home buying costs are very, very high right now. They've essentially doubled in the last 3 years. So it is a challenging time to be a home buyer, especially if you're a first-time home buyer and don't have the benefit of seeing your prior home go up in price and build up some equity that you can leverage in a transaction. So first-time home buyers are challenged by the market. At the same time, existing homeowners are challenged by the market because they are sitting on very low mortgage rates, in many cases under 4% or even under 3% in some cases, and market rates are up well above 7%. So trading up for those homeowners is an expensive proposition. And so the market is seeing not a lot of activity right now. Existing home sales continue to be quite low. And there's not a lot for sale because that mortgage rate lock-in effect is really hampering homeowners, keeping them on the sidelines. That's creating some opportunities for builders, but all in all, housing market activity on the whole remains quite low.
What type of overflow is that continuing to have within rents right now?
Yeah, so interestingly, I talked about, builders doing a little bit better than the existing home sales market. So we are seeing some people who might have bought existing homes look at the new market just because they're not finding what they want. At the same time, builders are building a lot of multifamily homes. Those are typically marketed for rent. So a lot of multifamily supply is coming on the way, and it's hitting the market at an interesting time. Our recent rental data has shown that rents have declined on a year-over-year basis for the past 3 months. We've got new rental data coming out next week. So, we'll look to see if that trend continues. That's spelling relief for renters, but it's also indicating some more competition for landlords is on the way as more supply is coming online when rents are already softening.
Danielle, going back to home buying, what's the rate you think at which it makes sense for a homeowner to say, okay, maybe I'll consider testing the market? We're not getting back to 3% anytime soon.
Yeah, no. So I think trying to beat their existing mortgage for many homeowners is just not going to be possible. You're not going to get a lower rate anytime soon. So it's going to be a different consideration for every single household. And they're going to have to think about their personal situation, how good of a fit their current home is, or how much more they need that additional space. If you've got a job change, you might have to move anyway. If you've got more kids on the way, you might have to move anyway. So there are family situations that are going to drive housing changes. I think the other thing people want to look at is their equity position. Do they have enough equity to roll into a new home so that maybe the sting of a higher mortgage rate is less impactful because they can put down a lot of equity and take on a very small mortgage? Or in some cases, homeowners who have 100% equity don't need a mortgage at all. They can be freed up to take advantage of a market that is much less competitive than it has been over the past couple of years.
If we do indeed see an inkling of a rate cut next year, or at least, some tenor or shift in the Fed that they're considering multiple cuts even, what would that do for the housing market? And would that mean that the prospect is largely changed for a lot of people? We see an overflow of new buyers and potentially sellers as well.
So I do think there is some pent up demand in the housing market. High rates are keeping a lot of people on the sidelines for affordability, or for holding on to their existing low rate. I don't think we're going to see rates dip low enough to see a flood of homes onto the market. But I think as rates gradually drift lower, those individual calculations of should I move now or should I stay put will make sense for more and more people, because as it takes time for those rates to drift lower, those current homeowners are building up more equity in their houses and are having more life changes that are likely to drive the need to move into a different housing situation. So I think we're going to see a gradual recovery in the housing market as those rates drift lower. And the point at which people acclimate, the longer it takes, the more they're going to get used to those higher rates. But I think for buyers in the market today, it's worth thinking about the fact that you can't control mortgage rates. And if you've been shopping over the past year, that's a very real reality to you. But there is something that buyers should know that they can take advantage of. And that's, we have these seasonal patterns in the housing market of supply and demand and ebbs and flows. And they kind of are looking to shape up so that the first week of October 1st through 7th, is actually the best time of the year from a seasonal perspective for buyers to buy.
That's interesting. That's in a few weeks. We talk about rates not being the only factor for first-time home buyers. There's also the hurdle of getting a mortgage approved, but also having that down payment. Given the tight conditions right now, I'm just curious, what are you seeing in the market? Are buyers putting down 20%? Is it more likely 15%? I mean, how are buyers getting a little more creative so that they can get that home, that condo in hand?
Yeah, so first-time homebuyers have never traditionally put down 20%. They tend to put down lower down payments amount, and that makes sense because they're usually, this is their first home purchase. They're usually younger. They don't have as much savings built up over a lifetime. The high mortgage rate environment makes it challenging because the bigger the down payment you can put down, the lower your monthly costs are going to be. But obviously, it takes time to amass that down payment. And especially in an environment where rents have been high, it's challenging to save up. So homebuyers are getting creative. They're looking to different types of savings to come up with down payments. In some cases, moving in with friends or family to save up for a down payment. And something that we've seen and continue to see in the housing market is people who are interested in looking for homes beyond their current location. And oftentimes they're looking at other more affordable locations. So if you live in a high cost area like New York, for example, you might look further out into the suburbs. Or if you have the flexibility to work remotely, which some workers still have, you might look to a different market that's much more affordable entirely. And that's another way that buyers are getting creative when approaching the housing market.
All right, well, it is day 2 of a busy week in housing data. Building permits and housing completions were both up on a monthly basis in August, but housing starts, well, they took a dip. Construction on new homes falling to the lowest level since 2020, a sign that higher mortgage rates are a growing challenge to the sector. For more on this, we want to bring in Jessica Lotz, National Association of Realtors Deputy Chief Economist and Vice President of Research. Jessica, it's good to see you. So let's talk about some of the pressures that we're seeing in housing. Clearly higher mortgage rates above 7%, proving to be a real challenge for the sector. Any relief in sight?
I mean, I think that we all hope that there is going to be relief in sight, but it's really difficult right now. It's difficult for consumers, but it's difficult for builders to bring products to market. I think seeing that housing permits were actually up could be some indication that even builders are hoping that interest rates will go down in the next few months, because there's about a 2-month lag between permits and starts.
It's interesting because we had heard from the NAHB yesterday, the chairman, Alicia Hui, saying that the 2-month decline in builder sentiment coincides with when mortgage rates jumped above 7% and significantly eroded buyer purchasing power here. So for buyers who are continuing to evaluate this market, Jessica, what silver lining could they possibly take away from even this week's Fed meeting and any commentary that they hear about policy decisions from this point?
Yeah, it's really hard right now. I mean, I will say for a silver lining, if you're a consumer out there and you're trying to purchase a home, I mean, at least we're not looking at last year's really strong demand, that frenetic activity that was going on in the real estate market, where we actually had 5.5 offers for ever existing home that was listed. If you're a consumer right now, you have the opportunity to actually tour a home. You are buying it at a higher interest rate. You may have the opportunity to refinance that in the future. So that could be the silver lining. As we expect that interest rates will drop, that's going to mean more demand in the housing market for this limited inventory. I wish that housing starts had gone up, because we really truly need that demand. We need that supply right now.
Jessica, what level do you think rates need to fall to in order to see a little bit more inventory, in order to move some of those potential sellers to actually list their house?
Well, when we saw that rates went into the 6s, we actually saw that housing starts went up. So it's possible that builders would actually feel more comfortable if if interest rates went down, that housing starts would go up at that range. It's also very possible that consumers themselves will feel more comfortable in that 6% range. Once you're above 7, where we have been for the last several weeks, I think it makes it very difficult for a consumer to imagine jumping into the home buying market, even among homeowners who are locked into lower interest rates as well.
Jessica, what is the likelihood that builders would begin reducing prices in order to spur some of that demand?
Yeah, and that's something that we're already seeing. Is we're seeing that they were having rate buy downs. They were definitely having incentives to bring into these new housing products. And so consumers were actually finding that quite attractive. And we saw that new home sales were actually up. So it is possible that some builders are still going to offer those types of incentives to bring consumers into the market, especially if they've already dug in and that ground is already gone. They're going to want to bring a consumer into that house.
Jessica, are you seeing a little bit of a different picture when you look to various parts of the country? Because yes, the Northeast, there's not a heck of a lot of homes for sale, but we have seen a little bit more activity when you look to the South and when you look to the Midwest.
Yeah, absolutely. And those have always been pretty attractive places to build. Traditionally, we do see more building in the South. That traditionally has been a place to do so. In the Midwest, I would say that also has been very attractive for consumers in recent years as we look at affordability. And a lot of people have relocated into those Sunbelt areas. So building there, not surprising as we look at where it is attractive to move to right now. A lot of people are attracted not just to favorable job markets, good weather, but also where are my friends and family? Where's my support system, especially if I don't have to be close to a workplace right now.
That's why I'm trying to get all my friends to move to Seattle with me, Jessica. Maybe one day.
You can't leave us here.
Yeah, I won't actually. But at the end of the day, Jessica, when you think about how this is also continuing to perhaps overflow into the renters market right now, is there any persistence that we're seeing from the housing market starting to, and not just starting to, but continuing to put pressure on renting prices?
Well, as a native Seattleite, I will say that I will be first to move there. But yes, as we look at multifamily, that's a big concern because we do see that home building is down there. What I would say too is that when we look at last summer, we know that there were multiple offer situations when it comes to existing home sales, but there were for rental units. And that's a big concern, as we know that there's a lot of young adults who are trying to have their own place, not to have a roommate, not to live with family. They want to find a rental unit. An affordable rental unit is very hard to find today.
New home sales dipped in August compared to the revised July rates, down 8.7% as rising mortgage rates weigh on home buyers. Meanwhile, home prices continue to trend upward amid low inventory. Case-Shiller's home index, and it shows 19 of the 20 major metro markets reported month-over-month price increases in July. Joining us now, we've got Jeff Tucker, Zillow senior economist. All right, Jeff, we've got a lot to digest here and really trying to wrap our heads around this here. When you think about the broader state of the home market right now and where buyers are showing any interest at all, where are you seeing that shift towards where they are even deciding to enter back into the home buying equation?
Yeah, that's right. I think where home shoppers are still buying and still shopping is where they can afford to. And so geographically, that is looking like places in the Midwest, actually, places like Cleveland and Chicago. Also more affordable markets in the Northeast, like Providence, Rhode Island. These are some of the markets that actually still have pretty strong price growth that showed up in the Case-Shiller report today as well. And then sort of in terms of home type, new construction in many ways is more affordable for a lot of today's buyers because builders have been offering very generous buy downs of those mortgage rates as a major concession to kind of make the mortgage math actually work for home buyers when they're looking at the existing home prices and running the numbers on mortgages and realizing with mortgage rates now up over 7% that they often just can't make it work. So a lot of builders have been able to buy down those rates into the the lower sixes or even into the 5% range. So that has really helped builders continue to sell some homes. I think what we saw this month, though, with that August data that just came out this morning, is that even builders are being tested. Do they have enough margin to be able to work with to keep buying those rates down to a point that makes the math work out for home buyers? So we did see new construction sales take a step back last month. And the way things are going in September so far with that kind of hawkish Fed forecast and mortgage rates rising further up to flirting with 7.5% now, even builders are really getting stretched in their ability to buy down those rates to an affordable level for home buyers right now.
Jeff, do you think we'll see rates hit 8%, the 30-year mortgage?
That's a great question. I don't think we have that in the data right now. Although I think if you kind of step back and look at the revisions, sort of the way the yield curve has stepped up and up and up over the course of the last year, if that continues to happen, if we get another few step ups like that, 8% is certainly in shooting distance. But at the moment, I don't see anything to kind of push us to that level. But unfortunately, I really don't see anything in the data to point the other direction of much reason to expect rates to come down very quickly anytime soon. We're still digesting this 4.5% 10-year Treasury yield. That's very high. That's going to keep pushing those mortgage interest rates up, especially because we know that spread is very high right now, and it seems to be widening further the higher that Treasury yields go.
Do you believe that this is going to create a flight from cities just based on a pricing basis here? I mean, for the third straight month, we're looking at Cleveland, Chicago, New York, seeing some of the highest year-over-year gains among these top 20 cities, these 20 cities that are indexed here. So where is this going to create some fallout in some of these regional housing markets?
Yeah, so this Case-Shiller report is really interesting because it's telling the story of what happened in the first half of this year, where buyer demand was rather low, but the supply of existing homes available for sale was even lower. There were just very few listings of existing homes. That's kind of what was driving this shortage, which created a bit of a frenzy condition in places like New York City. And it, in fact, even brought some price growth back to markets out west, like here in Seattle. San Francisco had, and Phoenix had some substantial sort of seasonal midsummer price growth this year. So in many ways, that kind of lack of supply was really driving the conditions this summer. That's also what created the opportunity for home builders to step in and meet some of that unmet demand from the existing home market. So, looking ahead, what does all that mean? I do think if you look at a market like Dallas, that was one of the big surprises for me in the Case-Shiller report, was how weak home price appreciation is in Dallas at the moment. I think part of the story there is that's a place where builders have been able to build. When you look at new home sales, it's in the South, it's in these big Texas and Florida markets. And that's helping meet buyers where they are. And it does mean that kind of shortage of existing home inventory doesn't loom as large there. It's not creating those kind of frenzied conditions that we're seeing in the Northeast and the Midwest. In those markets, they're much more dominated by the fact that existing homeowners are just hanging on to those 3% mortgage rates they have. They don't want to sell, and that's keeping the supply of existing homes still just incredibly low.
The real estate market has been worrying investors since the end of the pandemic, with the Federal Reserve's rate hikes impacting housing prices and demand being at all-time lows. Now, earlier this morning, August pending home sales index fell 7.1% from July, hitting its lowest level since April of 2020. Now, Nexias argues the real estate market is in a capital market recession, not a fundamentals recession. Let's bring in DWS Group co-global head of real estate, Todd Henderson, to discuss more. Thank you for joining us this morning, Todd. So break down the distinction here for our investors who are watching.
Well, the state of the market is very interesting. As you said in the headline here, we do not believe that this is a fundamentals recession. Fundamentals are as strong across three of the major sectors as they have ever been: vacancies, leasing activity, et cetera. In both all in the industrial, the residential, and the retail sectors. The office sector, much has been spoken about. It's challenged, and it is the most challenged sector. But when you look at what's happening in these three traditional sectors of retail, residential, and industrial, we have really low vacancies. Granted, we had earlier this year or late last year in the industrial and residential sector, we had deteriorating demand. But we felt like that was really the result of a COVID hangover, where demand was brought forward through COVID. And now the good news is we're starting to see the trend lines of continued growth in e-commerce, which helps the retail sector and the the industrial sector, which helps the industrial sector demand. And we're seeing, again, absorption of apartment units at the level we saw prior to the turn down and the significant delivery of new construction here over the last several quarters. So we feel like while the 10-year is bouncing around a lot and real estate is priced typically off the longer end of the curve, we feel like for the most part, the repricing in real estate is done. The fundamental story is strong, and we feel it sets up for good rent and NOI growth in the latter half of 24 and through 25 and beyond.
Where do you see the most strength when you say the fundamental story is still strong? I mean, our viewers see this and say, look, if you're looking from a residential perspective, sure, there's new construction there, but these rates are really high. Is it enough for me to get in? I mean, where do you see the strength, the big drivers moving forward?
Yeah. So on the residential side, there's a fundamental challenge here with housing in the U.S., and it's a lack of supply. It's not necessarily the case globally, but in the U.S., there's a lack of supply. There is significantly deteriorated existing home sales. Existing home sales, owners are trapped, if you will, in their homes because 85% of homeowners today have fixed 30-year mortgage rates below 5%. So they're not going to trade their homes and trade into a 7+% mortgage, which has resulted in further deterioration of supply. Home builders have started to see a lot of demand just because of the lack of supply. And unfortunately for home builders, they eliminated much of their land inventory at the end of last year and laid off their teams in the expectation that high rates would deteriorate their ability to perform and deliver earnings to their shareholders. So what we're seeing is a real shift in terms of demand for rental, whether it's single family rental, whether it's multifamily rental. This area, we think, combined with the high cost of housing, housing prices, they've come down a little bit, but they haven't come down materially to reflect what's happening in mortgage rates. And that's, again, because of the lack of inventory. But the cost associated therewith makes it much more economical for people to rent. And we believe that the rental market it's already rebounding, and we believe that it's going to continue to rebound strongly as the forward supply curve in rental housing also is diminished materially.
Now, obviously, still some uncertainty when it comes to the inflation picture here. Chicago Fed President Goolsbee saying that housing will be key to continued inflation progress in the next few quarters, with risk that rising home prices could also boost market rents. How do you then break this cycle then? If people can't afford to get in these houses, they don't want to move because interest rates are so high, but then that's also fueling inflation. What breaks this cycle?
Yeah, well, I think if you look at the core PCE, the trailing 3 months, if you annualize it, it's about 2.6%. I do acknowledge the fact that we are seeing some higher oil prices. We're seeing higher fuel prices. We have the potential for housing prices to stay high, given the supply and demand imbalance. But I think what you see here is the likelihood for a rate environment to be higher than what we have grown accustomed to over the last decade or so. And the question in the real estate market, the commercial real estate market, is whether or not the rate environment that we're in at the moment is the peak rate environment, and whether or not pricing in the marketplace reflects that rate environment. We believe that the 10-year being this morning in the rate of or in the zone of 4.6%. That we believe that we're going to trend back closer to 4%, and we believe that the pricing in the marketplace reflects the cost of capital. And again, we get back to the fundamental story: if the capital markets recession is for the most part done.
Finally, Todd, really quickly on the commercial real estate sector, or the office space specifically. I mean, we've heard all the doomsday scenarios that are out there, but as you think about the reality of workers not necessarily returning to the office in the way they did pre-pandemic, what does that real estate footprint look like 5 years down the road, 10 years? How are you looking at that?
I think CEOs and people who lead businesses recognize the importance of having people in the office more than not. Their training, collaboration, education, we call it osmosis learning or creative collisions that happen in the hallway. These are important things to the sustainability of creativity and growth in businesses. I think in 5 years, we will see much closer to where we were in terms of pre-pandemic. I don't say we would be all the way there in terms of occupancy in 5 years from now, but the real question is, how do we get there? And getting there is, or before we get there, it's painful. We're seeing, we're basically seeing a significant oversupply of office, not too different than what we saw in the retail market before the pandemic. And what needs to happen is some of the older office, the office that doesn't offer creative opportunities, it doesn't offer sort of almost like entertainment abilities within it, is going to suffer dramatically. But I think from a macro perspective, what you really have to look at in terms of office space is, where are people moving? Where is population migration? Where are job growth? And then what cities and locations have the newest, best office stock in those markets? And that's how you play the office market, either from an equity or credit perspective, until we get back to a place where people are in the office 4 days a week.
Mortgage rates continue to rise. The 30-year fixed-rate mortgage hitting 7.49% on average last week. That's according to Freddie Mac data just out today, and it's a 23-year high. This coming as mortgage applications have ground to a halt. According to the Mortgage Bankers Association, applications there dropping to the lowest level since 1996 as that rapid rise in rates pushes potential homebuyers out of the market. Joining us now, Redfin CEO Glenn Kelman. Glenn, tell us, when is the dam going to break here? What is going to change these dynamics?
Well, I don't think we're going to get a major break in the action until the Fed lowers rates, and that's unlikely to happen in 2023 or even in the early part of 2024. So this is different than other housing market downturns. In 2008, there was massive distress. People didn't want to sell, but they had to, and that brought prices tumbling down, both through foreclosure and short sales. This time around, it's a standoff. No one wants to sell their property. No one wants to buy a property. So sales volume is going to stay low for the foreseeable future.
Yikes, Glenn. This is sounding grim. Here's my question. As mortgage rates, though, they keep going up, Glenn, at some point, would you expect home prices to start falling here meaningfully?
Maybe some. So far, that trend hasn't happened. Inventory is down 15%. We have seen an uptick in listings just in the past few weeks, so maybe that'll show up in broader industry-wide numbers later in the quarter. And if that happens, then we could see some softening of prices. But right now, there just aren't enough homes to buy. And if I had to say where we were more short, it would be on the supply side, not on the demand side, although both are really down.
None of this is news that Josh Lipton wants to hear, Glenn, unfortunately. Yeah, Josh has been looking for some sunnier news on this one. Talk to me about sort of the different tranches of the housing market, because I'm curious how this is playing out with starter homes versus higher end homes, et cetera, or is it kind of all in the same boat right now?
It's fairly broad. I would just say that well-priced homes that are turnkey are still selling. So if the property needs some work, that's unlikely to appeal to someone who has already maxed out because of mortgage interest rates. And so we tell people to really get the property fixed up. And that's another difference between now and 2008. In the last downturn, people were really buying on square footage alone. This time around, the sellers are really trying to gussy up the house to make it look good. At the lower end of the market, it's a better market. At the high end of the market, we're really seeing properties sit for a very long time.
Yeah. Glenn, we're talking about the housing market nationally. I'm also curious, though, regionally, Glenn, as you look across the country, are there regional differences that are worth noting?
Sure. So Chicago is doing better. Florida is doing better. Texas has mostly been doing better. It's the West that's really struggling, and especially Oregon and California. People are fleeing high-tax states, and that trend has mostly not reversed. In Washington state, there has been a change in the weather just because some people are being brought back to Amazon and Microsoft. There are also people who feel alienated by the politics of Texas and Florida and want to come back to a more left-wing state. So for the first time, we are seeing some people coming back to coastal markets, but mostly the damage is concentrated in California, where it's really been a problem for the past 4 years.
And Glenn, we were joking about this being a bummer for Josh, who's looking for a house. I mean, it's not great news necessarily for your industry either, right? Redfin suffering amidst this to some extent, although your stock is up on the year. Are you all also looking for this turn in the housing market?
Well, you have to build your business for the economy you're in rather than hoping for a different one. So the only way Redfin is going to grow is by taking market share. So we're drawing visitors away from other real estate websites. We're getting more people to ask for tours as a result. But the problem is that once those people see how far their money goes, many of them change their minds. So we just need to drive that through to a sale. And at some point, we're just going to need some help from the overall economy. And it's really a tragedy at a generational level. At this point in their trajectory, baby boomers owned more than 30% of national wealth, whereas millennials own less than 20%. 1 in 5 millennials believes he or she will never own a home. And so I think we're just in a situation where sooner or later, government, the Fed, society as a whole is going to have to decide that housing is really important to the economy and that housing is really important to family formation and society overall. And so it's a basic human need at 4 million units instead of 6 million. Redfin is still going to take share. We're going to be just fine, but it's more competitive than ever. And maybe one other change that's interesting to me is just how price competitive real estate agents have been. I mostly have felt that this industry is completely resilient or resistant, to change. But over the past 6 to 12 months, I have never seen more discounting among traditional brokers than now. So that, coupled with some class action lawsuits in Illinois and Missouri and other big changes threatened by the Department of Justice, means that this whole industry is up for grabs in an exciting way that I haven't seen since starting at Redfin 18 years ago.
Glenn, my last question to you is, who is actually buying homes, though, Glenn? Do you all have data and insight on who is actually getting the deal done and moving into new homes? Who's my competition, Glenn? That's what I'm asking.
Well, Josh, didn't you relocate from San Francisco to New York? Is that why you're looking for a house?
It's great memory, Glenn. I did. I'm here in New Jersey, and it's brutal, Glenn. There's no inventory. You hear limited inventory. It's what my grandma Minnie would call bupkis. That's what's out there, Glenn. There's nothing. And affordability, as you know, has been crushed.
I had no idea you were Jewish, Josh, but you are one of many people who are relocating across the country. So about 18% of our customers used to be relocating, and now it's 26%. So aside from death and divorce, which is always going to be one reason people trade homes, the other big issue is that there's still unfinished business in America where people want to leave one state for another, often to flee taxes. And so as a result, we are still going to see this millennial generation want to have kids and buy houses for their families. We're still going to see this relocation. There's a bunch of social forces that are driving significant demand. It's just sidelined right now by rates. The rates are sidelining the inventory, and the rates are sidelining demand too.
According to a new report from Realtor.com, home prices saw a surprising uptick in price-reduced homes from August to September amid ongoing affordability concerns. Let's bring in Danielle Hale, Realtor.com chief economist, to discuss. Danielle, tell me there is some good news on the horizon.
Yeah, there is some good news on the horizon. I mean, as Danny was just talking about, the uptick in newly listed homes, we saw that in our data in August. I'm going to temper that good news a little bit, which is to say it seems to be a short-lived August phenomenon. In today's data out on September, we saw that new listings trend kind of returned to its normal pattern. So we're still not seeing enough sellers in the market. But there is some good news for buyers, which is in the midst of what is a very challenging housing market environment. This week, from October 1st to October 7th, is the best time to buy. So even though these big macro conditions are challenging, mortgage rates are high, home prices are high, if you look throughout the calendar year and you need to make a move now, this week gives you the best sort of combination of still available housing inventory with slower prices, somewhat more price reductions from sellers who are motivated, who want to sell before the end of the year, before the housing market really slows down for the winter. And so that's really creating a bit of a break amid a challenging situation for potential buyers.
So it sounds like a lot of this is more about seasonality versus, sellers just sort of pricing to be competitive as was just seeing house prices go down. So then in terms of a light at the end of the tunnel here, what is motivating sellers beyond some of these seasonal changes? Is it the pinch of inflation or baby boomers downsizing? What are some of the demographics here?
Yeah, so looking at best time to buy is really all about seasonality because that's very predictable in the housing market. The thing that has become abundantly clear is very difficult to predict is these mortgage rate trends and like these broader macroeconomic trends. We're seeing mortgage rates reach new highs when most forecasts heading into 2023 expected that we'd be past the peak of mortgage rates at this point and seeing them start to decline towards the end of the year. So taking advantage of these seasonal trends, which are much more predictable, I think is something that buyers can keep in mind. When we think about what's motivating sellers, we identified two potential causes of that temporary, or what has shown to be somewhat of a temporary uptick in August. And that was that, potential sellers were looking at the mortgage rate trends, seeing the mortgage rates start to increase in September and kind of thinking, well, I've been waiting maybe I should jump into the housing market before mortgage rates go even higher and buying conditions kind of deteriorate further for buyers. So that was one potential driver. The other is that people are just acclimating to this higher rate environment. And so if they put off plans waiting for mortgage rates to fall, maybe they decided it's not time to wait any longer. I just need to move ahead, and I'm just going to have to deal with the current mortgage environment as it is. And so I think it's a little bit of both factors. It might be more of the temporary thing, which explains the 1 month uptick, and now we're sort of going back to what was the previous trend. But I think as we see time progress, more and more homeowners will acclimate to these higher rates and just set their expectations accordingly and move ahead with what they need to do in the housing market.
Danielle, if you're a buyer in the market, you've certainly accepted that rates are higher. There's an interesting Wall Street Journal story out today, though, that talks about how that range of rates are increasingly widening. And I'm curious if you're seeing lenders really price their loans more aggressively now, knowing the limited number of buyers that are in the market. What are you seeing on that side?
I think absolutely with lower volumes in the market, there are fewer transactions, fewer buyers out there. Lenders do have to price competitively. So it has always paid to shop around for a mortgage. And I think that's even more so in this kind of rate environment. And as a buyer, there are things that you can do to improve the mortgage rate that you as an individual are going to get. Make sure that your credit score is high. Take a look and clear up any potential issues. Make sure you're in a good financial position, so you've got a significant down payment savings. It would be worth talking with a lender about the particular loan products that are available. You might, for example, do better with an FHA loan as opposed to a conventional loan, or if you're eligible for it, a VA loan as opposed to a conventional loan. So exploring the different products that are out there, and also maybe playing with your down payment, so that if you put a higher down payment, in some cases, maybe if you put a lower down payment, you might actually see the rate scenario change. So working through those scenarios with your lender can help ensure that you're getting the best rate possible.
And if this is the best time to buy, in terms of regions or metro cities, where can people get the most bang for their buck right now?
Yeah, so we're seeing the housing market remain relatively competitive in the Northeast and the Midwest, not necessarily the biggest cities in the Northeast, but in a lot of sort of the close-in suburbs and secondary markets that are within not too distant of New York and Boston. Those are areas that have a very high center of gravity right now. We're seeing homes continue to sell relatively quickly in those markets, and prices remain relatively elevated. So those are good places where buyers are looking for affordability on a relative basis and finding it. And we're seeing the housing market reflect those trends.
3 real estate groups are calling on the Federal Reserve to stop raising interest rates and prevent volatility in the housing market. In a letter to Jerome Powell, the 3 real estate groups, Mortgage Bankers Association, the National Association of Realtors, and the National Association of Home Builders, is asking the Fed to communicate 2 pivotal points. First, not consider further rate hikes. 2, hold off on selling any more of the mortgage-backed securities it holds until the housing finance market stabilizes. This comes as housing affordability conditions have been squeezed. And how did we get here? How did we get to this point? Well, the landscape for the housing market has drastically changed after the Fed raised short-term rates from near 0% to 5.25% now to dampen inflation. As a result, demand has tanked. There's low inventory in the housing market, especially in the resale market. There are fewer transactions when it comes to loan applications. Mortgage rates are hovering over 7%, squeezing that purchasing power that potential homebuyers need. And this also comes as the Fed has indicated higher for longer, a big debate among investors on what longer really entails. So this letter is a push for clarity, and we reached out to the Federal Reserve, and a spokesperson had no comment in regards to this letter. Kiko.
Well, new data showing that mortgage demand edged higher for 30-year fixed-rate mortgages in the last week. According to the Mortgage Bankers Association, the rate on a 30-year fix rose to 7.67%, but the big move in demand was for adjusted-rate mortgages, which jumped by 15%. Joining us now is Mike Fratantoni, a Mortgage Bankers Association chief economist. Mike, Thanks for being here. What do you think accounted for this increased demand, not just for fixed rate, but for those ARM mortgages?
Yeah, well, thanks for having me. And as you said, we really saw a difference in the volume last week where overall volume was up just a bit, but we saw that large 15% increase in people applying for adjustable rate mortgages. As you noted, the fixed rate at 7.67, that's the highest we've seen in 23 years. But because of some of the moves in the Treasury market, the ARM rate was down to about 6.3%, so down about 0.16% on the week. And people respond to price changes. It is very, very challenging to find affordability in today's market, given how much rates have gone up. But one way that borrowers can adjust is by looking for an ARM. And we saw in last week's data, we're up to a 9.2% ARM share. That's the highest we've seen in a while.
And Mike, your organization sent a letter to Fed Chair Jerome Powell recently. Why did you send that letter, and what are you asking for?
Yeah. So obviously the housing sector is one of the most interest rate sensitive sectors in the economy. And we were just weighing in with the view that we think the Fed's short rate increases, getting the Fed funds rate up to between 5.25 and 5.5, that is sufficiently restrictive to bring inflation down. And we're honestly more worried now about this additional pain in the housing market, given how much activity has slowed.
Mike, on that point, Peter Bukvar, Chief Investment Officer at Bleakley Advisory Group, here's what he told his clients about that letter. I'd love your reaction about this. Bukvar said, while I fully understand their concerns, I don't recall these groups during the mid-2000s calling for the Fed to raise rates as they were stoking that decade's housing bubble. And I don't believe they were telling the Fed to stop QE, including the massive buying of MBS mortgage-backed securities in 2020 and 2021, and to raise rates as home prices were leaping by 40% in 2 years. You think Peter Bukvar has a point there? What's your reaction, Mike?
I think he's a bit off base. The real estate finance industry is very much reliant upon stable long-term rates. And those stable long-term rates are dependent upon the Fed doing what they do best, which is keeping inflation low while trying to maximize employment. I would say he's directly wrong. Actually, in 2020, we did ask the Fed to stop buying MBS to the extent that they were, because a lot of lenders were getting enormous margin calls based upon the swings in the market. So our sense is, we want stable rates. Obviously, they can't be lower than can be sustained over time, and we need inflation to be low to keep those long-term rates as low as they can be.
Is the stability approaching, Mike? Are we getting any closer to stability? And what do you think is a sustainable long-term rate that can still coexist with a robust housing market?
Yeah, I think it's been really interesting just within the past week. You've had a number of Federal Reserve officials note that the balance of risks now really are leaning more towards concerns about weakness in the economy, that the spike in long-term rates we've seen over the last 6 weeks plus is really putting a lot of strains into the economy. Absolutely the housing sector, but other sectors as well. In terms of where we're headed over the longer term, we're going to be releasing our new forecast on Sunday at our annual convention. The Fed themselves have said that a neutral Fed funds rate is probably somewhere between 2.5% and 3%. That probably means a 10-year yield around 3.5%. And if the spread between 30-year mortgage rates and 10-year Treasury rates could get anywhere close to normal, that means a 30-year mortgage rate of, call it 5.5%. So that's where we think we'll get to over the next couple of years. We're in just this very, very stressful point right now at 7.5% plus on a 30-year mortgage.
So your outlook, Mike, for the U.S. housing market, walk me through it, because supply side, limited inventory, demand side, as we're talking, affordability's been crushed. What breaks that? Is it just enough demand just simply punch through that? Enough people have life costs and they just have to pay up for it? How do you think we move out of this?
Yeah. So we talked about how some borrowers are adjusting by moving to an adjustable rate mortgage. That's one dimension. You also see people able, because of maybe a hybrid work schedule, to look for properties a little bit further from their work, right? And so that's one way to bring costs down. They also might look for a condo or a townhouse instead of a detached property. So all of those ways are ways in which borrowers can adjust. Our outlook for housing really is very much dependent on the path for rates and the path for the economy. We think the economy is likely to be in recession in the first half of next year, but a fairly mild one. And sort of the net of somewhat lower rates and a somewhat weaker job market, we think it'll enable some additional existing properties to be listed, which will not eliminate, but make the inventory situation just a bit better. So we're looking for modest growth in home sales over the next several years. One thing we've certainly seen is that given the very strong job market, delinquencies are extraordinarily low, actually a record low in our most recent data point. And even with some increase in unemployment, we still expect the housing market is going to be strong in terms of performance of homeowners continuing to pay on their loans.
You've got multifamily starts that ticked up alongside single family starts. It's a little bit of a simplification, but you can think about multifamily as representing the for rent side of the housing market and single family renting the for sale side of the housing market. That's a little oversimplification, but pretty good for most purposes. And what we've seen is that rental construction and for sale construction has ticked up, creating more supply, but we're still in an environment where there's not a ton of supply in the for sale market, and we're getting to better supply conditions in the rental market. But still, if you look back over the last 10 years, we haven't built enough homes to keep up with households. So the big picture momentum in the housing market is that we're undersupplied, but that it's shifting as, buyers confront major headwinds from higher mortgage rates and higher home prices and higher rental costs. Even though they're easing, they remain quite high. It's a tough market to find a place to live right now.
And Danielle, I'm interested, do you think there's anything local officials and regulators could and should be doing to encourage more construction?
Yeah, I think that's a great question. So making sure that permits get approved in a clear fashion and expedited manner, I think that can really add a lot of costs to builders in the process of getting homes to the market. Local regulation, the unpredictability of the permitting process, making sure that they're keeping up with any local building codes, and to the extent that there's more stability in those codes, I think that can also help them get to market sooner. There's a lot of local initiatives underway right now that happen to be happening in my neighborhood, for instance, to increase density and to make it easier for builders to build smaller units that are, say duplexes instead of single family homes or triplexes instead of single family homes, to increase the density and enable builders to build more housing at an affordable price point, because that's the area of the market where we see the least supply and the most demand. So if we can figure out how to fill in those gaps, I think that'll be really important. Housing affordability is number one, with mortgage rates at 23-year highs and likely to keep moving higher as 10-year treasuries and other interest rates move up. We're likely to see similar trends in the mortgage market. And so I think it's going to continue to be a major pain point for households. So anything we can do to address the supply of those affordable housing units will help.
You sort of alluded to, obviously, the regional differences, right? And that's one of the things I have to wonder about because, we all have it through our own lens. But I look at my own area, the New York metropolitan area, and there is no place to build new houses, even if you change zoning, even if you wanted to. There's just not a lot of space in some of these densely populated areas. So it seems to me that it's not necessarily new construction that's going to save the day here. All that's going to help maybe is a little bit of relief on interest rates, which, as you say, isn't coming.
Yeah, I think relief on interest rates would certainly help, because I think that would increase the level of churn that we see in the housing market. If you look at market rates that are fast approaching 8% for mortgages that people would get today, compared to 90% of people have mortgages that are locked under 6% on their existing homes. So it doesn't create a big appetite for transition. But if we were to see mortgage rates fall, we would start to see some more transition in the market. But it doesn't change the big picture, which is if we look over the last decade at the number of households that have formed and the number of homes that have been built, there is a gap of between 2.5 and 6 million. So there is a big hole of households that we haven't built houses for. And that's why this big picture shortage situation, I think, remains. If you look at vacancy rates, whether you're looking at rental vacancy rates or homeowner vacancy rates, they're either at or close to long-term lows. If you look at how quickly housing units are being absorbed by the market, rental absorption, is up well above pre-pandemic pace. So there's a lot of demand for housing that isn't really being met in today's market. And unfortunately, with mortgage rates being so high, builders are having a hard time making the case to build themselves. Starts were up this month, but I think we're going to see some more headwinds ahead as builders are concerned about the amount of buyer traffic they're going to see, with affordability being as stretched as it is for the typical buyer.
And Dana, I want to end here. Another big theme to discuss is climate, the changes we're seeing there. What kind of impact does that have on new construction and the industry broadly?
Yeah, so I think builders are mindful of climate patterns. It's interesting that a lot of areas where there are climate risks present, it was very difficult to figure that out in the past, but fortunately there are tools available for buyers. The First Street Foundation is a great resource, and they produce information on flood risk and fire risk, which we've now embedded into the site on Realtor.com. So if you're shopping for a home and you're concerned about climate risks, you can take a look at the property level and see, what the flood risk is on a particular home, what the fire risk is, how that's expected to change over the future, and factor that into your home shopping in a way that you didn't necessarily have the opportunity to do before. We do know from looking at the data that home buyers do seem to have been trying to price that in. So if you look at homes that are in coastal flooding areas compared to homes that are nearby, but a little bit inland, we did see faster price appreciation for those more inland homes. But thanks to the data from the First Street Foundation that you can find on Realtor.com, it has become much easier for consumers to get their hands on that information and factoring it into the home buying process. So that's a great win, I think, for consumers and then for the market, because it means that the market will have a reason to serve those consumers and give them what they want and adjust accordingly.
Well, it's certainly a good news that more supply is being provided by home builders on the single-family housing starts. We saw the apartment construction actually decline somewhat. Maybe people are concerned about oversupply, but for the ownership market, the single-family housing start this year, there could be actually more new home sales compared to last year based on the trending condition, even though existing home sales are down by 20% due to the lack of inventory. But the builders don't have constraints on inventory. They just build it and create that inventory. So clearly implying that there are demand out there. People want to see more choices, more inventory, and people are responding to that.
What's the likelihood that they'll see that anytime soon, Lawrence?
Well, the momentum is good. So it's an incremental growth, but we really need to see a big increase in inventory. Currently, we have only 1 million homes on the market. Pre-COVID 2019, we had 2 million homes on the market. So essentially doubling in the inventory is required, which is the reason our organization is talking with Congress to say, can we provide some tax credit for mom and pop real estate investors, small time, who are holding maybe 5 properties, to say, unload 1 or 2 of those property onto the market, sell it to the first-time buyer, and one will get some tax credit. So trying to provide some incentive to bring more supply onto the market.
Lawrence, when we talk about what the level of mortgage rates should fall to or need to fall to in order to spur some of that activity, are we talking below 6%? Because ever since we've gotten near these 8% numbers, we certainly have seen a further freeze of some of the activity in the market.
Yeah, Federal Reserve is clearly overdoing the rate hike. I mean, they are breaking clearly on the commercial real estate side, but on the residential side, the affordability, the monthly payment to buy a medium-priced home by middle-income person has essentially doubled from pre-COVID to today. I mean, this is taking away the American dream, the dream of ownership opportunity. So we need to assure that mortgage rate trends downward, and that can only happen if the Fed essentially say, we will stop raising rates, and once the inflation is clearly under 3%, we will start cutting interest rate. So I think that trending, will begin to occur in early spring of next year, but I hope the Fed begins to make those announcements.
What type of new inventory, and we've kind of focused in on where there's inventory coming on the market from the existing side, but what about on the new inventory side where you've got fresh build outs or even an order backlog that many of the larger home builders here in the US are trying to work through, even in the face of some of the orders that are kind of off of the levels that they had seen last year in a more favorable environment as it may have been and as it was, even though rates were still in the Fed's kind of rising and the early side of their rising policy?
One interesting trend line that I'm seeing is that the housing start is the beginning, but when does it finish? Usually it takes about 6 or 7 months. That's the usual time length. But what we are finding now is 9 to 12 months, clearly implying that there could be some regulatory barriers at the local level. We need to remove any barrier that hinder the construction activity because we need more supply coming onto the market. And we should also consider, training Americans to go into construction industry, repair things, make things, rather than go to university, because we may have too many people going to university and not enough going to trade school, because lack of construction workers is also hindering some of the supply factors.
Lawrence, you've been covering the housing market now for some time. Just what's your assessment of what's going on today? How unusual these dynamics are that are at play? When you talk about the fact that we've seen a massive surge in mortgage rates, yet we haven't seen any relief, much relief in home prices, given the fact that there's simply just no supply.
Yeah, so lack of supply is driving the prices. So multiple offers still happening, perhaps not as intense as what occurred, say, 1 year ago or 2 years ago, but it's still happening in the marketplace due to the lack of supply. We did see some price decline out in the West region, Rocky Mountain State, California, state of Washington. But once the prices declined somewhat, there was a rush of buyers coming in. So right now we are seeing across all 4 major regions and across the country, South, Midwest, West, Northeast region, prices are rising. So this is clearly implying demand is out there. We just need more supply, even though mortgage rates are high.
And then just the average bidding that's going into this as well, Lawrence. How prepared should people be for the amount of bidding that they need to do and perhaps a percentage increase on top of what they're even offering?
First, you are absolutely correct. From consumers' perspective, it's not an easy market. First, people who still qualify for a mortgage, because at higher interest rate is a shrinking pool of eligible buyers. But due to the limited supply, one has to be ready. Get that mortgage pre-approval. Perhaps do some home inspection with personal eyes rather than trying to put that into a contingency, because as a home sellers, they don't like those contingencies, and they will go with someone who are saying, okay, anyone who bypasses appraisal contingencies, home inspection contingencies, it makes the offer more attractive. So something to consider, even though there are some little risk there. But given that there are so many buyers out there, one has to be ready.
Yeah, this week is wasn't nearing 8%. It was surpassing 8%, and that was prior to today's moves. And so just what we were listening to in the last segment clearly is indicating that there's a lot more upward pressure to put mortgage rates above 8%. But to your point, mortgage rates today actually impact both sides of the market. There's the obvious affordability crunch, makes it more expensive to get a loan and buy a home. But at the same time, since so many individual existing homeowners locked into such low rates, just a couple of years ago, they are not incented to sell. And so low inventory, even though there's less demand, and we still see rising prices.
I just keep reading the figure, Mark, that existing home sales are at the lowest since 2010. It feels just absolutely frozen out there. Is that how you would characterize it? And doesn't seem like anything's going to change anytime soon?
Yeah, 2010 was, the height of the global financial crisis. If you take the global financial crisis time period out, the last time we had home sales at this level was back in the late 1990s. So, getting below 4 is a rare event in modern, housing market history here in the U.S. Since, if the pandemic were the best of times for housing, then these are clearly recent worst times. And Fed's saying it like we're going to keep it higher for longer. Higher for longer means the disincentive for those existing homeowners to sell is going to continue to be there. So it's hard to see how it changes anytime soon, meaning anytime in the next 6 months to a year. In fact, your prior guest was talking about when was the Fed likely to cut rates again? Probably not until 2025.
And Mark, you mentioned there that we're still seeing these rising prices. Do you expect that to change, Mark? You see that breaking anytime soon?
I think the more that rates have risen in the last couple of weeks and are continuing to rise, there's sort of more anecdotal evidence of further price softening because the demand side is really sort of catching up with the lack of supply. The months of inventory is ticking up a little bit, and that's the dynamic of even though there aren't many homes for sale, there are fewer and fewer people out there buying homes because rates are so high. And that's going to sort of slow house price appreciation a little bit more. I mean, we went from house price appreciation in the 10 and 12% year over year range to now, according to our index, of 5 or 6%. We could even see a little more softening, but it's hard to see big declines in house prices, just even slower growth.
Mark, can you talk to us about the bigger implications for the U.S. economy here with the housing market in this kind of shape? I mean, when you're looking at the GDP now forecast for 5.4% this quarter for growth, I mean, that seems pretty good. Last quarter, I should say. But is that baking in all of this lack of activity on the housing front?
Yeah, the housing market is a significant contributor, obviously, to overall economic growth. But the truth is, buying and selling of an existing home doesn't necessarily add too much economic activity other than real estate commission fees and things like that, or that we all like to go and buy new furniture and housewares when we buy new homes. And those segments of the market are certainly being impacted. The mortgage industry itself is certainly being impacted because not only are home sales down, but refinances are practically non-existent. But otherwise, we're not so large a component of the U.S. economy that we're a huge drag, although there is certainly a drag to less economic activity around the buying and selling of homes, particularly found in places like furniture sales.
And Mark, I'll get you out of this here on this question. I'm just interested to get your take on the rental market, Mark. What do you see ahead there in, let's say, the next 6 to 12 months?
Well, there was a benefit over the last couple of years in that since it was so hard to buy a home, then sort of people were remaining renters, even though they wanted to be home buyers. And the multifamily building industry responded by bringing along lots and lots of multifamily starts. Now, household formation has slowed down, and there's less demand for rental relative to the heights of a year or two ago, and vacancies are rising. So the multifamily market is softening, and in many places, rents are coming down from the highs. That's mostly driven actually by a slowdown in new, young Generation Z households forming.
Well, the largest brokers in the country and the National Association of Realtors facing antitrust lawsuits that could shake up the U.S. real estate industry. This comes as real estate deals were canceled at the highest rate in almost a year, according to a new Redfin report. Here with more on the state of real estate is Emily Peck, Axios Markets reporter. Emily, thanks so much for being here. So, of course, as you know, the residential housing market has been, if not at a standstill, troubled, we could call it. And then if you're buying a home, you pay broker's fees. That's what these cases have to do with. So walk us through what is at stake here and what could change.
Yeah, so what's at stake is just like you said, it's broker fees. As a home buyer, they're kind of hidden from view. But basically what happens is you list a house, you have to offer a fee to the agent representing the buyer, and the fee is usually around 5-6%. And the buyer pays that, and the seller's agent and the buyer's agent split it. In this lawsuit, there's 2 class action lawsuits. One is in trial right now, and the allegation is these fees are basically a conspiracy between the agents to keep fees elevated and to protect their bottom line at the expense of home sellers who are shelling out, the 6% fee. And it's putting buyers and sellers who are supposed to be on opposing sides of the deal basically on the same side, because the buyer's agent benefits when the sale price of the home is higher.
And Emily, with these cases, what are the next dates on the calendar you're watching here?
Yeah, so this trial is supposed to be wrapping up probably early next month. And then, of course, it's going to be appealed. And the other class action will go to trial next year. So those are the big things to watch. And it's really unclear what's going to happen, though. So far in the case, the plaintiff's lawyers have really been, I don't want to say winning, but they got the class certified, and the judges, someone said to me, it looks like the judge is basically on the plaintiff's side here. They've kind of bought into the theory. We'll see if at the end of the day, there's a verdict that buys into the theory.
So, Emily, at a time when the affordability of the U.S. housing market it's tough, how concretely is this going to change what buyers and sellers have to pay in terms of fees, or what could?
So,
I know it's not certain yet.
Right, it's not certain yet, and it's going to take a long time for this to sort of shake out. There are consumer advocates who have been railing against these fees for no joke, like 10, 15, 20 years, and they're hopeful that this will be, if everything goes their way, there'll be a big change, and you can wind up paying lower fees in these transactions that could theoretically bring down home prices. But by the time it shakes out, I would think or hope that the current real estate market would move beyond its sort of moribund status right now. As you mentioned, there's more deals are falling through. Home affordability is at an all-time low. Mortgage rates near 8%, and home prices still really elevated. It's just like a terrible housing market right now. And I don't think that a resolution to these cases will come in time to kind of save the day, unfortunately.
And Emily, switching gears here a bit, you wrote another piece which I thought was really interesting, that about 16% of pending home sales fell through in September. Because it was new data from Redfin, Emily. Why is that happening exactly? Is that because people are, they're rethinking it and figuring out, actually it turns out I can't afford this house, or is it underwriters pulling approval? What is going on there exactly?
Yeah, so it's a little bit of both. Basically, these higher rates, and rates moved higher just in the past 2 weeks, as you guys I'm sure know, they're making buyers jittery. And so for some, they're pulling out of deals because they just think like, you know what, I don't want to pay this high of a mortgage rate anymore, even if they can afford it. Others are, they're seeing their underwriting go away. So it's sort of like a little bit of both, but it's like these higher rates have just made things more uncertain and made buyers feel more nervous. And someone even told me that buyers are now more picky. If rates are going up and they're like, you know what, this house isn't exactly perfectly what I want. And since this mortgage payment is going to be so pricey, I'm not going to buy this house. There's just a lot more jitters, uncertainty, and that's leading to this higher cancellation rate for these deals.
And Emily, when we say 16% of pending home sales fell through in September, is there any historical context on that, Emily? Is that the worst since 2 years, 4 years?
Yeah, it's around the same level, 16%, as it was when rates first started going up last year. But then before that, typically the cancellation rate cues closer to, say, like 13, 14%. So we have been in this sort of elevated cancellation zone vibe ever since, the rate hiking really started in earnest from the Fed.
An accessory dwelling unit, or an ADU, is an independent living quarter built on the same lot as an existing residence. Now, they can be attached like an above garage dwelling or completely separate from the main home. Now, while some build them to house additional family members, they can also be rented out for extra income and adding much needed housing to areas short of affordable options. Now, states are opening up new possibilities for the spaces with new policies in California. An ADU can now legally be converted to and sold as a condo. And when underwriting a mortgage, lenders can now count a portion of estimated rental income from ADUs. Mike Koenig is the co-founder and president of Studio Shed, the leading manufacturer of accessory dwelling units and backyard structures. Thank you for joining me this morning. So give us a lay of the land here. With these new policies opening up, what are some of the investments and the opportunities that now come with this expansion?
Yeah, I think there's a lot of investments, I believe, to be made
in terms of just adding income to your existing property. And for, say, real estate investors who are looking to, I think as the climate gets a little more, say, riskier, or capital becomes a little harder to obtain with rates, you can effectively take like an apartment building and spread it out over many homes.
So then for people who are wondering if they build their ADU in their backyard as a separate unit here, how does that work when they're trying to sell their property? Would they have to sell the ADU with the main residence as well? Or how does that get navigated?
Yeah, well, California just passed Bill 1033, and Seattle has already been doing this for, I believe, a couple of years. And it's effectively you're parceling off that part of the real estate, so you can just sell off the ADU or the home, and it just becomes zoned as a multi, like a condo.
So, I mean, then for people who are wondering about regulations, obviously it's different state by state. We've seen California leading the way here. What are the main questions that you get about regulations for people who are interested in building an ADU, say, in their backyard or on top of their home?
Yeah, so some of the typical questions are, one, can I put an ADU in my backyard? And then the second is, well, how big can I go? Our products range from, studio style ADUs to we offer a up to a 2-bedroom, 2-bathroom. So the first is, can you do an ADU in your backyard? And then the second, of course, is what size should they go with? Now, it is becoming easier as the weeks and months go on, as municipalities, combined with better zoning policies on the state level, to effectively get an ADU in your backyard. It historically has not been easy. I think with the new FHA policy on financing, it obviously opens up access on a much broader level, because you can qualify your income for the underwriting. And of course, with California Bill 1033, I think other states will follow, like, again, Seattle or Washington already did. So I think the challenge remains really on the municipal level, and the speed at which the municipalities are able to expedite the permits. That's really the longest stage in the whole cycle. Whether you're a studio shed like us, I mean, ours is faster because we have pre-engineered buildings and plan sets and all these things. But there's a disconnect between the number of ADU units that each municipality has a goal of. Denver, for example, wants to do 20,000 over the next, I believe it's 10 years. But there's such a lag on the municipal level. So that's something I think is the next opportunity for cities to work on.
So, Mike, with that in mind, then, how far do you think adding ADUs into the mix is going to go into solving the affordability issue and the inventory issue that we're currently seeing in the housing market?
I think it's never one thing, right? So I think that there's a lot of changes that need to be made. And again, I think that speed is critical. So I think you're seeing more, prefab or hybrid prefab 3D module solutions coming out. And, the ADUs are an excellent way to offset the high price of real estate and quickly add more doors or beds, if you will.
Higher mortgage rates and low inventory are some of the big challenges that have been facing the housing market this year, stalling much of the activity really that we have seen over the last several years. Well, now Goldman Sachs is out with its outlook for next year, for 2024, and they're warning of more pain ahead. We want to bring in David Miracle. He is at Goldman Sachs, chief economist in global investment research. It's great to see you here, David. So let's talk about the dynamics at play right now in housing, how you see that reshaping, or if at all, the housing market next year. Do you see any signs of improvement on the horizon?
Probably not in terms of either home prices or home sales. Home building has actually proven surprisingly resilient this cycle to mortgage rates that would have seemed awfully high back in 2019. So I think we kind of need to separate the two things out. On the home sales side of things, most Americans now have mortgages at rates that are well below current market rates. So understandably, people are reluctant to move because they'll wind up with a much higher mortgage. And so home sales have fallen quite a bit. We expect those to stay quite low next year. Home building did come down a lot in 2022 as the Fed signaled a hiking cycle. And I certainly think there will be some consequences of the renewed rise in interest rates. I would just say, relative to what you would have normally expected historically from an increase in mortgage rates of this magnitude, the impact this time around has been diminished by the fact that we have a serious national single-family housing shortage. This was something that, at the outset of the rate hike cycle, we thought was probably going to limit the impact. Again, not that there's been no impact. Home building activity did come down last year, but it's still comparable to where it was prior to the pandemic. And that's because if supply is the binding constraint on economic activity, then even bringing demand down a lot by discouraging some fraction of potential buyers from buying at these higher mortgage rates still leaves plenty of buyers in the market and still doesn't affect prices all that much, which means for home builders, if you can build a home and turn it around and sell it, that's still pretty attractive. So we're looking for home building to be roughly flat next year, home sales to remain at a quite depressed level.
Yeah, we were speaking about this just a few days ago and looking across the backlogs that many of the home builders still have that they're working through and where some of those new orders are continuing to flow in, even if it is decelerating. One of the things that we are continuing to monitor as well is where potentially there needs to be more decline. And I would love to know from your purview where the prices need to decline further for a lot of home buyers and prospective home buyers out there to feel like they can effectively offset where rates may be at right now.
Well, I think prices are unlikely to decline meaningfully precisely because of the supply shortage. I would distinguish a little bit between the single family market and the multifamily market. On the single family side, by most estimates, we have a shortage of many millions of homes because we've made it somewhat difficult to build in many places that people want to live in this country with zoning restrictions and things like that. The multifamily supply response to high prices, though, over the last couple of years has been much more forceful. And indeed, we've seen a lot of completion of multifamily units, and we have a huge number of multifamily units that are still in the pipeline that builders want to finish up. So we have made more of a supply impact on the rental market, and that has helped to slow growth of rents. But it's just very difficult in a short period of time to have a equally appreciable impact on the single family market. And in fact, we've seen the homeowner vacancy rate fall even a little bit further to now a historic low. So primarily for that reason, you're absolutely right that affordability has diminished substantially. First, prices rose a lot, then mortgage rates rose a lot. It costs an awful lot more to finance owner-occupied housing than it did several years ago. But because of the supply shortage, I think the demand is still there for the market to clear at prices similar to where we are. So we're looking for a small dip in prices in reaction to the big move in rates that we've seen this year, but then a small uptick next year. So no major changes from here.
Yeah, David, we got to hustle to our finish here, but ultimately, when you think about the kind of turnover on a market basis because of the zoning that you were mentioning, are you expecting there to be another wave of perhaps migration into different markets where affordability is that much more attainable for prospective home buyers?
I think that's a reasonable conclusion. For people who don't have homes, that you might see some migration toward cheaper markets when people get to the stage of their life that they want to buy a home. For people who do own a home, who do have a mortgage, in general, they're paying a much lower rate than is available today, so they're sort of locked in. But the people who are renting, who want to transition to buying, given the high level of prices and given the impediments to building more housing, in areas where prices are very high, I think it makes a lot of sense that we'll continue to see migration toward lower housing cost areas.
David, where do you see mortgage rates at the end of next year?
Similar levels. We don't have the Fed changing policy until Q4 of next year. And I think the increase in long-term interest rates that we've seen recently, which is of course spilled over to the mortgage market, has probably come from things that are likely to persist. Number one, I think the market has substantially reevaluated what it believed last cycle about the longer term neutral or equilibrium rate. And number two, possibly there's been some increase in term premia as well. Until the Fed cuts or until something interest rate related seems to go wrong in the economy, I don't see a lot of obvious reason to expect meaningful declines there.
Josh, I think there are two main things to say. One is that it was a strong report, as you alluded. On a month-over-month basis, the national composite was up about 0.4%, which is quite a strong report. And this is the 7th consecutive month in which prices have increased. The other thing that's important to note is that the report is the strength in the housing market is fairly broad. We track 20 cities in addition to the national composites. On a seasonally adjusted basis, prices were up in 19 of the 20, and the one that missed was just by a whisker. So it was a strong market in terms of breadth, it's a strong market in terms of level.
And when you, it's Julie here, Craig, when you look at the different cities, or the different regions, are they equally weighted? How do you all think about that in the composition of this index?
Well, they're weighted by the number of transactions that take place. But the interesting thing about the regions is to see how there's been a shift in the relative strength. I mean, if we go back 2 or 3 years, Phoenix, Arizona was the strongest city for a run of about 3 years in a row. And Phoenix is now actually trending downward. The strongest city, the strongest metro area, I should say, for the last 4 months has been Chicago, followed by New York. So it's been I referred to it a few months ago as the revenge of the Rust Belt, and that's really been what we've been noticing lately as prices in the Midwest and Northeast have recovered more than those in the West and South.
And Craig, now here's the point I asked you to bring out your crystal ball. So prices remaining elevated. What do you see ahead, Craig?
Well, there are two kind of countervailing things, Josh, both of which come from the presence of rising interest rates. The obvious thing to say is that rising mortgage rates make it harder to afford a given house with a given level of financing. So you would expect rising rates to suppress demand, and you would therefore expect that the rates that have risen so far this year would have led to weakness in the market. In fact, we've seen the opposite. I think the explanation for that is because rates were so low for so long, people were able either to buy with very low mortgage rates or to refinance into very low rates. And so if someone wants to move now, they're looking at increased financing costs, and that has the effect of reducing the supply of available houses. And net, it appears that, at least for the time being, the rise in mortgage rates has probably diminished supply more than it's diminished demand.
Right. It's a very tricky situation for a lot of folks right now, Craig. Everybody wants to know when it's going to change, right? Which, if we all knew the answer to that question, well, we'd be doing pretty well. But I'm just wondering, historically, when you look at your other indices, sort of looking at them against this one, is there anything that can help us as a leading indicator to help try to figure out when this might start to roll over?
Not really, and we've tried to do this historically to model S&P Case-Shiller to say, well, what other indices would match up, and it's very difficult to do, which is a way of saying there really is unique information that's being incorporated into housing prices. But speaking more broadly, I would say that if there were a true signs of economic weakness, and I don't see many of them, I'm not an economist, but I don't see many of them. I mean, employment is doing well, earnings are coming in okay, but certainly either of us could think of any number of things that might be a shock to the economy and would push the economy into recession. If that were to happen, I would be surprised if housing prices held up. And if it is true that the increase in rates has had the effect of suppressing supply more than demand, it's at least arguable that if rates level out and mortgage rates level out and begin to decline, maybe that would have the effect of freeing up some supply, and then the rate of housing price increases might moderate somewhat.
Yeah, thanks for having me. I think for us, it wasn't a surprising announcement. This has been a storyline that has been unfolding for the last several years. The issue at hand here is how commissions are set and paid. And we think that the writing is on the wall around the scrutiny that the industry is currently facing, that ultimately that structure is going to change. And the ruling we got yesterday aligns with that thesis that ultimately this scrutiny is going to reshape the housing structure as we know it.
And Logan, so how is it going to reshape? I think we're all trying to figure out what this ruling means, how long it's going to take for anything to change. What do we know right now in the wake of it?
Well, we're going to see a lot more lawsuits come into play, and that's probably going to confuse people even more. But, the days of buyers actually getting a free ride into buying a home because the seller would actually pay their costs is over. In a sense, but you have to look at the Zillows and the Redfins. If there's going to be less income made by the real estate industry, which is already in a recession because existing home sales are low, does that impact their business in the future going out? Or does a Zillow and a Redfin find a way to establish kind of a new marketplace where they can be the facilitator to buyers going into the marketplace? So right now it's a very unknown. But the headlines are going to be about the lawsuits coming out. Until you get some clarity and cost there, this will be a cloud around the real estate industry. And then after that, we'll see what happens when new regulations come in and how the sector will operate with those new rules.
And Ryan, Logan brings up a good point. It's a lawsuit. There's going to be an appeal. This will go on for years. We know this. But I do think investors already begin to think about risks, long-term investors at least. Are there certain business models that would be more at risk if this really becomes law?
Yeah, we've called out a few different types of business models as being beneficiaries and potentially at risk from how this could play out. The most obvious players who are at the epicenter of this scrutiny are the players that are directly tied to that commission pool that we think could see significant pressure upwards of potentially 30% over time. So that involves, the traditional residential brokerages, but also you have players whose business models are directly tied to that commission pool in other ways, which would include some of the legacy first generation lead generation portals like a Zillow or a Realtor.com, whose revenue models are directly tied to the buy side agent commission. On the flip side of that, we think that one interesting story that could be a significant beneficiary from all of this chaos and restructuring is CoStar, which is a dominant player in the commercial and multifamily markets, but has been expanding very rapidly into the residential for sale market. They have a new brand that they've been investing hundreds of millions of dollars behind called Homes.com. That is really the only portal out there today of scale that is exclusively focused on advertising homes and providing digital advertising services for listing agents. In a new world where home sellers are no longer incentivized to compensate buyers' agents, you could argue that they have a lot more flexibility to reallocate that advertising spend, which is otherwise known as the buyer agent commission, to these other models. So CoStar, we think, is set up well to benefit from the unlocking of that significantly under-monetized advertising TAM for housing in the U.S.
Ryan, how quickly or easily would some of the other players be able to pivot in that direction?
Look, there's some great brands out there in the market. Consumer eyeballs are ultimately the ones that drive the success of these businesses. Brands like Zillow and Realtor.com certainly can leverage those brands to continue to operate in a new market structure. I think there's some question around the swiftness with which those business models can pivot and the risk that a pivot poses to the existing revenue streams, which in certain cases could be cannibalized as these companies try to stand up an alternative type of advertising model that can thrive in this new market. So that will take time, and it will really depend on how quickly these management teams decide to respond to this new structure.
And Logan, I'm also thinking a settlement could still be a possibility. Is there a settlement that you think could make all the parties happy here?
Probably not make all the parties happy, but for me, what I'm looking forward in the next year or two is, can a Zillow or a Redfin or a Realtor.com facilitate a kind of a low fee for the buyer to provide the services for them to be part of the negotiation? And will regulations allow that to be kind of tied into the mortgages to make it a little bit more fluid situation? Right now, there's just so many questions out with the lawsuits and who's going to get impacted or who's going to make a deal. But looking ahead, there's opportunity here for somebody to step up. And of course, while all the chaos is going in, to me right now, the people that are putting their game plan into motion will benefit in about a year or two.
Chair Powell mentioned the 8% mortgage, and he sounded somewhat uncertain what that may or may not mean to the housing market next year. What are you seeing in housing in this country, given where rates are?
Yeah, well, first of all, the big thing, keep in mind also, very different than prior times. We have still a lot of fiscal stimulus with very low unemployment. And consumers actually in rather good shape. They have low unemployment. Home prices and asset prices have gone up for the better part of 15 years. They maybe now, but their equity in their home is at all-time records. They locked in a lot of fixed-rate financing, particularly mortgages, which is like 70% of consumer borrowing. So they're actually in pretty good shape. But it's definitely dampening new home buyers, slowing down people's ability to move. People today are doing adjustable rate mortgages, but the cost of carrying a mortgage is higher. So, buyers either are going to buy a smaller house, which is a choice, or they're going to wait or not buy at all.
It is definitely a different market for home buyers than we've seen in the past. But, all is not lost. There's still hope. Buyers can still get in with some creative financing to get in under that 8% mark. You just really need to do your research, talk to a professional, take advantage of seller credits and builder credits that are going on right now. And there's some other creative ways that we can actually get buyers in for less than that 8%.
And Kathy, when you say creative financing, what do you mean by that? What are some examples for people to consider?
Some of the things that you can do, for example, I mentioned that sellers are giving credits to help buyers buy down their rate. So instead of an 8% rate, we might be able to buy that down 2 whole points to maybe a 6% rate. Okay, so that's something that we can do. Another thing that buyers that's starting to become popular now is looking into some assumable loans for buyers. FHA loans typically are assumable as long as you qualify for them. Same for VA and USDA loans. So if you have a seller that has a 2 or 3% interest rate, you might be able to assume that loan. You have to, make up the difference in what their loan balance is and what the equity is, but that could be a very viable option for a lot of buyers.
Lance, when you think about that verdict that happened this week, that was found that the National Association of Realtors and these large brokerages conspired to keep costs high, artificially high. What does that do? How does that change the landscape of the housing market from your point of view?
Yeah, right now it's a tremendous amount of uncertainty for the industry. Nobody exactly knows how this is going to play out. I call it something of an earthquake, and it's either, is it a small quake or is it the first tremor in something much, much bigger? But as of today, as of November 2023, I don't think it has a huge impact on buyers and sellers right now. But I think what is impacting buyers and sellers today is the fact that affordability is deteriorated to historic levels. When accounting for incomes, mortgage rates, and prices, last month was the most expensive of this century since 2000. And, this month looks like it'll be the second most expensive now that rates have come down a little bit under 8. But back to what Kathy said, there's things that buyers can do in this market. And one of the things that's becoming more attractive is the assumable loans. This morning I was talking to the CEO of Rome, and they are a company that is a listing website, and they've done the data to get the mortgage information to find out what homes available for sale right now have assumable loans, meaning they're FHA, USDA, or VA. And so if you go on their website, you can search and see the homes for sale today that could potentially be an assumable loan.
And Lance, so there are some smart, as you're pointing out, tips and tricks that prospective home buyers can think about, but you have these very powerful forces, Lance, which you've talked a lot about. Limited inventory and affordability has been crushed. How do we move past that?
Yeah, right now the market is kind of constrained. So the tailwind for the market is the fact that on a national level, there's just not much resale supply coming onto the market. There's not much inventory. There's not much churn, people who are selling their home to go buy something new, because if they did, they would be trading in that lower monthly payment for something much, much higher. And the fact that the competitiveness coming out of COVID just kind of drew down the inventory. So resale is the tailwind, but the headwind is this affordability that's deteriorated. The fact that mortgage rates have gone up and touched that 8% threshold, given how much prices have went up since the start of COVID. And so the two forces together are just kind of gridlocking this housing market and constraining the activity levels.
Kathy, I want to ask you a question. So Lance characterized what happened in terms of that ruling this week as an earthquake, potential earthquake, and it's just about the definition of what scale, what size is this?
Yeah.
How do you envision this impacting your business, this ruling that came down earlier this week?
None of us really know. It's really a huge uncertainty in our market right now. It could be that buyer agencies will have a whole different look than what it does today. It could be a lot of different things. So it could be that lenders are going to maybe even pitch in and help with buyer agency. Maybe that's part of your buyer agency, your package when you get your loan, that, we work that in. A lot of things could happen and go several different ways. It really is kind of an uncertain market right now in terms of that. So I'm anxious to see. No, I'm not. I think that it is going to separate the wheat from the chaff. Definitely. I think that when the real estate market is good, a lot of people tend to get in that don't necessarily have the resources or, are just in for the quick buck and aren't in for the long term and aren't in for really providing good, reliable service for their clients. So I think it's definitely going to, separate the diamonds from the cubic zirconiums. So I'm not concerned though.
Lance, let me go back to the housing market right now, these challenges. I'm just interested, any intel or data, Lance, that you have about who exactly is buying these homes right now? Who's out there buying homes? Do we have a sense of the demo?
Yeah, so the group that's really pulled back here is two. The move-up buyer, the person who kind of needs more space for family reasons and is going out and getting more space, that person is not transacting as much because they don't want to give up that lower mortgage rate. So affordability's kind of locked them in. And so the people still out there kind of buying and selling. On the selling side, it's kind of like the death, divorces, what's constrained and what is always occurring. Whereas on the buying side, it's kind of some of the first-time home buyers who kind of have no choice because rents have gone up so much. So some of them who can still make it work financially and haven't lost their mortgage eligibility are still out there. And then some of, the wealthier retirees who just have the money and have the equity if they did sell, can still go out and purchase something. And then some of these smaller, mom and pop landlords are still kind of out there trying to find deals that pencil. And some of the institutional big players that really play off of yields, and they're just not out there as much right now. So the institutional side is really constrained as well.
And Kathy, I want to ask you one more question just about where mortgage rates stand. And, because we've had economists come on and talk to us about when you think about this from a historic perspective, it's actually not as high as it's ever been when you go back to the 80s, for instance. Do you think that there will come a point where, the demand is unlocked, even though rates are as high as they are right now?
I truly believe that there's a lot of buyers that are standing on the sideline. Like Lance mentioned, right now, the majority of the transactions that are happening are necessity transactions, people that have to buy and sell because of life changes, divorces, job changes, all of that. But there's a whole bunch of people that want to buy that are kind of waiting in the wings. And so I believe that there's going to become a point where they have what we call mortgage fatigue, where they're tired of waiting for the rates to go down and they just really want a house, and they're going to figure out a way to make it work.
Fed Chair Powell last week left the prospect of further interest rate hikes on the table. We heard this morning from Neil Kashkari, the Minneapolis Fed voter, saying that he would rather over-tighten. If we were to see rates move higher from where they are right now, does that change your forecast at all? Or on the flip side, to your point on home equity, the fact that homeowners are now sitting on fixed rate mortgages of 5% or lower, 80% of Americans, I should say, are sitting on fixed rate mortgages of 5% or lower. Does that make the economy more immune, perhaps, to the Fed's blunt interest rate tool?
Surely it's going to have an impact, but it has the most direct impact on asset prices. And so I think if you look at the housing market today, and I think this is so critical with the U.S. consumer, which drives 2/3 of the U.S. economy, you see home prices that are roughly at 2021, 22 levels, maybe a little bit higher, reflective of a very different interest rate environment. So when you have interest rates go higher, home values have to go lower. And I think something else is going, so that's just math. Mm-hmm. So I think something else is going to happen too. So when I say that over 70% of homes are owned by people over 50, AARP estimates, and this is a long-term estimate of multi-decade, that 51% of people over 50 downsize to smaller homes. That's over 30 million units of housing. And it's, I think it's rate agnostic because older people have lower mortgages, if any mortgage at all. Last year, you had record all cash deals in terms of home purchases. So in Naples, 58% of the homes that were transacted were all cash. So I think what happens is you have high levels of equity. When people want to sell, they will reduce their home prices and sell. That means the sooner you sell, the more the higher probability that you lock in the paper equity gains that you have. The later you sell, there's going to be today there is a demand-supply imbalance where there's too much demand, not enough supply. That's going to invert as boomers, more and more boomers start to sell and downsize, or over 50 start to downsize, and that's the vast majority of homes that will come on the market. Then you'll see a supply-demand dynamic shift. Now, because
what's going to drive that? Because as I just mentioned, 80% of Americans sitting on fixed-rate mortgages of 5% or less. You're saying they bought all cash. They don't have mortgages right now, but mortgage rates right now are prevailing at 8%. So what's the incentive?
Sorry. What I'm saying is that the deals last year that were done had the highest cash components in over 10 years. Today, if you look at the homeowners, 66% of homeowners, the older cohorts don't have much of a mortgage at all. They're sitting on so much equity. So when they sell a larger house and take out their equity, cash in their equity, they're going to be buying a smaller house, likely for all cash. The risk here is the ability of the buyer, the younger buyer, to buy from the boomer. And that's why I say prices have got to come down to be commensurate with rates. And there's a mismatch here now.
The housing market getting a bit of a reprieve thanks to the recent decline in bond yields. Latest report from the Mortgage Bankers Association showing the 30-year fixed falling to 7.61% last week. Joining us now is Mark Fleming, First American Chief Economist. Okay, Mark, so mortgage rates, a bit of a reprieve there. Is it enough, Mark, to give a lift to the housing market?
I don't know if it's enough. I mean, it is a big move from a weekly basis, but 7.6 is still a pretty high mortgage rate compared to what we had just a couple of years ago. I would say I'm happy because it's not 8% anymore. And I'm sure you've been talking about it. Like, the odds are that the Fed stopped cutting rates and some certainty's coming back into the market. And so, maybe we'll get even lower mortgage rates in the next few months. So I'll take any relief in the market right now.
Yeah, that's kind of where we are right now, right? The good news is it's not 8% anymore. And I guess the good news for those who are looking to buy a home is that real estate has sort of been more on the leading edge, right, in terms of where the Fed moves. Ultimately, though, does this come back down to inventory? And because inventory is so low, those prices don't necessarily come down at the levels that most buyers would like them to be.
Yeah, I mean, usually the housing market is first into recession when the Fed raises rates and first out. So, but there is a little bit of this time it's different in the sense that because so many people got those so low rates, there's no inventory out there. That's what's really keeping prices up. Even if rates come down a little bit, I don't know that that necessarily changes that dynamic of a shortage of supply. 90% of all mortgaged homeowners today have a rate below 6%. And I don't think we're going to see 6 anytime soon for a mortgage rate.
And Mark, where would you need to see the 30-year fixed to come on Yahoo Finance and be more exciting? So, this is what could really kickstart the housing market. Would it be 7%? Would it be 6%? What do you think?
I think there's sort of psychological handles around the main numbers. So getting back below 7 would be really good. Getting back below 6, a 5% range mortgage rate, I think would really begin to make people sort of say, well, look, I've lived in my house a few years. I know my mortgage rate's maybe a little bit lower, but I still want to move. You can be financially irrational, but more broadly, quite rational in your moving decisions. And that would really begin to unlock the market.
Financially irrational, but quite irrational. That seems like where Josh and I are right now. Let me bring in another voice here, because at yesterday's Yahoo Invest conference, we had former Wall Street analyst Meredith Whitney giving her outlook on when she sees the housing market opening up. Take a listen to what she had to say, Mark, and I'm going to get your reaction on the other end.
Mm-hmm.
Deals last year that were done had the highest cash components in over 10 years. Today, if you look at the homeowners, 66% of homeowners, the older cohorts don't have much of a mortgage at all. They're sitting on so much equity. So when they sell a larger house and take out their equity, cash in their equity, they're going to be buying a smaller house, likely for all cash. The risk here is the ability of the younger buyer, to buy from the boomer. And that's why I say prices have got to come down to be commensurate with rates. And there's a mismatch here now.
So when do you see this playing out?
I think it starts to happen in 24.
And when do you see the reversal of more supply on the market? Because
I think it's 24 into late 24 into 25.
So, Mark, you heard Meredith Whitney there talking about just where the cycle is right now. You've got sort of the older generation, the movers, who are sitting on, as she describes it, sort of a pile of cash where they, I mean, that ultimately comes down to squeezing out the first-time home buyer even more. When do we break that cycle?
Yeah, I mean, absolutely right. The older generation, the home ownership rate's over 80% for baby boomers, and they do have large amounts of equity. But really, the next step is aging out of home ownership itself. And so it's not about them then buying another home and competing against the first-time home buyer. It's actually about making that home newly available to the first-time home buyer. It's not a 2024 thing. I think we will have short supply throughout 2024. And to your point, the challenge is always for the first-time home buyer getting into the market and getting that first purchase bought. And unfortunately, it's still about as hard as it's been in a generation or two to do that today with these higher mortgage rates and the fact that house prices have continued to increase.
And Mark, we often talk about the housing market like one market, but are there still are there interesting regional differences out there, Mark, that you would call out when you look across the country, east, west, south?
Yeah, obviously the high price markets that we all know about on the coast, particularly the West Coast, they're very expensive still. Prices have actually come down in those markets, but not enough to sort of re-equilibrate reasonable affordability. It's the Midwest, it's the Ohios and the sort of Great Lakes regions are where you find the most affordable housing. And we measure affordability as a function of what is the average house price compared to what people typically earn in those markets for first-time home buyers. And it's places like Pittsburgh, for example, which is a affordable market today. Places like San Francisco, Seattle, LA are not.
Right, are you in the market to buy a home? Well, you're competing with the typical home buyer whose annual income is at a record high. The typical home buyer is raking in $107,000 per year. This is according to a report out this morning by the National Association of Realtors. Jessica Lotz, National Association of Realtors Deputy Chief Economist and VP of Research, is here to break down this report for us. Thank you for joining us this morning. So, as we're looking at especially these first-time home buyers, They made up 32% of all home buyers, up from last year's historic low, but still below average. But talk about the demographics. Who are these home buyers who are snapping up these deals?
Well, they're wealthier. We know that the typical home buyer, especially for a first-time home buyer, they're essentially making nearly $25,000 more than they were last year. So they have to be higher earners to actually enter into today's housing market. They're also tapping their assets. So they're looking at their stocks, they're looking at their 401k, even cryptocurrency to put down as a down payment.
With that said, I mean, this is a really tough market. We talked so much about the higher rates, specifically on the 30-year fixed, but also the fact that there are those who are looking for their second home who have equity already built up. So how does that stack up for the first-time home buyer when inventory is so limited?
Well, that's the thing. And that's why we're seeing still historic lows of first-time home buyers, is because inventory is incredibly limited. If there's a multiple offer situation, that repeat buyer who can put down a larger down payment than they have historically is going to win out on that bid. And in fact, we've seen actual down payments go up to a 20-year high, both for first-time and for repeat buyers. And I think that speaks to first-time home buyers saying, look, I have the money. I want to enter into the market too. Please accept my bid. But we're still seeing that repeat buyers are winning out.
And I want to talk about household composition and how much that's changed and how that's affecting who's able to afford some of these homes and where they're buying.
Right. So we're seeing that married couples are dropping, but what we see overall in the US is that there's generally a smaller share of married couples today. So we see more single women entering into the market. I think this is amazing. We see that they're competing against these repeat buyers who have higher incomes. They're saving for longer periods of time. But I have to say that housing affordability is going to impact these singles more than we would see for married couples.
Jessica, that 30% that you alluded to at the top of first-time home buyers who are snatching up these homes, how does that compare historically?
So historically, we've seen that first-time home buyers are 38% of the market. So we do still see that they're lower than what they have been historically. Yes, we do have a higher share this year than last year, but we're still near historic lows, unfortunately.
And Jessica, I want to ask you about home sellers, because we've been talking a lot of people sort of with their wealth locked in their houses because of their equity. Talk about the typical seller right now and what they're looking for.
Well, the typical seller is essentially someone who may be a retiree or thinking about retirement pretty quickly here because the median age is 60 years old. They have a lot of housing equity, so they're able to make these trades where they want to be, looking at their ideal location, perhaps in retirement. And we also know that they've been in their home for a decade. And overall, our analysis shows that that's about $200,000 in housing wealth that they could be sitting on.
You mentioned the 38% where it used to be in terms of first-time home buyers. What's it going to take to move the needle further? Does it come down to the rates coming down, or is it about inventory more?
I think it has to be both, and both of these things need to be out in the environment for us to see more first-time home buyers. And the reason why is because if we have lower rates, that's going to be wonderful for buyers who are sitting on the sidelines, but we're going to have multiple offers coming back, and perhaps those repeat buyers who are also sitting on the sidelines saying, I want to be in this lower interest rate home, I'll move into the market. And so that's going to put a lot of pressure on multiple bids coming back. And I fear for the first-time home buyers in that scenario, we need the inventory to support all buyers right now.
And Jessica, as you look at the industry itself and how much it's changing, obviously a lot of focus on commissions, a lot of people deciding not to go with a traditional real estate agent and looking for some of these online options. How does that affect affordability when people are thinking about how much they can spend on a home?
Well, I have to say that one of the things that was really impressive to see this year is that 89% of buyers and sellers used a real estate agent or broker. This is the biggest transaction of their lifetime. This is financial pressure, but it's also where they're going to live. And so they want to make sure that they're making the right decision, and they want an expert by their side as they go into that transaction. And we're seeing that agent adoption is up because people need that agent.
Mortgage demand is rising as inflation cools. Applications hitting a 5-week high. New data from Mortgage Bankers Association showing demand rose about 3% last week. But as another Fed rate hike looks more and more unlikely, does this mean the housing market could be ready to get a boost? Joining us now is Daryl Fairweather, chief economist over at Redfin. A new report from the firm says an 8% mortgage rate won't be seen anytime soon. So Daryl, great to see you, and I'll let you answer that question. Is this the kickstart the housing market needs?
It will kickstart some people back into the housing market, but it's not going to be a major turn of events. We may just see a few more people decide that now is the time to make a move and lock in a rate, but mortgage rates are still substantially higher than they were last year. Sales are still down, so I think it's going to be a slow recovery.
Do you think, Daryl, that mortgage rates have peaked?
I certainly hope so. I mean, anything could happen with new data prints, but it's good to get some good news. Hopefully, we continue to get more good news about inflation cooling, and that continues to be good news for mortgages.
I mean, when we look at history and we look at other mortgage rate cycles where we've seen a big increase in rates, how long do buyers tend to wait, right? I mean, it's difficult to time this stuff, but do they wait for a 0.5 percentage point decline? How does it sort of tend to play out?
It depends on what situation the buyer is in. If the buyer is debating whether to rent versus buy, it's still going to be more affordable to rent in most of America compared to buying. And if a homeowner is considering whether it's a good time to sell and move again, it depends on what the price point is of their next home. If they're downsizing, then these rates don't matter so much because they can use their equity to pay more in cash. But if they're upgrading to a newer, more expensive home, then these rates matter a lot. And any little movement is going to have a big impact on their budget.
And Daryl, sometimes when you'll hear people, they'll make the argument that what's going to break us out of this impasse here in the housing market is just life events. People, they get married, they get divorced, they have kids, the kids go off to college. Is that enough, do you think, to kickstart the housing market?
I think life events tend to happen sporadically, so I don't think it's the kind of thing where all of a sudden everybody is getting married or getting divorced at the same time. It's going to be more of a slow trickle of people deciding that, I can't wait any longer and I want to move. But a strong economy does mean that more people are moving for job opportunities. They feel more confident. They feel like even though rates are high, they can make it work for their budget. So that's a positive, is that the economy is still quite strong.
Daryl, I want to go back to something that you guys wrote about recently, the so-called Nepo homebuyers, right? That we were seeing because of the affordability problems, we were seeing homebuyers, particularly first-time homebuyers, get help from family. Is this a big change compared with history? Are more home buyers needing to get that kind of help? Sort of put it in perspective for us.
What's different now is that mortgage rates are very high and prices are very high. So if you're trying to scrap together a down payment, it is very difficult. And the more of a down payment you can put together, that means the lower your monthly mortgage payment is going to be. So if you only have enough money to put 5% down, that means you're going to have a really big monthly mortgage payment. But if you have help from family and you can get to 20% or you can get even above 20%, then that means that that monthly payment is going to be much more affordable to you. So having that help, having somebody to give you a cash gift is a huge advantage in a market like this.
And Daryl, part of what we're dealing with here is limited inventory. Do you think, just as an economist, that regulators and lawmakers should be doing more, could be doing more to increase inventory, increase supply?
Absolutely. And it's not that so much lawmakers need to intervene in the market. What they really need to do is to make it so that these zoning laws aren't so restrictive. We need to actually decrease the regulation on builders so they can build more dense housing, especially in places where land values are high, because that's where the jobs are, that's where the amenities are, that's where everybody wants to live. And it doesn't make any sense that we restrict that supply by only allowing for single family homes.
Is there any movement on that front?
Yes, there's been a lot of movement in places like California, Montana, Florida, across the whole political spectrum to rezone. And then we're also seeing some other creative tax policies, like in Detroit and in Minnesota, to tax land instead of the properties, so that encourages more development because then you're not being penalized for building more homes.
And finally, Dara, I want to get your take on a separate issue, which I know you've written about, you've researched and reported, that a lot of young Americans receiving family money to buy a home. What are the trends you're seeing there?
Well, about 40% of people under 30 received help from family, either a cash gift or an inheritance to buy their home. And what's so important about understanding that is that people whose parents were homeowners, they existed in a different time than right now. They may have had advantages and had programs that helped them that younger generations didn't have. So the historical context matters. And I think we need to make the playing field level for young people today so they don't have to rely on having wealthy parents or homeowner parents to get their foot in the door into the housing market.
Mortgage rates pulling back for the third straight week. The 30-year fixed mortgage fallen to 7.44%. That's down from 7.5%. That's the lowest level since September 28th. For more on what this means for home buyers, joining us now is Jeff Taylor, Mortgage Bankers Association board member and Emphasis Digital Risk founder. So Jeff, 7.44%, I guess that's a bit of relief for those looking to buy a home. But what do you think the impact here is for the market?
Well, thank you very much for having me today. So look, we were at 8% this only a month or so ago, so we're 50% basis points down. I think the big sort of news is when we look at the CPI dropping this month, we're starting to get closer to 2%. As Chairman Powell said, we still have a period of time to go. And also the Fed decided obviously not to raise. So I think sort of that sentiment is, okay, we're not going to see another raise. Inflation is starting to get better. And that's where you sort of seeing a 50%, a 50 basis points drop from the high of 8 down to 7.44%. I think this also will start to signal over the course of the next year an area where we'll start to see rates drop over the course of the next 6 to 12 months if the Fed continues to act the way that it is, and we're continuing to see inflation finally get more under control after the fight for the last couple of years.
And Jeff, nobody thinks that it's going to be a quick and easy process, that even if rates come down, that the housing market's going to remarkably recover overnight. But you do pinpoint, in addition to rates coming down, a couple of other things that could be supportive for that recovery. And one of them is what home builders are doing in terms of new housing. Talk us through that.
It's a great point, right? So many home builders having made the best year they've ever had this year. Yet what you're seeing is home builder sentiment has been down 3 months in a row. And about 62% of home builders are still providing incentives for home builders, for people to buy these houses. So if you're looking at a market that's incredibly tight on existing home sales right now, you have home builders right now that are building at an all-time high, and 62 are providing incentives that could really make it more affordable to get into a house. That's a win-win if you're looking to buy a house right now. So I would be very aggressive on the new home builder side, looking if I was currently in the market trying to figure out what I want to do, existing home or new home.
And Jeff, I'm just interested, are there historical parallels that you see that we can look to, sort of similar housing environments in the past that kind of mirror what we're seeing now, and any lessons learned from those?
So a couple of the most important things are we have an incredibly structurally sound housing market, right? These loans that have been made over the last decade are sound, right? Debt to income ratios, very strong. I think our overall delinquency rate is about 3.62%. And if you look at the Fannie Freddie book, that's sub 1%. So, with FHA and VA, it's a little bit higher. So we look extremely sound. We have over 30 trillion in home equity right now. So even if you have the occasional, the person has a life event or a credit event, we're nowhere close to seeing mass sell-offs in any one specific area, like we did maybe in 2008, 2009. So this market is very strong. It comes with its challenges, right? If I'm looking to sell my house to buy a new house, am I really going to get out of my 3% mortgage and sign up for a 7% mortgage? That might be hard to do. A lot of people might feel like I'm locked into sort of redoing the existing house that I have, or look for buying a new home.
So Jeff, when all is said and done, what's going to break the logjam?
What's going to break the logjam? What could break the logjam is we had a couple of million more houses magically appear, which is not going to happen. So I think what's going to be, it's going to be consistent. You're going to see home builders continue to build, which will put more supply into the marketplace. And then remember, we didn't build 6 million houses between 2010 and 2018. That's kind of one of the reasons that we're in this spot right now. So as more homes come into the marketplace, I think that's going to be something that will start to ease some of the issues as far as how tight these markets are. And then over the course of the next year, at the MBA, we believe that you could see a full 2% come off from 8% down to 6%. So as rates do decrease, which we are anticipating to happen by the end of Q4 2024, that could also be another incentive for people to get back into the market and increase the home buying market.
I think we're certainly seeing some momentum as a result of just some of the recent rate pressure relief. And also, if you look at some of the forecasts, if you look at what the MBA is projecting, what the Treasury is projecting, as well as the analysts, there's a good chance that we expect some rate pressure going into next year, up to 150 basis points, which is massive. And that's going to be great. You have a lot of consumers who have been on the sidelines, a lot of pent-up demand. I mean, people still want to buy and sell homes, so the demand is there. And I think this would be a great opportunity for folks to kind of jump into the business of buying a home. I think the other thing that is also really interesting is even for folks who have purchased this past year, that rate pressure relief is also going to be an opportunity to save some money and refinance. And so I think we're going to see some good things in this next year.
The momentum that you mentioned, is it being driven by millennials? And I ask that because housing affordability, it's still tough. Yeah. I'm an aging millennial, and a lot of my friends, they don't have the money still to get a home.
No. I think one of the great things is, I read an article the other day that talked about how, 65% of Gen Zers actually want to buy a home in the next 5 years. The unfortunate thing is the journey is going to be one that's filled with friction. And that's why we really focus on technology as we think about Rocket. How can we make the home buying experience more frictionless? How can we make it faster? How can we add certainty? How can we create value? I think what's great is, you have a generation now that has the ability to unlock significant wealth with the sheer size of the population. And so we're very excited to take a more technology-centric approach to the homeownership experience, as we've always done, but in particular, with that new population.
I want to talk a lot about some of the AI initiatives you have, because I do view you guys now as a fintech play. Let's say interest rates stay where they are, maybe come down in mid of next year into the summer. What does that mean for industry origination volume? Do you think it goes over 1.3 trillion? Because I know that's the key bogey for a lot of analysts on the street.
Well, the great thing about the mortgage business is it is a huge total addressable market. I mean, even now, the mortgage market is around 2 trillion. If you think about mortgage plus real estate, financial services that surround, that gets up to 5 trillion. And there's no player that has more than a single-digit market share. In fact, the top 50 providers make up only 38% of the total market. So it is a massive, massive market. And that's why our focus is really on growth. How do we grow our share? How do we take share from our competitors? How do we do that by creating a more disruptive and delightful experience, independent of where the rates are? The market will be the market.
In terms of AI, spring buying season 2024, do you have AI initiatives on the table that we will be able to see, and how does that change the experience for people?
Yeah, I would say absolutely. We've actually been experimenting with AI technology for years. We have a platform that we call Rocket Logic. It's our proprietary in-house loan origination system. We've been testing that out this past year with our mortgage banking team as well as our underwriting team. We have thousands of people that are actually using this. And what it does is it simplifies the home ownership experience. When you think about the journey, for a client, you have to go through lead generation, mortgage banking, underwriting, closing, servicing, appraisal, title.
I already don't want to buy a home.
There's a ton of stress.
I'm just going to stay in my one bedroom.
There's a ton of stress. And the way we think about it is, AI is actually a perfect solution for many of these processes, because you can take data, you can automate it, you can take knowledge and you can codify it. You can leverage things like natural language processing and automation to remove friction from the experience. So we have Rocket Logic. We've had that in play for the last year. We're continuing to innovate. We've got some big things, but we're already seeing some benefits. We've seen a 20% increase, reduction in turn time, so the process of getting through the loan much, much faster. We've also seen a 20% reduction in human touches because of that automation. And I will tell you that we're just scratching the surface of what's possible.
Well, mortgage rates going down for a fourth consecutive week. The 30-year fixed mortgage rate falling to 7.29% from 7.44%. That's the lowest level since September 21st. For more on what this means for home buyers, let's bring in Danny Romero. So a little bit of a relief here, even though we're still higher than we were a year ago.
Yes, I mean, enough relief to bring some buyers into the market. The volume of applications for a mortgage actually increased to 4% this week. So really signaling that people are getting into the game. And what stood out for me from the Mortgage Bankers Association data was that the FHA, which is the Federal Housing Administration loan, a popular financing option for first-time home buyers, that increased to 14.8%. That's a big jump in the share of overall loan applications this week. The average loan size was over $400,000, the lowest since January. So many first-time home buyers are also turning to the new home construction, especially that there has been such weak supply in the resale market. The market is still, though, steering towards those high-income earners. The National Association of Realtors found that the median household income is well over $100,000. So that's a big jump from last year.
And Danny, when you talk to analysts, economists, what are they telling you about the housing market for next year? What are they looking for?
Morgan Stanley believes that the housing market will slightly increase, but there are several factors for housing affordability to get better. Mortgage rates need to go down, incomes need to go up, and home prices need to come down. So those are some of the factors. However, they do say that because many homeowners are sitting on a lower rate, there won't be that much of a sizable price correction. So their base case for next year is a 3% drop in home prices. That's if rates come down. That'll spur up some demand, spur up some sellers to get back into the market. So that'll mean more supply. Their bull case is a 5% gain on home prices for next year. That's if not much movement really happens to what's happening currently right now. And then they said, however, if rates do stay high, they do expect home prices to fall as much as 8% because they say that if homeowners weren't expecting to stay in that home that long, that could spur up some sales.
Soaring mortgage rates are becoming a real problem for the housing market. We just got new data out this morning. Home sales seeing a 5.6% drop in the month of October. That was versus September's numbers. And now sellers are feeling the pressure to lower their home prices. New Redfin data found that over 20% of homes that sold in October lowered the price of those homes. So joining us now is Daryl Fairweather, Redfin's chief economist. Daryl, it's great to see you here. So a 5.6% drop in new home sales, certainly a number that's jumping out to us this morning. What are you seeing, though, on your site currently? Because we have seen mortgage rates fall a bit here over the last several weeks.
Yes, in the last several weeks, it's become better for buyers because mortgage rates have come down and new listings have been increasing. So overall, that's just better news for buyers. But, it's going to take a while for buyers to really internalize these lower mortgage rates. There aren't that many buyers on the market this time of year at the holidays. So it may get a few buyers off of the sidelines, but I think it's going to take until next year and continued declines in mortgage rates for us to see some real strength in demand.
Daryl, speaking of next year, what are your expectations for how the housing market will look, especially when you think about the first quarter of next year?
Well, I'm more optimistic now than I was just a couple of weeks ago when mortgage rates were getting close to 8%. The fact they've come down a little bit makes me more optimistic, but I think it's going to be another slow year, at least when we look back historically. We had so many sales during the pandemic that right now we're still kind of in this hangover and rates aren't helping the situation. There are going to be more people who are wanting to move because they have a new job or they're getting married or they're having kids. So people's lives go on and that creates demand. And if we have a strong stock market, people may feel good about spending money, but those high rates are the biggest drag on the housing market right now.
Yeah, and Daryl, you mentioned the fact that we need to see some material improvement here, more declines in mortgage rates in order to see that boost in demand. What level do mortgage rates need to fall to in order to really be a catalyst here for the housing market?
If rates fall below 7%, I think we're going to have a surprisingly strong year. That's when I think we're going to see more people out there with bidding wars even, which is pretty strange because back during the pandemic, rates were 3%, but rates going up to nearly 8% has reset the threshold, I think, for buyers wanting to get back into the market.
And are you expecting, what's your expectations for the all cash buyer? That had been previously a big part of the demand picture when it comes to home sales. What's your expectations for the cash buyer? Will it still be, say, a third of home sales in 2024?
We've seen more cash buyers right now just in terms of the share, but during the pandemic, there were a lot of cash buyers too, because cash is always king. It helps you win bidding wars. So even if rates come down, I think people will still continue to use cash as a way to win bidding wars, but they may go back and refinance right after the deal closes and actually get a mortgage. Doesn't mean that they're not getting a mortgage on the home. Right now, cash is helping people wait out the mortgage situation. Maybe they'll get a mortgage later when rates come down, but I think cash is still going to be a key strategy for winning a home.
So does that then tell us about home prices? If we're going to see more bidding wars, are we going to see prices head even higher?
Well, we're talking about a scenario where rates fall. If rates fall, we will see more buyers come back to the market, and with limited inventory, that will create bidding wars that push up prices. We're seeing a bit of relief on new listings right now, with more sellers deciding now is the best time to sell, and maybe that will continue into next year. So hopefully we'll have a bit of a balanced situation even if rates do decline, but I don't think that balance is going to last. The overall story for the housing market is that there are fewer homes available compared to the number of people who want to buy a home.
Where is inventory the best in terms of geographically speaking, Daryl?
It's best on the coast, especially the West Coast and San Francisco and Los Angeles. That's where those high rates are really hitting hard. And also it's where sellers can sell and then they have all this equity that they could take to a more affordable market. If you're selling $1 million home on the West Coast and you have paid off most of the mortgage, you can take that cash and buy something with all cash in Arizona or Florida or another more affordable market, and you can get around the whole mortgage rate problem. So that has created more listings, more inventory on the coast compared to some of those more affordable markets where there are buyers still coming in and not many people willing to sell.
Daryl, a lot of people have been priced out of the market given the fact that mortgage rates have been soaring, prices remain very high, so they've been forced to rent. What are you seeing in terms of some of the trends in the rental market? Are we continuing to see maybe a bit of softening there?
This year has been a good year for renters, and with the housing market being so tough, with rates being so high, it's been nice that people have been able to go to the rental market and at least their rents aren't going up dramatically from last year. I think next year, though, there's going to be more demand for rentals. For those 3-bedroom rentals that are very comparable to a starter home, I think there's going to be a lot of demand there and rents will increase. But for 0 to 1-bedroom rentals, there's a lot of new inventory coming online, and with more supply relative to demand, prices could fall for those smaller rental units.
Could a common Canadian and European lending practice be the answer to American housing hurdles? We got new data from Case-Shiller that shows home prices rose for the 7th month in a row, hitting a record high in September. This comes as inventory remains a major issue in the U.S. housing market. Homeowners don't want to give up historically low rates and are therefore keeping their homes off the market. Mortgage portability would give sellers the ability to buy a new home with their old mortgage rate locked in, avoiding that over 7% that new buyers are contending with. So could this be a viable option in the U.S.? Here with the details is Kyle Campbell, American Banker staff writer. So Kyle, is this something that could actually happen here in the U.S.?
Technically, it is definitely something that could happen, but it would not be a sort of quick solution, if you will. It would take some sort of act of Congress, but there is some precedent for Congress taking actions that are sort of drastic. If you go back to 2009, you have the Home Affordable Refinance Program, or HARP, which allowed for underwater mortgages to be refinanced. So effectively, it would require something like that would be sort of going back and revising the terms of mortgages. But there's certainly a lot of appetite for finding some solutions to this so-called lock-in effect that is, as you described, really sort of pinching the inventory for the housing market right now.
How likely is any of this?
Hard to say at this point. I'd say it's certainly not going to happen before the end of the year.
What would the timeline look like if we do see any movement?
It would probably be something over the next year, maybe 2 years, I would say. You probably need some momentum to build up in Congress, for someone to sort of say, hey, this is a cause that I want to sort of champion. And you need to see these interest rates that we're seeing sort of be sustained for a long period. Obviously, there's a lot of skepticism about just how long that higher for longer period is going to last. But if it does last quite a bit longer, and people are holding on to their mortgages longer anyway, then you might start to see some pressure and some willingness for lenders and for investors in mortgage-backed securities to say, hey, actually, maybe this is something that could be beneficial to us.
From your research, how much is this kind of lock-in effect, if you will, hurting the housing market, where people are just sitting in their homes, and it does, of course, reduce inventory, but how much is it really hurting the housing market?
I think it's tough to say that, to quantify just how much that's playing a role, but you certainly have the anecdotes. And one thing that I found interesting is looking at sort of the other side of portability is assumability, and some loans are allowed to be assumed by the new buyer, and specifically FHA loans. And if you look at the numbers there, through the first 3 quarters of this year, we've already seen sort of a record high for the number of assumed FHA mortgages. And it's not a huge number, it's 3,800, but again, sort of more than any year on record so far. So it shows that people are looking for creative solutions to make transactions happen. And in those FHA transactions, the average interest rate is around just above 4%. So it's a much better deal for the buyer.
From those that you're talking to within the industry in terms of an uptick or when we're going to see more activity, what does that timeline look like? And when it comes to mortgage rates, we know obviously the massive spike that we saw in the 30-year mortgage certainly had a chilling effect on the housing market, to say the least. What level, or is there any, relief in sight in terms of some of the pullback that we have seen in recent weeks?
I think that you're going to have to start seeing rates come down quite a bit to get past this lock-in number, because if you look at, I think Redfin has a statistic that roughly 90% of mortgages out there are 6% or lower, and quite a few are 4 and 5% or lower. So you're going to have to start seeing probably rates get back down towards that 6% level, or there's a belief that time just marches on. People eventually make moves for other reasons that are not purely interest rate driven, jobs, educational opportunities, what have you. So I'd say if it's going to be a near term relief, it's going to have to come on that mortgage rate coming down.
So with regard to mortgage portability, how much support are you hearing that it could actually get from lawmakers?
I'm hearing it more on the industry side, on different parts of the real estate industry. So I haven't heard a real robust response from lawmakers just yet, but these things have been percolating and bouncing around Washington. The Mortgage Bankers Association is hearing a lot of interest in it as well, looking into some of the potential challenges and potential benefits as well.
All right, Kyle Campbell, always great to have you. Thanks so much for joining us here. Staff writer with American Banker. Thanks.
Thank you.
The commercial real estate industry battered in a post-pandemic world, but our next guest says there are pockets of opportunity within the sector. Joining us now is Brian Klinksek, LaSalle Asset Management Global Head of Research and Strategy. Brian, thank you for joining us.
Josh, thanks for having me today.
Maybe Brian, just start, I'm actually just interested to get your kind of 30,000-foot view. We're wrapping up this year. We're heading into 2024. What's kind of your general take on the real estate sector? Because I know you think just at a high level, it's still unsettled.
Yeah, real estate is still adjusting to the big increase in interest rates that we have seen in most global markets. Interest rates, we've seen a lot of volatility, but the degree of change in the last 18 months is just huge. And it takes time for that impact to translate into the market, because the on-the-ground mechanisms that happen is refinancings and all of the issues with capital stacks that have been sort of turned upside down a little bit by lower levels of value, sticky expectations of sale prices by owners of assets. So that process is still continuing, and the market is still in a phase of price discovery. But a more stable rates environment, which seems to be in the offing, will help resolve that and will lead to a return of transaction activity in real estate, but at a rebased level. And so that's what we're expecting in the new year. Now, predicting interest rates is notoriously difficult. And so one of the key things that LaSalle is focused on, and my team on the research and strategy side is focused on, is finding value within real estate. Because fundamentally, if interest rates were easy to predict, we'd be making money, buying and selling bonds and derivatives based on those. And within real estate, the opportunity that we see has to do with sectors around rental housing, around logistics, being a lender into real estate, because debt lending is the part of the market that reprices the fastest. And so those are some of the pockets that we're focused on.
So what we have seen, we talk more about the residential market, meaning like people buying and selling homes. And there, of course, we have seen a freeze because people have locked in lower interest rates. Is some of that phenomenon happening on the commercial side as well? And so is that why maybe some stability in rates will help unfreeze some of it? I do want to get into the sectors, but I'm curious about this.
Well, the U.S. is very special in a global context from a residential perspective because we have 30-year fixed rate mortgages in the U.S. I actually live in the U.K., and you can't fix a mortgage rate for anywhere near that length of time. And so the U.S. has this unique characteristic, and that has made people sticky to their homes, which has actually put a floor under home prices and pushed some people into the rental market. We continue to see really strong demand in the rental market, which is where we're focused. We're investors in income-producing real estate. And the commercial side, it's a little bit more like residential mortgages in the rest of the world, where they reset more frequently. And so in the next, right now and in the next sort of couple of years, all of those resets and the maturity of those loans are going to have to be dealt with. And they're going to have to be dealt with in the context of property values that are lower than they had been.
And Brian, it's coming back to commercial real estate. When we look at a lot of American cities, downtowns, they still don't feel surely like as full as they used to be, right? What do you think the fix is there?
Well, I think the fix has to do around live, work, and play, and having a mix of activities in city centers. I think I mentioned that I live in the UK, I live in London. And in London, you see very different situations in different parts of the city. So Canary Wharf, which is a district of high-rise office towers, and there's not a whole lot to do other than go to the office, looks a lot like a lot of American downtowns, maybe like the financial district here in New York. And they've had a much weaker return to office there. But in the West End, where my office is, there's, go out to dinner, go out to a show. It's a little more like Midtown Manhattan, where, I was earlier today, and the vibrancy there is palpable. And so the long run has to be creating a mix of activities and uses that draw people in. The phrase that I use is commute-worthy experience. Is the being in that place worth the effort and the cost and the time and the money and the pain of riding the subway or being stuck in traffic to get there? And I think a lot of American downtowns don't yet deliver that commute-worthy experience.
So getting back to the sectors here, and on a related note, you guys like rental housing, I believe you said. So does that imply that you still think the residential purchase market is going to remain a little bit frozen in the U.S. and there's still going to be strong demand for rental housing?
Yeah, one of the great characteristics of the U.S. economy is mobility. People will move for jobs, and in this kind of tight labor market, people still need to move, but to buy housing is difficult. There's just nothing on the market because people have these long mortgages, long 30-year mortgages with low rates, and they want to stay in them. And so that's pushing people into rental housing. The fact that prices in for sale housing haven't adjusted much continues the affordability issue with becoming a homeowner. That pushes people into rental housing. One of the subsectors of rental housing we really like is single family for rent. Because just because you're a renter doesn't mean that you shouldn't have to, not be able to consider a house with a backyard and a place to, hang out with your kids. So sort of disconnecting rental versus ownership with the type of housing you want. Not everybody wants to live in an apartment or can live in an apartment with their family situation, which is why we like that subsector as well.
And Brian, I want to get you out into this. COP28, the global climate summit in Dubai, that kicks off tomorrow. When you think about climate change, how does that sort of just shape, influence, and impact you're thinking about real estate and real estate opportunities?
Yeah, I'd break it down into mitigation and adaptation. So on the mitigation side, that means reducing climate change. That is, some of the markets where we invest, pretty much all of Europe, Canada, Australia, some parts of the US, there is a absolutely strict regulatory expectation that we will decarbonize real estate, that the commercial real estate sector will decarbonize. Tenants are starting to expect it. So aside from needing to decarbonize because many people think it's the right thing to do, we have a fiduciary duty to our clients to produce real estate that can hold up in the regulatory environment and the demand environment. So that's how real estate is aligning on the mitigation side. Now, adaptation is that the world is changing, and that we're getting stronger storms and sea levels are rising, and making sure that we're targeting investments in locations that are resilient to climate change, where infrastructure is being built that can make it more future-proofed, and figuring out what investments we need to make into our properties to make them resilient to storms. So moving critical equipment from the basement to a higher level in case that space floods, so that we can get back online for our occupiers, for our tenant base in short order after some kind of emergency.
U.S. construction spending increasing more than expected in October amid strong gains in single-family home building. However, mortgage rates above 7%, remaining a challenge for both builders and prospective home buyers. As the affordability crisis persists in the housing market, we're taking a look at a different approach from home buying. Here to discuss is Bruce McNeilage, Kinloch Partners co-founder and CEO. Bruce, it's great to have you. Listen, we know buying a home right now, Bruce, not easy. High mortgage rates, limited inventory. So I'm curious, Bruce, what it's meant for your business, the build-to-rent market.
Yeah, so the build-to-rent market is probably the fastest growing segment in the housing business and also in all of real estate. We are doing very well. Obviously, the tougher it is for Americans to afford a new home, we are the next best alternative. You can rent a brand new home, give the keys back in a year or two when you're ready to purchase a home. And what's better than a brand new house?
A brand new house at a lower price than having to buy it, I guess, which is good for your business. Bruce, as we prepared to talk with you, and really over the past months as we've been talking about the affordability crisis, I keep coming back to the question of whether the sort of American dream of home ownership is dead effectively, and whether that's okay. Is it okay for people to just rent, for example, or are Americans really missing out on wealth building, for example, by not being able to afford to buy houses right now?
So I don't know if it's dead or dying. I just know it shifted. When I got out of school, you were taught, hey, buy a house, settle down, start making mortgage payments, gain equity. And now things have changed. People aren't buying houses till they're 35. They want to have more experiences. And so they're putting more money into their lifestyle and not buying houses right away. So I don't know if it's dying or dead. I just know the idea of the American dream has shifted. And quite frankly, I don't think it's going back to what it was a generation ago.
And Bruce, Wall Street right now is betting the Fed's done hiking. Cuts are in the pipeline. We can debate when that's happening, Q1, Q4. But when that does happen, they do start cutting. What is that going to mean for your business, Bruce?
I mean, I think our business is robust. We're running at about a 98% occupancy, and that's in all areas that we own houses in. Industry average is about 98% too. So we've been there when interest rates for mortgages were 3%. We're there now. There's just not enough housing in America, and we're several years behind. I mean, we're millions of houses behind, and it's just going to take many, many years to catch up. And with these high interest rates, it's just making it very tough for people to own houses. But with our industry and what we're bringing to America, we are offering a housing alternative, and that housing alternative is very attractive to families and other folks in our country.
And Bruce, you mentioned, people sort of see this as a starter option, right? And then they turn over the keys when they buy a house. But is the duration of occupancy lengthening now because of what's going on in the home buying market?
I think it is. The average tenant that rents an apartment stays about 2 to 2.5 years, where in our business is 4 to 4.5 years. Because again, why would you move out of a brand new house after 12 months? And so, yes, we're seeing people stay longer. For the first time in my career, people renting out of choice, not out of necessity. So people are actually making a conscientious effort. They don't want to buy. Maybe they want to be mobile. Maybe they're thinking about moving to a new city. But we are seeing the business grow, and more need right now than we can fill. I mean, we're building houses, buying houses as quick as we can. It takes just a week or two to rent and lease a house right now.
Bruce, there have also been some concerns raised about the model that you guys have put forth, and of course you're not the only ones. You have some competitors out there, about private ownership. Private equity ownership is usually what's brought up of neighborhoods, the effect that has on home values. Are these homes kept up in the same fashion? There are a number of different concerns. How do you address those?
So we're building brand new neighborhoods. We are not taking houses out of stock for individual buyers. So when you're creating 100 or 200 houses, that's not taken away from the general public or the first-time home buyer. We own the houses. We also own the homeowners association. We're taking care of landscaping, things like that. So truthfully, our houses, our neighborhoods look a lot better than many of the neighborhoods throughout the cities we're in, because we're taking care of everything versus individual owners, each one of them having to take care of the lawns, landscaping, and things.
And Bruce, I want to get you out on this. Just look at the regions where you all are focused. Looks like Nashville, Bruce, Atlanta. I see South Carolina here as well. Why those markets, Bruce? And as you look at it in 2024, any plans to expand?
So our industry is primarily in the Smile States, and that's from the West Coast. You look at Arizona, Las Vegas, that area, down through Texas and up through the Southeast like we're in. And those are the states that are growing. Automobile manufacturing is coming to the South. Most of the states that our folks are in don't have a state income tax. Florida, Tennessee, Texas. And people are moving from California, they're moving from the Northeast and the Midwest, and they need housing. And that's really where the growth of our industry in the future is. And that's really where the growth of the population growth is in our country.
Bruce, thanks so much for spending some time with us. Bruce McNeilage, appreciate it.
The housing market has been in a tough time here, but it seems like prospective home buyers are getting impatient. According to Bank of America's Home Buyer Insights report out today, 62% of them are waiting for rates to fall to buy a home, and that's down from 85% in April. To break down the numbers, Matt Vernon, Bank of America head of consumer lending, here with us. Matt, great to just grab you for a hot second here. We know that home buyers are getting impatient. So what are we seeing in terms of the turnover of people that are saying, you know what, I just got to get out there and see what's available and perhaps put some bids in?
Yeah, hey, I think the stats that you mentioned are eye-opening, because it's clearly illustrating that the consumer today that is in the home buying journey at the beginning, in many respects, is beginning to your point, lose patience with the rate environment, because ultimately that dream of home ownership is alive and well for all the reasons that we've talked about in the past. So they're beginning to enter into it. I think the real important aspect of this, though, is the existing home buyers, and ultimately the motivation for them to begin to list their homes as well. And there was some encouraging data in the survey as well there, where homeowners are looking to list their house more specifically than they have in the past. In fact, 50% of home buyers currently, even with low rates, have said that they would sell their home if the house of their dreams came available, or they could move to a more affordable area.
Matt, you mentioned the fact 50% there saying that they would be, I guess, open to moving if their dream home was available. What are some of those other top reasons or other motivating factors that you're seeing for people that maybe have been hesitant to list their house to put it up for sale?
Yeah, I think the survey has told us a few things in addition to finding that dream home. One, job opportunity or relocation. We saw a preponderance of that. We also saw folks that ultimately wanted to move to more affordable areas, be it within the area that they live, or even beginning to move from state to state into the Sunbelt states and other areas to find a more affordable execution. And in some respects, you've got the baby boomer population that's beginning to downsize, which ultimately should provide inventory to those first-time home buyers and others.
Okay, and at the same time, you still have a lot of the new home builders that are trying to kind of backfill for where there has been underproduction. What are we seeing on that new home side and financing options there?
Yeah, we've seen the numbers kind of move around a little bit this year. In September, we saw single-family home starts raise or be adjusted upwards to 759,000, up from 679,000 in April. And then here recently, we've seen it move a little bit less. That said, the permit process is very active, so we do expect sales of new single-family homes, and ultimately that development aspect that you're speaking of to continue to increase as we head into 24.
Matt, there's been so much talk about what mortgage rates need to fall to in order to spur some of this activity that maybe we already are starting to see when it comes to the fact that homeowners are a bit more open maybe to putting their house up for sale. The focus that we have been placing on the need for the 30-year fixed mortgage rate to drop to about 6%, somewhere in the 5.5–6% range, in order to see an uptick in inventory. Is that a bit overdone, or do you still see a need for mortgage rates to fall a bit more?
Hey, I think that's an individual decision by all of the prospective homeowners. I think the advice that I've always given in this type of environment is go and buy a home when you're financially ready and a home meets your needs, because ultimately, regardless of the rates, and our survey reinforces this, that rate is sometimes a shorter duration because of the refinance activity that you may have in 12, 16, 18 months. And I think consumers are beginning to see, with recent rates coming down, and then some of the commentary from ourselves and others very publicly, that we expect to see rates to come down as we head into the middle and latter half of next year, is adding confidence that while they may have some short-term challenges from a rate perspective, that those won't have a long duration to them, and they can capitalize on refinance activity in the future.
Well, all year we've noticed that with any small change in mortgage rates, buyers respond. When mortgage rates go up, they back off. When they come down, they come back to the market. What's a little bit different that we're seeing now is more sellers contacting us wanting to sell their homes, which would mean if that trend continues that we'll see more inventory next year, more home sales without prices going up. We were worried that if mortgage rates were to fall, that would bring a lot more competition to the market, but we're a bit more optimistic now that more new listings will be coming on so we can get more sales without much price pressure.
Do you have a floor on mortgage rates that you're looking at right now? We saw them as high as 8%. Every percentage point means a big deal to affordability. Where do you see the rates landing?
There really are no limits on where rates could go. I think we've known that from history. If we were to have a surprise recession, rates could fall very dramatically. But in the most likely scenario, we expect rates to come down to around 6.5%-ish, maybe 6.6% by the end of the year, which isn't a huge relief, but it's enough to make hundreds of dollars of a difference for a potential home buyer. And that's a monthly mortgage cost.
And you also are looking at home sales increasing on the year overall as a result of what's happening here, as prices see a decline, not much of a decline though.
Yeah, so with more listings coming on, that's what we're forecasting. We're thinking that there's going to be less of this mortgage rate lock-in effect, people just getting impatient with wanting to sell. People may have been postponing it for year after year with these higher mortgage rates, thinking that the market was going to get better. And now we're seeing a bit more sellers coming to the market saying now is the right time. So if that trend continues and we have more inventory, then that would lead to more sales without any price pressure.
What about the rental market? What trends do you see there? It's been somewhat stigmatized, that is renting versus owning, not necessarily here in New York where most people have to rent, but overall, nationwide, where do you see those trends?
We think the stigma of renting is going to go away next year, basically because of math. It's more affordable to rent in much of the country than it is to own. Now, a lot of the rentals that are available are on the smaller side, those 1-bedroom or even 0-bedroom units, which don't tend to directly compete with your 3-bedroom single-family home. But still, if somebody is deciding that they want to stay in their apartment a bit longer before they make the jump to owning a home, I think next year it's going to be seen more as a financially prudent decision, not something that is throwing your money away on rent.
And one of the other things that we're potentially looking at next year is sort of structural changes in the real estate industry. We had a recent court ruling that could affect, how, frankly, firms like yours work and just the brokerage industry broadly. So what are you looking for on that front?
I can't speak on the lawsuit directly, but what I can say is that we've seen trends in the real estate industry with fees coming down and more buyers using the same agent that the seller is using on a home. So we think moving forward, we're going to see more of that dual agency, especially if there are limitations put on the way that buyers pay agents and sellers pay agents.
Well, it has been a brutal housing market for home buyers between a lack of inventory, high prices, and high mortgage rates. But that doesn't seem to be affecting some of the home builder stocks. Joining us now is John Lovallo, UBS home builders and building products analyst, to talk about the outlook for this space. So, John, wanted to start sort of big picture here, right? Because the home builders have been in an interesting position because of the tightness of the market. There seems to be a lot of demand for new inventory. So have we seen sort of a rising tide for all of the home builders as of late?
Yeah, Julie, thanks for having me, first of all. I think that's exactly right. The environment out there today is such that there is very little existing home supply. Think about it, mortgage rates went from 3.25% up to almost 8% a month ago. They've trailed back about 90 basis points since then, but are still at very high levels. And when you put that in the context of something like 80% of mortgages in the US being struck at 5% or below, and almost 60% at 4% or below, that's created this lock-in effect where people don't want to move. They can't make that math work. And surprisingly, overall demand has remained resilient. So the extent that someone wants to buy a home, today more than at any point in history, they've been forced to look at new homes. And I think when you couple that with the fact that the new home builders on the public side have the ability to offer a lot of attractive financing options, that has created a lot of market share wins for the public home builders. And to your point, has created this sort of rising tide lifts all boats for the publics.
And John, I'm interested too, when you look at your coverage universe, these home builders, John, have their business models kind of shifted at all in the last few years? For example, have they become more efficient?
100%, Josh. Look, I think that this is something that is not fully understood or appreciated yet in the valuations of these stocks. Is if you went back a decade ago, in many cases, and not to be disparaging, but in many cases, these companies were looked at as land speculators that at the end of the day will put a home on to monetize that land. That has changed dramatically. They are truly focused on the home and on the community development. They have delevered. They carry less land. They carry better land. And in fact, they're doing much more, I would say, diversified things with their capital, where they're not putting every dollar of cash flow back into land. They're paying dividends, they're buying back stock. So they are much different companies, in our view, require probably a higher multiple. And to your point on the way they're building, they have absolutely become more efficient as a function of COVID. They were forced to. They're offering less SKUs. They're building homes a lot more efficiently than they have in the past, and that's evident in the returns.
Can they sustain this level of returns going into 2024?
A great question, and it's one that is highly debated at this point. I'll be honest with you, we are a little bit more cautious than I would say some of our sell-side competitors, and we believe that the higher interest rate environment, and who knows where rates go, but let's just say they're higher for longer, is going to cause continued sort of incentivization, which will weigh on margins next year. Now, to be perfectly clear, we expect margins to remain above historical levels, but maybe trend down off of today's sort of mid-teens. If that is the case, you will see some normalization in returns. But let's be clear that even on our estimates that are, call it 15% below our sell-side competitors, the stocks still look very compelling from a valuation standpoint.
And let's get to some names here, John. I think your number one pick, correct me if I'm wrong here, is D.R. Horton, which is, listen, it's had a remarkable run, John. 2023, it's up about 55%. Is that your top pick heading into 2024 as well?
We haven't published our 2024 outlook yet. You're absolutely correct to assume that is our top pick as of today. And I think there's a number of reasons. One, it's the largest builder by volume by a margin of around 20%. There's a lot of advantages to size and scale in home building. I would also tell you that they attack what we believe is the strongest part of the market, which is kind of that first-time entry-level buyer, which is a need-based buyer. To the extent that they can buy a home, they will. They're getting married, they're having children, things that sort of necessitate more space. And then on top of that, this is a company that has been a very efficient allocator of capital and a very, very good executor over time.
John, especially for a company like D.R. Horton that is servicing first-time home buyers, how are they approaching the so-called affordability crisis, right? Or is it just that there's so much demand it doesn't matter? Some people are going to need to buy homes, and so it's happening. Are DR and some of the other home builders making adjustments to sort of account for that as well?
Great question. Yeah, look, I think that there's a number of factors going on right now. One, I think that they're building smaller homes a little further away from city centers. Two, they are doing something that has been incredibly powerful, and that is buying down mortgage rates or offering incentives. So they're actually assisting the home buyer lower that mortgage rate through these buy down programs. And so if you're a buyer of a D.R. Horton home, you're not paying the headline rate of 7.2. Maybe you're paying 5.5, 5.6%, somewhere in that ballpark. And that has proven incredibly powerful as a marketing tool for these home builders. And it's not just D.R. Horton that's doing it. Most of the builders are. So I think that the combination of building smaller homes, maybe a little further away from city centers, and these rate buy downs has been the key. The other thing I would mention is that we've done some survey work that would suggest that nearly a quarter of first-time buyers report receiving financial assistance from parents or family members. So there is this large generational wealth transfer that is occurring in the U.S. that should remain a tailwind over the next 5-10 years.
And John, I want to end here on one last name, get your take on it. NVR, John, it's also had a great year. Listen, it's up more than 40%, but on that one, you're neutral. Why are you on the sidelines there, John, and what would it take to get you more bullish?
That's a great question. I mean, NVR arguably has the most efficient build model out there. I mean, they are 100% of their land is purchased on option. They have the highest returns out there. There's a lot to like about NVR. Big market share in their markets as well. In the attempt to sort of differentiate, the way we're kind of looking at things with NVR is they are in sort of more mature markets than some of the other public home builders that really focus on kind of the Sun Belt areas. And because of that, we think that their growth is going to be a little bit slower. Now, they're not going to lag the group by much, but in the effort to sort of differentiate, that is how we've done it, and that's sort of on the growth profile.
Steep housing prices making the dream of buying a home unattainable for many Americans, but there is some optimism for some areas across the country in 2024. Realtor.com recently out with its top housing markets for next year. And joining us now, Realtor.com Chief Economist Danielle Hale. Danielle, it's good to see you. I guess we're all moving to Toledo, Ohio for the second year in a row, it seems, according to what you guys are looking at. I mean, it is interesting, the persistence of strength in some of these areas. What's driving it?
Yeah, I think that's right. We have seen the affordable markets in the Midwest and the Northeast, not the biggest cities, but the secondary markets where homes are more affordable, really do well in this housing market where home prices continue to remain high nationwide and high mortgage rates are really stretching buyers' purchasing power, in some cases to the breaking point, except not so much in these areas where buyers' dollars really stretch further and buying a home does still feel possible.
And Danielle, what are some cities or metro areas that maybe took a hit this year that you all think, you look in your crystal ball, you look out at 2024, and you think they may be poised here to bounce back?
Yeah, so our top housing markets list comes into two major groupings, essentially. Affordable markets in the Northeast and Midwest, like Toledo, like Rochester, New York. And then you've also got a pocket of markets that are expected to do well in Southern California, where home sales have really been sluggish as a result of high home prices and high mortgage rates. They've had not only rough 2023, but also rough 2022. And so we expect to see that area begin to bounce back as mortgage rates turn the corner more convincingly, which we expect them to do in 2024. And that reduction in mortgage rates is going to help improve conditions for buyers in Southern California. We're not going to see a return to pandemic levels of home sales activity, but we are going to see a nice bounce back in those markets.
Danielle, what are people doing in these places? In other words, right, are people moving to a place like Toledo and looking for a job because it's affordable, or is it expansion from nearby other cities where people can maybe telework? What phenomenon is driving, because obviously people still need jobs when they're in these various places?
Yeah, it's really a mix. Some of these markets do have homegrown local buyers that are able to take advantage of stronger employment conditions in the area. But a lot of times it's people coming from nearby markets. So in Toledo, you might get buyers from Chicago, for example. In Rochester, you see a lot of buyers relocating from New York City, sometimes even Boston, looking for affordability and trying to find more space for their real estate dollar. You'll notice that the top market in Southern California, for example, is the Oxnard, Thousand Oaks metro area, which is just outside of the LA area. So again, we see that theme of people looking for affordability, maybe willing to tackle a longer commute in order to get there, so that they can find a place to live that still falls within their budget. And this is especially true as hybrid work remains the norm in many markets. Even though we're not seeing as much full remote work as we did in previous years, hybrid work enables people to tackle those longer commutes so that they can get more affordability from the housing market.
And there was a good story in the Journal this week that had a lot of people talking, and the piece said how home ownership in this country is now a pipe dream for more Americans. Their words. It's just the math for buying a home between the high prices and the high rates. It doesn't work anymore for a lot of Americans. What was your response to that, Danielle?
Yeah, so buying a home has become more challenging. It's one of the reasons why, even though we do expect an improvement in affordability in 2024, we don't expect to see a huge uptick in home sales nationwide. Some of these markets will see home sales go up, but nationwide, we're expecting just a 0.1% increase over what we saw in 2023. And for context, we expect sales in 2023 to tally, the lowest that they have at least since 2008, and possibly even stretching all the way back to the mid-90s. So it's a tough place to buy a house right now. Some people look at the overall home ownership rate and think, oh, the overall home ownership rate continues to be relatively high. People must be doing okay. But if you drill down and look at the home ownership rate by age, you can see that an aging demographic population is masking real significant challenges for younger potential buyers who are not yet homeowners, but who likely aspire to be. And so, I think the Journal has probably hit on some real significant challenges in the market and the stress that it's causing a lot of younger households.
New data from Redfin showing there might finally be some signs of life in the housing market. The recent decline in mortgage rates driving more activity as listing, pending sales, and price growth all hit their highest level in roughly a year. Joining us now, Redfin chief economist Daryl Fairweather. So, Daryl, is it just a matter of rates are down, so things are improving?
Yes, in the short run, whenever rates come down, conditions improve. Just in the last month, rates have come down enough that a typical home buyer will save hundreds of dollars monthly on their mortgage payment. So this is a big deal. It's a big difference. Rates are still high, but any improvement is welcome.
And Daryl, let me ask you, so according to Mortgage News Daily here, I'm looking at the 30-year fix. They say it's at 6.64, Daryl. I'm just interested, where do you think we head from here? Could we, in 6 months, could we be knocking on 5%, maybe even lower?
I think that is an important question. We were forecasting that rates would fall to 6.6% by the end of 2024, and we're already practically there. So does that mean that rates stay stable from here on out? It really depends on the trajectory of the economy. If inflation comes down faster than what we're expecting, there is more room for rates to fall. But I think the best guess is always that rates will stay where they are as long as nothing's changing.
And what's going to happen on the price front? Because we still are seeing prices go higher.
Yes, prices keep going higher because the fundamental problem with the housing market is a lack of supply. There is very little inventory on the market. We're starting to see some signs that might let up next year. We're getting more inquiries from people looking to sell next year. So we're anticipating more new listings, which would facilitate more sales, about 5% more sales. We're still comparing ourselves to probably one of the worst years on record for home sales. So 5% increase doesn't get us back to where we need to be, but it is an improvement.
And Daryl, let me ask you this, because you also noted something interesting, that deals are still falling through, I believe you said the highest rate on record, Daryl. What is going on there exactly?
Well, with rates being so volatile, it makes people second guess their decisions. A buyer who locked in a home just last month and is still in escrow, they may be seeing that rates are falling and they may want to get out of that deal and wait until next year when they're thinking there might be more inventory, better selection, maybe even lower rates. So anytime there's a lot of volatility, it makes people second guess. And also sellers are second guessing too. If a buyer comes to them and says, hey, there's something wrong with the house. This roof is older than what I thought it was, or it needs more maintenance than what I thought. The seller is going to be less willing to give a concession if they think the market is going to be more favorable to them next year. So all this volatility just makes it so sellers and buyers can't really see eye to eye.